Year to date, their US counterparts. FTSE 100 futures looking to gains of 0.2%. We're looking at oil prices higher, silver higher as well, so maybe that lifts the energy and mining stocks on the FTSE 100. DAX futures pointing to gains of just 1 point. There you go, talking trading water, currently unchanged. Anna.
Yes, absolutely. It doesn't do justice to the underlying stories, does it? Let's talk about some of those stories, because we could see a great deal of movement in some of these stocks, at least. Dassault Systèmes is in focus, the software company, of course, giving a weaker than expected sales growth guidance number for 2026. That's on top of fourth quarter results that missed estimates, so that's adding up to something a little bit negative, perhaps, there. Siemens Energy, on the other hand, first quarter earnings beating, strong orders, and interestingly, they're saying 25% of gas turbine orders are tied to data centres, a theme we will pick up when we speak to the management later on. And we'll watch LSE Group. The FT is reporting that Elliott Investment Management has built a significant stake here, trying to, quote, engineer an improvement in the performance of the business. So we'll certainly watch that one, Guy, as well.
Absolutely. And that comes back to the other story as well. LSEG in that kind of mix in the software narrative that we're watching so carefully. Right, here we go. Let's show you some numbers to give you an idea of what's going on. We're not expecting the index story to be very exciting. In fact, we haven't got all of the index story. There you go. The FTSE 100 is up. The stock 600, we will wait and see what it does in just a moment. But we're very, very kind of sideways at the moment, and that kind of feels like the narrative that we're operating with at the moment. It's hard at an index level, a top-down level, to get a clear sense of direction, because the macro picture, the micro picture, the bottom-up picture is so confusing at the moment. Trying to get a handle on what is happening here, I think, is really difficult for a market that has been very macro-driven for a very long time, Tom.
In terms of that cyclical tilt that we're starting to see again reflected in the sector-by-sector breakdown, with energy up 0.4, you've got utilities gaining 0.3%, banks also up 0.3. These are modest gains that go, of course, across the sectors. Personal care and drugs, that sector up 1.2%. Basic resources now top of the list. We've seen moves higher, particularly in silver this morning. Basic resources, the top gainer across your sector so far, up 1.2%. And no big surprise, is technology on the downside. Once again, as a sector, lagging by 0.7%, Anna.
Yeah, we might have some decent volume going through some of those individual names that we were mentioning, because I don't see an opening price on any of the three that I talked about. Dassault Systèmes, Siemens Energy, LSEG, waiting for some clarity perhaps on where those go at the start of the trading day. And yes, to the point we keep making, the sector breakdown is entirely split. Half the sector's going higher, half the sector's going lower, as the stories sort of bubble up within that structure.
Tech is down there more broadly. So if you take a look at the top, in terms of the points drop this morning, SAP and ASML are the two biggest that we're seeing. Siemens is in the mix as well. Some of the defence stocks are there too. But on the upside, it's a real mix as well. Delhaize is having a good day.
Capgemini also negative, and I wonder if there's some read across from the Dassault Systèmes story, if people are trying to join dots there, or doing what they did last week, which was sort of selling all things and then asking questions later.
Yep. Delhaize, to your point, and we've been talking about the consumer in the US, that K-shaped recovery. Or the K-shaped shape of the consumer in the US, and we had the retail sales coming in softer, but Delhaize, with that big exposure to the US market, and as one of those staples, essentially, in terms of being a grocer there, performing quite well and coming out with decent results. And as a result, to your point, up 7.2%, one of the best performers right now.
We have weakness coming through in some of the house builders today. So Barrett Redrow, I can see, is down by 5%. We had an update there. They were sticking to the guidance on the number of units planned, but something in the numbers went down badly with the market, and that stock down by 5%. So there's lots of bits and pieces happening this morning. We'll wait for clarity on some of those stocks in focus. Paul Markham joins us, Investment Director and Head of Global Equities at GAM Investments. Really nice to have you with us, Paul. Thank you for being here. So, I mean, the big question we're asking at the moment is around AI and to what extent we can pick the winners and losers. Now, clearly the hyperscalers are doing what they're doing and reassuring everybody they've got the customers for the big CapEx data center build out that they're doing. But at the more granular level, we're looking at all of the legal services, software companies, wealth managers, and trying to work out who wins, who loses. Are we able to do that, complete that exercise yet?
Well, I think what's happened, Anna, is that the market, as you just mentioned, has moved first and then we'll think about it more profoundly later. I think there are a few things that we can say. One is that the picks and shovels so far have been the way to do that, so that the enablers of AI have been the winners. The hyperscalers have actually been underperforming for the last little while. On top of that, I think some of the software names at some stage will start to catch a bid, and that is something which I think has been really priced in very aggressively on the basis that AI can go straight to the sort of service proposition that business services style companies can offer. I think that actually that's not as easy as it sounds, because data is not so easy to scrape as the market is presuming. I think also there is a sense that, in certain... I think right now we think of AI as being at our service, and I think when we really cross a Rubicon is when it becomes something which becomes a decision maker in itself. And at that stage, I think things like legal services could well catch some attention because that's going to change the regulatory framework.
Right, yes, I was going to say, because that regulation would be the thing that might stand in the way of that, and might stand in the way of that until we have a huge track record behind us. That's not the kind of thing that any regulator would take lightly.
That's right. I mean, the training aspect of it is going to be... That's right, they are.
Around these businesses.
But I think that the aspect of AI playing the part effectively of a human in terms of human decision-making process is really critical, and that's going to be something which is going to come around in the next couple of years. And when that happens, I think there'll be a bonanza for regulatory and legally related areas, not just yet, but I think that will come, and I think that eventually software will find some sort of a level where markets are attracted by the valuation.
Paul Warning, we don't know at this point. That's the problem. So what I hear a lot of is diversify. Is that the right way to deal with this scenario?
I think you might be right there, Guy. I think certainly there's been a lot of stuff in the industrial space, in particular, traditional cyclicals, which have been beaten up. What I would say is that one needs to make the difference between buying something because it's come back a long way and is still alive and kicking as a business and has a role in a post-AI environment, instead of buying stuff which is kind of dead. And I think that
we can determine that, can't we?
I think there are certain areas where the valuations are permanently impaired and the businesses themselves may be permanently impaired, and I think some of the advertising industry falls into that category from my perspective.
What I'm also hearing is that there's this narrative going around that what you do is you diversify out of the United States into other markets around the world. And there seems to be this assumption, which I'm scratching my head about, is that the rest of the world is uncorrelated to the American equity market. And if I buy Europe or I buy Asia, it's an uncorrelated trade to what could happen in the US. Is that true?
No, it isn't true. It does have a lower correlation, but it's not uncorrelated. And also, something which we should also remember is that in certain markets, particularly Europe and Japan, the sector mix is quite different to what it is in the US. So that means that the more cyclical or value-oriented parts of the market can do better, and they may outperform at the index level. Below all of that, if you look on like-for-like, apples-for-apples comparisons between stocks and sectors, they're going to be following the US. And you only have to look at what volumes do, what price action does on days when the US is closed, and other markets still do follow the US very, very closely.
Well, what does that mean about your views on outperformance for other regions outside of the US, Europe, and predominantly Asia as well through the rest of this year? Does that challenge the idea that outperformance can be sustained?
I think if you are able to switch into other sectors which aren't necessarily the recent performers, the stuff that's been correlated very heavily to certain parts of tech, for example, if you're buying at the index level, you might want to buy those areas which are more heavily weighted into cyclicals, industrials, etc. At the stock level, I think that they're going to perform very similarly. I think for Europe in particular, which has been a good performer, I'd be a little bit concerned about strength of the euro. And I think that still is a very, very informative aspect of European market. We had a guest on yesterday
who said it had to get beyond 130 to be a concern because it's just one factor in the mix. What level can a euro dollar?
I think from here it's already a problem, and we've seen that coming through in certain companies' results in the recent past.
You mentioned sectors or areas or companies that are dead, and you mentioned the advertising industry. To be clear, you think the advertising industry is dead as a result of AI, and is that the right interpretation? Is that what you meant by that? The advertising industry is you wouldn't be buying the advertising industry. To some extent,
to some extent, the advertising industry was already derating in terms of stock multiples, and the industry was already starting to suffer a little bit at the hands of various forms of technology and also a little bit of disruption around the structure of the industry in terms of the leading companies, the way that the agency model operated, etc. The internet had done some of that. I think that AI just makes the creation and production of advertising campaigns so much easier, and it's something that somebody who's relatively untrained in that space could do with the help of an AI tool.
Can I ask you about something very macro that we haven't talked about yet and has been happening for the last, well, certainly since the weekend, and that's the fact that the yen has been strengthening, and that wasn't widely anticipated perhaps by everybody given what we'd expected this new Prime Minister to be about, or confirmation of the Prime Minister with a much bigger mandate. And I mention this because it's been so crucial to risk appetite globally, it seems, that people have been able to borrow so cheaply in Japan. And for a long time, we've been asking, what difference does it make that it gets more expensive in Japan, just like everywhere else? What bigger picture impact does this have, do you think?
There's been so much funding, Anna, of various trades facilitated by a very low interest rate environment in Japan for a long time. We've all heard it talked about so much, the carry trade. And as rates go up in Japan, that is going to continue to unwind. And when that happens, that is yen positive. Whatever is happening on the other side of things with fiscal deterioration, with some inflation coming through in Japan, nonetheless, there will be purchasing of yen by certain domestic and selling of yen by those who've been borrowing in it. And I think that is going to be a dynamic which we need to watch. And I think that something that a whole generation of investors haven't really learned what to do is how to invest domestically in Japan. And it may well be that domestically focused Japanese stocks that aren't the banks could start to get quite attractive from the perspective of that yen environment.
And does it have an impact on global risk-taking then? I mean, all other things being equal, which they never are, but does it have that kind of impact?
It does. What it also may do is put further upward pressure on the Swiss franc, because that is one, again, which can be used in that same carry trade way. So I think it does upset a little bit of flows around the world. I think if you mix that together with other sources of volatility, such as the rotation coming around from maybe some AI fatigue, shall we say, and also, of course, some disruption in the metals markets, particularly with gold and silver, then that could create some volatility, I think.
How does this all translate? Like, at the end of the day, what happens to the indexes? What happens to the Nasdaq, the S&P? What happens to the FTSE? Do we just continue to go sideways, particularly in the States? Is that the trend that we're going to be watching at? What breaks us out one way or the other from this?
I think that there's certainly, you're absolutely right, and you said it at the top of the hour there, Guy, which is that it's a bit like the old analogy of the duck, which is looking serene and the feet are going underneath, and you could go a long way to get nowhere. And I think that's certainly a period of time that I would expect to see at some stage. The market's been unprecedentedly strong for some years now, and I would expect there to be a period of consolidation. I think that certainly there is going to be an attraction towards some of those lower multiple stocks in the market, the opportunity for rotation without much visible index-level movement, although tech has become such an informative part of the big indexes that what you could see actually is the
index is going down.
Most of the S&P going up and index going down, and that is entirely possible.
What does that do to flows?
On the retail side, that is negative, and particularly I'd say for things like the ETF market, I think that does lead to retail pulling their money out. If you've made a lot of money, if you're a little bit jumpy, you may want to sell, and that's something which could have an impact in the near term, I think.
Great to see you, Paul. Thanks for bringing us your thoughts on what's happening out there. Paul Markham, Investment Director and Head of Global Equities, joining us from GAM Investments. Let's take a look at what is happening with that equity picture right now. This is the picture that we are seeing, and as you can see, there is a lot of red out there this morning. Defence stocks are under significant pressure. Tech sector continues to be under pressure. Even luxury, which kind of bounced around a little bit yesterday with the caring story, is under pressure as well. So Europe is kind of under a little bit of pressure, but again, there are stocks out there that are having a good day today. Ahold Delhaize is not on that list. There are plenty of stocks that are maybe balancing some of the negativity you see on the screen in front of you. Let's get the details of what is happening there. Chloe's here.
Good morning, Guy. We've got the London Stock Exchange Group moving higher this morning, and that is after the FT reported that Elliott, the activist investor, is building up a stake in the company. This, of course, comes as we have got all of those fears around AI disruption for financial services and software firms, but also as LSEG is dealing with that extended slump in IPO activity on that London market. And so this news of the stake being built is being received quite warmly, and we're up about 4.6% this morning for LSEG. Moving on to another big gainer, and that is Siemens Energy, which is up more than 5% this morning after reporting record orders of gas turbines. It's really benefiting from this electricity demand, this surge in electricity demand from data centers. This is, of course, part of this AI boom, and that's one of the big beneficiaries, and so we are up quite strongly there. Heineken is also in the green. It announced that it will cut as many as 6,000 jobs to try and mitigate this slump in alcohol sales, but the volumes for beer are actually a little bit better than expected over the fourth quarter, so that is seen as a bit of a positive, and therefore we are up. However, Lufthansa is down this morning. It is in the red after the pilots have threatened to strike over pensions, and we are down about 3%. And then to finish up, we have got also Gerresheimer in the red this morning. This is a company that makes packaging products for cosmetics and medicines. It's decided to delay its results announcements, and we have got JP Morgan analysts saying that the things are going from bad to even worse for the company, and there's so much uncertainty for investors there. And we are down massively this morning, more than 30% for Gerresheimer.
Okay, Chloe O'Malley with some of the stocks to watch. We're still waiting for pricing. In fact, we have it now. That's our system, down 18%. There you go. Arguably another victim of the sell-off in terms of software. Of course, this is a industrial software company, so that's weighing on the CAC current over in France. Coming up, AI fears, speaking of which, spark stock sell-offs, as wealth management companies are the latest to tumble. More on what has been released and what it's doing to these various sectors. That's coming up. This is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's Jobs Day, and Bloomberg has the report under surveillance.
Where's the emphasis, on headline payrolls or on the unemployment rate?
I'm focused on the unemployment rate, as is the market.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
What we're seeing is certainly a growing labor force.
A labor market that actually could be improving.
The January Jobs Report, today on Bloomberg.
Welcome back. This is the opening trade. We are 17 minutes into the opening, into our trading day today on Wednesday, the 11th of February. And it took almost 15 minutes to get an opening price on Dassault Systèmes. The broader picture for stocks is flat to negative, it looks like. So Stock 600 is down 0.1% or so. And we are seeing some downward pressure being applied by this kind of movement. So, in fact, I'll make sure. Yes, Dassault Systèmes, that is the right share price, down by 19%. And that on the back of the numbers that they have produced today and the guidance. This is an application software business. So let's talk to Neil Campling about that right now, Bloomberg senior strategist who's been watching this story unfold, as have we this morning. Talk us through what it is they've said and not said then, Neil, that's led to this big move in the share price.
Yeah, well, we've seen obviously threats around AI, sort of around discussions for the last couple of weeks. And any company that comes out with any hint of a negative obviously gets hit hard. Problem for Dassault is they have given guidance for 26 that suggests like-for-like growth is going to be 1 to 3%. Well, sorry, 3 to 5%. Now, that compares to 6% in street models. So at 3%, that's half the growth rate. And the risk, I think, is that 3% could look optimistic. Yeah. Because we're going to have to wait until November for the Capital Markets Day to get longer-term vision and guidance. Obviously, that's a long time to wait, especially in a world.
Are they saying we don't know?
I think that's the implication, is probably we don't know what the disruption or the impacts are. And we're seeing this for many software companies at the moment, and that's a real problem. Because in software, we've discussed this before, investors and analysts need to look at terminal values. They like to look at DCF calculations. And that's all based on 5-10-year projections. And now we're looking at, I think, a sector where we're unknown. We don't know what the next 6, 12, 24 months is going to look like. Yeah. And that's what his valuation is.
How can you give a 5 to 10-year projection in this environment with this AI disruption?
This is the risk. If we go back to ChatGPT's launch in November 2022, there was an education company called Chegg that came out in May 23 and said, we see AI disruption today. Since they announced that, the CEO came out and said that, the stock has lost 98% of its market cap. And that's what happens when you are disrupted. And that's the issue that you have when we don't know who the winners and losers will be at this stage.
And do earnings, well, I was going to say, do earnings updates then help to tell us the answer? Well, Dassault suggests not, because we haven't got enough clarity, really, for the company to be clear, to give clarity to the markets about where it expects to go. Because I was looking at one company, which is AI infrastructure related, but is software, and that yesterday, that was Datadog over in the United States, and that stock really jumped on the back of its earnings report. And it's in that software basket where there'd been a lot of nervousness. But it seems interesting that some companies then are going to be able to give some, have visibility.
Absolutely. And actually, Datadog announced a deal with Anthropic. So you're seeing some AI companies that still rely on these data feeds, etc., that take place. So it depends on the company. As we see with every innovation cycle, there are winners and there are losers. And it's trying to work out which ones they are. And that is difficult. But any company that disappoints, even at the margin, does get, it is that case of sell first, ask questions later.
Do wealth managers have to fear for their future? How worried should we be about Hazel?
I think AI tools will impact the lower margin products, but the question is, will you give your wealth to be managed by an AI bot? I don't think you will.
The financial markets already use huge amounts of artificial intelligence and have done for years. Of all the sectors in the world that you would have thought would actually be there for transformation to be delivered by AI, it would be the financial services sector, wouldn't it?
Absolutely. There's lots of tasks that can be used by AI. But we've had AI in trading for many years. Yeah. We use black boxes, we use dark pools, etc. That makes, but at the end of the day, why do investors And portfolio managers go to the brokers still for trading today. They want their orders managed, not just put through a pipe. So there is still value. It's working out.
Well, I suppose this goes back to the conversation we were having with guests earlier about the moats that are around these businesses.
Yeah.
So there'll be some businesses that have no moat, and their lunch can be eaten by others. Whereas there are other business models where they will have a moat, and some of that will be their stickiness. The extent to which these customers are already invested in this product, the extent to which it goes right through their business, and ripping it out would be costly in itself.
Yeah, absolutely, and it is definitely that digital moat and that business moat that is the key. There are companies that clearly have that moat, but there are many Me Too's that don't have that moat. So the winners become very, very powerful, and we've seen the AI enablers that have benefited from these moves so far. But it's where those companies affected by the disruption that get impacted at the margin.
St James's Place is currently down 7.2%. A lot of it's going to come down to talent as well. So the companies that can attract the talent can actually make these transformational changes and actually produce these AI products. And I was speaking to a venture capitalist yesterday who was saying private equity-owned software companies are struggling to hire good talent because they're owned by private equity. You don't have the incentive upside, and so those are very vulnerable.
So you need stock to be able to
in that particular
incentivize.
VC's view. Yes, because if you're a software company owned by PE, you don't have that upside potential. They're not hiring the best engineers, and they are very vulnerable. Is the view from one private investor. So I think talent is another factor. Can companies like St James's Place hire the kind of talent that's needed to actually build out AI-enhanced products for their customers?
This takes us into deep territory, but I was quite taken by the opinion piece by Paul J. Davies this morning that talks about where the financial services sector goes, and he was talking about, yes, the financial services, to your point, Neil, has a long history of reinvention, and it does that pretty well, and Goldman Sachs was talking about that also. But then saying, does this take us, if we're talking about white-collar jobs en masse, does this take us into new financial models for countries, essentially? Do we have to move to a different form of remuneration? The UK is really exposed. But he starts talking about, universal basic income. That starts to get politically very complicated. But these are the kind of conversations that are happening even, within financial services circles right now.
It's fairly easy to understand why. And at what point does society go, no, we don't want to do this?
You need buy-in for this kind of technology.
And also,
at some point,
there's this kind of view that companies, that consumers will lose, that companies will make lots of money. But ultimately, you need the consumer to be able to sell stuff to. So if the consumer's on universal basic income, do companies really make a lot of money? I don't know. It doesn't feel like it fits together to me.
We have a question from a viewer, Neil. Does your guest, you're a guest, I guess, technically. Do you believe, Neil, that AI, as of now, cannot compute market sentiment, and as trading will always have a weight towards such tendencies, AI may not help in that respect? So I guess it's a question around AI assessing market sentiment. Do you have a view on that?
Yeah, absolutely. Obviously, we use AI internally here at Bloomberg to help with some of the tools, but I can tell you right now, often the AI trying to read and understand a price action on a stock, on an equity, actually gets it wrong. You have to talk to people in markets to get a broader understanding of sentiment of what people are doing to explain the price action related to a stock price move. Sometimes it can be an obvious, but actually, in the majority of occasions, look at the IB chats. You have to get human understanding of relating.
It's going to get better at that, isn't it? That's the whole point, isn't it? It will improve. It will learn.
We watched a robot do a cartwheel yesterday, Neil, and a backflip, and that apparently was learned behaviour. So we'll see. This is having an impact on others in the sector. So just to make that point, software and IT stocks are more broadly down. So Dassault System, of course, is the poster child for this now, down 19%. But we've got SAP down 2%, again, Sage down 2.5%, Capgemini 3.3%. So this is having something of an impact. And to your point earlier, commentary from, for example, JP Morgan saying this is worse than even the most negative that was feared around specifically Dassault System.
Yeah, I mean, it was because we'd already had low expectations for Dassault. So this is clearly a very, very poor update for that. And again, the nervousness around investors is, I don't want to sit here and wait to see what comes next. I'm getting out. And actually, unfortunately, one thing that, with the sell side being reliant on, their recommendations, if you look at it, only 2 analysts, I think, had sell ratings on Dassault. You had about 24 that had hold or buy ratings. So again...
So the humans are doing a great job, are they?
Humans are doing a great job on that occasion, absolutely.
Neil, thank you very much. Thank you for joining us, and we've lingered on this subject, and we thank you for doing that with us. Good to have you on the programme with us. Coming up on the programme, we will turn to the subject of Siemens Energy. We've had some strong orders coming through. The CEO joins us next. This is Bloomberg.
The problem we've got as an industry is when the government overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back. This is the opening trade. We are 30 minutes into today's session. Happy Wednesday. European stocks across the benchmark down 0.2%. The DAX is down 0.4, dropping 91 points. Over in France, the CAC 40 falling 0.4%. Dassault Systems is weighing on that index. Here in the UK, a lift coming through from the energy sector and basic resources, two leading sectors right now in the session. The FTSE 100 is up 0.2%. Guy, what are you seeing?
2 to 1 down. That's the ratio. That's what we're looking at within these markets. There are obviously some big single stock sector stories, single stocks and sector stories that we're watching, particularly around software. There you go, 214 up, 378 down. Volumes reasonably kind of even this morning. The leader. Let's start with a positive. Let's put a positive spin on this morning. If you're in the grocery space, you're having a good day. Del Hayes is up by nearly 7.5% at the moment. It is doing very well. Siemens Energy. We're about to talk to the company's CEO. Huge numbers of orders coming through for gas turbines. Did I see 25% of those are coming from the AI story? That's fascinating. Heineken's also up. Job cuts coming through. The volume story, actually, maybe the biggest driver of this, though. We're seeing maybe volumes coming down a little less than anticipated. That's giving Heineken a bit of fizz this morning. Let's talk about where we are seeing the weakness. The standout story is obviously in Dassault. Do not confuse this with Dassault Aviation. This is Dassault, the software company, and it is down now by 20%. 21%. I'm rounding up a little bit, but 21% to the downside. Huge move in that space. We talked about the software story and how it's affecting wealth managers. And James's Place is down by 8% this morning. That stock's been incredibly choppy over the last few years. And Lufthansa, its pilots are worried about their pensions and their strike action once again hanging over this airline, the German flag carrier, down by 2.25%, Anna.
Guy, let's get an update on some of the other stories we need to keep in mind this morning. The Financial Times is reporting that the activist hedge fund Elliott Management has built a, quote, significant stake in the London Stock Exchange Group, or LSEG. The stake comes as the UK company contends with fears over disruption from AI and a lackluster listings market. Bloomberg LP, the parent of Bloomberg News, competes, of course, with LSEG in providing financial data. US House lawmakers could vote as soon as Wednesday on whether to reject some of President Donald Trump's tariff policies. The votes come after lawmakers last night rejected a last-ditch effort from House Speaker Mike Johnson to prevent them from carrying out this move. Meanwhile, the European Parliament is moving closer to approving a trade deal with the United States after senior lawmakers agreed to make some changes ahead of a vote planned this month. And Bitcoin has drawn fresh support from some of its largest holders, though the return of demand remains narrow enough to raise doubts about whether it marks a recovery or mere damage control. So-called whale wallets accumulated about 53,000 coins in the past week, their biggest buying spree since November. Bitcoin is roughly 40% below its October peak, and actually, despite that buying by those so-called whales, Tom, that is not helping it this morning. Last time I checked, it was weaker.
Yeah, the OG of the crypto space down 2.6% right now at 66,800 for Bitcoin. Let's get to the AI story. This is an AI story. Siemens Energy is on track for another year of rising revenue as surging electricity demand continues to bolster sales of its gas turbines and power grid products. Group orders jumped by over a third to 17.6, just shy of 18 billion euros. Let's bring in Siemens Energy CEO Christian Breu. Christian, good morning. The stock is up about 160% year to date. We can add on the moves today, of course. Are you essentially an AI stock at this point, Christian?
Good morning. Thanks very much for having me. No, not really. Even so, I would say the AI is the cream on the cake for us on the orders. And you have seen it in the gas turbine orders. It's roughly 25% of the order book today is related to data centers. But keep in mind that actually the industry was actually much more designed to be a 60 to 70 gigawatt market not so long ago, right? And now we look into 100 gigawatt markets, and that is really a lot driven by the data centers. But important to note is that a lot of orders actually come not from the data center side. The largest order on the gas turbine side this quarter has been Europe non-data center. So it's a little bit more diverse, the picture, but I'm super proud of what the team has achieved to really build a position from ourselves in the data center market.
Yeah, and look, we're admittedly slightly obsessed with the data center story, given all the ruptures we're seeing in the markets. Christian, what are the risks that order backlog, as substantial as it is not converted into sales? What kind of risk are you putting on that? As some out there question the spend and capex around data centers?
Yeah, first of all, I have to say, so far we see reservations converting more or less one-to-one into effective orders, and I have not seen any cancellations yet. I would always say, as much as I understand the question around is there a bubble, is there risk in there, electricity will be needed. Might there be, let's say, ripples along the road in terms of companies are changing? Might be, right? But for us, delivering the underlying electricity to these data centers, I'm relatively comfortable looking forward that this power will be needed. The other question you always also have to ask ourselves, what if we cannot supply the electricity to the data centers? Because AI is going to be around us at whatever level, we're going to need it. So I think it's really important that we fuel that industry to grow and prosper. And in that regard, I feel comfortable if I look on our backlog on the AI side.
Christian, good morning. It's Guy. Can you deliver all the orders you're getting at the moment? If I come to you now and ask for a gas turbine, when am I going to get it?
Well, we will have a debate, let me put it this way, right? And obviously, we mainly discuss about 29, 2030 delivery. There's here and there some slots which we try to accommodate in 28, and we try to create as much flexibility for our customer as possible. What our benefit is in that area is we have a relatively broad portfolio from very small gas turbine to large gas turbines. The large gas turbines are the most sold out, so we try to find solutions where we go to smaller turbines and still serve the customers. But absolutely correct what you're asking. Execution of all that backlog will be a significant stretch to the industry, and it's not just about us, it's also about the construction companies, civil companies. We will have to see over the next 12 to 24 months, how do we grow this industry faster?
Okay, and is the challenge within the supply chain, your supply chain, or is it within your factories? Where are the bottlenecks?
If you look to our products or the gas turbine itself, the biggest constraint I see at the moment on the component side, if it comes to blades and vanes or larger forgings, which is a limited market in terms of suppliers which are active there. And that is what we're trying to expand. And you may have seen our $1 billion announcement in the US. Part of it goes into exactly expanding that supply chain. And we also obviously have a factory ourselves on blade and vanes, which is not sufficient to supply us completely, but to a certain extent, also that we are expanding. And that will be key to grow that supply chain first. I think on the assembly side, we have some more flexibility.
Good morning to you, Christian. Can I ask you about the after-sales market, the services side of the business? What are you expecting to see there? How predictable is the revenue? How fast can it grow?
Yeah, I mean, that is obviously the good thing about this business. Keep in mind, this is today roughly 60% service business on the gas services side. And obviously, with all the new units coming now into the market, we will have a significantly growing service business thereafter. Keep in mind that a lot of this service business you're only going to see after 28. We guided in the midterm until 28. A lot of the positive effects from the service side you're only going to see thereafter when the new units come into operation and they go into the first turnaround. But that is actually the nice thing about the business, that we sit on a fleet which afterwards will be serviced from us nicely.
Can I ask what conversations look like about supplying to the wind industry in the United States right now, Christian? How difficult to navigate is that territory?
Yeah, first of all, the most discussions we have is executing what we have on hands, right, in terms of getting through the orders, particularly on the offshore side. That is something which are wind parks nearly completed, which we obviously want to get through. On the onshore side, you may know that our position in the US is a little bit muted simply because after our challenges in the onshore wind businesses, we did not push a lot for the new onshore business. That helps us now in the current situation. So what we are discussing at the moment is mainly repowering projects. So using existing sites and repower this, that is our main business in the US. In that regard, I have not a major concern on our wind business in the US at this point in time.
Christian, I want to go back to the demand that you're seeing for those gas turbines. Guy Johnson's mansion will not be receiving its mini gas turbine until maybe 2028, 2029, 2030. You said you need to invest, you and the industry need to be investing more. You're investing $1 billion in the US, as you mentioned. Are you going to be investing a similar amount in Europe? What is the investment determination from you and the team?
Yeah, I mean, overall, over the next 3 years, we indicated that we're going to invest around 6 billion euros in the different factories. Obviously, we're trying, first of all, to expand all factory footprints, what we have, to have a capital effective use, really. And this is what we're trying to do. So it means, yes, we're also investing in Europe. Yes, we are also investing in Asia. Yes, we're also investing in the Middle East to continue to do this. I also said when I was talking about the 1 billion in the US, there might be more coming depending on how the market develops, but we are firing on all cylinders across the board.
I think I've got a Siemens fridge. Very different business indeed. Completely different business. Christian, thank you very much indeed. Thank you very much indeed for spending some time with us this morning. We'll look forward to seeing...
Wait, how big is your fridge if you need a gas turbine for it?
It's big.
Can you wait 5 years?
Big. Yeah. It's a problem. You've got powering it's massive, like it's data center. I don't know. I guess the pivot from that is Total Energies, Total. I suppose it's a fairly easy one. Gas to Total, they make gas. We're kind of dealing with the entire supply chain here. The company on the move this morning after slashing its buyback to $750 million in the first quarter of this year. That's after lower oil prices hit profits. Fourth quarter net income dropping 13% year on year. Mitchell Furman, our European oil majors reporter, joining us now. This doesn't sound good, but this is a market that's meant to be doing fairly okay at the moment.
I mean, Total's shares are rising this morning, and their report today marks the conclusion of big oil earnings. And we saw yesterday BP completely halted their buyback and their shares plunged. But Total guided the market that this was coming. Their share buyback was now going to be tied to oil prices, which were trending lower when they said this last year.
Okay, so is this, so we saw BP scrapping their buyback, didn't we? And now we see this move from Total Energies. Is everybody pinning this to what were until January lower oil prices? I mean, the BP story is separate, new management, but is that the driving force?
Yeah, for Total, it definitely is. They were very clear in the fall that the buyback would be lower. They didn't say exactly what. They gave a range, and this is the lower end of that range. So, you know, there is room to run for Total. They're being conservative. They, Patrick Pouyanné, the CEO, this morning said that the oil markets are seeing some oversupply as well as a buildup on sea of Russian crude due to sanctions. So the market, while it has these oversupply dynamics, there's also the geopolitical risk premium tied in.
What do we see in terms of the valuation gap between European oil majors and their US counterparts? Is that does that? I mean, it's been long running. Is that something that closes in 2026?
Yeah, it'll be a challenge for sure for the Europeans. Exxon and Chevron reported strong results, this last quarter as well, and they have big growth stories. They have production in the U.S., Guyana, the Middle East, and that is going to help offset, potentially lower prices for the Americans and the Europeans. Both need to, they're all trying to cut costs as well as ramp up production.
Yeah. Mitchell, thank you very much indeed. We'll watch that. We'll watch that story. Mitchell's not particularly convinced that the valuation story, the valuation gap is going to close this year, maybe. Mitchell Furman, our European oil majors reporter. We didn't even ask what it means for climate change. We're going to break through 1.5 degrees. I mean, that's almost a given. You could get to 2 degrees, 3 degrees, devastation for the oil industry, the energy industry, how they adapt to that, the regulatory changes, they kind of under pressure. So far, they're shifting away from renewables right now.
Massive shift in terms of the US commitment.
Huge.
Now you've got to pivot from that to
Bad Bunny.
Bad Bunny and Zara t-shirts.
Coming up, this is something that President Trump feels strongly about as well. Coming up, how much are some resellers charging for a Bad Bunny Zara t-shirt? Guy Johnson's been stocking up. And notes following the Super Bowl. The answers when we come back. This is the stat you need this Wednesday. This is Bloomberg.
Say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. and it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up to the minute news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Welcome back. Before the break, we asked you, what are some resellers charging for a Zara Bad Bunny, that's important, the Bad Bunny part, T-shirt and thank you note. Following the iconic Super Bowl halftime show performance, the answer, 30,000 euros, or just over 35,000 US dollars. Inditech's own fashion label Zara collaborating with Bad Bunny on the Super Bowl show and dressed the performer, his dancers, band and orchestra as well. Zara say that they have no plans to sell the outfits commercially. Bad Bunny's role in the Super Bowl also underscoring Zara's growing cultural reach in the US. Guys digging deep to see if he can afford a $30,000 Bad Bunny Zara
Trying to find
t-shirt.
a link with the US consumer here. What does this tell us?
Nothing.
I don't know. I have no proof that they were US sales. I mean, maybe they.
I got nothing on this. White tie. Maybe we could start doing that. Maybe that's the way forward.
Go with the white tie.
Yeah.
And that pose.
That
Maybe
pose.
not that.
I think on set that would get out really well. On a Bloomberg set. Anyway, how do I pivot from this to that? I have no idea, so I'm not going to. Okay, all 27 EU leaders apparently are going to be wearing those white ties. No, they're not. They're going to be meeting at a centuries-old Belgian castle today for a day-long retreat, which is going to discuss ways to integrate EU markets. I feel we've had this conversation before. This comes as European Council President Antonio Costa said the bloc needed to unify its markets to compete is necessary to compete globally. Let's talk about this. Ollie Crook is here wearing a red tie. Good morning.
Yeah, good morning.
So what are we going to get out of this?
Yeah, indeed. I mean, listen, so basically the way that Antonio Costa wants to frame this, and of course he is the sort of great shepherd of the 27 EU members to try to get this collective action over the line, and his ambition is to try to move the focus from defense, which was last year, trade last year, and then moving it into competitiveness. That obviously is a much thornier issue. There are a lot of complexities, whether it's completing the capital markets union, sort of destroying internal barriers, they want to cut red tape, all of the things that we've really talked about a great deal in the past. This is the ambition to really focus on that this year. Last year was about defense. That's what it's about now.
We've done defense, yeah?
Apparently, right. No, but that's basically how he's sort of trying to frame it. The difficulty is, of course, that is the more complicated bit. What I think is also interesting is that Macron and many others, they want to capitalize on what Macron has now branded the Greenland moment, right, which is getting this impetus and this enthusiasm through and really getting these European leaders to move this stuff forward. I think there's also another Greenland moment, which is not just about Europe, it's also about the broader multilateral system. And I spoke to Antonio Costa because we had that really rousing speech from Mark Carney in Davos that was big on ambition, big on ideas, little on execution of what that actual world looks like, that multilateral world led by middle powers. Antonio Costa's job is to sort of guide middle powers, so I asked him what that world could look like. Have a listen.
I'm not so pessimistic as Mark Carney has been, and I don't said that the rules-based order is died, and we need a new one. Of course, it's under threat, but I think we are strong enough to protect the rules-based order, because we don't have a real alternative to the rules-based order. The alternative is the chaos, and that's why like-minded partners like the European Union, United Kingdom, Canada, Japan, and other countries are very strong upholding the international rules-based order. One of the reasons, because you are investing a lot in these trade agreements is because we need a rules trade order to ensure predictability to the economic agents. It's impossible to have a strong economic growth with uncertainty. And we need to provide certainty. And the best way to provide certainty is to protect this international rules-based order also in trade.
So really taking that momentum of that Greenland moment, that of course puts into the fore the main debate we always have in Europe, which is about joint debt. Macron is saying that this is actually the moment that we need to see that. And actually, when you speak to finance ministers over the last 12 months dealing with Trump, that seems much more likely to try to get some of these investments going.
Yes, maybe Canadians are thinking about whether they need to, join the EU or just maybe work more closely with it. Let me pivot the conversation to the other thing that's on their agenda, and that's very much Ukraine. Yeah. What are we going to hear, or what did Costa have to say about the future of Ukraine?
Yeah, so basically how he sees that the sort of Europeans get their seat at the table and actually can contribute to this negotiation process and actually have some input is basically by bringing Ukraine into the European Union, the accession talks that are happening. There's a lot of debate at the European level of how exactly to go about this because, of course, if you sort of fast-track the Ukrainians into the system, it really is going to make a number of other candidate countries very, very unhappy. So they're discussing different ways of maybe a tiered system where maybe the Ukrainians get some benefits of being part of the EU. And this is, of course, a very lively debate because some people are very in favor of that. There are some, of course, who are very against that, like Hungary. So the real question is, are they going to find ways around that? That is going to be one of the big debates that they're going to be expanding on Thursday when they meet in Belgium with potentially white ties.
Oliver Crook, thank you. Well, we'll watch the tie action, certainly. Oliver Crook, 1:30 p.m. on the data front. It's delayed January jobs report in the US, and there's a Treasury 6 p.m. UK time as well of 10 debt state.
Weirdly, the payroll print on a. What else we're watching? Getting this. How are you dealing with? How are you thinking?
The headline number that you really care about is unemployment, but of course you get the revisions to previous numbers, you get the actual NFP. I think it's important to think about what context this number comes in. So we had retail sales yesterday that disappointed to the downside, and you also had jobs data last week that again was on the weaker side. Now the feed through to ADP to NFP isn't great, but it has had an impact on the whisper numbers. We talked about it having reduced 20,000 on those jobs numbers. It reduced a further 10,000 yesterday post-retail sales. So the whisper number is now 30,000 below consensus estimates. So that's a relatively low bar, I think, for the numbers to come in and beat. And I think also that pricing for the Fed has remained very sticky, where you don't expect a cut until after Powell's term. So I think you'd need a really big downside surprise to have that shift.
Okay. So how's the market positioned? What causes a surprise?
I think if you have an unemployment rate that ticks up, that's very negative for growth.
Now?
Yeah, something like that, yeah. Mm-hmm.
Okay, so a higher unemployment number is what people are going to be watching out for.
Yeah, I mean, obviously you care about the other numbers as well. Yeah, exactly. Because if you think about what the Federal Reserve is looking at, they're thinking about a labor supply that's coming down quite significantly as immigration comes down as well. And you're also having less labor demand. And so you're thinking about what is the balance? How does that feed into the unemployment rate? Because what really matters for consumption is, are people employed? Are they getting paid? Now, the retail sales were a little bit more concerning, but on aggregate, consumption and growth looks pretty good. So I think you need to have some sign that that feedback loop becomes negative to get very concerned about the economy and to expect more cuts.
I've just heard anecdotally from young people, family in the US, in their kind of 20s, they're finding it really hard to find jobs. It's just anecdotal, but that at least is some of the feedback I've been hearing. Scarlett, are you less or more clear about the direction of travel for equity markets after today?
I think we'll get a better, I'm thinking, I think you need a lot of data moving in a negative direction to price more cuts, and for bad data.
Aren't cuts good?
I think if you cut below neutral, that's bad, because that tells you that you're going towards a recession. And so the amount of cuts we have right now is the low end of what you can price without assuming that you're going to get a recession. So if you transition to recession territory, I'd get very worried about equities. I just don't think 1 week labor market print is what's going to do that when you have aggregate growth that's quite strong.
Scarlett Montgomery-Coney, thank you very much indeed. Come on, Markets Live. team. So the displacement story and that anxiety continues, and we're seeing that reflected in Dassault Systems. We're seeing that reflected in St. James's Place. Dassault Systems down over 20%, 21%. St. James's Place, wealth manager, of course, on the back of the news around this AI piece of software that could challenge that space, down 9%.
There's a story we haven't talked about this morning much, which is nickel. So nickel's going up because the Indonesians are putting reducing mine permits for its biggest mine to produce nickel.
They want prices up.
They want prices up. So what this speaks, but this speaks to the idea that countries are going to control resources in a way that they haven't done before, which I think is really interesting.
Critical minerals means something quite specific, but lots of minerals are critical, it seems, in the stage of the economy we're at right now. Wednesday, 11th of February, that is it for the opening trade. The Pulse is up next. They'll continue to track that Dassault Systèmes share price, no doubt, and take you towards the start of US trade. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television. Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Weak U.S. retail sales bolster the case for further Fed easing. Traders now turn their attention to the delayed January jobs report. The world's biggest nickel mine is ordered to drastically cut output as Indonesia seeks to revive prices of its biggest export commodity. Plus, Siemens Energy jumps as surging demand for electricity pushes orders for its gas turbines to a record. Let's pick you up on some of the market price action. Today, a big day for investors with that jobs report coming, delayed obviously with the shutdown. S&P futures up 0.2% after a pullback yesterday, but better handover from Asia Pacific this morning. 10-year yield sitting at 4.13. We did have weaker than expected U.S. retail sales, driving those yields lower throughout the course of the session yesterday. And then geopolitics in focus. We've got Brent getting very close to $70 a barrel, up 1.2% this morning. all eyes on that meeting between President Trump and the Israeli Prime Minister Netanyahu in DC today to talk about Iran. And then nickel on our radar today. That metal is up 2.3%. On supply disruptions. The biggest producer in the world in Indonesia has cut its supply, and this is the impact on the market. As for European indices, this is the picture for Europe, and what you're seeing is sort of a mixed bag. It's been a big day for earnings in Europe. Some of the positive performance has come from Ahold Delhaize, Siemens Energy, Heineken. On the flip side, we have Dassault, Kering, St. James's Palace, all underperforming. But you can see a spot of green on the FTSE, and there we're keeping a close eye on the price action with the London Stock Exchange after Elliott Group disclosed a stake in the company. So that is the setup as we head into the session for the conversations that matter and the insights you need. Let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Joanna Versace in Dubai, filling in for Francine Lacroix today. Now, the delayed U.S. jobs report for January is expected to show a notable markdown to payrolls growth. Traders will turn their attention to what that might mean for rates. The Fed's Beth Hammack believes they will be on hold while the data is assessed.
Rather than trying to fine-tune the funds rate, I'd prefer to err on the side of patience as we assess the impact of recent rate reductions and monitor how the economy performs. Based on my forecast, we could be on hold for quite some time.
With me now is Ven Ram, Bloomberg Markets Live cross-asset strategist. Well, big data coming up today. We have the jobs print. The headline number is expected to be a 65,000 rise. How much is this going to move the needle, do you think, for Fed and Fed policy in the second half of this year? We just heard from Beth Hammack saying she expects rates to be on hold for a while.
I think that if the number is anywhere along the expected lines, I think the Fed will take it as read. I think that the more important read will be the jobless rate number. For a long time, we never saw a jobless rate above 4% in this expansion, Jumana. So we are getting consistently readings above 4%, now 4.4%. So if that picks up, I think that will have the Fed worried, because we are in this lower higher, low fire environment, and if anything challenges that assumption, the Fed will be a bit concerned. But, you know, to go back to Beth Hammack's point, I think the Fed is well poised at this point, because if you look at their inflation forecasts and if you look at their forecast for economic growth, the Taylor rule posits that the rate should be exactly where they are.
Right.
So I think that, you know, that's why she's saying what she's saying.
Interesting. But yesterday we did have weaker than expected retail sales figures. And on the back of that, you did see bonds rally. You saw 10-year yields at the lowest level, actually, in the past month. What is that having a notable impact on the USD? Is this sort of the second leg of the dollar underperformance for this year? You think the catalyst for the market pricing and more easing?
Absolutely. I just did an analysis this morning, which is available for terminal subscribers. It shows that the dollar is undervalued by 4.2%. That's a huge undervaluation gap. And that kind of goes back to the April tariffs last year when the gap was similar. So I think that, you know, this is bringing on dollar hedges. People are concerned that, you know, the Trump maybe wants a weaker dollar. We heard him say that last month. And, you know, also the rate checks on USD JPY, which they've walked back, I think those have done immense damage to the dollar. So I think that the dollar is going to remain on the back foot for now.
Yeah, and a lot of whiplash in that dollar-yen currency pair. Ven, really good to chat to you. Bloomberg M-Live strategist Ven Raab. Well, to continue that conversation, we're now joined by Nanette Hescher-Federb, EMEA CIO at Lombard Odier. So much to talk to you about, because we've got macro, we've also got micro. We've had a bunch of earnings hits, and of course the AI disruption of last week. Let me just start with the macro this week. How important for market direction do you think today's jobs figure is actually going to be?
I think it's going to be quite relevant for especially fixed income markets and expectations of future Federal Reserve policy, especially if layoffs are picking up. This is certainly the area of focus right now. So, yeah, the macro data will, I think, give new information for Fed policy in the second half of the year.
Does the appointment, or I should say the nomination of Kevin Warsh, substantially have an impact on what you're expecting out of monetary policy for the second half of this year?
I have always had the view that the debate around the person of the next chairman or chairwoman of the Federal Reserve was much too focused on personalities. I do think that the composition of the board is much more important. Monetary policy is being set in consensus in the governing board, and so for me, it's much more important to see how that board is continuing to get composed of for the future.
Okay, fair point. Let's talk about markets, the price action between last week and this week. You saw in the middle of last week a real shakeout in some of the AI ecosystem. Software as a service took the major brunt of the selling. By the end of the week, you saw a massive short squeeze take place. Do you believe that the worst of the selling is behind us now?
We have certainly regarded this as an opportunity for investors to take exposure to a sector that commands generally a premium over the broader IT sector. I'm referring to software. There has been a lot of concerns that AI might be disrupting software companies, but we have held the view that actually it is empowering them. It is shortening the time for coding. It is enabling efficiencies of workflows. So for us, it's actually been an opportunity here to take exposure on a sector that gives also possibilities to invest more on the cloud infrastructure and also on some subsectors like cyber defense.
Yeah, I mean, last week there was also a lot of talk about this pullback incentivizing a rally elsewhere, i.e. that it would be an opportunity for us to see a more broadening of the rally that's taking place in U.S. stock markets. Do you subscribe to that view as well? And if so, which other parts of the economy do you want to have exposure to?
You know, certainly the tech sector continues to have strong earnings drivers, and we should not be looking away from that when opportunities such as those on software arise. But you're right to say that macro data have been actually better than expected altogether in 2025. We have upgraded our outlook for 2026 in terms of global growth, and that bodes well for a number of sectors as well, regions that benefit from better growth. Materials is one sector that we really like. We think that there is still a lot of upside. With your previous guest, you've also discussed about what commodities are doing. Metals are playing a very important role. So material sector, one that we like, and healthcare, I think, as well, for different reasons. Altogether, it does speak for a broadening of the earnings trend, positive earnings trend for more sectors.
Yeah. Well, let's talk more about the geographic divergence with earnings, because what you got is a pretty robust earnings season so far out of the U.S., but in Europe, it's a mixed bag. And one thing that caught my attention this morning, a Citi index showing that more analysts have downgraded rather than upgraded profit estimates since the end of 2025. How does that set the stage for the European equities outlook for this year?
I think European equities have, over the past 2 years, really depended on only a few sectors, financials being one very important one in Europe. So how the broader market in Europe develops over the next months very much has to do with how financials are doing, and also, of course, industrials for different reasons. So in Europe, I would expect a continued mixed bag. We have the region at neutral, but there have been some positive surprises in Asian regions, Japan in particular, obviously standing out, and with the political clarity that we now have with regard to economic policy in Japan, I think a good omen for continued earnings trends going up.
Well, I was going to ask you whether you think this trend, the momentum behind Asian equities outperformance can continue in the near term. You point to, obviously, the price action in Japan, the Nikkei touching an all-time record high, but do you think that this rally still has legs?
There's always possibility for volatility. We should not forget that earnings are very dependent also on where the yen is headed. Should the yen strengthen, there might be a little bit of momentum stalling, but many investors do take exposure to equities in Japan, perhaps unhedged, and so they could gain at the margin on their currency position what they may lose in earnings strength. So I'm not so worried with respect to the outlook for Japan and for broader Asia. I think there is a number of factors that are speaking for even Asian emerging markets. We hold a positive view altogether for emerging markets, think that they have good exposure to some of these critical commodities that are likely to see a comeback altogether in 2026.
Okay, so I understand the commodities angle. One thing that we didn't discuss that perhaps is quite integral to the performance of emerging markets is the weakness in the USD. Do you expect that to persist and therefore to provide somewhat of a tailwind also to some of these emerging market assets?
I think that's the case because in the U.S. we are likely to see rate cuts later in the year. That provides for a cyclical environment that is translating into a little bit more weakness of the dollar. Importantly, we should distinguish that cyclical weakness does not mean a debasement. So I've always made that point. We are not talking about a dollar debasement, but of a cyclically weaker dollar. 122 in euro dollar over 12 months is about where we are seeing this currency pair. In that context, emerging market assets altogether, whether it's on equities or also on bonds, are going to do well.
Nanette, a real pleasure to chat to you. Thank you so much for coming on the Pulse today. Nanette Hescher, FEDERB, EMEA CIO at Lombard Odier. Now, coming up, the head of the European Council tells Bloomberg there's a new urgency for the EU to finally unify its markets. Details next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's Jobs Day, and Bloomberg has the report under surveillance.
Where's the emphasis, on headline payrolls or on the unemployment rate?
I'm focused on the unemployment rate, as is the market.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
What we're seeing is certainly a growing labor force.
A labor market that actually could be improving.
The January Jobs Report, today on Bloomberg.
Welcome back to The Pulse. Well, Bitcoin has drawn fresh support from its largest holders. So-called whale wallets accumulated about 53,000 coins in the past week, their biggest buying spree since November. For more, we're joined by our senior editor for digital currencies, Ana Herrera. So really interesting to see this price action, well, I should say the buying emerge in the context of the price action. How much of this is about signaling a bottom versus pure damage control, given how much the price of Bitcoin has dropped?
I mean, that's a very interesting question. It's hard to know. Obviously, the whales, I guess, have an incentive to make sure that we don't fall further. It could also mean that they do think this is a sort of good buying opportunity. Historically, Bitcoin has tended to go up again. What's very interesting, though, is that, obviously, the price, we haven't seen a lot of new buyers come in. And that's a signal that things aren't going to go very well, perhaps, for a while longer. Bitcoin, historically, when the price has gone up, has drawn in a lot of retail investors, and that's not really happening yet. And we can see it in the ETFs as well.
Well, this is the thing, right? So there was a lot of hope that you'd get a broadening of the buyer base of Bitcoin, institutional buyers, retail buyers, the launch of those ETFs. But actually, if you look at the ETFs, they've been net sellers over the past year. So about $11 billion in sales in aggregate. Is that likely to continue?
I mean, I guess it depends on sentiment and how the price goes. Today, for example, we are seeing Bitcoin fall again. It doesn't seem like it's tracking Asian equities either, which was what it was doing for a while, going up with equities, especially or down with tech stocks. So it's hard to say. Obviously, Bitcoin ETFs have been and crypto ETFs have been a big success from the beginning. So maybe that's just a little bit of repositioning from that large inflow. But obviously, one of the things that the market is struggling with is that it doesn't seem to have a new narrative, right? Historically, we've seen Bitcoin compared to digital gold, Bitcoin compared, to a hedge against inflation, and now it seems like it's falling in between, and people aren't really sure what it is. So until it finds a new sort of narrative, it might be hard to see how it goes up significantly, and therefore the ETFs attract more flow.
Yeah, or maybe just a turbocharged risky asset. Ana Herrera, thank you so much, our senior editor for digital currencies. Thank you. Well, Commerzbank lifted its guidance for profit this year after reporting higher than expected earnings in the fourth quarter. It's a boost to CEO Bettina Orlep as she continues to defend the bank against a potential takeover. She spoke to Lizzie Burden on Bloomberg Daybreak Europe.
This is the best result we ever had in the history of the bank, 18% plus in comparison to 2024. And it was mainly driven by three topics, not surprising ones: growth on the revenue side, very good cost discipline, and high asset quality. And that then leads also to a very attractive capital return of 2.7 billion euros in total, which we return to our shareholders for 2025, including a very attractive dividend of €1.10, which is 70% up in comparison to 2024 dividend. And actually, the story continues because I have the benefit of already looking on the January number, and we had a very strong January.
And you've also lifted your guidance for profit this year. What are the main risks to that outlook?
Well, I mean, first of all, we concentrate on the tailwinds, and what we see is that we will see for the first time after 3 years, we expect growth for German GDP, so it's 0.9%, which is clearly helpful. We also assume that there will be, at least for Germany, a stable, or Europe, a stable interest rate environment, which is also supporting our case. This is also why we raised our outlook for NII to 8.5 billion euros. then we strongly believe in our power to increase our net commission income by, again, 7%, and then combined with strong loan growth and a good cost discipline, that leads us to the raised outlook, with also a much improved cost-income ratio of 54%.
Bettina, can you put a number on how much that German fiscal stimulus is going to boost Commerzbank this year? Because the Deutsche CFO was a little more hesitant. They think that it's going to take a bit longer to really feel the impact on their bank.
Well, I can only look on the 2025 numbers, where we basically have not seen any growth for Germany, and still we reported a loan growth of 10%. So we are kind of not completely independent, for sure, but we're kind of independent. But because what we do is, specifically when it comes to investments of our corporate clients, we are at their side wherever they go. So either they invest in Germany or they invest abroad, which we have seen in 2025, and we are part of it. But clearly, the 0.9% will also help our growth.
That was the Commerzbank CEO Bettina Orlopp speaking to Lizzie Burden earlier. Now, EU leaders are set to meet tomorrow to discuss ways of integrating their markets. The president of the European Council has told Bloomberg that the bloc needs to unify its markets if it wants to compete globally. Let's bring in Bloomberg's chief Europe correspondent, Oliver Krug. Okay, Ollie, so there's this big EU competitiveness summit taking place tomorrow. And the single market once again on the agenda. What do we know about what they're looking to achieve?
Yeah, I mean, I think even so, how difficult to pronounce and often spell the word competitiveness speaks to some of the difficulties of getting that competitiveness up at the European level. Because at the end of the day, we've been talking about this for about 18 months, Jumana. We've had the Draghi report. He spoke in very stark terms when he put it out last September. And we should say that we haven't made a huge amount of progress in terms of actually achieving a lot of the concrete steps he laid out. He basically said Europe has two choices. Either you make very significant, somewhat painful reforms, or basically the European economy just limps into the sunset and basically becomes irrelevant. And we have seen the European economy sort of diminish globally in terms of its importance. So for Antonio Costa, the head of the EU Council, whose job it is to really bring all of these 27 leaders together for collective action, his priority this year is all about that competitiveness. It's about cutting red tape across Europe. It's about sort of cutting back regulations. It's about sort of getting that capital markets union that we've talked about for 10 years over the line. And that is going to be one of the major discussions. Now we have Emmanuel Macron referring to this moment for Europe as the sort of Greenland moment, this moment where it sort of moves together collectively in the sort of face of that very difficult Trump administration. But also we were talking to him about this idea that Mark Carney has presented, this idea that this multilateral order can actually be upheld by the middle powers. So I asked Antonio Costa whose job it is to basically align 27 middle powers out of this sort of theory of that really sort of beautiful idea laid out for Mark Carney. What does that look like practically? Have a listen.
I'm not so pessimistic as Mark Carney has been, and I don't said that the rules-based order is died, and we need a new one. Of course, it's under threat, but I think we are strong enough to protect the rules-based order, because we don't have a real alternative to the rules-based order. The alternative is the chaos, and that's why like-minded partners like the European Union, United Kingdom, Canada, Japan, and other countries are very strong upholding the international rules-based order. One of the reasons, because we are investing a lot in these trade agreements, is because we need a rules trade order to ensure predictability to the economic agents. It's impossible to have a strong economic growth with uncertainty. And we need to provide certainty. And the best way to provide certainty is to protect this international rules-based order also in trade.
So in many regards, this meeting of European leaders that begins tomorrow is not just about sort of what they want to achieve in that meeting, but really what the entire year is going to look like. And really, it's going to be that word, competitiveness. Let's see if it doesn't get sort of blown off course by Washington, D.C. and what we get from the Trump administration in the next few months.
And also, if I can eventually learn how to say it, Ollie. Look, while we have you, I also want to ask you about the EU-US trade deal. Around Greenland, there were questions about whether the EU would actually push forward with those discussions. What is the latest now?
Yeah, so basically after that Greenland detour, this was supposed to be ratified earlier in the year. It was delayed because how can you sign a trade deal with a partner who's basically threatening to impose further tariffs? It has now gotten to the point where the European Parliament will sign this into law. However, they've added a few clauses in it, basically clauses covering that if there is any sort of threat to territorial boundaries, the trade deal can be renegotiated. If you do not get a deal on steel and aluminum, and remember, this is still the big thing that's outstanding for European leaders, there are still 50% tariffs on steel and aluminum. If you don't get a breakthrough from that, the EU is still reserving the right to basically renegotiate the deal. But for the time being, a sort of story that began in April with Liberation Day, a deal that was really agreed to in July at Turnberry, and now it is going to be signed into law likely at the end of this month, really moving the conversation forward on trade and hopefully for the last time from the European perspective. But of course, Jumana, there's no guarantee of that.
Yeah, there never is. Ollie, good to chat to you. Oliver Kirk, Bloomberg's chief Europe correspondent. Well, coming up, we're going to turn to commodities. Oil is gaining on concerns over Iran, while Indonesia moves to shore up nickel prices. We'll talk all things commodities next with Francisco Blanch from Bank of America. That's coming up next. This is Bloomberg.
is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving something.
Yeah, probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning and welcome to The Pulse. I'm Joanna Bersecci in Dubai. These are your top stories. Weak U.S. retail sales bolster the case for further Fed easing. Traders now turn their attention to the delayed January jobs report. The world's biggest nickel mine is ordered to drastically cut output as Indonesia seeks to revive prices of its biggest export commodity. Plus, Siemens Energy jumps as surging demand for electricity pushes orders for its gas turbines to a record. But at least 10 people have been killed and 25 injured in a mass shooting in northern British Columbia. It happened at Tumbler Ridge Secondary School yesterday afternoon. Police believe the suspected shooter died from a self-inflicted injury. The incident appears to rank as one of the deadliest mass shootings in Canadian history. And the U.S. House of Representatives could vote as soon as Wednesday on whether to reject some of President Donald Trump's tariff policies. The votes come after lawmakers last night rejected a last-ditch effort from House Speaker Mike Johnson to prevent them. And the Israeli Prime Minister Benjamin Netanyahu is set to meet U.S. President Donald Trump later today. And Netanyahu says he will discuss Iran, Gaza, and other regional issues with the U.S. President during his visit to Washington. The U.S. and Iran have so far struck a positive tone about the start of diplomatic talks. Let's get out to Tel Aviv now and speak to our Israel Bureau Chief, Ethan Bronner. Ethan, the Israeli Prime Minister is no stranger to the White House. He's paid almost half a dozen visits to the U.S. Since Trump came into office for the second term. What is he looking to achieve out of this trip? Because it was quite hastily arranged.
Quite right. It's actually, I think, the 7th, but you're basically right. Look, I think he's quite worried that the American-Iranian talks are going to limit themselves to stopping the growth of nuclear weapon development. And the Israelis are quite concerned about the Iranian ballistic missile development, as well as their ongoing support of their militias that in the region, so-called proxy militias like the Houthis and Hezbollah and Hamas. And so he wants to try to get the Americans to agree that all three are on the table with these talks with Iran.
Yeah, and we'll see. Obviously, both sides are presenting the first phase of discussions as constructive, but unclear exactly the scope of how broad those negotiations are. Ethan, how much is Gaza also going to feature in the discussion? Looking ahead to next week, we know that there is a plan for the first meeting of the so-called Board of Peace to discuss funding. Is that likely to come up in conversations as well?
There's no doubt it'll come up. This is a big issue because, from the Israeli perspective, it feels that the Americans may be sort of slipping away from a particular commitment to make sure that Hamas is fully disarmed before anything moves forward in terms of rebuilding. So that's going to be a big issue, too. You don't forget that Prime Minister Netanyahu is running again for re-election in the next 6 months, and he has promised his population that there will not be a threat from Hamas, from Gaza, and I think he wants to make sure that that happens. So, yes, it will certainly come up.
Okay, Israel Bureau Chief Ethan Bronner with a look ahead to that meeting that's taking place between the Israeli Prime Minister and President Trump later today. It's scheduled for around 11 a.m. Eastern Time, so we'll see what comes out of it. Well, tensions over Iran have pushed oil higher despite a U.S. industry report indicating rising stockpiles. Let's get more on the outlook with Francisco Blanch, head of global commodities and derivatives research at Bank of America. There is so much to discuss with you today, Francisco. I am going to start with oil because you were just talking about the upcoming meeting and obviously the geopolitics of the Middle East region. Oil, Brent, is getting closer to $70 here. How much of that can be attributed to pure geopolitical premium?
Well, yeah, thanks for having me. Look, I think oil right now and just the rest of the commodity complex is really dominated by three themes: geopolitics, trade, and technology. And certainly right now, geopolitics are the main driving force, pushing oil close to the high end of this year's range. But we still expect, of course, if we have kind of either a peace deal with Iran or maybe just kind of a limited skirmish like we had back in June, for prices to revert back to around $60 a barrel on Brent. The market is oversupplied. Inventories are rising. They've been going up for a while. And we expect roughly a 2 million barrel a day surplus this year in the global Brent market. So
wow.
That's the fundamentals. That's what the fundamentals are saying. There's a lot of barrels, and Saudi Arabia's post the return of OPEC plus barrels, or the group has. So we think those barrels will start coming back if we breach the $70 mark. And again, OPEC has a couple more weeks to decide what to do here. But there's plenty of oil in the market, and the price war that or the recovery of market share that OPEC started a couple of years ago hasn't quite been fully finished, and there's more barrels to come.
Yeah. Okay, so you anticipated some of my questions. I was going to ask how much of an oversupply you see. You say 2 million barrels per day, but let me just ask you about OPEC as well. Do you think if we shoot above $70 and we stay there, that OPEC would then be incentivized to bring on some of the spare capacity they're sitting on back to the market? And if so, how much are you anticipating?
I think so. I think OPEC will bring back a lot of capacity. We're going to see a meaningful decline in spare productive capacity over the course of the next year or two. And again, if prices were to move meaningfully below $70 a barrel, we could have a resurgence in shale output in the U.S., which is probably the last thing OPEC wants to see. Remember, between 2022 and 2024, when prices averaged $86, $87 a barrel, on Brent, we ended up with an extra 3 million barrels a day of U.S. crude oil output plus natural gas liquids. So OPEC doesn't want to have a repeat of that. Saudi Arabia itself ended up cutting 2 million barrels a day during that window. That's not going to bring back good memories. They need more volumes out there. So I do think the group will try to push more oil and recover market share, and certainly hope that over the course of the next 2-3 years, there will be less spare capacity in the market.
Yeah. Well, let's pivot to some of the price action in metals. I'm going to start with industrial metals. Nickel this morning on our radar. We're seeing quite a big move upwards on the closure or the restriction of supply that's coming through from the world's largest nickel producer in Indonesia. And I guess this really speaks to the fact that this is a market that is really hinging on supply shortages, at the same time combined with a huge interest because of the energy transition and the scramble to get hold of raw materials there. Do you expect that to continue acting as a tailwind for nickel and other industrial metals?
We think so. As I mentioned, trade, technology, geopolitics, all at the center of the action here for commodities. There is nickel, there is tin, which has also been extremely tight. There has been a big run-up on copper, a big run-up on aluminum prices, and of course there's the precious metals, which are kind of acting with a life of their own. But yes, there is a strong push. The U.S. is trying to build under Project Volt a strategic reserve of critical minerals. That's $12 billion being put in place by the U.S. government. The issue with metals really is that we've moved from the 1990s Japan model of just-in-time to the 2020s Chinese model of just-in-case, and every government wants to take advantage of that just-in-case trend. Obviously, Indonesia, being the world's largest producer of nickel, is trying to bring the metal in line with what we're seeing across the industrial and precious metals complex. So I don't think there's anything other than that. They have a dominant position in the metal, and they're just trying to push the price higher by reducing quotas on what's effectively the largest mine from 42 down to 12 million tons. So doing so, they will support prices, and that's essentially the move by the government here.
Okay, so let's talk about precious metals, saving the best until last. It's been quite volatile a couple of weeks. Gold seems to be stabilizing around $5,000 here. I mean, how much of this move upwards in silver and gold can be attributed to speculative buying versus actual fundamentals and structural shifts? And, people talking about debasement trade, reserve allocation away from the USD into gold. So how much of the price action here is justified?
Well, look, I mean, precious metals are always speculative instruments, right? I mean, there's the majority of the gold comes straight from the ground and back into the ground. Last year, 80% of mine production went from 4 kilometers underground to basically 20 meters underground. So that's all speculative. And silver obviously has stronger fundamentals. There is no question. There's a use of silver in industry, in particular in solar panels, and you talked about energy transition earlier. But I do think, particularly the silver rally has been much more driven by retail buying. We saw tremendous turnaround in the SLV ETF, for instance, which is a preferred vehicle for investors. And also in gold, we've had a lot of investor money coming in. Central banks, however, significantly pulled back last year by about 20%. We saw a big decline in central bank demand, which I think is a concern to some. But of course, gold has become a bit of a hedge against just about anything. Fiscal worries in the US and Europe, equity market concentration, and the investment in AI, or monetary policy, which is why gold got washed out when Walsh was announced last Friday as a candidate, as a nominee to chair the Federal Reserve, allaying some of the fears that the Fed could become very political. So I think gold's a bit of a hedge against everything. We still like it. We still think it will go to $6,000 an ounce over the course of the next 12 months. But of course, the volatility is eye-popping, and we don't expect the same kind of return, the same kind of Sharpe ratio, if you like, that we've seen, which I think may maybe reduce some of that demand for asset allocation. So that's our view.
You know,
So
whatever
still
you're worried about, I guess.
but concerned.
Yeah. So whatever you're worried about, essentially, buy gold. It's a hedge for everything. At least that's how investors are behaving. Francisco, really good to chat to you. Thank you so much for coming on. Francisco Blanch, Head of Global Commodities and Derivatives Research at Bank of America. Well, we're sticking to the oil theme today. Total Energies moving higher after slashing its buyback to $750 million in the first quarter of the year. That's after lower oil prices hit profits, fourth quarter net income dropping 13% year on year. For more, Mitchell Furman, our European oil majors reporter, joins us now. So let's start maybe with this lower share buyback. Is it simply down to lower oil prices, at least up until now? Because now, you know, we've seen the geopolitical premium being priced into the oil complex.
Yeah, for Total Energies, it is tied to the oil price. Late last year, Total guided the market that it would tie its share buyback to a Brent range of $60 to $70 per barrel. And so Total is kind of taking the position that the CEO this morning said that he doesn't know what will happen this year with oil prices. So this was a prudent move, he said, to shore up the balance sheet and protect it from any potential swings in price this year.
It's interesting to see the divergence in the way the market has taken the news out of Total Energies this morning. The stock is up versus BP yesterday. I guess BP speaks to perhaps a more broader structural move for the portfolio. But why has the reaction been a net positive for Total Energies on the news that they're cutting their buyback?
Yeah, Total told the market this was coming, right? So this was largely priced in. They gave a range, and this move was at the low end of that range. But investors were made aware that Total would be shrinking its buyback. BP investors, it's a larger story. BP's changing management. They've had years of underperformance, and the balance sheet needs significant repair in order to even embark on a growth story. So investors are also have no clue when BP will restore its buyback.
Yeah, I guess there's not a focus on cleaning up the balance sheet. How has debt featured in Total Energies today in their earnings report?
Yeah, debt fell for Total a little bit, and that's part of the story that Total is trying to tell, that this plan of cutting the buyback is to protect the balance sheet, in this year where a lot of folks are kind of projecting a oversupply in the market, but at the same time there is a geopolitical risk premium in oil prices, it's trading around $69 a barrel, and that's a much more comfortable position for the oil majors than at the low end of the range that Total gave last year of $60.
Yeah. Mitchell, really good to have you on. Thank you so much. Mitchell Furman, our European oil majors reporter. Well, Dassault Systèmes is the biggest faller on the Stock 600 after giving a weaker than expected sales growth forecast on top of fourth quarter earnings that missed estimates. The French software company saw its biggest intraday fall since 2002. Dassault has described the AI boom as an opportunity for its industrial software business. And Siemens Energy shares rose to a record high, driven by strong order growth for its gas turbines. The German manufacturer says it's on track for another year of rising revenues. Speaking to Bloomberg, CEO Christian Bruch said that he remains confident in the company's AI-linked order backlog.
The AI is the cream on the cake for us on the orders, and you have seen it in the gas turbine orders. It's roughly 25% of the order book today is related to data centers. But keep in mind that actually the industry was actually much more designed to be a 60 to 70 gigawatt market not so long ago, right? And now we look into 100 gigawatt markets, and that is really a lot driven by the data centers. But important to note is that a lot of orders actually come not from the data center side. The largest order on the gas turbine side this quarter has been Europe non-data center. So it's a little bit more diverse, the picture, but I'm super proud of what the team has achieved to really build a position from ourselves in the data center market.
Yeah, and look, we're admittedly slightly obsessed with the data center story, given all the ruptures we're seeing in the markets. Christian, what are the risks that order backlog, as substantial as it is not converted into sales? What kind of risk are you putting on that? As some out there question the spend and capex around data centers?
Yeah, first of all, I have to say, so far we see reservations converting more or less one-to-one into effective orders, and I have not seen any cancellations yet. I would always say, as much as I understand the question around, is there a bubble, is there risk in there, electricity will be needed. Might there be, let's say, ripples along the road in terms of companies are changing? Might be, right? But for us, delivering the underlying electricity to these data centers, I'm relatively comfortable looking forward that this power will be needed. The other question you always also have to ask ourselves, what if we cannot supply the electricity to the data centers? Because AI is going to be around us at whatever level, we're going to need it. So I think it's really important that we fuel that industry to grow and prosper. And in that regard, I feel comfortable if I look on our backlog on the AI side.
Christian Bruch, CEO of Siemens Energy, speaking to us earlier. Well, coming up, sell first, ask questions later. Wall Street's rising fear about AI is pummeling shares from software makers to wealth managers. We'll tell you more next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Asia is at the forefront of some of the world's biggest stories. I'm Sherry-Ann in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Heineken says it will cut about 7% of its global workforce, up to 6,000 jobs, to counter a slump in demand for alcohol. The Dutch brewers said total volumes fell 1.2% last year. The chief executive told Bloomberg he's seeing big differences between emerging and developed markets.
It's really a tale of two stories. We see our growth algorithm in emerging markets very much alive, where demographics, urbanization, GDP per capita is driving an increase in consumption. We have key markets like Vietnam, India, Ethiopia, South Africa, Latin America markets, which tap into that trend. The other tale, of course, is the more developed markets like Europe and North America, which seem more challenged and where bigger and bolder innovation is needed. Case in point being our Heineken 0.0, which locked in the 7th year of mid to high single-digit growth in the important US market.
Okay, good morning to you, Dolph. So if that's the story, emerging markets versus developed markets, is the alcohol moderation story in developed markets, is that going to result in you being more EM and alcohol-free focused as a business?
I think in a way these growth drivers have been there for a while. If you look to the focus of our M&A for the last 5-6 years, we did a big deal in India, which arguably is the biggest remaining opportunity for very fast growth. A big deal in Southern Africa with Distel and Namibian breweries. Very recently, very happy to close at the end of January our acquisition of Fifco in Central America. So we are deploying our additional capital in growth markets with good fundamentals. And in the more developed markets, it is really about premiumization, which remains very relevant, and we are a global leader. Low and no is still, on a global scale, a couple percent. In important European markets, already 5%. And key specific markets like Germany, the Netherlands, Spain, is already 10%. So we believe this low and no and 0.0 beer has still really years and years of growth ahead of it.
Dolph van der Brink, the CEO of Heineken there. Well, investors have been aggressively selling shares of traditional wealth managers and insurers over fears that new AI tools will quickly replace their core services. St. James's Palace in London is one of the biggest fallers, down around 10%. Now, it follows steep falls in the U.S. yesterday, with Schwab, Raymond James, and LPL Financial all falling after startup Altruist unveiled a tax strategy tool called Hazel. For more, we're joined by Matt Bloxham from Bloomberg Intelligence. This seems to be becoming a bit of a theme. Sell first, ask questions later, and now it's hitting the wealth management industry.
Yeah, I guess we're seeing a mirror of the kind of buy first, ask questions later trade that people put on when the AI theme was on the tear. And, you know, it's not surprising. I think a lot of the kind of marginal money that came into these kind of AI themed stocks was really done on perhaps not a huge amount of fundamental analysis, just kind of buying everything, hoping that the kind of rising tide favors all ships. But you know, I think what we're seeing here is a wake-up call for companies across any kind of service sector, is that you're behind the curve on AI and that you need to give the market a much clearer steer on what your AI strategy is. I think, you know, in the mid to long term, you would like to think that companies like this, St. James's Wealth, you know, all these wealth management companies can actually successfully integrate AI tools into their offerings to maintain their kind of market positions. But I think a lot of companies have been slow to do that. And, you know, without that clarity, investors are kind of, you know, rightly asking the question, you know, if you don't do something and do it quick, then maybe your business is in a lot bigger trouble than we thought.
Yeah, and sticking to the industry, huge capex spending plans. Alphabet raised billions of dollars yesterday, $20 billion in the US, $30 billion in total, a little bit more, to fund its AI capabilities. But the bond issuance was very well received by the market.
Yeah, it was, and I think that's an endorsement of Google's strategy and their position. Obviously, being a long-time leader in the tech market, there were, not so long ago, some kind of doubts about Google's exposure to the AI theme and the threat that ChatGPT posed to their big ads business, which is where they make most of their money. But Google's done an incredibly good job of integrating Gemini into existing tools, protecting its ad spend, growing the cloud business. So I think it's a ringing endorsement of the Google strategy that credit investors are prepared to back them so much.
Yeah, massively oversubscribed on those books, especially that 100-year sterling bond. That caught my attention as well. That was 10 times oversubscribed. So there you go. Matt Bloxham from Bloomberg Intelligence, thank you so much. Well, the big focus for investors today is going to be that jobs report. Let's take a look at how U.S. futures are shaping up as we head into the event. A little bit of green. Futures up 0.1%. The Dow up about 0.2. NASDAQ basically trading flattish. But it is going to be a market-moving event and a data point to watch out for. And, of course, it is delayed because of the shutdown. So that is happening later today. And then on Friday, we get CPI in the U.S. as well. But up next, Bloomberg Brief. This was The Pulse, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance. World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Bloomberg has learned that there are discussions around a potential all-cash offer for Warner's studio and streaming businesses.
For the past few years, we hadn't really seen any deals above $30 billion. And now we're seeing, Warner Brothers, $80 billion, the big railroad deal. And what we're hearing from sources is that next year we're going to see more of the same. It's just going to be the mega deal.
I would expect next year will be an even better year for M&A and IPOs.
That's just kind of what we do at Serena Ventures, is just kind of learn how we can fill in different gaps in different areas that are being missed. And by the way, these gaps tend to be really, really massive.
I know you've been very bullish on the return of M&A. Do you expect more deals, if they are of this size, to have the same sort of structure and contours?
I think we're going to see the return of large transactions, and I think they're going to avail themselves of both private credit options and public options.
There's a lot of merger talk. There's a lot of firepower.
Investors wanted to know at what price would this deal be, and now they answered that question at $70 a share.
So congratulations to Bloomberg's deals team for getting it first.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Countdown to the jobs report finally. Future is rising, the dollar slipping just a little ahead of the delayed January payrolls data. No quiet corners. AI disruption fears hit European wealth managers following a sell-off in U.S. peers. And Israeli Prime Minister Benjamin Netanyahu is set to meet President Trump at the White House to discuss Iran. So let's take a look at those futures. Well, NASDAQ 100 futures have flipped negative now, but we're looking at very small gains and declines this far out. Don't forget, yesterday we saw a drop of about 1/3% for the S&P 500, about 0.6% for the NASDAQ 100. So it's been a bit of a down week. Everything but tech is holding up this market. Small caps, utilities, real estate. Just pick your sector as long as it has nothing to do with tech. Let's take a look at the bond universe before, I guess, a widely anticipated jobs report. I mean, it's been delayed, but what will the data really tell us? 2-year yield at 3.44, the 10-year yield well below 4.20 again at 4.13, and that 30-year yield at 4.77. So we'll be keeping an eye on all of that data for the next few hours. But first, let's get to some individual market movers now. And for that, we'll go to London and Abir Abu Omar. Abir.
Good morning, Bonnie. Let's turn towards a story that ties in with crypto or Bitcoin. I've been talking a lot about Bitcoin this morning. Robinhood, with results yesterday, it's down over 7% in the pre-market trade this morning. And that is primarily because of their crypto business. It was down nearly 40% over the fourth quarter. And remember, Bonnie, Bitcoin, the weakness in Bitcoin has continued into this year. So the push that Robinhood has had into prediction markets makes sense. Turning into another stock that is a blast from the past. Well, I mean, it's not having a blast this morning. Mattel is down over 30% this morning. And this ties into the retail story that we saw coming out of the U.S. yesterday. The retail data over the last month of the year was pretty flat. That is what we saw, and that is reflected in Mattel's stock that did not really have good sales over the past quarter or the last quarter of the year. But on the upside of the market, the last stock that I'm looking at this morning is Cloudflare. The software provider is having a pretty good morning after results yesterday. Now, in contrast to what Cloudflare is doing this morning, we saw AI-related stocks in Europe not do very well on disruptions this morning. But this is the flip side in the U.S., where Cloudflare is doing good on earnings from yesterday, Vani.
Well, Abir, we will keep an eye on those stocks today. Thank you so much. That's Abir Abu Omar, and she's going to be back with us later in the program. Also coming up in this hour, we'll look ahead to the payrolls report with Jennifer McKeown of Capital Economics. Delayed January jobs report coming out later this morning then. Let's get a preview with Bloomberg's Michael McKee. So, Michael, the consensus seems to be around 65,000, but what would actually be outside any margin of error? What would be a surprise?
Well, that's the interesting question, and you put it well in the opening when you said, what are the data actually going to tell us? Let's take a look at the numbers that we do expect that will matter to the markets today. That 65,000 number could be boosted a bit by seasonal factors because the seasonals expect a lot of retailers to be laying off employees, but they didn't hire as many this holiday season, so they may not lay off as many, and we might have an artificial boost there. The other thing with the January estimate is that we don't know at this point what the break-even number is. The question you asked, Vani, there is, what's an acceptable number? Some analysts say now with the labor market shrinking, it could be as low as 35,000. And so that would be a very good number. Wall Street a little more pessimistic, expecting only 35,000 jobs. So you get a bigger number, and maybe you have a positive impact on Wall Street, especially if the unemployment rate should go down. We're expecting 4.4%, but it could round down to 4.3%. And a number we don't often look at, but has become very important right now, is the labor force change. Fell by 46,000 in December. Of course, with the president deporting as many people as possible, the labor force is shrinking, and that makes it much easier to get a neutral rate of employment where unemployment doesn't go up or down.
Well, Michael, we did seem to have a tone shift in Fed speak this week, and obviously markets are starting to price in at least a third rate cut this year, but that's not really in keeping with what we're hearing from this latest round of Fed speakers, right?
Well, you have to keep in mind that we rotate 4 new Fed Bank presidents into the voting rotation this year, including Beth Hammack and Lori Logan from Cleveland and Dallas, both of them speaking yesterday, both of them suggesting that they're not in any hurry at all to cut rates again. Here's Beth Hammack of Cleveland.
Rather than trying to fine-tune the funds rate, I'd prefer to err on the side of patience as we assess the impact of recent rate reductions and monitor how the economy performs. Based on my forecast, we could be on hold for quite some time.
And it's important to keep in mind that we'll have another set of jobs numbers and another set of inflation numbers before the Fed meets again in March. And one other thing everybody wants to keep an eye on today is we're going to have the annual benchmark revisions to payrolls through March of 2025, and they could reduce payrolls during the year leading up to March by as much as 900,000. And then you get seasonal adjustments for the last 6 months that could bring us down another 200,000. It would be the level, not the change, that we are looking at for a much lower number, but it would suggest weaker hiring. Whether that matters or not to the Fed, if the labor market is shrinking, we're going to have to find out. So it's going to be an interesting day, Bonnie, to try to see how equity and fixed income markets react to this.
Yeah, there's going to be a lot of signals, a lot of clues in this data. Michael, thank you. Looking forward to hearing from you again later. Turning to technology, European wealth managers falling after a drop in US peers over concerns of AI disruption from Altruist's new tool. It's not just wealth managers either. French software company Dassault Systèmes falling the most since its IPO in 1996 after weak guidance from fears of AI vulnerability. Joining us now is Tom McKenzie, host of Bloomberg Tech Europe. Tom, Ed Yardeni used to have this idea of a rolling recession. You know, he thought we were in a rolling recession in various parts of the market over the last few years. It seems like that's what we're getting now. Every time we get a new AI tool, we get this rolling pocket of weakness in some part of the tech sphere, right?
Yeah, look, it speaks to two things. And to your point, another day and another rupture across a sector that seems and feels threatened by what is happening on the AI front. But it does speak to these two aspects. One, the markets are clearly very anxious. Investors are anxious about what this disruption is going to look like. And number two, the pace of innovation coming through from companies, not just the large language models, not just the labs, not just the hyperscalers, but also other companies that are wrapping AI around their products or products around AI. That innovation is coming through at a rapid pace and is causing this kind of volatility. So we have the wealth managers, to your point, in focus today. You've got St. James's Place here in the UK. The last time I checked, that was down about 11%. You had Charles Schwab, of course, falling, 7-8% by the close yesterday. So stateside, the wealth managers were impacted. The concern at the top line, at least, is that if you have AI products, it can do your tax and accounting for you, if it can do some wealth management products for you and make decisions on your behalf, then maybe these companies are less valuable and their proposition is less valuable than they had been before. But a lot of investors we speak to say, look, this is also speaking to a kind of sell now, ask questions later theme and feel through these markets. And so for some, there'll be a buying opportunity for here. But you know, the investors we speak to say you'd have to be pretty brave at these rates, given the ruptures that we're seeing across software. And again, it's not just wealth management. To your point, we go back to what happened in the insurance sector, what happens in the legal sector, private credit. We should expect that this volatility and these ruptures continue, again, as more products are put on the market and challenge some of the assumptions we make about pricing and competitive moats.
Yeah, Tom, do we know anything about more AI tools in the pipeline that could pose a threat? Can we get ahead of this, perhaps, for some sectors?
Well, you just know that, you know, OpenAI and Anthropic, these are pre-IPO companies. They're under pressure at different levels and to different extents to monetize their massive spend and investment commitments that they're both making. And so you can expect that both those companies and others, the Googles and the Geminis of the world, are going to be coming through with additional products that, again, will challenge various different sectors or at least cause some volatility, leave some questioning the valuations on certain sectors and certain companies. So I don't have a time frame, I don't have a list of products that are coming through on the pipeline, but I think it's a fairly safe to assume that given the pressure these labs are under, that they are going to be coming through, pushing further into verticals much beyond the base foundation models, pushing further into verticals that will challenge different sectors and different companies. I think you can assume that. Dassault Systems is really interesting today. I mean, just like nosebleed levels for that French company. It makes industrial software for the auto space, for the pharma space, dropping the most, Vonnie, since its IPO. And part of that is a kind of triple whammy. They missed on earnings, they missed on the forecast for this year, and of course, they caught up in the broader software sell-off.
Tom, it is something to see each day coming in and watching these markets. That is Bloomberg's Tom McKenzie. Thank you. And do tune in to Bloomberg Tech Europe with Tom as he takes a deep dive into quantum computing. That's this Friday. Now to other top stories trending on the terminal this morning. At least 10 people have been killed and 25 injured in a mass shooting in northern British Columbia. It happened at Tumbler Ridge Secondary School yesterday afternoon. Police believe the suspected shooter died from a self-inflicted injury. The incident appears to rank as one of the deadliest mass shootings in Canadian history. The world's biggest nickel mine in Indonesia has been told to slash output. This as authorities step up efforts to boost global prices of the battery metal. PT Weda Bay nickel's ore production quota has been reduced to 12 million tons this year. That's down from 42 million last year. And the White House revised its fact sheet on the US-India trade agreement to adjust language around agricultural goods, further sparking confusion. The revised statement removed a reference to pulses, including lentils and chickpeas, and changed phrasing around India's offer to buy more American goods. Coming up, Prime Minister Benjamin Netanyahu prepares to meet President Trump. More on what the two leaders plan to discuss next. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. It's Jobs Day, and Bloomberg has the report under surveillance.
Where's the emphasis, on headline payrolls or on the unemployment rate?
I'm focused on the unemployment rate, as is the market.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
What we're seeing is certainly a growing labor force.
A labor market that actually could be improving.
The January Jobs Report, today on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Israeli Prime Minister Benjamin Netanyahu set to meet President Donald Trump at the White House today. He's expected to push for rolling back Iran's military activities in the Middle East and its ballistic missile program. Joining us now is Bloomberg's Onur Ant. Onur, obviously Netanyahu has a purpose in visiting Trump. He's going to try and influence him for when President Trump deals with the Iranians. What would Netanyahu consider a win?
Well, for the Israeli Prime Minister, the key priority is to push President Trump to keep his negotiations with Iranians broad, in the sense that they should not be just focusing on the nuclear enrichment issue, but as you said earlier, they want the U.S. to push Iran to limit its ballistic missile capabilities and sever its ties with militant groups in the region, namely Hamas in Gaza, Hezbollah in Lebanon, and the Houthis in Yemen. So this is going to be the key priority for Netanyahu going into these meetings. But the problem here is that although there have been some American officials that spoke along the same lines or similar lines over the past few weeks, we have seen that U.S. President Donald Trump himself said a narrow deal that looks at the nuclear enrichment issue alone with Iran could be acceptable for the U.S. So there's clearly a discord between Washington and its biggest ally in the Middle East on this matter. And this is why Netanyahu is going to, or has gone to Washington, D.C. to basically try and change the U.S. attitude toward these negotiations with Iran.
And Iran, for its part, has also said discussing proxies and discussing ballistics off the table, right, Onur? Moving to a different theater, Ukraine now, the Financial Times reporting that it's begun planning a presidential election alongside a vote on any kind of peace deal with Russia, and that President Trump has actually said this has to happen by May 15th or you lose your security guarantees. How does Volodymyr Zelensky manage this? Votes by May 15th?
Well, it's, yeah, as you said, this report alone is quite important because it's it marks possibly the single most important development since we have seen this build-up of U.S. pressure to push Ukraine to a peace deal or, as you said, risk losing proposed U.S. security guarantees. Now, there are two actually complicating factors for Kiev. First of all, how do you execute this election and the referendum on such an ambitious timeline during a time of warfare? But also, there is an added layer of complication for Zelensky, and that is the fact that the gaps between Russia and Ukraine for a peace between the two to be achieved remain very wide. There are certain issues that they have yet to agree on, and probably the single most important bit is that any such deal at this moment could involve or could force Ukraine to cede control of some territories, including the Donbass region, and that's something that Ukrainian President Zelensky has been adamantly opposed to since the beginning. So that those two factors really make the implementation of such an ambitious election plan or election timeline, it just makes it extremely difficult.
Yeah, there seems to be a huge rush on. Onur, we have to leave it there. Thank you so much. That is Bloomberg's Onur Ant, managing editor for Middle East and North Africa. Let's take a look at some commodities now, because we have New York crude still above $64 a barrel, Brent crude above $69 a barrel. So that calm that returned to the market after it looked like there might be some kind of an accord with the Iranians, I mean, it's there, but we're not seeing any huge sell-off. Gold back above $5,000. Look at that, up another 1% now. Coming up, Heineken plans to cut 7% of staff as beer slump weighs on the Dutch brewer. More on that next. This is Bloomberg.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Bloomberg Brief, I'm Bonnie Quinn in New York. Heineken gaining in Dutch trading after ending 2025 on an uptick boosted by a cost-saving program that saw the brewer cutting up to 6,000 jobs. Bloomberg spoke with CEO Dolf van den Brink earlier.
It's really a tale of two stories. We see our growth algorithm in emerging markets very much alive, where demographics, urbanization, GDP per capita is driving an increase in consumption. We have key markets like Vietnam, India, Ethiopia, South Africa, Latin America markets, which tap into that trend. The other tale, of course, is the more developed markets like Europe and North America, which seem more challenged and where bigger and bolder innovation is needed. Case in point being our Heineken 0.0, which locked in the 7th year of mid to high single-digit growth in the important US market.
Okay, good morning to you, Dolph. So if that's the story, emerging markets versus developed markets, is the alcohol moderation story in developed markets, is that going to result in you being more EM and alcohol-free focused as a business?
I think in a way these growth drivers have been there for a while. If you look to the focus of our M&A for the last 5-6 years, we did a big deal in India, which arguably is the biggest remaining opportunity for very fast growth. A big deal in Southern Africa with Distel Namibian breweries. Very recently, very happy to close at the end of January our acquisition of Fifco in Central America. So we are deploying our additional capital in growth markets with good fundamentals. And in the more developed markets, it is really about premiumization, which remains very relevant, and we are a global leader. Low and no is still, on a global scale, a couple percent. In important European markets, already 5%. And key specific markets like Germany, the Netherlands, Spain, is already 10%. So we believe this low and no and 0.0 beer has still really years and years of growth ahead of it.
Dolf van den Brink there, the CEO of Heineken. Time now for your front page news. First up, the Financial Times is reporting activist hedge fund Elliott Management has built a significant stake in the London Stock Exchange Group as it contends with fears of AI disruption and a lackluster listings market. The FT reports Elliott has encouraged the LSEG to consider launching a multi-billion-pound share buyback once the £1 billion launch tranche is completed, and to focus on closing the gap on margins compared with rivals. Next up, the Wall Street Journal is reporting activist investor Ancora has built a roughly $200 million stake in Warner Brothers Discovery and is planning to oppose Warner's deal with Netflix. The Journal reports Ancora believes Warner failed to adequately engage with Paramount Skydance, and has privately informed Warner CEO David Zaslav it's considering launching its own proxy fight if Warner's board doesn't negotiate the best deal for shareholders. And finally, on the front page of the Washington Post, a federal grand jury in D.C. refusing the Justice Department's attempt to indict 6 Democratic lawmakers over their comments to military service members. The Post says it's the latest rebuke of the Trump administration's push to prosecute the president's foes. Federal prosecutors last year launched an investigation into the lawmakers, all of whom served in the military or with intelligence agencies, after they released a short video advising current military members to reject, quote, illegal orders. All right, let's take a look at these markets. We have a few hours to go before the delayed January jobs data and, more importantly, perhaps, before the 2025 benchmark revisions. Futures are going nowhere after the S&P 500 was down about 0.33%. Still up on the year, though, in February. We have a little weakness to the US dollar, as you can imagine. A day like today, you might see that, but also we are seeing continued strength for the Japanese yen. And then we have the 10-year yield just down a basis point. Tiny little bit of a bid into treasuries there at 413.08. Let's take a look at Bitcoin. We haven't looked at Bitcoin so far today. We are hearing reports of whales perhaps getting back into the market, but we're still trading around $66,000 a coin. So we are still in that sort of sub $70,000 range. All right, coming up, we're going to push ahead to that jobs report. We'll speak with Jennifer McKeown of Capital Economics. This is Bloomberg.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg. It's 5:30 a.m. in New York City. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Well, it is countdown to the jobs report. Futures are deciding what direction to take. The dollar a little weaker ahead of the delayed January payrolls data and those revisions. No quiet corners. AI disruption fears hit European wealth managers following a sell-off in their U.S. peers. And Israeli Prime Minister Benjamin Netanyahu set to meet President Trump at the White House to discuss Iran. So let's take a look at those futures then. After a little bit of a sell-off yesterday, trying to decide which direction to go, but Russell 2000 futures are sure they're going higher. After all, small caps have been some of the leaders. Anything but tech, really, over the past few sessions. In particular, every time a new AI tool comes out, it sends fear and panic into certain corners of the market. Let's take a look at the bond market, because that curve, of course, came down towards the end of last week, and it's staying down there. It's at 344.57 on the 2-year, all the way out to 477.19 on the 30-year, with swaps pricing in the potential now for a third rate cut this year, ever so slightly. Let's get a look at some individual stocks to watch now. Over to London and Abir Abu Omar. Abir.
Hi, Vonnie. Let's start with Robinhood, the online brokerage firm. This ties into the macro story of what crypto is doing, right? I mean, Bitcoin was down quite a bit over the past month. It was down over the fourth quarter, and this is what Robinhood is saying is primarily the reason behind their disappointing earnings yesterday. Actually, crypto revenues in Robinhood were nearly 40% down over the fourth quarter. So it really makes sense that the company has turned a little bit towards prediction markets and putting their investment there. That was the best performing business. Second stock we're taking a look at this morning is Mattel, which is doing pretty terribly this morning in the pre-market. Vonnie, down nearly 31% on disappointing sales over the Christmas period. Now, when a toy maker, when the Barbie maker is posting disappointing earnings on Christmas, that tells you that it's a really terrible story for investors, and that's why the stock is down this morning. And finally, we're taking a look at Lyft. The stock is down. It was down about 17%. It's down a little bit more now in the pre-market trade. It is also an earnings story quite similar to the earnings that we saw from Uber. It's much larger competitor, but also investors are quite, jittery when it comes to the disrupting tech that is coming to these ride-sharing apps, primarily robo-taxis. So this is creating some weakness in Lyft this morning. Vonnie.
Those are gargantuan moves. Gosh, this market doesn't play around. Abu, thank you. That is Abir Abu Omar. We're 3 hours away from January payrolls, plus, of course, 2025 revisions. Let's bring in Stuart Paul of Bloomberg Economics for a preview. So, Stuart, the consensus is 65,000. The whisper number is more like 35,000. What's Bloomberg Economics?
I think both the whisper number and the consensus forecast are way too high. We think that it's going to be even below 10,000 jobs added in the month of January. I think folks are really failing to incorporate the updated birth-death model at the Bureau of Labor Statistics that estimates basically the number of companies that are born and the number of companies that go bankrupt, and as a consequence, the number of jobs that are created on net each month from that business dynamism. When that process is revised, it's going to strip out about 30,000 jobs per month that had been propping up the typical monthly flow of job creation. And I think that that's why we saw comments from White House NEC Director Kevin Hassett, from Peter Navarro, trying to talk markets down from expectations of such a high jobs print. I think 70,000 or even 40,000 on the whisper is way too high. It's going to be closer to zero.
Worst case scenario, say it is zero. Say it's minus. Hell, why not, right? Is that enough to cause the Fed to start worrying again? I mean, the difference of 30, 40,000 in a typical month and a typical year wouldn't really be that much outside the margin of error.
I think for a single month's print, it wouldn't drive the Fed to change its mind about rate cuts in the near term. I think if we were to see an uptick in the unemployment rate back to 4.5 or even higher, that would get the Fed to move. I think that for the rest of the market, though, for folks who think that the labor market is outright tight, this is going to be a wake-up call. When we see revisions, when we see a re-estimation of the birth-death model, and we see a slower flow throughout 26 of net jobs created each month, I think it's going to be a real wake-up call. But for the Fed, it's all about the unemployment rate.
So the fact that swaps are pricing in a third quarter point cut this year and 2 by September, is that more a function of President Trump saying, interest rates should be the lowest in the world, they should be at least 2 points lower than they are, or is it actual data and the idea that we might have serious revisions to last?
I think part of it is about the revisions. I think some people, as we saw in the bond market, some folks are starting to understand that the labor market is cooler than previously believed. I do think that politics are playing a big role. Part of the pricing in of an additional cut in 2 by September is the expectation that political pressure on the Fed and the confirmation of soon-to-be Chairman Warsh will result in additional cuts this year. We think that it's possible that we get even a fourth cut this year if we see the turning over of inflation that we think is going on right now. Once we get past January, I expect we'll see a real coming off of goods inflation.
What makes you so confident, given that we are still seeing companies report tariff pass-through inflation?
So we're still seeing it at least through January, but we're seeing a much narrower breadth of discussions about price pressures, of any sort of input cost pressures. It was interesting when we saw PMIs, Vonnie, that there was a little bit of a stronger than usual January bump up in prices, and it seems as though companies are taking the opportunity with cover from tariffs to raise prices to catch up just a little bit. But beyond that, when we screen through 17,000 earnings transcripts, it looks as though discussions of price pressures are fading pretty materially. So as much as we hear about it sort of in high-profile stories, the breadth of discussion about it is actually narrowing pretty swiftly.
Stuart, thank you so much. Looking forward to seeing what that number is and what all the numbers are later on. That is Stuart Paul of Bloomberg Economics. Jennifer McKeown of Capital Economics looking at 30,000 jobs created in January at the lower end of estimates, although not quite at the Bloomberg Economics end. As for the revisions, she's seeing the average monthly change in payrolls of 49,000 in 2025 to be revised down to show a change of between minus 25,000 and zero. Jennifer is Chief Global Economist at Capital Economics, and she joins us now. So, Jennifer, do you agree with what Stuart just said? Are those all the reasons why you see weaker jobs?
Yeah, I agree with a lot of what Stuart's just said for sure, and that these revisions and the change to the birth-death model are really going to make this report much harder to read than usual. I think Stuart's right that there will be some shock out there about a relatively soft print. Some people may not have foreseen either the change to the birth-death model, which will affect the January number, or the incorporation of actual data from the quarterly census of employment and wages, which will affect how business births and deaths are incorporated throughout 2025. So as you were just saying there, we were expecting some really significant downward revisions as a result of that, which might come as a bit of a shock as well.
Well, Paul Donovan of UBS made a good point this morning talking about those revisions. He said that they'll bring the data closer to reality, but that won't change the narrative that the employment reality last year was consistent with a low fear of unemployment and consumers willing to cut savings to pay for tariffs. So even if we do get, much more negative numbers for last year, what does it matter in some ways?
I think that's right to an extent, Vonnie, because we've already seen from the household survey that employment looked to be significantly softer than the non-farm payrolls data were implying. So this doesn't come completely out of the blue. There were already other closely watched indicators out there that were pointing to a softer labour market. So I don't think it changes things dramatically. I think one thing that will be really interesting is whether in the profile, when we take those revisions together with the January outturn, is the profile going to show something of a pickup coming into January, albeit from a softer start point than we'd previously assumed? If that pickup is there, and we are seeing it in the household survey, then that should give the Fed some comfort that while the labour market has been softer, it is starting to recover. And that's something that Lisa Cook, one of the more hawkish members, has been suggesting, that yes, the labour market has been a bit soft, but that it is starting to recover. And that means that you don't need many more rate cuts, whereas, of course, Christopher Waller, Michelle Bowman are pointing much more to that weakness as justifying the rate cuts. So I think the profile is going to be really interesting.
Yeah, I mean, we have, 5 meetings between now and September, and the market is saying by then we'll already have seen 2 cuts. Does it matter when they come, if that's the case?
I don't know if it matters very much when they come. It certainly matters if they come, and I doubt that both of them will. Our assumption is that we only get 1 rate cut from the Fed this year, and only then once we have a new chair. So I think that would come as a bit of a surprise. It's likely to push up yields a bit as markets come to that realisation. It might help to support the dollar too.
You mentioned Lisa Cook and Tom Barkin, but there is a big split on the board, and obviously inflation concerns haven't gone away. Let's take a listen to what Beth Hammack had to say.
Rather than trying to fine-tune the funds rate, I'd prefer to err on the side of patience as we assess the impact of recent rate reductions and monitor how the economy performs. Based on my forecast, we could be on hold for quite some time.
On hold for quite some time. That is very much at odds with what a lot of market participants and very many members of the board think, Jennifer. So how do we find a middle ground? How does the FOMC find a middle ground?
Well, it's just going to be watching the data very closely, isn't it? And particularly those data on the labour market to try and judge whether things are weakening or whether the strength of broader activity, and particularly this kind of AI investment optimism, is driving demand up and perhaps putting some heat into the US economy. Our view is that it will probably be more the former. And with interest rates already quite close to the neutral or equilibrium, it's not surprising that that a greater divide is emerging on the FOMC. But I think there's not really going to be any justification from the US economy to bring rates significantly down below that kind of neutral level.
Well, Jennifer, we'll have more clarity a little bit later on, at least about the jobs data for the last few months anyway. That is Jennifer McKeown of Capital Economics, and thanks for joining. Now to other top stories trending on the terminal this morning. At least 10 people are dead and 25 injured in a mass shooting in northern British Columbia. The shooting happened at Tumbler Ridge Secondary School Tuesday afternoon. Police believe the suspected shooter died from a self-inflicted injury. The incident appears to rank as one of the deadliest mass shootings in Canadian history. The world's biggest nickel mine in Indonesia has been told to slash output. This as authorities step up efforts to boost global prices of the battery metal. PT Weda Bay nickel's ore producing quota has been reduced to 12 million tonnes this year from 42 million last year. Two co-founders of Elon Musk's artificial intelligence startup XAI are leaving the company after less than 3 years. Jimmy Ba and Tony Wu's departure mean half of XAI's founding members have now left. Their exits follow XAI's recent merger with SpaceX. Coming up, Prime Minister Benjamin Netanyahu and President Trump prepare to meet in Washington. More on what's on the top of that agenda next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Talks in the Middle East ongoing. Qatar is saying that the nation's leader and President Trump held a call to de-escalate tensions in the region. This as Israeli Prime Minister Benjamin Netanyahu is set to meet with President Trump today at the White House. Before departing Israel, he said indirect U.S. diplomacy with Iran tops his agenda, saying, quote, excuse me, I will present to the president our views regarding the principles of the negotiation. Joining us now is Bloomberg's Tyler Kendall. Tyler, what will Netanyahu try to get across to President Trump that President Trump doesn't know already?
Yeah, hey, Vani, good morning. Well, there's actually reports that the Israeli Prime Minister Benjamin Netanyahu will present President Trump with new military intelligence regarding Iran's military capabilities as he tries to push President Trump to extract more concessions on the table when it comes to U.S.-Iran negotiations. This will mark Netanyahu's 7th visit to the White House under the second Trump administration, as he's going to try to pull on that personal relationship as these talks move forward. Now, Netanyahu's visit to the White House comes after a flurry of diplomatic activity last week. We saw Netanyahu meet in Jerusalem with Special Envoy Steve Witkoff, as well as the president's son-in-law, Jared Kushner, who are leading the bilateral negotiations between the U.S. and Iran, which kicked off on Friday, and both sides characterized as being relatively positive. Still, we know that they went into the meeting with perhaps contrasting parameters. Iran had gotten its request to keep these negotiations bilateral and only focused on its nuclear program. But we know the U.S. as well as Israel is really looking for these talks to expand. They also want to see them address Iran's ballistic missile program as well as its support for proxy militia groups in the region. And we know the U.S. wants to bring in some other regional partners so that there can be perhaps more discussion when it comes to regional stability in the region. This is something that White House officials have repeatedly said, that they want to make sure that there is more of a coalition involved in these discussions for there to be perhaps more of a lasting scenario here. So with all of this said, we heard in an interview yesterday, President Trump said that he maintains diplomacy is on the table. He maintains that he thinks Iran wants to make a deal, but he ultimately alluded to this idea that there is still the potential for military strikes. In fact, our own analyst, Vani, at Bloomberg Economics, say that that likelihood is pretty high, particularly as we heard President Trump tell Axios yesterday that he could send a second armada to the Middle East amid what has been a major bolstering of U.S. military assets in the region.
And then domestically, President Trump's facing a little bit of pressure too. The House talking about voting against some tariffs. Tyler, take us through this. What can the House do?
So this is actually a blow to House Speaker Mike Johnson, Vani, who has been trying to shield his members from taking politically fraught votes. And it is setting up a potential rebuke for President Trump on one of his signature policies as we head into midterm campaigns and the election later this year. I won't get too into the weeds of what happened, but late last night, we essentially saw 3 Republicans cross party lines and block an attempt from Mike Johnson to block a vote on the president's tariffs. This is now setting up procedurally in the House that we could see votes as early as today rebuking the president's policy, potentially repealing the first vote that's going to be up, his tariffs lobbied against Canada on an emergency basis. And I will quickly add, if we look at the 3 Republicans that crossed party lines, they really represent different factions of the Republican Party. You have somebody like Thomas Massie, who has been very outspoken against the president, also somebody who's in a competitive district in California. So it really spans this. Vani, we'll have to see where it ultimately goes.
Yeah, we'll watch throughout the day. No doubt there'll be some developments. Tyler, thank you. That is Bloomberg's Tyler Kendall. Turning to tech now, and European stocks are lower with wealth management stocks struggling after an AI tool aimed at creating tax strategies sparked a sell-off in its US peers. AI fears also hitting French software company Dassault Systèmes, which fell the most since its IPO in 1996 after issuing weak guidance. Joining us now is Matt Bloxham of Bloomberg Intelligence. Matt, can we expect this across industries as more AI tools roll out? I mean, AI has been in all of these industries for the longest time. Is it just that these shiny new tools are creating panic?
Yeah, I think they are to a degree, and I think it should be a very loud wake-up call to management teams across pretty much every sector, to be honest, that you need to double down on what your AI strategy is and get going with implementation if AI needs to be an important part of your business going forward. And I think this tax planning tool from Altruist Technologies is a good example of how established industries face the threat of being quite significantly disrupted, but there's still a big opportunity for the established companies like people like Charles Schwab to defend their leading positions by having a clear strategy on AI and making that very transparent and clearly communicated to the investor community so that they kind of feel reassured and confident in the outlook.
Yeah, because you wouldn't have thought that one company, Altruist, would have such a wide moat, right? That not only would there be no competitors to it, but all the established players are sort of taking a nosedive. It's all very, very strange. What other tools are in the pipeline or might be in the pipeline that are going to scare away investors?
Yeah, it's a good question. I mean, I think obviously some of the areas that kind of seem ripe for disruption are travel, for example, and obviously people already use AI assistants quite heavily for travel planning, but most people are kind of doing that just through ChatGPT or Gemini. And if you think of the likes of all the kind of big travel planning websites and online platforms, you could easily see some kind of new tools come there that kind of integrate all of that stuff and offer a compelling alternative to consumers. And again, there's still an opportunity for those existing platforms to evolve their offering and offer the same kind of services, but it's a question of speed and minimizing the risk that a disruptive new entrant can grab share and really become the new leader of the future.
Yeah, and how long is it going to take for some of these CEOs to come out and defend their own products, right?
Yeah.
Matt, thank you so much. Matt Bloxham of Bloomberg Intelligence. Coming up, jobs report front and center today. Your day ahead is next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg. Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now look at what's ahead today. We do have consumer earnings. They're continuing with Kraft Heinz and also Hilton before the bell. Then, of course, the main event, delayed January payrolls at 8:30 a.m. Eastern, and, of course, revisions to all of last year's benchmark revisions there. And President Trump and Prime Minister Benjamin Netanyahu meeting in Washington today a little later on. Let's take a look at some micro movers before the open. Robinhood down almost 8% now. That's a year-end crypto rout story, basically denting its revenue. Lyft down a whopping 18%. It disappointed with its forecast, and it had a surprise revenue miss, in fact. And Mattel down by almost a third, wiping out nearly a third of its market cap. Its holiday results missed estimates, and that was a massive surprise. Let's take a look at the macro environment before Jobs Wednesday. We have nothing really happening with futures, a little bit of weakness for the US dollar, and we have just a little strength in treasuries, but not a huge amount of movement. If anything, yields are just coming off a very little bit. Once again, we have a stronger yen today, as well as that yen just keeps strengthening after Takaichi's really hold on power, much stronger hold on power. So that has something to do with that story as well today. Anyway, that's it for Bloomberg Brief. We're going to be continuing to watch out for that economic data at 8:30 Eastern and banging the drum right up to that data. Surveillance will continue that conversation next. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is not an economy that requires a significant amount of job growth behind it.
Jobs is a challenge, as I think wage growth will be a challenge.
We're not concerned we're going to see a spike in the unemployment rate.
The labor market is softer than what might have appeared up till now.
I don't know if the market's ready for seeing a negative print.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday, it's Payrolls Wednesday. Economists are looking for payrolls growth to hit 65K as weaker than expected data is keeping a bid in bonds, and the president is setting the bar sky high for growth this year. We begin this hour bracing for a delayed jobs report following a string of weaker than expected data from jobless claims to retail sales and a market-moving statement from the president's economic advisor, Kevin Hassett. One shouldn't panic if you see a sequence of numbers that are lower than you're used to, setting the tone for smaller numbers in the months ahead.
And setting a tone for sudden fears that maybe the U.S. economy isn't quite as strong as people previously expected. We came into this week with this feeling that it was all sunshine and rainbows, with $650 billion of capital expenditures coming from the big hyperscalers. It was going to create nirvana of economic growth in the United States. And then suddenly, bam, we get the 1-2 punch yesterday of retail sales and delinquencies. And then all of a sudden, we have expectations for a weaker jobs report, which raises the question, are we underestimating potential weakness in this economy that could stymie some of the hopes and dreams?
Well, let's pick out one data point, the employment cost index. And I think that's an important one. So I think there are obvious supply-side factors at work, which is what Kevin Hassett is giving a nod to. We can explain away this story. The break-even rate is lower. It's contributed to that. I get all of that. But the obvious tell at the moment, to tell, I think, historically as to whether a labour market is loose or tight, our employment costs. And employment costs were softer than expected. And I think it's difficult to construct an argument that coming into this year, this labour market has been tightening instead of loosening.
And this is something that we've heard from a lot of economists, that if you want to understand exactly what the dynamic is in the labor market, take a look at how much they're paying people. And guess what? They're essentially not raising wages. And you can see that actually the jobs that are being gained are not the high quality ones that are paying people a lot of money. This is the reason why the Chris Wallers of the world are very concerned. You've got the Fed potentially pricing in, at least according to market expectations, more rate cuts. A real question, though, of whether this is structural, whether this is cyclical, and at what point it will bleed into some of the market-moving offense that we've seen, which really has been driven by CapEx.
Well, it's driving a big move in the bond market, let's put it that way. Yields are lower once again. We're down by a basis point, 413 on 10s. New lows for the year off the back of this weaker than expected economic data. That's the bond market. In stocks, a few things to track. Charles Schwab and the wealth management firms. The AI disruption continues. It cascades through the equity market and reaches a new place. These stocks are trying to recover following a dire day yesterday and the introduction of just a tax management tool enough to upset some of the individuals in those names.
I love that even the CEO of Altruist, which is the closely held company that came out with this algorithm to have personal planning programs, said he was really surprised by the move, but great, we welcome it. And guess what? We're raising money. I mean, look, there is a question of how much this is almost like a witch hunt because we don't understand exactly what some of this technology is going to deliver. So sell first and examine later. And that ultimately expresses some of the rotations that we've seen with people, just a knee-jerk response to shed any risk to any disruption. Well, guess what? We're all getting disrupted. The question is how, and the question is how significantly.
In 2 hours' time, Rick Wurster, the Charles Schwab CEO and president, joining us a little bit later this morning. Look out for that conversation. Can't wait, right here on Bloomberg Surveillance. Equity futures on the S&P just about turning positive on the S&P 500, firmer by close to 0.1%. Coming up this hour, we'll catch up with Stuart Kaiser of Citi with stocks within 1% of all-time highs. Scott Lincecum of the Cato Institute joins us as Congress splits over President Trump's tariffs, and Steve Englander of Standard Chartered calling for a street-low negative payrolls print. We begin this hour with stocks little changed ahead of the payrolls report. Stuart Kaiser of Citi calling for an above consensus 135 and the unemployment rate to stay unchanged, writing the following: the market rotation has been powerful and prolonged, but will have space to run. Stuart joins us now from what? Stu, good morning.
Hey, good morning.
What's going to sustain that move?
The rotation? Look, I think honestly the rotation's been going in the direction that most investors wanted it to be going, to be honest with you. Since probably November, people have been kind of selling large cap growth and kind of rotating into value, and particularly into cyclicals because anticipation of the stimulus and a strong U.S. economy. So we think there's space to go there. You also have to remember that the positioning in large cap tech and growth had built up over 2 to 5 years. This is a massive positioning in the market. You're not going to sort that out in 4 to 6 weeks. So I think if the economy remains solid and people want to be in that cyclical part of the market, it can keep going. What happened last week or the week before really is it was not the direction of travel on that trade, it was the speed and bumpiness of that. And I think that speed and bumpiness kind of created a little bit of a risk shock, both to quants and to some long-short fundamental funds. And that's really what happened. It wasn't that people didn't want to be in cyclicals. They made a lot of money in cyclicals in January. It was that the trade just got a little bit too hard.
There was a big if that you used just then, if the economy remains solid. So let's get into that. Is the incoming data beginning to undermine the trade?
It depends which one you look at. Our City Economic Surprise Index is in very, very, very strongly positive territory. Atlanta Fed GDP is tracking kind of mid-4s, which is very solid growth. The unemployment rate's at 4.4%. To your point, retail sales was weak. You had Challenger, you had Jolts, you had claims last week. All that kind of second-tier employment data was a little soft. So I think by and large, if you believe in just like the Atlanta GDP tracking, the economy still looks pretty solid. People still want to see this tax refund data, which hopefully the IRS will release at some point. But so it's a mixed bag. But as you mentioned with what Hassett was saying, if you're trending at 50K, let's say, as break even on jobs, that data looks weak based on our historical standard, but if that's the break-even rate, then if you're printing kind of sub 100K, it's not a weakening economy necessarily.
So if you try to sort of distill fact from noise, I'm just wondering, what's the threshold to undercut some of the argument of some sort of economic recovery that's been underpinning the cyclicals, right? I mean, it isn't just rate cuts at this point, it is some sort of recovery. What kind of data would you have to get to really undercut that argument based on the fact that so far what we've gotten doesn't seem to shake it for you?
Look, I think it's the unemployment rate. If I had to boil it down to one number, honestly, if there's 3 things you can tell me ahead of time this year that I would like to know, would be unemployment rate, average size of the tax refunds, and OpenAI revenues. if I could know those 3 things in advance, I'd probably resign and just manage my own PA. But I think ultimately this boils down to the labor market. If people have jobs, the spending is going to kind of continue, and if the arms race in AI is close, if these models are kind of within, a competitive range of each other, all of that CapEx spending you talked about, you stay in that arms race.
Let's talk about the OpenAI revenues, because that's actually really interesting, especially in light of some of the disruption that we're seeing in equity valuations. I'm just wondering, how do you distill what's reality and what's potentially fear that's getting baked in? How do you value something that seems to be so undiscoverable right now, which is the potential of some of these algorithmic, large language models?
You ask AI, of course. And
I've tried. It hasn't come up with a conclusive answer. It depends which engine you look.
Look, I think that, the issue here for a lot of folks is, especially in the software space, some of these stocks are viewed as having very low and potentially zero kind of terminal values, right? And if that's the game you're playing, that is a very high-risk, game to play. And I think what you've seen recently with some of these new announcements is, hey, I thought that company might be terminally at 0 5 to 7 or 10 years from now. And now the stuff has moved so quick, it's like, uh-oh, what if that 0 or whatever terminal value is actually 3 years away? That has a massive impact on your ability to kind of own these stocks and see them. I think the market is probably overreacting a little bit to some of these stocks being full-time zeros. Like, any given company, I can use AI and I can build my own HR software, but do I want to be an HR software company? Like, no, I'm a bank, or no, I'm an industrial. So, there is a limit here to, if the business is so bad that I can just rebuild it in a month on AI, why would I want to be that business? Like, I want to be my business and I just want to save some money there. So I think the question here are these things zeros? It's what's happening to their margins and what's happening to their long-term revenue outlook, and how do I value that? And to your point, that is so uncertain. That you either need to do it through options or through a basket of stocks, because putting all your chips behind 1 or 2 of these it's a tough game.
We were spooked 12 months ago as well. Is this a deep-seek head fake, or is this the real deal, something that constrains multiples for the year out?
It feels a little more DeepSeek-ish, for now, just given how much the market's kind of recovered in the same way. The scary part about DeepSeek was that was the shot across the bow, and then a month later, we were at all-time highs, and then a week later, we were down 10%, right? So, like, the sequencing of last year's DeepSeek event was a pretty tough one. It feels a little more DeepSeek-ish, but you're definitely seeing a change, A, in the reaction function to AI headlines, and B, like, how people want to want to have that risk on. They've stepped away from owning the spenders and wanting to be in the spendees. And really, I think, increasing the risk on the victims.
So certainly the CapEx numbers now are higher than they were 12 months ago, without a doubt. The enablers is where a lot of people wanted to go, the chip players. How well understood is that story now, and how well priced is it?
The question there, I think, ultimately is just like power usage and intensity in the end, right? Like in the sense, like, so let's say take Amazon, for example. If I don't like that they're spending $200 billion because I think that's too much to spend, well, I must love whoever they're giving that $200 billion to, right? Because they're overspending. You know, the enablers and the memory stocks, the semis, et cetera. You know, we like AI power gen, first off, that's what we like to do it. But again, that also has a tail risk to it. Because if ultimately I need slightly fewer chips or slightly less power, that thing also kind of collapses on itself. So all of these trades right now are so sort of knife edge, and I think that's why you're seeing these intense reactions to them.
Do you think deceleration in CapEx numbers starts to matter? Deceleration in growth of these CapEx numbers starts to matter this year?
I think it depends what the message is on that. If it's, hey, you know, we did a massive upfront CapEx spending investment, and now we can enter a glide path, let's say, where CapEx is X% of my free cash flow or X% of my revenue, and we're seeing like a way to monetize that, I think that's a very positive message. If the market forces it, the way the market forced Meta to cut spending on the metaverse, you know, X number of years ago, and so it's kind of like, how is that message? I would actually wish these companies would say, don't put a 200 billion number out. Say we are spending X% of our revenues or X% of our net income on this for the next 3 to 5 years because we think it's a massive investment opportunity. The market, I think, you know, got a little bit concerned that, you know, Amazon is negative free cash flow in their own forecast, not in our forecast, in their own forecast. So it's an issue here. Yeah.
I bring this up because UBS put out this note yesterday that CapEx growth is likely to moderate from these levels, which could improve investor perceptions of those doing the spending, but is a potential negative for some of the companies in the enabling layer. That's really the heart of the issue at the moment.
Yeah, how much do you actually get money going to NVIDIA? How much do you get money going to some of the other chip players? How much do you get money going to some of the infrastructure plays? Look, this is the reason why this is such a perilous bet. And this is the reason why you're seeing some of these massive trillion-dollar stocks trade like penny stocks, because ultimately there's so many unknowables, and the scale of these unknowables are massive.
Stu, just quickly, leadership has changed.
Yep.
That is quite obvious over the last several months. Through last year, payrolls didn't really matter at the index level, given the contribution that came from names that weren't sensitive to payrolls. As that starts to change with the shift in leadership, do we become more sensitive to the incoming data, like payrolls at 8:30?
I think we do because, you know, to your point, last year you were in these large cap growth stocks. Now you're in a more cyclical, economically sensitive stock. So in theory, yeah, the market leadership should be more sensitive to weak economic data than it has been. And I can tell you, investor sentiment is going to be much more sensitive to this because coming into the year, we liked that cyclical play, and investors, I think, piled into it. 2 weeks into the year, we were getting questions of, is it time to monetize this? I mean, that's how sort of jumpy people are about this. So yeah, I do think payrolls in particular, but the unemployment rate specifically, I think, you know, is going to be much more impactful than it had been the last.
The bull case is the consensus view. And the bull case hinges on tax refunds, to your point, the economy holding up because of the monetary policy cuts we've already had from the Federal Reserve. And on top of that, the CapEx spend. Now, how strong is that confidence, that conviction level? Because it feels like every time we just get a bit of data that pushes back and pokes a hole in it, things start to unravel pretty quickly.
It feels like people have a lack of understanding of exactly where this economy is going. If we're depending on tax refunds and we don't understand the scope of them, and we don't understand whether people are spending them, and we don't understand whether that will sustain some of the retail sales that clearly were pretty weak heading into year end, well, clearly people are getting pretty jumpy right now.
Equities this morning positive by 1/10%. Stuart, it's good to see you. Thank you, sir. Stuart Kaiser of Citi, the jobs report later this morning, 8:30 Eastern Time. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Here's Yahara Arnold. Hey, Yahara.
Hey there, John. Good morning. The House set to vote today on whether to reject some of President Trump's tariff policies, starting with a resolution opposing the president's tariffs on Canada. Speaker Mike Johnson has been using legislative procedures to delay these votes, but 3 Republicans joined with Democrats in blocking his latest attempt. TSMC shares on the rise in Chinese trading. The company's January sales grew at their fastest pace in months. The chipmaker reporting a 37% rise in January revenue. That was way better than 30% revenue growth it expected for the full year. The fight for Warner Brothers Discovery is heating up again. The Wall Street Journal reporting that activist investor Ancora Holdings has amassed a stake in Warner Brothers. The size of the position currently unknown, but Ancora reportedly planning to oppose the plan to sell its assets to Netflix. Warner Brothers has remained opposed to recent offers from Paramount Skydance. And that's your Bloomberg Brief. John.
Vonnie, thank you. My apologies for that. Vonnie Quinn on our briefs this morning. Up next on the program, pushing for tariffs.
Tariffs are very important. I'm taking in hundreds of billions of dollars in tariff money. And we're going to start paying down debt. This country has never been so strong.
That conversation up next with Scott Lincecum of the Cato Institute, live from New York City this morning. Good morning.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
The winning streak ends in yesterday's session. Equity futures bouncing back by about 0.1% on the S&P 500. The main event later this morning, about 2 hours away. The jobs report looking for something around 65K. We've talked about a wide range for a week now, given how delayed this is. We're looking for something between 135,000 and negative 10K, if that's helpful.
And that could be good and it could be bad because ultimately we don't exactly know what those numbers mean. We're also getting the benchmark revisions to the quarterly household survey from last year. This is important because we found out yesterday that the momentum heading into the end of the year was less than we expected coming from retail sales. Do you get a similar read-through when it comes to some of the revisions in the labor market?
Governor Waller looking for what? Zero zip nada?
Yeah.
His words. It's not pretty, is it?
It's the reason why he has been so dovish and really calling for rate cuts. And ultimately, you're seeing a lot of pushback from other Fed members, in particular Lloyd Logan, in particular Beth Hammack. How much do you get consensus to cut rates in time based on what markets are expecting right now? They're bringing forward the potential for an April rate cut. It shows you where their minds are.
Bond yields coming in just a little bit. On a 10-year maturity, we're down another basis point, 413. Under surveillance this morning, pushing for tariffs.
Tariffs are very important. I'm taking in hundreds of billions of dollars in tariff money. And we're going to start paying down debt. This country has never been so strong. I just hope the Supreme Court does what's right for the country because now, will I figure something out? But the answer is yes. But it won't be as beautiful as it is right now.
So here's the latest this morning. House lawmakers set to vote on the fate of President Donald Trump's tariffs on Canada. A trio of Republicans joining Democrats calling for the vote. Bloomberg's Tyler Kendall joins us now from Washington for more. Hey, Tyler.
Yeah, hey, John, good morning. Well, this is paving the way for lawmakers to potentially rebuke one of President Trump's signature economic policies as we head into the midterms. We are expecting a vote as early as today that would look to repeal the tariffs lobbied against Canada on an emergency basis. Just as an aside, that is, of course, interesting timing considering the escalation recently between the two countries. But this is expected to be the first in what is likely going to be a series of votes over the next few weeks and months targeting the president's tariff policies, and really marks a defeat for House Speaker Mike Johnson, who has spent the last year trying to prevent his members from taking politically fraught votes on the tariff issue. Now, as we look ahead, and not to get too much into the weeds of what happened, but last night we saw essentially 3 Republicans cross party lines and block Speaker Johnson's attempts to block these votes. And it's interesting because if you look at the 3 Republicans that ultimately sided with Democrats, they represent different factions of the Republican Party. You have Thomas Massie, who has openly feuded with the president, Kevin Kiley, who is facing a very tough re-election campaign in a swing district in California, and then Don Bacon, who is ultimately retiring. Now, a similar effort has already passed the Senate. If this passes the House, it likely isn't going to make its way into law because President Trump would have to sign it, and it takes 2/3 of majority of Congress in both chambers to override any veto. But still, it could heap pressure on this White House in a campaign year when the economy is the top issue. John, we know the White House has been lobbying on Capitol Hill against this measure. The USTR Jamison Greer was on the Hill in recent days talking to lawmakers about it, and the administration had asked in particular for this vote to be delayed until at least June. That's when the Supreme Court term is up, and we are expecting a ruling on the emergency tariffs before then.
Tyler Kendall with the latest. Tyler, thank you. Joining us now to extend the conversation, Scott Linscomb of the Cato Institute. Scott, welcome to the programme. Interesting exchange with the President in an interview broadcast here in the United States in the last 48 hours or so. Scott, the President was asked about tariffs and he brought up the example of Switzerland, and he said that he didn't like the way he was spoken to, so he ratcheted up the tariff just a little bit more. Does that undermine the official justification for these tariffs?
Well, it certainly does. This is supposed to be about a national emergency that requires, it's an event that's so abrupt and so urgent that the president needs to invoke powers that are typically reserved to Congress and that the president typically isn't allowed to access. So if the whole basis for these tariffs is not the trade deficit or fentanyl coming across the border, and instead is the Swiss representative's voice, then the president shouldn't really have the ability to invoke these tariff powers at all.
Scott, this is definitely going to be something that I'm sure the Supreme Court is paying attention to, at least the lawyers who are arguing for it. I am curious about what Tyler was just talking about, which is that you are getting some pushback now from Republicans around some of this tariff policy, in particular tied to affordability concerns and how this is playing through to their voters. How much more of that do you expect?
I expect a lot of it this year. In poll after poll after poll, the president's tariffs just aren't popular, and voters have tied them to continued concerns about affordability. Economists don't want deflation, but voters do. And the fact is that while inflation is slowed, prices definitely haven't gone down, and particularly for key staples at the grocery store like beef. And so you're going to, I think, see continued connection of the tariffs to the affordability issues. And you're going to see Democrats, I think, use that as a lever, including through symbolic votes like the one we're going to get, I think, today, if not tomorrow.
Right. This is the reason why people haven't been paying attention to symbolic votes, is because they are symbolic. And that's the reason why the Democrats have kind of been a little impotent on this. The interesting aspect is that there are a number of Republicans that are starting to join forces. And I do wonder how much heading into and after the midterms you start to get a real check coming from some Republican constituents based on what they're hearing from voters. Do you see that as crimping some of the tariff plans that have currently been laid out?
Yeah, quite frankly, I don't think that the Congress is going to have the ability to do too much to stop these emergency tariffs under the International Emergency Economic Powers Act, simply because they're going to need veto-proof majorities to get past Trump. So even after the midterms, I think it'd be really difficult for Congress to really pass any sort of tariff reform, whether it's to the emergency tariffs or to the national security tariffs under Section 232. I mean, I'd love to see it, but the reality is these institutional checks are pretty weak because of the veto-proof majority necessity. And that's why I think one of the reasons why the Supreme Court's decision, whenever we get it, is so important here, because that would be a legitimate check on those emergency tariffs if the court really does say the president's not allowed to use them.
Scott, we've seen lots of justifications for the tariffs that were introduced a year ago: raising revenue, national security, bringing manufacturing home, getting your own back when someone upsets you on the phone, all of those things. The number one issue for me, Scott, is getting China to rebalance. And the Treasury Secretary had come out repeatedly and articulated quite perfectly as to why we need to do that, and not just us, the Europeans as well. Now, Scott, I think it begs the question now, after the evidence of the last 12 months, what we can actually do about that, because that trade surplus from China has never been wider despite the tariffs introduced last year.
Yeah, it really shows the limitations of unilateral tariffs to do a lot to change foreign government behavior, particularly when it comes to a massive economy like China that's dealing with really systemic issues that simply can't be fixed by, subsidizing a factory or removing a subsidy or something like that. So the fact is that you need a lot more than simply applying a tax on some imported goods to fundamentally change China's economic model. And quite frankly, you might not be able to do it at all. Unilateral policies coming from a single government tend to produce backlash in the target country. You've seen some of that in China as well, where they're actually doubling down on nationalization and self-sufficiency efforts. And then the last thing, of course, is that Trump's tariffs haven't just targeted China. When you're also targeting China competitors like India, Vietnam, Malaysia, even Mexico and Canada, it makes it even harder to induce those types of changes. And I think, again, that's why we've seen record exports out of China simply getting moved to third countries that don't have Trump tariffs attached to them.
A record trade surplus last year. Scott, thank you, sir. Scott Lincecum there of the Cato Institute. Up next on the program, Sucharita Kodali of Forrester.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Snapping a two-day winning run on the S&P 500 with a very mild day of losses this morning. A mild bounce up by, let's call it 0.2% on the S&P 500 around this up, still within 1% of all-time highs on the S&P 500. Switch it up and get to the bond market. 2-year, 10-year, 30-year yields shaping up as follows. Yields lower again. Yields are down every single day this week so far, Monday through Wednesday. The 10-year back down to 4.13, and fueling that move, weaker than expected economic data, which is just lowering the bar just a little bit and putting more weight and more emphasis on the payrolls report at 8:30.
Yeah, it's the fact that we didn't just get one data point that was weaker. We got several in a row. We got retail sales, and then we got consumer delinquencies ticking up. We also got commentary from a host of companies talking about how the lower income consumer is really under pressure. At the same time, Hilton's just reporting earnings and saying we only see tailwinds, and we're honestly increasingly optimistic about our performance, and they beat expectations. So it is a very difficult picture to really come up with some sort of cohesive narrative.
Heard the same from Marriott.
Exactly.
Yeah, Brian Moynihan. Speaking to Leslie Picker yesterday, same thing.
Exactly. We expect a strong market ahead. We expect a strong economy. So how do you get a cohesive narrative? And this is the reason why so many people have been pricing in dynamism. You're hearing that a lot. You're also hearing the other side, and we may hear more of that today.
Forgot that really strong ISM from last week very quickly, didn't we? Just like that, kind of moved on.
IS what?
Exactly. It's the tug of war between that and the string of weaker than expected data we've seen over the past few days. Get to foreign exchange, the dollar down, weaker for 4 consecutive days. The euro stronger again, 119.14 on that currency pair. As we count you down to the opening bell a few hours away, let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We're seeing Lyft shares getting hammered in the pre-market, down more than 17% after it posted a surprise revenue miss and a disappointing outlook. But what's really adding pressure is the competitive landscape and the fear that as Waymo and Tesla expand their autonomous vehicle fleets, that ride-hailing as we know it may no longer exist. So the Lyft results not enough to allay those fears. Meanwhile, the crypto rout at the end of 2025 had a big impact on Robinhood. The sell-off cut deep into profits with fourth quarter net income sliding more than 30%. But Robinhood saying that its future is not tied to crypto, it's tied to prediction markets, with the CEO saying that it is the fastest growing business in the company's history. But that optimism not enough to lift shares down 7% this morning. And we end on Mattel. Those shares are plunging nearly 30% in the pre-market after the toy maker posted a significant miss and issued weaker than expected guidance. The Barbie maker saying it expected a surge in sales during the holiday period, but it just didn't materialize. It says that consumers were hunting for deals and that retailers were handling their inventory very carefully. So a miss there. Shares are down 29% now. John.
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, rising fears of AI disruption hitting wealth management firms. The release of a tax strategy tool by the little-known startup Altruist, sending shares of Charles Schwab, Raymond James, and LPL Financial tumbling in Tuesday's trade. Elsewhere, Ford expecting profits to jump this year even after a surprise $900 million tariff bill at the end of 2025. The automaker planning to ramp up production of higher margin trucks and SUVs after pivoting away from electric vehicles. And finally, the White House adding to confusion over trade, a new fact sheet on the US-India agreement, removing references to agricultural goods such as lentils and chickpeas. The document also changing phrasing around India's offer to buy more American goods.
This comes with a lot of concerns on both sides, in particular in India, where a lot of farmers have been worried about some of the agreements that initially were laid out to buy pulses, which are things like lentils and peas and things that are really important. I think that India consumes something like a quarter of the world's total pulses. There's a bigger point here, though, and it goes to the Ford issue as well. The fact that Ford, on December, I believe, 23rd, got a note from President Trump saying they missed something and that they had an extra $900 million charge shows how messy it is to get your hands around some of these proposals. That was actually a proposal that had gone into effect. The India-U.S. trade deal still isn't in effect, and clearly a lot of the fine print's getting worked out.
Execution's been a problem in the last 12 months. I think I'm understating that just a little bit. Going into the midterms, I would say this about tariffs, trade, and the White House. Watch what they do and not what they say, because what they will tell us repeatedly is this is good. And I understand the rationale for them, particularly with national security and bringing some manufacturing home and relying less on China. But when it comes to the midterms and affordability, if you want to make the case that tariffs aren't harming affordability, it's difficult when you keep turning around and providing carve-outs for the consumer. And I'm thinking of things like beef and seeing more of that in the months to come. So sure, they'll say this is good for the consumer, but when it really starts to count and we get closer to the midterms and we see more carve-outs, I think that tells you what they really think about some of these tariffs.
There have been a lot of issues with execution. On one hand, it's the rationale and how cohesive some of the arguments have been. There has been a sort of scattershot approach to justifying tariffs, and that doesn't work in order to have any kind of continual rationale. And then there's, of course, the question of exactly what these tariff regimes are, because we don't have details, and frankly, it seems like they're changing for the moment. So it raises this issue of, can we price out tariff risk for the rest of the year? And is the impetus going to be on reducing them because of legal and, frankly, popular challenges?
Affordability is a massive issue. Let's keep it on the consumer. Delinquency rates surging to the highest level in nearly a decade, according to the New York Federal Reserve. The data adding to a downside surprise on retail sales. Sucharita Kodali of Forrester writing, the consumer is not happy. Confidence is still extremely low, and AI tariffs, geopolitics, and domestic polarization aren't helping. Sucharita joins us now for more. Sucharita, welcome to the program. Let's talk about the tax refunds, because a lot of weight's been put on that, and there is a belief that will turn around this story. Do you share that belief?
No, because the tax refunds happen every year and they really don't have an amazing impact on retail sales. The bigger issues are the macroeconomic conditions of the consumer. And given that so much of the spending happens later in the year anyway, I don't think that these tax refunds are going to have much of an impact. It may be a short-term blip for a certain number of retailers like Walmart, but for the broader economy, it will be negligible.
We were looking through the delinquency data just yesterday. I'm sure you did the same thing. Where are the problems more acute at the moment? Is it just low-income consumers, where we've noticed a problem for quite a while, or are you starting to see that migrate up?
The delinquency issue is definitely growing amongst lower consumers, lower end consumers. But the truth is also that we are coming off of record lows for delinquency rates. And even though the number is increasing, it's still at historical lows. And I think that is there's the warning sign, but yet there's not the clarion call of the platform is burning quite yet. And certainly I think that factors like consumer confidence are a bigger issue, because that is being reflected in the sales of some of these even mass merchants, companies like Target. So that seems to be the bigger issue. When you look at debt levels, you'll hear a lot about debt levels going up. The upper end consumer, the most affluent consumers with the highest credit scores, are actually the ones taking on the greatest percent of debt right now. And that includes everything from automotive to home debt. And that is likely also buoyed by the fact that the market is doing well. So the lower end consumer isn't necessarily borrowing, but of what they are borrowing, which is often things like student loans, they are defaulting more frequently.
If the lower income consumer isn't borrowing that much, and frankly, if it's not world on fire types of data coming out of the delinquency side of things, why weren't retail sales better, especially given some of the guidance that we got from some of the big companies?
Well, I think that is what's happened with retail sales is that it has been essentially driven by the higher end consumer for some period of time. So you have not only the higher end consumer driving disproportionately greater sales, but that higher end consumer in many cases is also trading down. So they are more likely to even go to some of these mass merchants, whether it is Walmart or their standby staple, which has been Costco for years. So that's what you tend to be seeing. And then the lower income consumer is either cutting back or trading down entirely. So I'm not surprised by retail sales being flat. They've been trending relatively softly for a number of months. And we essentially see retail sales being at pace with inflation now. And with the fact that prices are higher, that actually means the number of units that people are purchasing is actually indeed lower. That doesn't bode well for 2026.
Sucharita, I saw a number of research notes. Lower income people are definitely having a harder time spending money. You're seeing this across a whole host of different metrics, but also younger people. And that was often put in tandem with low income. It was low income and younger people. I'm looking at a story about how Five Below is rebounding because Dubai chocolate's hot and they're really capitalizing on it. But I'm just looking forward, how bad, how dire is the situation for young adults, given the fact that you've got a labor market that is questionable, new hire market that's questionable, and frankly, the overhang of all of that debt you were just talking about?
Well, the younger consumer for decades has certainly been kind of the recipient of a number of challenges pretty much since 2008. They've always come into difficult economic environments, difficult economic circumstances, tough labor markets. There's more uncertainty now than ever before. And I think that's the big challenge. The expression I keep hearing is peak ambiguity. If we thought that March 2020 was a period of tremendous ambiguity, we are at an even worse time with respect to not knowing what the future holds. Young consumers certainly have been a recipient of that, and the level of student debt that they've had to take on. And anytime you have higher interest rates, which may change the variability in the overall payment structure, that's not a good thing either. And if you don't have a job to help offset and pay those loans, that's certainly a problem, and it's going to be reflected in ultimately retail sales as well, certainly for the stores that are addressing younger consumers. How things will change, typically the arc is that within 5 to 10 years, most of these consumers do settle down and they go to grad school or they ultimately get some other job. But what that job outlook is going to be in 5 to 10 years remains to be seen.
I missed that, Bramo. What's happening at Five Below? What's hot right now?
Dubai chocolate.
Oh, Dubai chocolate.
I don't know. I was actually just looking
What
it
is
up.
that all about?
So I was just looking it up, actually. You read my mind. You're looking at what I'm looking at. I was looking up, why is Dubai chocolate such a thing? You go into any store.
So what is
it? It's something that's a TikTok trend that is chocolate with layers of pistachio that are inside of it, and it's very rich, and so people are very excited about it, and you can charge a lot of money for it. So probably the margins are pretty steep, which is the reason why you see it at the checkout counters of pretty much every kind of...
Have you tried it?
No, have you?
Okay, no.
Obviously.
No.
Well,
no.
partly
I've
because...
seen it. I've seen it, just don't know what it is.
Partly because A, I like dark chocolate.
Okay.
B, it feels gimmicky to me, and I have this immediate aversion to gimmicks. And C, like TikTok trends in general. I mean, I guess it goes.
Yeah, I think we're months late to this. If the kids are watching, they're like, yeah, this was like last year's story.
This is like 6 7.
Sucharita, thank you. Sucharita Kadali there, Forrester, thank you very much. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. At least 10 people are now dead and 25 others injured after a mass shooting in a remote town in Western Canada. Police found 6 people dead in a school, including the suspected shooter, who appears to have died from a self-inflicted injury. 2 other victims were found in a residence connected to the incident. It's Canada's deadliest shooting since 2020. Israeli Prime Minister Benjamin Netanyahu meeting with President Donald Trump at the White House today. Netanyahu is expected to push for a sweeping rollback of Iran's military activities and its ballistic missiles program. Israel concerned the U.S. will settle for a narrower nuclear agreement. Ford shares on the rise in the pre-market. The automaker is saying it expects its profit to jump this year, despite a surprise $900 million tariff bill at the end of 2025. The company plans to increase capital spending this year to as much as $10.5 billion. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in the next hour. Up next on the programme, counting down to payrolls.
This is not an economy that requires a significant amount of job growth behind it. And that's how you end up with this dichotomy of slower job growth, but an unemployment rate that could decline to 4.3%.
Steve Englander of Standard Chartered joins us next. His number for 8:30, negative 10K. That conversation in just a moment.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, no, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersecci in Davos, Switzerland, and this is Bloomberg.
Stocks are bouncing back by not even 0.1% on the S&P 500. A bullish note out of JP Morgan in the last 24 hours. Dubravka Lekos-Bucha saying, given the positioning flush, overly bearish outlook on AI disruption of software and solid fundamentals, we believe the balance of risk is increasingly skewed towards a rebound. We had the same really from Cantor's Eric Johnson on this program yesterday.
Yeah, saying that he really thinks that that's going to lead an upward bounce, and you have seen some of that. There has been this question, Stuart Kaiser raised this, about how much of this is technical. How much is this CTAs? How much is this other traders that had certain programs that were blown out by some of the moves, and now it's resetting? And that does seem to be what's coming into the fore right now.
Looking forward to the payrolls report later on this morning. Some data at 8:30 Eastern time. Under surveillance this morning, counting down to the jobs report.
This is not an economy that requires a significant amount of job growth behind it. When we hear Kevin Hassett say, get used to lower numbers, but don't panic, an economist's take on that is, well, this is not an economy that requires a significant amount of job growth. That's how you end up with this dichotomy of slower job growth, but an unemployment rate that could decline to 4.3%.
So here's the latest this morning. Traders are awaiting the delayed January payrolls report due out in just under 2 hours' time. Steve Englander of Standard Chartered expecting a street low negative 10K. Steve joins us now for more. Steve, welcome to the program. If we get 10K, should I panic?
You shouldn't panic, but I don't think the market's prepared for it. I think there'll be a lot of sticker shock, especially because the revisions are likely to be large and everything's going to look worse. I think it's complicated because it doesn't say that the economy is deteriorating at warp speed. What it's telling you is that the labor market was never as tight as we thought it was. And that's going to be the message, the ultimate message, I think, that they take away. But initially, I think we'll see a big market reaction, both in the dollar and in money markets and in bond markets.
Steve, how well understood do you think that is already on the FOMC, given the 3 cuts they delivered at the back end of last year?
Well, it's kind of understood. But I look at the Bloomberg forecast of 65,000. The consensus, that looks a bit high. It doesn't look to me as if the market's fully factoring in the magnitude of the move that's going to be made in terms of revising the data. Now, it could be that there's going to be this colossal footnote, and half an hour later, everybody's going to get it. But I think initially there will be some surprise there.
So, Steve, many people will come on the program, I'm sure, and make the case that the so-called break-even rate is lower, that there are supply-side factors at play. The real slack indicator is both unemployment and wages. What do you expect to see in those 2 data points today?
I mean, we're pretty much at the consensus on the unemployment rate. Look, I think the unemployment rate is gradually rising. All the indicators suggest that the labor market is on the weak side, not 3 standard deviations weak, but maybe 1 standard deviation weak. And that's kind of what's showing. PMIs are in the 40s. That's not a recession. If they were in the 30s, that would be a recession. But it's certainly not good. And I think that that's sort of the overall message we're getting. Weak-ish labor market, but not a disaster.
Steve, hasn't the market already been primed for a bad number based on some of the rhetoric that we've heard from the administration? Albeit, the administration did clarify yesterday that both individuals who talked about this did so before seeing the actual report. I am curious, though, how much has this market already priced in something like what you're talking about?
I'm just not sure. I mean, I Googled birth death, which is the big adjustment that they're going to make, NFP, BLS. There's just not that much that's been written on it. And when I see we expect a downward revision of 60 or 70 because of the change in that model. It's hard for me to see how you get a 65K consensus if that's, actually, if we're right. And I hope we're right.
Steve, you Googled. You didn't ChatGPT. The reason why I say this is because ultimately there's a real question behind some of these numbers. How much is this because of immigration? How much is this because we just have a smaller population? How much is this efficiency? And how much is this something different, structural, where smaller businesses don't have the confidence to invest in people when they're investing so heavily in infrastructure that could potentially change their need for people? Do you have a sense of how we can parse that out in some of these numbers?
I think it's very hard. I really think we don't even have a good sense of what population is. If you look at the way BLS handles it, they just throw population change into January of every year. And last year they threw 3 years of immigration into January numbers. So it makes no sense whatsoever. Immigration, we really don't have a census of, immigrants, undocumented immigrants especially. So we don't know where they were in the labor market. So I think it's going to take a while to figure out. And well, as you said at the beginning, I think we'll have to watch everything that's supposed to be correlated with labor market strength, whether it's wage growth, whether it's the unemployment rate, other indicators to really be to sort of figure out what's going on, because I think the numbers that are supposed to tell us what's going on are a bit shaky because of the way the economy has shifted, and BLS really hasn't kept up with those shifts.
Well, Steve, we've got more data on Friday. We've got the CPI report. What are you and the team looking for on Friday, and how wide open is the door to an interest rate reduction in the time left that Chairman Powell has running the Federal Reserve?
We don't know how wide open it is because, we get labor market data, price data a couple of times a week, in one form or another. Everybody's talking productivity growth. And even with yesterday's weak numbers, we're still like, well into the threes in terms of expected GDP growth. I think that's increasingly the story that's going to drive things. And I think the Fed, after 3 cuts, the Fed's going to wait and see whether there's any indication that labor markets are really deteriorating, faster than they were or stable. So I think ultimately they don't move. That's our view, that they don't have to, and that the equilibrium real interest rate is higher than the flat 0.5, the very low numbers that they've been putting out. So we don't think that they're going to move at all.
Steve, consensus feels a little flaky. It feels a little almost lazy. Torsten Slock of Apollo talked about this. Given everything in the pipeline, we've basically got people around 2% for GDP for the year ahead, 2.4%, something like that, and 2 rate cuts from the Federal Reserve. Steve, do you think that masks a much greater divide on Wall Street, where there is a camp of people who believe we could see 3% GDP and a conversation about hikes, and then another camp where they think that growth could fall off a cliff and we'll be talking about cuts again at the end of the year?
I think there is. Even with the productivity numbers that we expect in strong GDP, that looks increasingly likely, I don't think a hike is on the table, because the productivity growth keeps a lid on unit labor costs, and the Fed will be watching that very carefully. But there is this dichotomy between people like us who look at the productivity and output numbers and say, this is fantastic, it's really shifting. And there is a camp that focuses on the labor data and says, ultimately weak labor markets are going to drag down the rest of the economy. And there's, the Fed is going to have to react. You can make the argument, and we disagree, but you can make a solid argument that that's the case.
Steve, it's good to see you. As always, thank you, sir. Steve Englander there of Standard Chartered. I'm probably not choosing the best words, but let me have another stab at it, another go at things. I think the average right now masks a much greater divide on Wall Street at the moment between the bulls and the bears on the U.S. economy and what the Fed's going to do by the time we get to year end.
I think a lot of people would agree with you. There are people who think the economy is going to fall off a cliff, and that's going to be 5, 6, 7 rate cuts. And then there are people who think that there are going to be no rate cuts, and we're going to be contemplating rate hikes at the end of this year. And so you've got the average of those two that looks like a pretty continual, gradual easing cycle, which is what the Fed is saying. But ultimately, what you see under the surface are people who see the economy truly breaking out in one direction or another. And that, I think, is sort of the tail risk that isn't being expressed in equities and some other risk assets.
You'll see this again at 8:30 Eastern time. Let's say we get, 20K. Let's say we get 20,000. You'll have one economist come on the program and say, that is absolutely dreadful. Governor Waller's right. We're on the edge here. We need to cut more. And you'll have someone else come and say, the break-even's around that. Don't worry about it. There's lots of stimulus in the pipeline. We'll be at 3% GDP growth by year end.
Yeah, economic data has become a Rorschach test. And we've seen that for the past couple of years. People talk about how the data is not reliable, how it's muddy. Even if it is reliable, what do you do with it? This is the reason why people are looking at some of the revisions, to understand just the momentum behind some of these numbers. But even then, what do you do with it? And ultimately, do we need people anyway in this recovery? I mean, so it's like you could go any level of derivative away from this question to understand exactly how confused people are. Ultimately, it's going to come down to earnings and ultimately the unemployment rate.
As a preview of the conversation about 2 hours from now. Up next on the program, Lisa Shallard of Morgan Stanley, Wealth Management, Tobin Marcus of Wolfe Research, Binky Chowdhury of Deutsche Bank, and the former St. Louis Fed President, Jim Bullard, the second hour of Bloomberg Surveillance. Up next.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What we're starting to see is more of a rotation. That S&P equal weight is where the overperformance has been.
Earnings growth will still be driven largely by tech.
Investors are more worried about being left behind.
What we have ahead is a very good backdrop for equities.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. It's Payrolls Wednesday. The data 90 minutes away. Equity futures on the S&P 500 just about unchanged. Likewise on the Nasdaq and the bond market. Yields near the lows of the year. On a 10-year maturity down around a basis point, 413, with the jobs data just around the corner and the number we're looking for, something around 65K.
Yeah, and the real question will be the unemployment rate, because we have to understand what exactly 65,000 looks like. Then you also are going to get benchmark revisions for the full year of 2025. What do those look like in terms of the momentum? And ultimately, this comes at a time where a growing number of people are questioning the bull market thesis in the economy, not necessarily in capital expenditures, but in the economy, and how far that can fuel some of the trades that have gained popularity, including the cyclicals.
So what are you pushing back against? You're pushing back against the rate cuts we've already seen, the tax refunds are about to get, and a massive capex, $650 billion worth for the year ahead across 4 companies. So add some on top of that. How hard is it to fade that story into the year ahead?
It's very hard, which is the reason why I think a lot of people are finding difficulty doing so. At the same time, how much has this been overpriced? I think that there are 2 sides to this question. We have to look at how fully that has been priced in, and then what some of the flies in the ointment might be, which is that people aren't getting jobs. So that's a little bit of a fly in the ointment. You start taking a look at retail sales. Oh yeah, and they're also not spending that much more money. Oh, that's a little bit of a bummer. So you start looking at this and you say, how far can the economy fall off a cliff, and how much can that challenge some of the bull thesis?
Do you think to some extent as well, Bramo, that the market channel starts to infect the Main Street economic channel as well? The headlines we saw last week in software, in the last 24 hours in financial services, if you work in those industries, you'll be taking those stories seriously. And when you start to plan the summer vacation, the spending on big ticket items for the year ahead, is that going to hold you back just on the margins, just as you get a little bit more wary about the industry that you work in?
Well said. I would say that, and I would build on it. Not only are individuals holding off, but so too are companies, small businesses. Why would a small business invest in itself if it doesn't understand what its own business model might look like in a year? If you look at peak uncertainty, this is the reason why the engine of hiring, which is small businesses, I think that they account for some 70% of hiring in the United States. How much are they going to really invest invest in bringing on new people if they don't understand whether they're going to have to lay them off in a year or whether those people are going to drag down the profitability?
It wasn't my intention. This got gloomy very fast in the last 2 minutes or so.
It wasn't gloomy.
Not even trying.
These are the real questions that people have ahead of payroll.
Stocks are doing okay. We're up by 1/10%, within 1% of all-time highs. Coming up this hour, Lisa Shallard of Morgan Stanley as AI disruption shakes markets. George Pollack of Signum as contradicting views on jobs numbers begin to emerge in Washington, and the former St. Louis Fed President Jim Bullard on the central bank's uncertain future. We begin this hour with stocks ticking higher following a wealth management sell-off sparked by a new AI tool. Lisa Shallard of Morgan Stanley writing, with much ink spilled on equity volatility, transparency and composition matter in this moment, with selectivity key for fixed income investors. Lisa joins us now for more. Lisa, good morning. Good to see you.
It's great to see you.
Let's start with small caps. Are you fading that trade? Is it time to get out?
We have 100% faded the small cap trade. Our sense is that there was a lot of enthusiasm, premised on this idea that we're going to get this big reacceleration in the economy. But what people forget is that the small cap cohort is really, really low quality at this point. We've gone through, literally a decade of private equity picking off the most durable, leverageable business models. And what's left in the public market, literally 43% of the Russell 2000 is unprofitable. 8% of the Russell 3000 is unprofitable. These are companies that are unprofitable against a backdrop where U.S. nominal GDP growth has been over 5%. I mean, we've had a wind at most companies' backs between inflation and pricing power and real growth. And if these guys can't be making money in that environment, my goodness, are they going to, if the economy slows, God forbid, are they going to be able to make money? So we think that this was definitely a knee-jerk playbook trade. Hey, we're going to get stimulus, we're getting reacceleration, pile into small caps. I think it's going to be really hard when it comes to show me the money in the earnings season for these guys to meet and beat.
So if the bias is large cap over small cap, where's the leadership coming from in large cap?
We think we're going to go back to a high-quality large cap trade. That means, in fact, some of the Mag 7, right? I think we've seen some of that selling off or that dispersion trade a little bit overdone. So there's probably some of those guys that you can start picking. Some of the software trade is probably overdone. We're continuing to buy. We loved the sell-off in financials yesterday because financials is our #1 high conviction sector. So we're, piling into that silly sell-off yesterday, and we genuinely think it's silly. We like industrials, we like energy, we like healthcare. So, we think it's a stock picker's market, so you got to be selective, but the idea is rotating back to quality.
Just in case people believe there's a wealth management bias here.
Yes.
What made it silly?
So I think if you take a step back, while there is no doubt there are going to be disruptive technologies, disruptive applications, I think that there's a material misunderstanding about the way a lot of these businesses work. Let's take software, right? So I don't have to speak my own book. In software, one of the key things that a lot of these enterprise software companies have been able to do is capture data. They own the data, and they've owned cleaning up data and unifying it across the enterprise. No matter how good of a Gen AI tool you have, it is premised on using and learning your data. And so I think that the end game here is going to be a lot more nuanced than this, let's rotate and throw the baby out with the bathwater with these big sector moves.
The problem for an investor, the problem for me trying to understand this is on one side of the ledger, you have the potential disruption that could eradicate certain business models, but also benefit some of the high quality names that you're talking about. This is the promise that's getting priced into some of the valuations. So on one hand, either those are priced too high, or the disruption is perhaps a bit more real than we had expected. Which is it?
So I think it's a little bit of both. And I know that that's a very unsatisfying answer, but we are going back to a market where fundamental analysis, where that real hard work of stock picking, of discriminating, where, this is an environment where we think, quite frankly, some of the hedge fund managers are going to be able to thrive after a decade of them kind of, barely meeting fixed income type returns, right? So it's all about picking quality, selectivity, doing your homework.
A lot of people have talked about quality as gold. People have talked about quality as precious metals. And that has been one of the key sort of safe haven assets out there. You are starting to cast some doubt on that particular trade. Why?
So I'm not so much casting doubt on the gold trade. I'm casting a lot of doubt on the silver trade, a lot of doubt on the Bitcoin trade. So gold is has a very interesting story associated with it. Obviously, the first is around global de-dollarization, central banks diversifying. But the other piece of the story that I don't know is well syndicated or, quite frankly, even well believed, is that ultimately non-dollar stable coin issuers, right, are beginning to build collateral to issue non-dollar stable coins. So the second largest buyer of gold last year was Tether. Second largest buyer of gold. And they are doing that for a reason, because they know that they are going to have opportunities to collateralize in a non-dollar stable coin. And that's a way to give their stable coins legitimacy. So I think that there's a real story around gold that is very, very legitimate. Silver, I think, has been a truly kind of speculative. Yes, you had a supply-demand, divot there, but I think it's excessive relative to gold, and so we'd be selling silver. And Bitcoin, we've been very clear, it's a speculative, liquidity-driven asset class. When the global liquidity is building, it's something that potentially you can trade. But increasingly, we have done work across the lifetime of Bitcoin and have seen this seasonal pattern that it goes through these crypto winters where you get these big bear market sell-offs. And we think we're in one of those big bear market sell-offs. So we'd be avoiding Bitcoin for right now.
Let's stay on gold.
Yes.
Given the forces behind it that you described, what role does that kind of thing have in a portfolio?
So what's been spectacular is that gold has been one of the few things that has diversified stocks. Gold's correlation with traditional things, right, like real assets or the US dollar or inflation break-evens, is completely broken. But what it has done a really good job at is diversifying stocks.
Because if I look at the charts, the pushback would be just eyeballing the thing. They kind of look the same. Stocks are up and gold's up. And it's correlated with risk.
That is true, but on the days that stocks have been down, gold has done a better job than long-duration treasuries.
What role do treasuries have now?
So that's a great question. I think it's really about coupon clipping right now. I think it's going to be very hard to use long duration and use TLT, for example, to hedge your stock as a diversifier. I think this is about kind of sitting in the belly of the curve, between kind of 4 and 7 year duration and just clipping the coupon and saying, yep, we've got a steep curve down on the front end, up on the back end. I'm going to try to stay stable here and just collect, 4 or 5%.
Torsten Slok of Apollo just published it. I'm sure you saw the note drop into the inbox. Bond yields should be higher because he is super bullish this economy.
He's the one who's talking about potential rate cuts or discussions of rate hikes. Rate hikes, thank you for correcting me, later this year because of how strong the economy is. I'm just sitting here thinking, you've got asset classes that are being financialized that have never been financialized before. I'm thinking about gold.
Sure.
In order to avoid using treasuries as the classic haven trade. So you could say whatever you want about whether treasuries will act that way, but there is an entire industry trying to financialize things like gold, things like Bitcoin, because they want that alternative and they're looking for other hedges. I just wonder what that does in terms of some of these violent sell-offs and moves that you see in the algorithmic trading. I wonder how much that's part of it.
I saw a story about that. Isn't it in a massive vault somewhere in a cave?
Yeah. Yes.
Very interesting story. I read that recently too. Lisa, thank you. Lisa Shank
Absolutely.
there of Morgan Stanley. Equity futures on the S&P positive by 1/10%. Let's get you an update on stories worldwide with your Bloomberg brief. Is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Mattel shares plunging in the pre-market. The toy maker reporting disappointing results for the holiday season. The maker of Barbie and Hot Wheels also forecasting full-year guidance that fell short of Wall Street estimates. Saks is closing more than 10% of its full-priced stores across the United States. It's part of the company's effort to come back from bankruptcy as a smaller, more profitable department store. The stores closing include those in New Jersey and Philadelphia, which have been mostly unprofitable. President Donald Trump is weighing quitting the USMCA trade pact. Sources telling us here at Bloomberg the president has asked aides why he shouldn't withdraw from the agreement, but hasn't signaled his final decision. The trade pact faces a mandatory review before a possible extension on July 1st. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Just to clarify, Tether stores that in a Cold War-era nuclear bunker in Switzerland.
So,
did you read that story recently? It's fascinating.
Would you like to try to
do a tour?
Yeah, I think that we should take
undisclosed location, I believe.
I think that we won't disclose it. We'll take surveillance on the road. We'll go to the vault. We'll say, you know, we'll be in the nuclear era bunker.
Keep the secret.
We'll keep the secret, and we'll just sit there with the gold.
Did we ever do the tour of Fort Knox? That was meant to happen too.
We would like to do that.
That never happened.
Outstanding.
Up next on the program, preloading payrolls.
I've cut hundreds of thousands of jobs, and we still have good employment numbers. But if I want to have the greatest employment numbers you've ever seen, all I have to do is say I'm going to hire 500,000 people.
Up next on the program, George Pollock of Cigna, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The delayed jobs report, 1 hour and 15 minutes away. The estimates, the range pretty wide. At the top end, 135, and the low end, -10. City at the top end at 135. The median in our survey here at Bloomberg, about 65K. Going into that report, equities look like this on the S&P 500, the Nasdaq, the Russell, up by 0.1% on the S&P, on the Nasdaq up by 0.2. If you turn to the bond market, yields pinned to the floor this week off the back of weaker than expected economic data. Lows of the year at 413, around those levels on a 10-year maturity at the moment. And then this note drops from Torsten Slok of Apollo. 10-year bond yields should be higher.
He looks at how much he expects the economy to accelerate, and he's in the camp of seeing some of the One Big Beautiful Bill tax refunds really driving consumer spending, as well as some of this CapEx. Meanwhile, other people are saying, hold on a second, real people are struggling, and you're not seeing that in the numbers, which is the reason why even Citigroup, seeing 135,000 at the highest end, they are so bearish on the economy. You wouldn't know it, that the headline numbers aren't necessarily going to reveal the underlying pain. So you have these two bipolar stories, put them together, you get some nice averages, but ultimately it is a lot more bifurcated.
Huge division beneath the surface, without a doubt. You mentioned Citi. Andrew Humhorst looking for another 75 basis points. 3 cuts from this Federal Reserve. Under surveillance this morning, preloading payrolls.
They talk about construction jobs are way up, right? Well, they're up because they're building all these factories all over the country. Our employment numbers are very good. But Remember, we have to make America great again, right? You don't do that by hiring all federal workers. We want them to be in the private sector. I've cut hundreds of thousands of jobs, and we still have good employment numbers. But if I want to have the greatest employment numbers you've ever seen, all I have to do is say I'm going to hire 500,000 people.
So here's the latest this morning. President Trump touting U.S. employment data ahead of the delayed January jobs report. The president's rosy outlook coming in stark contrast to a warning from the NEC director, Kevin Hassett, saying, quote, one shouldn't panic if you see a sequence of numbers that are lower than you are used to. Bloomberg's Tyler Kendall joins us now for more. Tyler, don't panic, but is never a great way of starting a sentence.
No, it's not, John, and it does seem like there are some conflicting views out of the White House as top administration officials appear to be lowering the bar ahead of today's report, but President Trump has only raised the bar when it ultimately comes to growth. And it's not just the NEC director, Kevin Hassett. We also heard from senior trade counselor Peter Navarro yesterday, who in an interview said that, quote, we should revise our expectations down significantly for today. Now, we know there are, of course, a range of factors, but I'll give you the White House's view going into this report is that they have been arguing that potential low hiring number today doesn't necessarily paint the full picture when it comes to the labor market, as they talk about a decline in population growth and also the president's deportation policies. Meanwhile, if you hear President Trump in recent days when he's talking about the economy, he seems to be really focused on an expansion fueled by other things like CapEx spending, the AI boom efficiencies, also onshoring manufacturing. You heard him talking about construction jobs in that interview there. So a range of factors that the White House and President Trump seem to be looking at when it comes to this. But ultimately, no matter what happens today, this is an administration that is under pressure from American voters when it comes to the economy, and we head into the midterm elections. In fact, I'll point you to a new poll out from Gallup just this week that shows nearly 50% of Americans have negative views when it comes to the labor market. And John, I'll also quickly mention, keep in mind, this has been definitely a soft spot for President Trump when it comes to his views of this jobs data. Today's report will be the first report since he named his new head of the BLS. Brett Matsumoto hasn't been confirmed yet, but his nomination about 2 weeks ago came after months of that spot remaining unfilled.
Tyler Kendall with the latest in Washington. And just to be very clear here, Director Hassett isn't wrong. There are supply side factors at work that most people, in fact, I would say all people that come on this program endorse. It's just to what extent? And can you escape what's happening with the unemployment rate, which is a decent measure of slack and is higher now than it was 12 months ago?
It's the reason why you point to the employment cost index, and rightly so. The idea that wages really tell you whether there's heat in the economy in terms of the labor market or not. And ultimately, what you're seeing is the employment cost index going down. In other words, how much people's pay is increasing is slowing down. This doesn't speak to a robust labor market, and it speaks to a demand side issue, not just a supply side issue.
Combined with massive sentiment issues, the idea that people's attitudes towards the labor market have really soured, the idea that things aren't as plentiful as they used to be when they look for jobs, and is that starting to infect and constrain spending on the consumer's behalf? Coming into the new year, you certainly saw that in the retail sales number, and I have to say, you know, I'll reveal a bias, bullish the US economy, we all should be. I don't want that to be the story for the year ahead. We want to see people feel confident about their prospects to get a job, to spend money, but that's soured in the last couple of weeks off the back of the data we've seen.
Yeah, I saw you ordering Dubai chocolate in bulk because you wanted to try it.
Right down the phone in the commercial break.
Clearly, because you are bullish on things like that are sold at places like Five Below, which is actually doing extremely well.
Which needs my help at the moment.
Exactly, they do with some management shifts as well. But look, you take a step back, you're absolutely correct, and this is the reason why retail sales spooked a lot of people. This is the reason why you pair that with defaults creeping higher, not a 5-alarm fire, not, oh my God, the world is falling, but this does signify some weakness that people haven't priced in.
George Pollack of Cigna joins us now for more. George, the President and the White House, the Republican Party's got a problem. You can see it in the polling. Do they have enough time to turn the story around?
I don't think they have enough time to turn the story around. What I think they need to be able to do is reframe the story between now and November and basically say, we are making a large bet on reshaping the U.S. economy for the 21st century, be it onshoring manufacturing, being a large bet on nuclear energy, and saying, we're not just focusing on the next 12 months, we're focusing on the next 20 years. And I think for the president, he has to focus on that message, the idea that I'm not just doing this as short-term policies, I'm doing long-term policies. And in the long run, this will be what's better for you because, as you guys were saying, in the short term, there's not much for them to do.
George, it seems like the messaging has really consolidated around one theme, and John was laying it out, that ultimately the reason why the jobs numbers are a lot lower is because of less immigration and the idea that you need fewer jobs to keep a balance to the employment market. Based on just polls and your research, how much is that actually breaking through to the voter population?
I don't think it's breaking through whatsoever to the voting population. All they care about is that when they look at the job market, when their kids look at the job market when graduating from college, that they're struggling or they're perceived to be struggling to find jobs. I think for this administration, the issue is as much, and it's kind of like the Biden administration, as much as they want to say, look, this is happening for a reason, it's all good. When the voters look outside their windows and look at the kids, look at the people around them, all they see is economic weakness.
You know, I wonder if we're framing this in the wrong way. I mean, politically, it's framed as whoever's in the White House it's their fault. At the same time, if we talk to economists, we talk to a lot of structural changes, a lot of entrenched issues that have really hampered some level of hiring. How much is this something that can be addressed with rate cuts, that can be addressed with fiscal, and how much is this something that needs to be balanced out when we really understand the technology?
I think you've hit the problem spot on, though, where you're right. We can not only blame the White House, you have to look at economic factors and other contributing factors, but the president is the one who built himself into this box where he blamed President Biden, and in the past he's blamed President Obama for weak job numbers. So now he's holding the bag of weak job numbers, and he can't just say, like President Biden and President Obama did, that, well, this is structural, this is why it's happening. He's built himself he's put himself into a box canyon, and he can't really get out of it.
I've got a really welcome counterpoint to all of this, just dropped in my inbox. It's from Bank of America. And Bank of America, by the way, have already said fade any of the weakness that you see in consumer spending. This is based on their internal data in their Consumer Checkpoint report. Consumer spending showed solid resilience in January. So let's park December. January, with total card spending rising 2.6% year over year, the strongest paced in nearly 2 years.
And this goes with what we heard from Brian Moynihan yesterday. Brian Moynihan saying that they're investing more, that they see consumers spending 5% more in January than years earlier. So really expressing that confidence that they're seeing in that credit card data that you're talking about. So just how weak are things? Again, this goes to the Rorschach test of 2026. When you see that data, when you see the dots, what is it that you see?
Look, the bifurcation is what we still see. So you can have great aggregate levels, the average level of spending, fantastic. You see that in the data. Beneath the surface, and Bank of America is saying it, income-based divergence in spending and wage growth persists. We're concerned that a K-shape is opening up between higher-income households and middle-income households, alongside the existing gap with lower-income households. So it's not for us to sit here and say there aren't any problems, that what people are saying about how they feel about the economy isn't real. You're seeing that in the data. It's just the average numbers right now are still pretty decent.
The key here, middle income is important. The idea that what it means to be low income has really shifted, because a lot of people who are caught in the $200,000 income or $250,000 income are struggling to support a household of 4, 5, 6 because of some of the costs that you have. I'm thinking of that essay that was really fascinating, laying out what does it mean to be poor in this current environment, and I think that's shifting, and that's what they're pointing to.
Yale just told you that if you earn $200,000 a year, you can't afford to send your child to our university. They basically just told you that. $200,000 a year is not enough now to send your child to college. That's a problem.
Especially if college costs are not going down, you're seeing $70,000 to $90,000 a year, especially if essentially you're not seeing wages increase at a faster pace and we don't have an employment picture. I mean, this is really the structural challenge that we face.
So the spending numbers are decent, but the upper income cohort is doing more and more of the heavy lifting, and that gap is opening up, and the problems are starting to migrate upwards. That's an issue. Hey, George, it's good to catch up. Thank you, sir. George Pollack there of Signum. Big Chada of Deutsche Bank up next.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Jobs number 60 minutes away. Equities doing okay, up 1/10%. A little bit softer in yesterday's session, but no real drama. Some drama in wealth management firms. We'll talk more about that later. On the Nasdaq 100, up by 0.15. On the Russell, up by 0.2. Just moments ago, Morgan Stanley's Lisa Shallett making the case to get out of small caps, really pushing back against the case for moving away from large cap equity.
The number one case that she made is, who are these companies that haven't made it to either large cap capacity or be moved on? Ultimately, they are pretty low quality. And she said something like almost half of them are unprofitable. So if you have some sort of rollover in the economy, these are the most susceptible, and they're getting bid up because people view them in the same light as they used to, which is higher quality, not necessarily the dregs.
Vinky Scheller of Deutsche Bank is going to weigh in on the dregs, if we can call it that, in just a moment.
Well, I mean, that's sort of
Not sure how people feel about that. Okay.
I don't think that's fair.
Switch on the board and get to the bond market. In the bond market right now, yields are lower again, 413 around the lows of the year. We're down a basis point on a 10-year maturity, and the data got us here. Plus some comments from Kevin Hassett, the director of the NEC, suggesting that maybe that number today might be smaller than anticipated.
Yeah, expect smaller payrolls numbers coming out because of the immigration backdrop, et cetera. That claim was repeated, or that type of tone is repeated by other advisors to the president. And then the White House came out and said they hadn't seen the report ahead of time. This isn't a tell. And yet the market's going, yeah, we believe you. And it seems like people are keeping this trade on. Look, we are pricing in more rate cuts, potentially even in April, which would be the last month that Jay Powell will be the chair of the Federal Reserve, ostensibly, and potentially he could even initiate another rate cut in his tenure.
Jolts, jobless claims, challenger job cuts, retail sales. Data hasn't been great. ISM is the offset to all of that. The ISM manufacturing number was actually pretty brilliant. ISM services was middle of the road, okay. Are we going to see more of the ISM or more of the others?
Maybe both. And this is sort of the key, because even the ISM figure, if you looked at the employment component, it came in below expansionary territories. We still haven't seen the employment component pick up even in one of the better areas. So can we see that boom without the employment? And I think that is the underlying question.
So jobs data are about 60 minutes away. The opening bell about 2 hours away. With your morning movers, Yahara has more. Hey, Yahara.
Hi, John. We start with Kraft Heinz. Shares are falling 6% in the pre-market after the company said just moments ago it is pausing its plan to split into two companies. Remember, back in September, Kraft Heinz said it would split into two firms, one focused on its fast-growing condiments and sauces, the other on slower-growing products like Oscar Mayer. But now the new CEO says he wants to focus on returning the company to profitable growth before any split takes place. Meanwhile, moving on to Cloudflare, those shares are rising nearly 14% in the pre-market after the company not only beat expectations, it also raised its revenue forecast. This is a company that got dragged down amid last week's software sell-off. But Cloudflare is not just software, it also provides the infrastructure to run secure systems. And the CEO says they're shipping capabilities at an unmatched pace.
And we end on Moderna shares. They are falling nearly 10% in the pre-market on news that the FDA refused to review its mRNA flu vaccine, the latest sign of tougher oversight on vaccines by the Trump administration. Moderna says it wasn't about safety or whether the shot worked, but how the study was conducted. So they are seeking an urgent meeting with the FDA. John.
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, increasing concerns about AI disruption hitting wealth management firms. The release of a tax strategy tool by the little-known startup Altruist, sending shares of Charles Schwab, Raymond James and LPL Financial tumbling in Tuesday's trade. Elsewhere, the president discussing the prospect of leaving the USMCA trade agreement. Sources telling us here at Bloomberg the president is privately asking aides about the move. The trade pack is due for a mandatory review before a possible extension on July 1. And finally, the president also continuing his push for the Federal Reserve to cut interest rates.
Interest rates should be lower. You know, every point is $600 billion. Think of that. $600 billion. All he has to do, if we went down 2 points, we don't have a deficit anymore.
If only it was that simple. The president previously claiming his Fed chair pick, Kevin Walsh, can grow the economy by 15% if he, quote, does the job he's capable of. And based on the data I've just seen, middle-income workers would agree with the president because they would like a rate cut and fast. I want to go back to that Bank of America consumer checkpoint data that I mentioned just moments ago. Consumer spending, based on the internal data from Bank of America, doing quite nicely in the month of January, with total card spending rising 2.6% year over year. So that's the good, the welcome news. Beneath the surface, though, this is what they have to say. Income-based divergence in spending and wage growth persists, and we're concerned about a K-shape opening up between higher-income households and middle-income households. So not just the top and the bottom, but the middle. And that's an issue. And they offer these two stats, Lisa. So let's go through them. The gap in spending growth between higher-income and middle-income and lower-income households, the largest since mid-2022. And the wage growth gap between higher and middle-income is largest in nearly 5 years. That is a data point worthy of attention.
Yeah, and this is a reason why the sentiment surveys are not cohering with what we're seeing in the averages, because the averages smooth out some of this dispersion and make it look better than a lot of people feel that it is, especially if they're not in the upper echelons of income earning. As you look at this and you say, okay, does this scream for a rate cut? What kind of economic remedy would this actually require? And the answer is not clear, because people who are in the lower income and the middle income, if you think about it, the wage growth gap is also very high, which means that they are not seeing their pay being raised as quickly. So if you see inflation kick back up to a significant degree, guess who gets taxed the most as a result of it? It's these individuals. So if you cut rates too much and you do get some sort of reignition of inflation, they get penalized. If you don't cut rates and you don't get an acceleration in the economy, they get penalized. So exactly how are you going to remedy this situation?
They're getting squeezed. It's very difficult to do just that. Let's turn to the equity market and push this story through it. So the rotation out of mega cap tech stocks continues. Binky Chatter at Deutsche Bank is writing this. Sector funds excluding tech have seen a record $62 billion in inflows in the first 5 weeks of the year. That's more than they saw in all of 2025. Binky joins us now for more. Binky, good morning. Good to see you.
Good morning.
You track the data, you look at the flows. Do you see this as sustainable or just a knee-jerk trade to start the year? An itch to rotate?
So what I would say is basically, I think you got to put it in a little bit of context.
Please do.
So there was a fundamental driver that began the rotation, and that was really what we got from third quarter earnings, which, just as a reminder, began to get reported in the middle of October. And what you saw is, you know, a very, very clear sign, basically, of a broadening in earnings growth. And I would emphasize that if you break it up into two, and you're looking at mega cap growth in tech and everybody else, it was not really at the expense of mega cap growth in tech. It was just really a pickup, basically, in growth for everybody else that, you know, we've been waiting for some time, basically. Simple, you know, metrics would be, in the second quarter, we had very respectable S&P 500 earnings growth. So, you know, to the point that the averages can mislead, S&P 500 earnings growth was 9% in the second quarter of last year, but there were only 2 sectors with positive growth. That broadened to 6 in the third quarter. And for the fourth quarter, it looks like we are on track for 8 sectors with positive growth. So there is a fundamental driver of the rotation that began. And then, of course, you know, as you fast forward to today, there are concerns about basically AI disruption. And so you're getting the negatives here, the positives here. And so, you know, it sort of exacerbated basically the speed of the rotation. Today, you know, we are more cyclically vulnerable because we have much greater cyclical exposure. So payrolls is important. I would say on payrolls, you know, it's not so concerned really about the layoffs and firing that we hear about all the time. It's really an issue about the hiring rate. The hiring rate is at you know, at COVID lows. It's actually not very far above where we were at the lows in the global financial crisis. And so, you know, you have to think about basically what is the environment that corporates face. The hiring rate did tick up late last year, after, I'm sorry, the year before, after the election, and then, you know, dropped back down post-Liberation Day and hasn't really recovered from there.
There's a lot to unpack in there. I want to get into the idea that this market is more vulnerable to a downshift in the cycle because it is more heavily exposed to the cyclicals. I just wonder what's been priced in. I mean, this is an incredibly financialized market. This is incredibly driven by technicals right now as well. How much have people priced in a roaring economy of Torsten Slok versus some of the expectations that have come through based on the data points that we've gotten over the past couple of days?
Yeah, I would look at that, you know, as we always do, which is basically through the lens of equity positioning. And I would say fundamentals-based investors, we call them discretionary investors. Their positioning is, you know, teensy little bit above neutral. So I would say no real concern there. I would say, you know, at current absolute and relative prices, if you look at it again through the lens of positioning, what you know is getting priced in for mega cap growth in tech is a big down move basically in earnings estimates, while the facts are that earnings estimates for them are actually going up, including for software for this year, for example. For everybody else, it's kind of in line, yes. I mean, they are sort of positioned for a slowing in upward revisions to estimates, but it's a very modest amount, so I wouldn't make too much out of that.
What have you been advocating for with clients with regards to software? You mentioned that cohort of names that got hammered last week.
I mean,
what have you been saying?
I mean, our call, we do it at the sector level, so it's for all of mega cap growth in tech. We've been neutral for a while. We basically remain neutral. I'd say, you know, the tactical case for a continued bounce from here is pretty strong, I would say. I mean, if you look at relative valuations, you look at relative positioning. Positioning in cyclicals is today a comparable to the positioning in mega cap growth in tech. One is growing at close to 30%. One's growing at close to 6.5%.
Well, this to me really screams of you going into some of the big tech names that have gotten beaten up, but also the software stocks, as you're talking about that. Shopify came out with revenues, fourth quarter revenues that beat, and this is one of the stocks that was really beaten up, hammered, as a result of some of the software drawdown. Right now, you're seeing those shares up some 12.5% pre-market trading. I mean, absolutely surging as a result of what we have seen. I'm just wondering how much you think this is going to be one of the biggest outperformers and driving the market up as people reassess what that threat is coming from some of these AI tools.
Yeah, I mean, you know, it's a threat that you cannot disprove. It's a threat that takes many, many years to basically play out. So I would argue from a tactical point of view, it's just way overdone.
Binky, it's good to see you. It always is. Thank you, sir.
Thank you.
Binky Chadha at Deutsche Bank there, bullish on this equity market. Futures doing okay, up by another 1/10% with an update on stories worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Alphabet raising almost $32 billion in debt in less than a day, underscoring the massive funding race among tech giants investing in AI. The company tapping the sterling and Swiss franc markets with record-setting corporate bond sales. Alphabet says its capital spending this year could climb to as much as $185 billion. Ford shares rising in the pre-market. The automaker saying it expects its profit to jump in 2026, despite a surprise $900 million tariff bill at the end of last year. The company plans to increase capital spending to as much as $10.5 billion. Nickel futures jumping after the world's largest mine in Indonesia was told to slash output. Sources telling us here at Bloomberg, authorities telling PT Weda Bay Nickel to cut ore production by over 70% compared to last year. Indonesia is looking to boost global prices of the country's biggest export commodity. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, awaiting a Warsh-led Fed.
Kevin Warsh, I've known for a dozen years. He's accomplished, he's respected, and he's been critical that the Fed has not really anchored its policy in policy rules.
We'll get into that in just a moment and look ahead to the payrolls report 50 minutes away with the former St. Louis Fed President Jim Bullard from New York City. You're watching Bloomberg TV.
Rodriguez. And I'm Jason Kelly. And we're back with Off the Field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
So this is how this morning is set up. Equities slightly positive by 0.1% on the S&P. The data just around the corner. Let's call it 44 minutes away. The payrolls report, the delayed payrolls report from January, remember. The estimate, the median in our survey, about 65,000. In the bond market, yields just off the lowest levels of the year at 4.13 on 10s, down about a basis point on a 10-year maturity. Just about unchanged the front end of the curve at 3.45. Had a repricing at the very front end of the curve off the back of this weaker than expected data, which makes us vulnerable, of course, to better than expected data in about 40 minutes, so look out for that. I want to get you up to speed as well on some headlines that's coming from an interview with the Ukrainian leader, President Zelensky, saying a deal on territory is in focus for the next round of talks with the US, and saying that Ukraine is ready to meet in the United States next Tuesday or Wednesday, and it's unclear if Russia agrees to meet.
Yeah, and this is the ongoing negotiation, a real question of whether they can get some sort of peace deal. We'll get more details as this comes out. What Zelensky said in a phone interview in Kiev on Tuesday, none of the sides is keen on the idea of the free economic zone, neither the Russians nor us. We have different views on it, and agreements were as follows. Let's come back with the vision of what it may look like for the next meeting. So that potentially is what's on the table.
Let's see if we can make some progress in the next week or so. Let's turn it back to the data and, of course, to the Federal Reserve under surveillance this morning, awaiting a Walsh-led Fed.
Kevin Warsh I've known for a dozen years. He's accomplished, he's respected, and he's been critical that the Fed has not really anchored its policy in policy rules. Kevin Warsh will have to work with the committee and will have to bring the committee along with him if he wants to make the changes that he says he wants to make. The chair has the power of persuasion, but at the end of the day, he or she only has one vote.
So here's the latest this morning. Traders weighing the future of monetary policy under a Federal Reserve chaired by Kevin Warsh. The former St. Louis Fed President Jim Bullard joins us now for more to talk about that and, of course, the payrolls report just around the corner. Jim, welcome back to the program, sir. A Warsh-led Federal Reserve. What changes should we be anticipating?
I know Kevin Warsh well. I think he'll do a good job. He has been a critic of balance sheet policy. For those that don't recall, in 2010, he was an opponent of the second round of quantitative easing. And actually, the day after the vote, he put out a op-ed outlining his objections. And about 6 months later, he left the Fed. So he felt very strongly about that issue. He felt that the Fed was straying into fiscal policy, something that has been debated at the FOMC ever since. And now he'll have a chance to bring that vision into play.
So, Jim, you didn't hide your feelings about the communication architecture coming out of the GFC, the dot plot, for instance. Is that something you'd advocate to ultimately get rid of?
I think it's time for a reform of the dot plot. The committee hasn't found a way to do that, but I think with an incoming chair, now would be a good time to look at it. Former Chair Ben Bernanke put out some suggestions last spring, and maybe those could be the basis for a compromise on the committee.
This does seem like a pivotal point. I mean, we're sort of at a tipping point in the economy potentially, but there is no real need for the Federal Reserve to react. There's a question about later this year, if Torsten Slok of Apollo is correct, we do get some sort of reacceleration, what the reaction function will be from a Warsh Federal Reserve. If we do see inflation really remain sticky or even tick upward, do you have confidence based on your understanding of how he was back in the earlier tenure when you worked alongside him, of what his reaction function would be?
I think he'll be very careful and cautious. He certainly does not want to reignite inflation in the U.S., and I think he'd be very careful on that issue. The committee has already come down 75 basis points. I think the attitude on the committee seems to be that now they can wait and see. A lot of the news, maybe not the very most recent news, but the basic news on the economy has been for a booming economy in 2026. And if that's the case, the Fed probably won't see the need to do too much more.
Part of the problem, Jim, and we were just talking about this, about the K-shaped economy based on the Bank of America credit card data showing just how much that K has widened, not just with the upper class and the lower class, the upper class and the middle class. I'm just wondering how rate cuts fit into that. If you have a structural problem where you do see a number of people being left behind in both the employment level as well as just wage growth, how do rate cuts target that? Do they make it better or do they make it worse?
Well, the sad truth is rate cuts probably, don't do too much about that because that affects everybody in the whole economy, not just in the U.S., but across the world. So it's hard to talk about something that's targeted to a specific group. That's really the role of fiscal policy. And that's something Kevin Warsh has emphasized. You want to make a good monetary policy for the U.S. and by extension for the rest of the world, and then let the fiscal policymakers, work their magic through the democratic process and try to come up with various programs to help certain segments of society.
Jim, Governor Wallace talked about the headline number, not just the disparity beneath, and that's a man you worked alongside, of course, at the St. Louis Fed. I'd love your view on this statement that he put out after he dissented to the last decision to keep rates unchanged. The recent data, quote, indicates to me that there is considerable doubt about future employment growth and suggests that a substantial deterioration in the labor market is a significant risk. Do you think the Fed has done enough already to insulate against that risk?
Yeah, my judgment would be that the committee took that argument on board. They made the moves that they wanted to make, and now they want to hold where they are because inflation is still above target. Also, I think the non-farm payrolls number is, as you guys have discussed extensively, is very hard to interpret right now because of the change in immigration policy. It's a sharp change in immigration policy compared to where we were. So you might want to look at the unemployment rate instead, and that's always been a major indicator, of course, for the Fed, but it's only 4.4%. So that is actually pretty close to the natural rate of unemployment, according to most estimates for the U.S. economy. So you might say, well, the labor market, based on that, looks pretty good. We already took out some insurance against the possible deterioration, and we've still got inflation above target. So I think that's basically where the committee's coming down.
Jim, there's a lot of discussion about what the Fed should do and then what the Fed will do. And that's where the politics comes into play, and this question of how much the political overlay and the demands to get the economy really hot, 15% growth rates, come into play. How do you see that at a time where increasingly central banks are political, just in part due to the fiscal overhang, the deficit that increasingly is tied? So you've got the interest payments that are tied to what the Federal Reserve does. I mean, how realistic do you see that threat?
Well, the Fed, of course, these are political appointees on the Board of Governors and not political appointees at the Federal Reserve banks. And the art of this is to pull these decisions a little bit away from the day-to-day fray of politics inside the Beltway and try to make decisions for the medium term and the long run. That's been, by and large, very successful over the last 100 years. And when Congress has looked at this in the past about possibility of changing it one way or another, they've always come to the conclusion that they like it the way it is. So, I don't think we should think of totally independent Federal Reserve. That would sound like you don't have enough accountability, but you don't want the decisions being made directly by the banking committees or the Financial Services Committee or inside the White House. So the art is to get this a little bit away from the day-to-day politics, and I think that's the way it's going to stay. Because Congress has looked at this many, many times, and they've come to the conclusion that they like it the way it is.
Hey, Jim, it's good to see you. As always, thank you, sir. The former St. Louis Fed President, Jim Bullard, weighing in on the Federal Reserve future leadership and the jobs report just around the corner, 35 minutes away. You've got headline numbers that matter to markets and the disparity beneath, which really matter to the electorate and ultimately will matter to the future of the politicians in office right now. The wage growth gap between higher and middle income is the largest in nearly 5 years. That data coming from Bank of America. The gap in spending growth between higher income and middle income and lower income households, the largest since mid-2022.
This belies some of the averages and speaks to the consumer sentiment surveys that run in contrast to the earnings and the market performance.
The headline data, card spending up 2.6%, still looks pretty good.
Everything looks rosy.
The details still problematic. Coming up on the program, we'll catch up with the Charles Schwab president and CEO Rick Wurster and a whole lot more. The third hour of Bloomberg Surveillance just around the corner.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
I met him 1988 after my first restaurant opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did there.
You didn't know he was an actor?
No, I don't know. What he doing? Because I never watched the movies, I was traveling the business. But of course, after, people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's a for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So, example, Nobu Hotels idea come from him. He said, "Hey Nobu, so we have a lot of new restaurants coming in somebody's hotel." For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of your net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
This is not an economy that requires a significant amount of job growth behind it.
Jobs is a challenge, as I think wage growth will be a challenge.
We're not concerned we're going to see a spike in the unemployment rate.
The labor market is softer than what might have appeared up till now.
I don't know if the market's ready for seeing a negative print.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. The jobs report is 30 minutes away. Equity futures on the S&P 500 positive by about 0.1%. Likewise on the NASDAQ. Bond yields very close to the lows of the year. On a 10-year, we're down another basis point, down every single day this week so far. 413.28 is where we are on a 10-year maturity. 30 minutes away, the jobs report, delayed, of course, about a week. The payrolls report and the estimate we're looking for. The median estimate in our survey, about 65K.
Yeah, and a 4.4% unemployment rate, which would be holding steady from the prior read. This wouldn't be a terrible reading compared to what we've seen from Stephen Englander, talking about negative 10,000 jobs and a potential downward revision to the household survey that also comes out today. A real question is how offsides will this market be to either a bad print or now a good print based on how much bad news has already been priced in the past couple of trading sessions.
We've discussed it extensively throughout this morning that this market is now more sensitive to incoming economic data in a way that it wasn't in the previous 12 months, given the shift in leadership. Last year, it's big tech. Big tech and those stock stories immune to the payrolls data. This year, it's about the cyclical parts of the market and small caps. You need the economy to performing well to justify that rotation.
Yeah, make payrolls numbers great again. That's sort of where we're at, except there's a little bit of a problem, which is how do we understand those data? How do we understand exactly what we are seeing in the underlying economy as we get data points like the one of the Bank of America that show huge dispersion in wage growth, huge dispersion in job opportunity, huge dispersion in spending capabilities. And so you look at the average and you say, what do I do with that? And that's the reason why people are saying be a stock picker and take a look at which companies are benefiting and which are not.
You're going to see the market trade the headline and the politicians suffer from the disparity. And they're going to introduce the remedies that actually might make it a problem for Wall Street. And that was the early signs that we started to see at the start of this year when the president came out and started talking about interest rate caps and those kind of things. Gone away a little bit now, but no doubt we'll be back on the table the closer we get to the midterms.
Yeah, and then there's, of course, the big question of how much of a constraint does this put on some of the electricity usage of the big tech players, considering that electricity costs are going up. This is a reason why policy volatility is named as one of the top risks for this year, according to a recent JP Morgan survey, because ultimately this disparity gets closed through fiscal response, and that means politics, and that means this is the reason why we pay attention to every truth in every policy proposal coming out of Washington.
Those surveys do bug me sometimes, though. You know, when it's like their top risk is uncertainty. They're like, uncertainty is my top risk. That's what I'm worried about. I'm worried about uncertainty.
Yeah, my top risk is, meh, I don't know.
Do you know what I mean?
It's sort of outsourcing it.
Like every other year, you had a fortune teller who told you everything was going to be okay, but this year you're worried about uncertainty.
This year it's a black swan. Literally,
Right,
it is
come
a
on.
black swan that could come to my dress.
Big hour coming up. Charles Schwab CEO Rick Wurster joins us as AI fears send wealth manager stocks falling. We'll also catch up with the U.S. Interior Secretary Doug Burgum as the country prepares for major changes to climate policy, and Mike Gapon of Morgan Stanley reacting to the payrolls report. We begin this hour following a tough session for wealth management stocks as a little-known tech startup Altruist unveiled a new tool aimed at creating tax planning strategies, sparking a sell-off across the industry. We're joined now by one of the companies under the spotlight in the last 24 hours, the president and CEO of Charles Schwab. Rick Wurster joins us now for more. Rick, welcome to the program. I just want you, if you can, to take us behind the scenes. When you see your stock falling 5, 6, 7%, and you're sitting there looking at the Bloomberg terminal, Bloomberg.com, wherever you look, I hope you go there, and you say to your team, why are the stocks falling? What's happening to our name? Rick, how did you respond just yesterday with the management team?
Well, I did look on my Bloomberg terminal. I've been a user for a long time, and so trying to understand what was happening. You know, for us, AI is a real accelerant. So it was puzzling to see our stock sell off related to AI because we're benefiting from it in multiple ways and bringing it to our clients to help them in their financial lives. And we think we're best positioned in the financial services industry to help clients with AI because of our size, our scale, the depth of our relationships, and all the data we have, which is a key ingredient to winning in AI. And I'll share an example. You know, last week, we brought the best of people and technology to our clients. We had a family come in that had a complex trust. They wanted to have a discussion with their children about what that trust meant, how it was going to help them in the future. But it was a 400-page document, hard for the kids to understand. And using wealth.com, which is a tool that we have available for our clients, they were able to create a 2-page visual summary of their trust and estate document that led to a conversation with their advisors and their trust experts that brought a lot of light to what was in that plan and put the whole family on the same page. And that power of people and technology, I think, is what will win in the wealth space. And we think we're the winner on both fronts, which is why we were disappointed and surprised to see our stock sell off yesterday.
So, Rick, let's talk about the people selling and ultimately why they sold, because in their minds, you've got this company, this small startup that's going to automate personalized tax strategies and make it much cheaper and threaten your pricing power and the pricing power of wealth managers more broadly. What are they getting wrong?
Well, I think that AI tools like tax planning, which we have available today, is something that's going to make advisors more effective, more consistent, able to serve more clients, but it's not going to make them less useful. Ultimately, what the client is looking for is convenience and expertise. And the advisors are going to continue to play a critical role in bringing together all the AI tools, all the right information to have that discussion with the client. They're going to lean into relationships. They're going to lean into judgment. Ultimately, these are complicated decisions, very emotional decisions that often involve family dynamics. And that role of the advisor as a critical sounding board to the individual and to the families We don't think that's going away, but we think AI will make those conversations more impactful and more powerful.
So, Rick, I don't think market participants think it's going away wholesale either. I think what they think is going to lead to fee compression and a shift in market share. And ultimately, Rick, that's the difficulty that you've got now. It's the difficulty proving the negative, that won't happen. How do you go about doing that in the year ahead?
You know, this is the same story from 10 years ago when robo-advice was going to displace the advisor community and pressure fees. And if you look at what's happened, first of all, I think we're the biggest robo-advisor in the industry. We have $100 billion of assets. And we've provided that technology to our advisors who have used it to be more efficient in delivering for their clients. But you haven't seen it displace the growth of the advisor community. In fact, it's grown and fees haven't come down. And that, again, that was a new technology 10 years ago. It's been additive to the advisor community, just as I think AI will be. And so I don't see fee pressure. I actually see this accelerating the importance of the role of the advisor, who's going to have to work and bring all these AI tools together and all the different insights and make them impactful for the client.
Rick, there's a larger question here, especially on payrolls Wednesday, which is, I guess, where we're at, which is in order to justify the fees and the business models, you need to hire higher caliber people, but many fewer of them. In other words, a lot of these other smaller tasks can be done by artificial intelligence, by some of the robo-advisory programs that you already have in place. Have you already seen that come to your business model?
We're seeing AI help our clients in multiple ways. One, it's bringing new tools and capabilities, like the tax, trust, and estate capabilities that we're using wealth.com that I described earlier. It's allowing us to reach new clients. And I think that's why you won't see the population of advisors shrink, is that AI will be useful in reaching new clients that we couldn't before. I watched a client interaction in our agentic AI capability pilot that we're using with clients that we built in partnership with a leading AI firm just this week. And what that tool was able to do is have a direct dialogue with the client digitally that understood what the client wanted and needed. And then after having a tactical conversation, asked the client, this agentic AI said, can I call you and have a broader discussion about your financial goals and plans? And this agentic capability was able to have a conversation about his desire to put his 2 kids through college, to be able to travel in retirement, and ultimately to leave a legacy to his family. And then that led to a conversation about a concentrated position he had and maybe the need for him to talk to one of our experts about using a tax loss harvesting strategy to diversify that position. Those are conversations that at the scale of 46 million clients we couldn't have before. But now with the power of AI, not only are we reaching those clients that we have a relationship with, but we're able to help a whole new group of clients that we couldn't before. So AI is going to be powerful for our industry. We're going to be the natural winner because of the depth of our relationship, our client base, our technology, and the data. And we're leaning into this trend in a significant way because we do think it's going to be big.
It sounds like a lot of what Brian Moynihan of Bank of America said, which is that the entire business size would grow tremendously and the size of the employees might not change, but the ability to capture a larger share of the market does increase. How much do you find, Rick, that you have to invest in some of the technology, that you have to do different CapEx plans in order to keep up and make sure you're not left behind?
Well, we're investing a lot, but Lisa, I'll come back to the benefits. We look over the last 5 years in which when we have been investing heavily in our efficiency and leveraging AI to do so, our cost to serve an account has come down 21%. On an inflation-adjusted basis, that's 40%. Our headcount isn't any lower, but we've grown and we've used technology and AI to be more efficient, to serve clients in different ways, to answer their questions more efficiently, to do more digitally. All of that is leading to cost efficiencies for our business, but it hasn't meant lower headcount.
Rick, if you could point to one thing, what do you think is your biggest moat right now?
I think the size and scale of our firm and the fact that we keep the clients at the very forefront of everything that we do. For 51 years, we've been about client choice and innovation and technology. If a client wants to work completely with a robo-advisor or an AI advisor in the future, we're going to have those capabilities and we're going to make it available to the advisors on our platform. But I think most are going to work with the combination of people and technology, because these are emotional decisions where that combination is going to be really powerful. And we're going to make that available to our advisors and to our clients. So I think our biggest mode is that we always put the client first. We innovate, we adapt, and we move forward to make them as best off in their financial life as they can be.
And Rick, just as a final question, just to speak to you as a human being, you wanted to make this appearance happen today, and we certainly welcomed it. I always enjoy catching up with you. Was there something about yesterday that just kind of pissed you off as a man, as a leader of a company, that made you want to engage a little bit more?
Well, I think there's two things. Number one, I think the market's missing that we are a natural winner in the AI space because of all the advantages we have, because of our size, our scale, our data. And so I think it's important for the market to understand that and see us as an AI company. Number two, we've seen what's happened in some of the other spaces like software, and we wanted to be able to come on and tell our story about why we're so much different and why AI is a beneficial to our business, not a hindrance, and it's going to help us flourish and grow and serve clients in new ways and ultimately lead to the growth of the company.
We saw this with software names last week, and what I didn't hear much of was insider buying. Lisa and I were just talking about this, Rick, and we're wondering whether you saw the move and you stepped in.
Well, I own a lot of the stock. I love the stock. If I'm allowed to, I'd tell anyone to buy it where it is today. I think we've got tremendous upside. If you look at our earnings last year and our revenue, we hit all-time highs. In our winter business update this year, we guided to or presented a scenario that would lead to earnings of $5.70 to $5.80. 2027 looks very bright. We've got so much going for us, and AI is only going to accelerate our ability to deliver for clients and grow our firm. So I couldn't be more bullish about where we are and where the stock is.
Rick, thanks for making this happen today. We appreciate your time. Thank you, sir. We'll do it again soon. Rick Wurster there, the Charles Schwab president and CEO, on some of the competition they face now, particularly with the moves of the last day or so.
Look, clearly he's fired up. Clearly he wants to defend the business model.
Without a doubt.
And he's showing how it can actually be a beneficial attribute for them. At the same time, they're facing off with an existential threat that is undefinable because we don't understand how far some of this technology is going to go, which explains the move. A real question of how this is going to shake out. The point that Brian Moynihan made is really important. These are companies with much bigger businesses and smaller footprints in the employment side of things. And that's what he's talking about too. Essentially, it's staying the same size, but their business is growing and consolidating share across the industry.
It's hard to prove the negative. It was the takeaway with the software story last week, and it's the takeaway from the wealth management shakeout you've seen in the last 24 hours. It's really difficult to come out and craft a message that proves the negative.
It's like a high school rumor. When someone goes around and saying, I didn't say that, I didn't do that, everyone's thinking like, of course, and that's what happens. And it's a similar kind of feel right now. It's kind of like a high school playground.
Future's doing better. Is that how you describe the market? Used to be toddlers, right? And now it's a high school playground.
We've grown up.
I know. Good for us. We're up about 0.1% on the NASDAQ 100, on the S&P up by 0.12%. Going into payrolls about 16 minutes away with an update on everything else happening in the world with your Bloomberg brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Ukraine's President Volodymyr Zelensky says he's accepted a U.S. offer to host another round of talks to end the war with Russia. Zelensky telling us here at Bloomberg that the next stage of talks will zero in on the issue of territory. He also said that the war could end within months if the talks proceed in good faith, and Ukraine needs to approve a final proposal. Kraft Heinz shares are lower in the pre-market, the company announcing it's pausing its planned breakup into separate companies as the new CEO, Steve Callan, focuses on improving results. Callan says his #1 priority is returning the business to profitable growth. So far this year, shares have risen just over 2.5%. Nike's turnaround plan apparently in full swing. CEO Elliott Hill sitting down with Bloomberg News at the Olympic Winter Games in Milan.
The portfolio that we have, 3 strong brands, Nike, Converse, and Jordan. Yeah. The focus on sport and how we're segmenting each of the brands by sport, and then ultimately paying it off in 190 countries around the world is only Nike can do at the size and scale that we are.
Hill and the leadership team at Nike aiming apparently to reverse the company's performance. Shares are down more than 11% over the last year. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Up next, we'll get you some Morning Calls Plus. We'll catch up with the Interior Secretary, Doug Burgum, with major changes coming to U.S. energy policy. That conversation up next, live from New York City this morning. Good morning.
countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
The rotation's been going in the direction that most investors wanted it to be going, to be honest with you. Since probably November, people have been kind of selling large cap growth and kind of rotating into value, and particularly into cyclicals, because anticipation of the stimulus and a strong U.S. economy. So we think there's space to go there.
Stuart Kaiser of Citi weighing in on this market. Equities look like this morning, up by 0.1% on the S&P. Likewise on the Nasdaq, a similar move on the Russell. That's the price action. Let's get you some morning calls. First up from Bernstein, raising its price target on Apple to 340, highlighting Apple Intelligence as the quote big story. Your second call from Wells Fargo, cutting its price target on Lyft to 18, warning of share loss concerns ahead of an autonomous vehicle debut. And finally, Citi downgrading Mattel to neutral, saying the toy industry is becoming a story of haves and have-nots. Check out that move this morning. Mattel in the pre-market down by 28%. There's some of the morning calls this morning. Let's turn to energy and critical minerals. The Trump administration set to announce a major shift in climate rules, rolling back an Obama-era policy regulating fossil fuels. On that and more, the U.S. Interior Secretary Doug Burgum joins us now for more. Mr. Secretary, you have been a busy man over the last week. I actually want to start with Project Volt, and then we'll get to the EPA and what's going to happen with regulations around fossil fuels and such. Mr. Secretary, what is Project Volt, and how should I be thinking about this in comparison to, say, the SPR?
Well, it's absolutely a comparison. The Strategic Petroleum Reserve has created a great buffer on price shocks for American consumers for decades and decades. We have no equivalent on critical minerals. There are 60 minerals on the critical minerals list. Some of those are rare earth elements. China, as you know, Jonathan, controls about 85 to 100% of the processing and refining on about 20 of those, enough to put a stranglehold on global industry, whether it's tech, high tech, whether it's defense, whether it's consumer. And so with the threats last year put out by China on export controls, the U.S. leapt into action. We're broadly bringing mining back in America, but this idea of creating a strategic critical minerals reserve across 60 different elements, driven by the private sector, great leadership by across the board of multiple cabinet secretaries in the Trump administration, working with the Ex-Im Bank, working with the private sector, about $10 billion in a loan, about $2 billion in equity capital going in. This is going to be private sector funded, market driven, and those critical minerals will be stored at locations that are economically smart and economically efficient around the country. But the idea is that we will, in addition to that, last week there was also at the State Department a historic meeting. Over 50 countries came to the U.S. All of them, some of them already signed on, many others interested, joining a club of nations with free trade on critical minerals with price floors. The key on price floors is that it would block China from illegal dumping to kill the price across any one particular critical mineral. And that's going to allow the assurance for capital to start flowing back into mining and refining of these minerals in the U.S. and in our allies. So tremendous interest from the leaders, ministers from around the country that were there at the event hosted at the State Department last week. So anyway, great progress going to make sure that U.S. is secure relative to our position on critical minerals.
And Mr. Secretary, you certainly alluded to it. China's got a stranglehold over critical minerals, and America needs to do something about it. And overwhelmingly, there's agreement on this program often, almost weekly, to do something about it. What is less understood is why they have that stranglehold. You talked about pricing and dumping. What about regulation emissions. This is typically quite a dirty process. Has that held back production domestically as well?
Well, there's been an attack on American energy in this country, but even longer than that, there's been an attack on mining in our country. And just like President Trump says, drill, baby, drill, we've got to get back to mine, baby, mine. The U.S. graduated 36,000 lawyers last year and about 300 people with mining and metallurgical degrees. China, of course, is not doing it cleaner than anyone else. I mean, whether they're tearing up the Congo or Indonesia, child labor, illegal cartels, criminal organizations, all of these things that are going on. It's a dirty industry potentially for the environment, but there's a lot of corruption around that, in part because countries like America or like those in Europe that have rules, that have EPAs, that can do things cleaner, better, safer, smarter, both in terms of the environment, in terms of the labor force, basically got out of this business. And we've got to get, the free world's got to get back into the mining business and show that with innovation that we can do it, and we can do it in a way that protects the environment, protects the workers, and also then protects the economies of these countries. And so this is a strategic importance for the United States to get back in. And part of that is the permitting process. We've put a stranglehold on permitting, but for President Trump, we're breaking the logjam on permitting. Big announcements coming around the endangerment finding, and this is going to be a huge step forward in terms of getting projects done and keeping plants open in America.
Mr. Secretary, there's a question around refining things like lithium that are crucial for a lot of the high-tech aspects that go into our economy. There's a question about copper, really necessary for the build-out of some of the hyperscalers in particular. On the other side, there are things like coal, and there's a real question of some of the rollbacks, the EPA rules, like lowering emission standards as well as potentially increasing the use of coal. Why are those necessary to get some of the national security goals that you're talking about?
Well, we'll be making some more announcements on beautiful clean coal today, as President Trump likes to call it and should call it, because there's a coal plant running in America today. It has survived an onslaught for 20 years. But they've taken everything, virtually everything out of the NOx, the SOx, anything that would be considered an issue relative to the environment. And what's left, the attack on coal as a baseload power, has been largely around CO2 emissions, and with the reversal of the endangerment finding that says that this was massive overreach by the Obama EPA, that we are going to go back to a thing where we can have consumer choice, that's lower prices. And of course, with the big storms we had in the Northeast last week, I mean, check back on Secretary Wright's press conference last Friday, but we would have had millions and millions of people in this country without power if coal hadn't stepped up. Coal was the hero of keeping the lights and the heat on in America, and all of the money that has been spent in the northeastern part of this country on renewables. There was times during those storms where we had less than 2% of the power coming from wind and solar. There was more coming from burning wood and trash than there was coming from wind and solar, and coal in some parts of the country was providing 25% of the electricity. So we need the Biden plan of energy transition was actually energy subtraction. It wasn't addition, it wasn't transition, it was subtraction. They were shutting down base load and then replacing it with intermittent, unreliable, foreign-sourced forms of energy that required us to build out all kinds of additional infrastructure on top of the infrastructure we already had. That's what drove up prices. And now we're facing this AI arms race with China. We need more power. We need energy addition. The way to have energy addition is to stop getting rid of the stuff that already works. And of course, that includes our fossil fuel baseload. In the PGM market, 70% of the power was coming from hydrocarbons, during those storms. I mean, America and the world is dependent on it, and is going to be in the long future. Innovation is what we need to help solve any concerns that people might have about future climate change.
Mr. Secretary, a lot of people could get on board with that. The problem is that a lot of people have pointed out that it feels like there are certain energy sources that have gotten subtracted in this administration as well, wind being among them. That it's not necessarily that we want all energy sources, but picking winners and losers. How do you counter that?
Well, it's easy because we're not picking winners and losers. We're picking reliable, affordable, nationally secure sources that can provide what Americans need, what we need for low prices for consumers, what we need for industry, and what we need for AI. What we're not subsidizing any longer is intermittent, weather-dependent, foreign-sourced, which in the case of offshore wind hits all three of those, but it's also the highest cost. It's not affordable, and it's also opposed by our marine fisheries. I was meeting with a group of third and fourth generation fishermen in New England last Friday. It's blowing up their business. These are the farmers of the sea that put food on our table. You meet with the marine mammal groups, the Save the Whale groups. They're opposed to offshore. National security now, there's classified reports out that the radar interference above the water and the sonar interference below the water of these massive offshore projects represent real national security risks. These are not made up things. These are things that have to be considered, particularly related to offshore. But with the working families tax cut bill that got passed last July, people are not contemplating new projects. We have companies that are coming to us from around the world that are saying, hey, we're not going to be building offshore because we get it. It was only viable because of the massive tax subsidies. So Americans had to pay twice. They had to pay in terms of higher electric costs, and then they also had to pay through these tax subsidies. So it's all of the above that are reliable, affordable, and dispatchable, and don't require massive subsidies. I mean, and that's the level playing field that we're at right now.
Mr. Secretary, just quickly, because people will hate us if we're talking about wind farms when payrolls comes out in about 60 seconds' time, but I want to squeeze this in. Courts, as you know, have ruled against your administration's stop work orders on these offshore wind farms. Are you going to appeal that?
Absolutely, we are. And as I'm sure as we get into court and have sessions and share classified information, there will be further discussions on this. People are saying that, oh, this is some ideological attack on offshore wind. No, this is like a real, genuine concern. And as Americans, we should be concerned. No one's reading a story about pilots getting shot down in the Iran or in the Russian-Ukraine war because everything is autonomous. It's autonomous on autonomous. And if you've got massive radar interference just off our huge population centers, if you wanted to attack America, you would launch autonomous drones through those things, or you'd launch autonomous submarines because of the sonar interference. And so we just have to wake up. Warfare has changed in the last 4 years. The world's different, and we have to be ready to respond to it.
Mr. Secretary, we'll talk another time a little bit more about this, no doubt. Thank you, sir. The U.S. Interior Secretary, Doug Burgum there. I promised that we wouldn't be talking about wind farms when payrolls comes out. Payrolls is out in about 8 seconds' time. Equity futures on the S&P 500 firmer here by about 1/10% on the S&P. On the NASDAQ 100 up by 1/10. On the Russell up by 0.2. The jobs number we're looking for in our survey, the median estimate 65K. We have got a nice big upside surprise, 130. That is 130,000 payrolls. The estimate in our survey was 65. To work through the rest of the report, looking at monthly earnings, average hourly earnings month on month, that comes in at 0.4. That is also an upside surprise. The estimate in our survey was 0.3. And this is the right kind of downside surprise. The unemployment rate coming in at 4.3. The estimate was 4.4. So going through this, just data point by data point, a high-level read on things, upside surprise on payrolls, wages just a little bit hotter month on month, and the unemployment rate lower than expected at 4.3% against an estimate of 4.4. The outperformance in the equity market, guess where that comes? It comes from the Russell. Russell 2000 futures outperforming off the back of this. Let's push it through the equity market. On the S&P, on the NASDAQ, on the small cap so far this morning, the S&P up by 0.3. Likewise on the NASDAQ, there's your outperformance up by 0.6 on the Russell. In the bond market, yields have been drifting lower over the last few days off the back of weaker than expected economic data. Off the back of that, yields higher by 5 basis points on 10s, and at the front end of the curve, 2s up by 9. We can get to the benchmark revisions in just a moment. We were expecting some big numbers. I can tell you we've got some big numbers, but so far, just to focus on this jobs report, that jobs report, better than expected.
That sound you hear is a huge market that is pricing out rate cuts anytime soon, because ultimately people are saying this and maybe dismissing some of the data that we got yesterday. 2-year yields surging up more than 7 basis points, which gives you a sense of how much people are repricing. How much was that a head fake that we got yesterday in terms of retail sales and consumer delinquencies? 4.3%. The fact that the unemployment rate went down was not in a lot of people's bingo cards.
The dollar stronger off the back of this as well. Euro dollar down by about 1/3 of 1%. Euro dollar right now, 118.55. So a few things were happening this morning. One was the jobs report, and the other was the annual benchmark revisions, and that subtracted 862,000 jobs. That's not a typo. 862,000 jobs subtracted. The estimate was negative 825,000. So I would say that's roughly in line with expectations, as dramatic as it is. The story this morning, though, is the bounce back we're seeing in payrolls for January, and whether that's going to continue, given what's been happening in the equity market and the vicious rotation we've seen into more cyclical parts of stocks.
Especially because the outperformance in the headline number really came from private payrolls. If you take a look at the private payrolls number, that was 172,000 versus the expected 68,000. That is more than twice as much as what we were expecting in terms of what Wall Street analysts had penciled in. This just shows, this does point to robust growth, even with 17,000 jobs taken off the 2-month average in terms of what the revisions were. So if you take a look at the bigger picture, this seems to weigh in on the everything's just okay front rather than, uh-oh, the sky might be falling in a couple months' time.
Don't panic, Kevin Hassett said. No one's panicking looking at that.
Honestly,
is it fair to say Kevin hadn't seen the numbers?
I think that that's the takeaway, is that the people who came out talking about potentially seeing lower numbers had not seen these numbers, and this is confirmation right here.
Enda Karen joins us now from Washington, D.C. to break down some of this. So, Enda, let's start with the jobs report for January, and then we can get to the benchmark revisions. What's your reaction to that?
Face value, it's a very strong number, John, like you were just mentioning there, 130,000 on the month, much stronger than expected. And within the details, some strong numbers. Look at manufacturing, adding, I think it was 5,000 jobs. That's a big turnaround from the manufacturing story of last year. The unemployment rate falling as well, that's unexpected. And the private sector seems to be driving the job story because the government continues to lose staff, looking at the headlines coming out from the data so far. So, as I say, face value, first reaction, these numbers lend themselves to, at the very least, the stabilizing jobs market that the Fed were talking about a few weeks ago.
Andy, you've heard the pushback multiple times. It'll be no different this morning. People will say there's narrow breadth here. Most of this is healthcare. They'll also say, look at the benchmark revisions. All of this will just get revised away in the year ahead. Are they wrong?
Well, the benchmark revisions are notable. They've obviously come in a little bit better than expected, Jonathan, coming in with an 8 handle rather than the 9 handle. So that's not insignificant. I think, though, in terms of, policymaking world, they're already ahead of the curve on that. They would have anticipated, given the preliminary revisions that we had, that the jobs market would be that much weaker last year anyway. So to some extent, that story is baked into the cake. But there's no doubt about it that, and that's what I said earlier, at face value, the January figures are strong. But of course, there will be a revision story, not just on a month-by-month basis, but again, when we get to the end of the year, some of this will be recalculated. But right here, right now, you'd have to say that January number at least suggests a healthier jobs market than a lot of people were expecting.
Enda Karen with the latest down in Washington. Enda, thank you. If you're just joining us, welcome to the program. A decent surprise, a welcome surprise. Let's go through the data together, and then we'll turn to stocks, bonds, and foreign exchange. In the jobs data, an upside surprise, the headline number 130, the median SMNR survey was 65. That's strong. You turn to wages, that comes in just a little bit hotter than expected month over month on hourly earnings. Month over month, that comes in at 0.4. The estimate was 0.3. Downward revision to the previous month, keep that in mind. The unemployment rate drops to 4.3. We were looking for 4.4. So at first look, you look at that and you're like, okay, let me go to the equity market, and I think small caps are outperforming, and they are. They're up by almost 1% as this market continues to drift towards the more cyclical parts of the equity market. An endorsement from the data this morning, which goes against the grain of the last few days. Weaker than expected retail sales, jobless claims, challenger job cuts, jobs, all of that stuff feels like a distant memory all over again. All of a sudden, people are like, yes, I knew this was going to happen. Look at the ISM manufacturing. That was great. It all makes sense. It all makes sense now, doesn't it? Turn to the bond market. 2s, 10s, and 30-year bond yields are drifting higher. 2-year bond yields up by 8 basis points, so up 8 basis points at the front end of the curve. 10-year yields up 5 to 4.19. It's a repricing of the curve, particularly at the front end, which, of course, is more sensitive to interest rate reductions or hikes over at the Federal Reserve and Fed policy more broadly. And the idea that we're going to cut is going to get pushed out. And Torsten Slok of Apollo is probably feeling better about himself in this conversation about rate hikes by year end.
Look, it's up by 3 basis points. I told you they were too low, those 10-year yields. Look, ultimately what you are seeing in markets is now less than a 20% chance of a rate cut priced in by March, and then really ongoing, just removing that chance throughout the remainder of the year, partly because it does seem like the labor market is not cracking. That said, and this is actually a comment from a Bloomberg user, which I think is a really interesting one, which is annual benchmark revisions, updated birth-death model, and new seasonal factors. It's apples to oranges comparisons. What data are we actually looking at? I mean, look, ultimately, the market is taking this at face value, and I am too, because ultimately it's a good sign to see that there is job creation, particularly in the private sector. On the flip side, how do you get some sort of longer trajectory look based on all of the revisions, the seasonal, everything that's been going on?
Good luck, Mike Gapin. He joins us now. Michael Gapin at Morgan Stanley. Mike, good to see you. Welcome to the program.
It's all clear now, isn't it?
If I was calling you as a client, my first question would be, Mike, how much confidence can I have in this? Is this the real deal?
I think it's largely the real deal. Everything that you mentioned is completely fair. Benchmark revisions, new birth-death adjustment. There's favorable seasonal factors in this report. But does it wipe away 170,000 private payrolls? Probably not. I mean, we were at 90,000 on private payrolls, and I felt optimistic, right? So if truth is 90, I'm super happy with that number, right? So at 170, I think it's hard to bring all of that back and look through it. So and to your point, it does fit a lot of other data points in the economy. Durable goods have been strong. ISM has picked up. Manufacturing output has been on an upward trend. So seeing some complementary hiring alongside that is a welcome sign for the economy.
Do you think focusing on December retail sales like we were yesterday is a waste of time? Are you expecting a bounce back? Should we just see that as a head fake?
I think we will see some bounce back, but not entirely. There is softness in that report. But just remember, even in what I'll call normal times, retail sales is very volatile, gets revised frequently. So the signal out of retail sales, I think, is always kind of maybe second order. I think the market puts more weight on it than it otherwise should. But look, even with that number, consumption is likely to come in at around 2.3% in the fourth quarter. Still a solid number with a weak December retail sales.
Are these good jobs that are being created? Do we have a sense of the quality of them?
Well, I haven't seen the mix, but I think the average hourly earnings number at 0.4 suggests that there are quality jobs on that front. That's an average number across all the sectors. So I think any job is better than no job. So I certainly think there's quality in it, yes.
I guess that I'm looking at, for example, 124,000 created in health and social assistance, private education, 137. I mean, some of the main winners have really come from a couple of sectors that are sort of independent of the cycle. It's that we're getting older and that we're paying a lot of money for our kids to go to college. I mean, how much can we glean strength from these numbers and a sense of sustainability?
Well, the narrowness of job gains has always been the question. The narrowness of growth in the economy has always been an issue. It's spending by upper income consumers. It's AI-related business spending. Our thesis is that you will see some broadening out in 2026. So as you mentioned, the rebound in small caps, we do think that if you get a stabilization in the labor market, inflation does come down, it can support purchasing power of other parts of the economy, and the economy can broaden out. But so the narrowness of the recovery and the ongoing expansion is an issue. We think it'll broaden out. We'll see if it happens.
Right now, you're seeing the market price out or push back some of the expected rate cuts to July from June previously, in the sense that maybe this is not an economy that needs rate cuts. There are a number of people at the Federal Reserve who believe you should keep running this economy hot, because otherwise people could lose their jobs and the whole restructuring that takes place with artificial intelligence. And if you don't do that, you'll get scarring that lasts a long time. Where do you fall on that? Do you think that that's a legitimate argument, that you should proactively cut rates at a time of structural change?
I think they've done some of that. I think it's easy to see that they've done that over the last 2 years. The question is kind of where does that process end? I think the June-July period for the next rate cut is about right. And this data today says rate cuts, if and when they come, will be based on inflation. So when does the committee get evidence that inflation is decelerating, that tariffs are a transitory upward push on inflation? Sometime around the middle of the year is probably where that evidence comes through. But to your question, I think they have done some cutting preemptively to support the labor market and prevent some downside risk. We'll see ultimately if that was enough.
I noticed that was your focus coming into the new year, looking at the dual mandate, that you thought the inflation side of things, price stability, was going to be more instructive for the future of Fed policy.
That's right, and this number, I think, confirms that, right? So they had to do some, they decided, the Fed, to do some risk management rate cuts to support downside or prevent downside risk to the labor market. They put in 75 basis points of cuts. The data suggests that things are stabilizing. So if and when the Fed cuts further, it will be, where inflation is coming out of the first quarter. We think it'll be about 3% year on year. We think it'll settle down to about 2.5% by the end of the year. Somewhere in there is room for a few more rate cuts.
The 2.5? We cut around 2.5 now?
No, well, we're thinking 3.
Okay, all right. Michael Gapin of Morgan Stanley. Michael, thank you. Appreciate it.
you.
Thank you very much. So not quite Governor Myron-style rate cuts, but we're getting rate cuts.
You know who else thinks that we're going to get rate cuts and also thinks that we're going to get 3 rate cuts? Citigroup. And guess what? They nailed it. They got 135,000. We came in at 130,000. So they nailed it, and they still think we get 3 rate cuts this year. So it sort of speaks to exactly what Michael Gapin is talking about.
That's the moment we're in. A great divide on Wall Street at the moment. That you can offer one bank 130 and they're like, yeah, great. And another bank 130 and they're like, yeah, the Fed's still going to be cutting 3 times.
Yeah, and ultimately it comes down to the evolution of inflation. So get ready for Friday, CPI Friday, because it is going to be an exciting one, considering that now this is a market that's focusing more on exactly how much room that gives the Fed.
So if you are just tuning in, welcome to the program. A nice welcome, upside surprise on headline payrolls. That comes in at 130. The estimate was 65. The unemployment rate pulls back. That's the right kind of downside surprise. We're down to 4.3. The estimate was 4.4. And in the equity market, there's your outperformance on the Russell. It continues. The rotation gets some more oxygen. The Russell 2000 up by 0.8%. And notable at the front end of the yield curve, we reprice higher and push out rate cuts up by 7 basis points. The 2-year at 352. With an update on that and a whole lot more with your Bloomberg Brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. So, yeah, recapping all of that again. The major upside surprise for the labour market. Non-farm payrolls for January coming in at 130,000. That's more than double the average analyst estimate. The annual benchmark figures were revised down, but close to expectations. The unemployment rate ticked down to 4.3%, and that was below estimates. More details emerging on the fight for Warner Brothers Discovery. Activist investor Ancora, which recently disclosed a $200 million interest in the media giant, strongly opposes the proposed merger with Netflix. The firm released a presentation urging Warner Brothers' board to engage with Paramount's offer, which last amounted to $30 per share in cash. The Super Bowl drew a TV audience of nearly 125 million viewers. NBC said that was a 2.2% decline from last year's record. Unlike last year, the big game competed for viewers with the Winter Olympics, which are also being broadcast by NBC Universal. And that is your Bloomberg Brief. John.
Vonnie, thank you. We're blaming the Winter Olympics for those numbers.
Of course,
Is that what that was?
That's ridiculous.
Really?
Honestly.
Come on. Okay. Up next on the program, Jim Bianco of Bianco Research. With bond yields jumping as payrolls blow past expectations, plus Jahaira has your morning movers. Shopify gaining after a 4th quarter revenue beat.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else. But so does the Cabela shopper and the REI same things. They want clean air, and they want clean water, and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest. And this is Bloomberg.
We should do payrolls Wednesday more often if we get numbers like this. An upside surprise, 130, the estimate 65K. Wages, hourly earnings a little bit hotter than expected, and the unemployment rate just a touch lower than anticipated. Equities up across the board and some outperformance on the Russell. We're up by 0.9% on the Russell 2000. In the bond market, yields higher at the front end. The 2-year yield up by 8 basis points, the 10-year bond yield up by 5 as we reprice Federal Reserve interest rate cuts and push them out by a month or so. As we count you down to the opening bout, 42 minutes away, let's get you some single names and morning movers. Yahira has more. Hey, Yahira.
Hi, John. After a rough week for Shopify, getting caught in the software sell-off, it is in the midst of a comeback. Shares have climbed for 3 straight sessions, getting a boost yesterday from MoffettNathanson upgrading the stock, and today the shares are soaring up nearly 11% after it beat on revenue during the holiday quarter and gave a strong guide for the first quarter. Meanwhile, moving on to Mattel, not having the same luck. Shares are falling 30% in the pre-market after it posted a significant miss and issued weaker than expected guidance. The Barbie maker saying it expected holiday sales to surge, but that did not materialize, saying that consumers were hunting for deals and retailers managed their inventories very carefully. And we end on the semiconductor company Astera Labs. Shares are plunging 11% in the pre-market after revenue fell short of the more lofty estimates out there. Plus, some analysts are flagging that operating expenses were higher than expected, limiting the company's earnings beat. John?
Yahira, thank you. Thanks for the update. As we count you down to the opening bout, the cash open just around the corner with equity futures on the S&P as session highs up by 0.5%. Let's keep it on the data. An upside surprise, 130,000 jobs added in the month of January. Traders now pushing out this year's first rate cut to July from June. Joining us now to discuss is Jim Bianco of Bianco Research. Jim, the obvious question I asked Mike Gape and I'll ask you, Jim, is whether this is the real deal. How much confidence can you have in that jobs print?
Oh, I think you could have some confidence in the jobs print. I mean, I know there was a lot of revisions, and I know historically January and July are the most suspect months for seasonal adjustments, but that number was so strong in January that even if you were to give it a wider berth because of seasonal adjustments, it was still a good number. And I think that with the revisions, I think you can have a decent number on it. But, you know, the real question is, we average 15,000 jobs a month in 2025, but yet we still have 2.5 or 2.7% GDP growth for the year. That's what the estimate is. The stock market was up 17%. I think if you went back a year ago and you would have told us, you know, we're going to average 15,000 payroll jobs a month for 2025, we wouldn't have expected the stock market to do what it's doing, and we wouldn't have expected growth overall to be as strong as it was.
This is partly because this market believes what Kevin Hassett is saying, is that this is a supply side issue as much as it is a demand side one, and it's come from lower immigration and the fact that the population isn't growing. What do you make, though, of where wage growth fits into this, given the fact that we really haven't seen the commensurate wage growth that would signal that kind of labor market tightness that maybe some of these numbers might give hope for?
Yeah, and I mean, I'll underscore what you just said by pointing out that in the press conference 2 weeks ago, Jay Powell said that labor supply, how many jobs the U.S. economy need, is effectively halted, meaning I'm taking that to mean it's very close to zero. So if you're going to print, 100,000+ jobs, well into 170 for private sector, I guess I'm not going to be surprised that we saw wage growth at 0.4%. Because if we are going to see 100,000 job months, we're going to see wage growth with that too. We're going to see wage inflation with that. So I think it might be coming if we're going to see some big numbers like this.
So if you believe this through the market, what is the trade? I mean, ultimately, if you do believe
that rate cut now, maybe when we get a Kevin Warsh as Fed chairman, there'll be some political pressure on him to cut rates because the president has said he's going to sick his lawyers on him if he doesn't. But other than that, I don't think the data is going to basically support any rate cuts, at least for the near term.
We were told, Jim, that's part of a stand-up routine. That was just a joke. He wasn't serious. I've got no idea what the future holds. Jim, just to follow up, you've seen what Torsten Slok of Apollo's got to say. He thinks a rate hike is part of the conversation at year-end. It's a provocative piece. I'm sure you've read it. What did you make of it?
I mean, his argument, I think, is right. And I don't think we're that far away from it because the assumption, if you listen to all your guests that come on, the assumption is everything will slow down by mid-year. Inflation will come down, the economy will slow. But if it doesn't, and it continues on the trajectory that we've been on for the last 3 or 4 or 5 months, and inflation stays sticky around 3%, I think it would be fair to start talking about rate hikes because at that point, you could argue that the neutral funds rate is close to 4%, and currently we're at 3.5% right now.
Jim, it's good to hear from you, sir. Jim Bianco there of Bianco Research. Following the jobs data, the jobs numbers are really noisy, and they are subject to great revision, and we've seen that through the last couple of years, and you see it again this morning. If you want a decent anchor of where this labour market is at, not a perfect one, this is an imperfect one, but a decent anchor of where things are at, the unemployment rate's a decent way of doing it. That's why we started the program. That's why we're going to finish the program. That if you want a decent measure of slack, you can look to unemployment or you could look to wages. And the fact that the unemployment rate has come down and continued to come down is an encouraging sign that even with jobs growth as muted as it has been, better today, but as muted as it has been, we haven't seen that slack continue to increase.
And not only that, but you also saw average hourly earnings increase or exceed the expected bump of 0.3% and actually come in at 0.4%. So all of this painting a pretty rosy picture. When you look under the hood of where the job growth came from,
healthcare.
It came from healthcare. I mean, I think that this is really interesting. Private education and healthcare services, 137,000 jobs created. Where didn't it come from? Government. 42,000 jobs taken out there. And guess where else? Financial activities. That trimming around the edges, down 22,000 jobs in the financial activities areas. So it's a really interesting picture where the job creation is really shifting around.
Want to see more of it? Goes against the grain just a bit, given the data we've seen recently. Certainly want to see a lot more of this. I think if you go to the next Fed meeting, though, and unemployment is falling and not climbing, it's difficult to make the case to reduce interest rates anytime soon.
That's why July gets a lot more interesting, and that's why the Warsh Fed gets a lot more interesting, especially if the market doesn't see the data to justify rate cuts, but you do have the legal threat, maybe, threat overhanging over the Fed chair to potentially go forth with a rate cut regardless of
it's
the economic
better
data.
On a Wednesday because we can talk about it on Thursday and Friday, and
it sets up CPI.
The story doesn't die into the weekend.
I think this is actually really good.
This is good.
I think
it's a trial run. We should do it more often.
I was going to say the same thing. It was a successful trial run.
Coming up tomorrow, Congressman French Hill, Kristen Bidley of Citi, Megan Graper of Barclays, and Matt Lazzetti of Deutsche Bank from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
All right, it's Jobs Wednesday, 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
An absolute blowout of a jobs report. January payrolls doubled the estimate, and the unemployment rate unexpectedly fell.
And that strong data gives investors some relief as markets still punish companies seen on the wrong side of AI.
And more earnings roll in with results from Ford, Kraft, Mattel, and others, giving investors a fresh read on the consumer.
It's a bit of a weird one. Consumer maybe isn't spending as much, but jobs are plentiful. It's a confusing picture, and maybe as part of that confusion, Kraft Heinz is changing one of their game plans. I'm looking at the shares this morning, down 6.8%. The CEO saying that they will not be splitting into two publicly traded companies this year. Steve Callahan wants to focus on profitability, invest $600 million into marketing, R&D, and select pricing. I should also say Warren Buffett hated that they were splitting up. So yeah, that could have played into it too.
Well, he put them together, right? The Ford Motor Company expects its profit to jump this year despite a surprise $900 million tariff bill at the end of 2025. The company plans to increase capital spending to as much as $10.5 billion. Another positive driver, Danny, really for the U.S. economy.
Yeah, there's a lot to see today in terms of positive drivers, and there's the big one. The U.S. adding 130,000 jobs in January. That is double the analyst estimates of 65,000. The unemployment rate unexpectedly ticked down to 4.3%. Traders have now pushed back bets on a Fed rate cut from June to July. Let's bring in White House Acting Chair of the Council of Economic Advisors, Pierre Yared. Pierre, thank you so much for joining. Right off the bat, one of the things we're trying to square is Kevin Hassett, the NEC director, saying to expect weaker jobs. And then we get this blowout report. How do you reconcile the two?
Great. Thanks so much for having me. It's a pleasure to be here. You're absolutely right. It's a blowout report. It exceeded almost every single forecaster out there, I think, except for two. And not only is it total jobs that are up above expectations, it's also private sector jobs. that are at 170,000, so more than, or 160,000, which are more than double expectations. I think the way to think about, the way we were thinking about it is if you look at demographic changes as well as the big reduction in immigration relative to, in particular, illegal immigration relative to what was happening under the Biden administration, those two factors should lead you to lower break-evens, and that's consistent with, what a lot of forecasters have put out there. So given that you anticipate lower break-evens, it's even more remarkable to get a job number that is that strong.
Yeah, I mean, the fact that we are looking at unemployment at 4.3% and, adding double the amount of jobs that Wall Street had anticipated makes me wonder about rate cuts. I mean, are they really necessary here when the labor market seems to be doing fairly well and inflation is still a huge problem for consumers?
Well, listen, when you look at inflation, inflation has been trending down. It can be volatile for months.
But it's still high on top of already high numbers. I mean, we're adding insult to injury here, so...
If you look at 3-month inflation rates, it's very low. It's within the normal ranges. So, and if you look at the trend lines, it's been low. Now, I don't know where it's going to come out on Friday. It could be that there's some seasonal adjustments because of a very cold January. But overall, you see inflation trending down. The Fed does have to balance its dual mandate, and it's got to be consistent with what its strategy review instructed it to do, which is to focus on the type of job growth and the type of labor market that's consistent with its inflation
I think part of the concern, and Matt was getting at this too, is that we clearly have a strong jobs market, and even if inflation is trending down, it's not at target. And then you have the President of the United States saying that if the new Fed chair does his job, we'd have growth at 15%. All of that feels like a recipe for inflation. So is it a mistake then to be pressuring this Fed to move away from a focus on inflation?
The Fed should be the forward-looking, not backward-looking. So when you're looking at inflation, you shouldn't just be responding, or jobs, you shouldn't be responding to what's happened in the past. You should be looking at what's going on in the future. So if you look at what's going on in the future, it does look like we have significant productivity growth. So in the face of significant productivity growth, that puts downward pressure on inflation. The president's supply-side policies, deregulation, tax incentives for investment, all of those factors lead to significant productivity growth, not to mention the big explosion in AI. So in the face of productivity growth, which we haven't, this type of productivity growth may be reminiscent of the type that we saw in the 90s. That would be disinflationary growth that's consistent with a healthy labor market. And so that's what the Fed should be thinking about.
All right. I mean, the prices consumers are paying are still a problem. Affordability is still a problem. But let's put that aside if you don't recognize it and focus on the labor market. The labor force grew by 387,000 in January. And I thought we would see the labor force shrinking because of immigration policy, mass deportations. What do you attribute that growth to?
If you want to look at the labor force over time, I think the best way to look at it would be in terms of the census, because month to month it's going to be a little bit difficult to assess this using the household survey. So over the past year, what we do see is that relative to trend, the labor force growth or the population growth has declined, and that's consistent with the evidence that we got from the census. So according to the census, we had, relative to trend, something like 300,000 fewer lower population. And so in light of that, you would anticipate that that should continue into the next year.
Gary, if you look at where the job growth came from, 82,000 jobs from healthcare, social assistance increases 42,000. That's 95% of the jobs that were added in the past month. This is a non-farm payrolls that was virtually all growth coming from healthcare and social assistance. It's a trend that we've continued to see because of demographic changes. But does that mean that this growth is less healthy if it's really only being held up by one industry?
You have to consider the base when you do that kind of analysis. Most of the jobs that we have in this economy are services. So on a proportional basis, that's the right way to think about it. So on a proportional basis, those are growing, but you would anticipate larger absolute values given that it's a larger portion of the economy. And as you mentioned, if you have an aging society, it would be natural that we would get a little bit more employment growth in healthcare.
By the way, manufacturing added jobs. We got 5,000 new manufacturing jobs in January. After a string of losses, fair to say last year wasn't great for manufacturing. Are we going to start adding more manufacturing jobs to this economy as the president's policies take hold?
Let me talk about construction, then I'll talk about manufacturing. In terms of construction, we saw significant increases in construction over the past month, especially if you look at non-residential construction. That's consistent with the president's economic policies. So because of these economic policies that are there to drive investment and factories in the economy, you saw an increase in construction jobs. If you look at what we should anticipate more manufacturing jobs as a consequence. But if you look at manufacturing holistically, you can see that manufacturing value added, the growth in manufacturing has been very strong. In addition, if you look at manufacturing productivity, that's been very strong this year, and then that's been reflected in significant growth in manufacturing wages. I mean, one thing about the report, of course, is that the report showed that average hourly earnings, weekly earnings, those are up, and they're up across the board, and they're up in manufacturing.
Pierre, we also had government jobs falling again. How many more do you anticipate? Do you think that this trend will continue of government jobs coming off?
I think what the administration wants to do is to ensure that the government is right-sized. And when you look at where the government is right now, we're at the lowest level of federal government workers since 1966, which is quite remarkable. And what's true is that there's significant waste, fraud, and abuse, and we need to right-size the government and ensure that all of our workers in the economy are put to their most efficient use. So when you have government workers that lose their jobs, they're reallocated towards the private sector. And what's been remarkable is that even after the QCW revisions, you see that you've got 615,000 private sector jobs in the economy. And that's the way to grow the economy, to ensure that everybody is put to their best use.
All right, Pierre, great to get some time with you. Really appreciate you joining us this morning. White House Acting Chair of the Council of Economic Advisors, Pierre Yared, talking about the jobs blowout, 130,000 jobs added in the month. You can see here futures are responding well. S&P futures up this morning 0.6%. NASDAQ futures gaining 0.8%. So it's interesting, you know, as yields come up, there is less of a bet that rates will be cut or won't be cut as soon, right? We were pricing in a full rate cut by June. Now that's pushed out to July, but stocks are still responding positively.
Yeah, I guess we flip back to good news is good news, bad news is bad news. We saw that earlier this week, for example, with the retail sales data too. Matt, some of the individual companies that we're looking at this morning, Spotify, they beat estimates across the board in the Shopify rather. Spotify was yesterday. Shopify beat estimates in the fourth quarter, except for operating expenses. It's also authorized a $2 billion share buyback, shares up 12.33%.
Humana's profit forecast fell short of estimates, with earnings guidance more cautious than normal to account for this dynamic environment, and it sure is.
That maybe is an understatement. Mattel holiday sales fell short of estimates, and its outlook was on the lower end for profit. Shares could fall by the most on record if this, a nearly 30% loss, holds. What happened in December? We're going to have more on the toy industry in the next hour. Please say we're going to be speaking to the Hasbro CEO, Chris Cox.
Yeah, Mattel could use a little magic, and Hasbro has it, at least in terms of the gathering. We'll ask Chris Cox about that. Coming up, Kraft Heinz is putting its separation into two publicly traded companies on hold. As Danny told you, we're going to give you the details next. This is Bloomberg Open Interest.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Peru is maybe first country inspired to me to how can I use the different ingredients. First time I went to Peru, trying to culture food. I never had this ingredients never used in Japan. Kind of like a wow, you know, and cilantros, chili, garlic, and olive oils. It's a lot of good seafoods, complete different way. Example, they have fresh fish, but Japan, the fresh fish uses sashimi, but Peru use fresh fish, make the called ceviche, cooked with lemon juice. You never use soy sauce. First time I eat this, kind of wow. So then after this one, my open eye more, my cooking style that change, combined to Japanese style and another country food, then make novel style.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Let's get to high interest now. Look at what's making headlines around the world. Ukraine President Volodymyr Zelensky says his country will join new U.S.-hosted peace talks next week with territory as the main sticking point. A proposed free economic zone in Donbass faces skepticism from both Kiev and Moscow. He says the war could end within months if talks move in a good direction, but any deal must be approved by Ukraine's parliament or voters. President Trump is privately weighing whether to withdraw from the U.S.-Mexico-Canada agreement, the trade pact that he negotiated in his first term. The deal faces a mandatory review by the 1st of July. An exit could disrupt $2 trillion in trade and trigger tariff hikes as talks with Canada and Mexico grow increasingly strained. And the Ford Motor Company says profits could rebound to as much as $10 billion in 2026, despite a surprise $900 million tariff hit that doubled its trade costs at the end of last year. The automaker is leaning on strong pickup and SUV demand, cost cuts, and slimmer EV losses, even as aluminum shortages and trade policy volatility pressure margins. Let's talk about Ford with Bloomberg Autos reporter Keith Naughton in Detroit. And Keith, I can just imagine being CFO Sherry House when the administration says, oh, by the way, you actually owe us an extra $900 million in tariff costs. What happened there?
Yeah, so on December 15th, when Ford was announcing that big write-off on its EV business, they also raised their guidance and said they'd make $7 billion earnings before interest and taxes in 2025. Then a week later, on December 23rd, the White House tells them, you know, that break we gave you on tariffs, it only starts on November 1st, not May 1st, as you thought. That was a $900 million difference. And suddenly the tariff bill for Ford doubled to $2 billion. They missed their EBIT target. They missed their adjusted earnings target. The fourth quarter ended up being far worse, and it was already looking bad to begin with than they had expected.
It's one step forward, two steps back. The step forward being the elimination of these cash penalties to meet different fuel economy metrics. And they're trying to pump out more SUVs, more pickup trucks. Keith, how has that project been going for Ford?
That's great. And they are trying to, crank out the V8 engines and big SUVs like the Lincoln Navigator and the Ford Expedition, which they're doing. They're having record sales with those. Where they lost production, it was with the F-Series pickup trucks that were affected by a fire last fall at a supplier in upstate New York. So they are getting that production back up. They're adding pickup truck production. This is Ford's most profitable product line. So they're really trying to boost that. And that's why they're forecasting earnings to increase to $8 to $10 billion before interest and taxes this year.
Hey, Keith, thanks for that latest on Ford after their earnings. That's Bloomberg's Keith Naughton in Detroit. Elsewhere in earnings, Kraft Heinz is pausing work on his planned separation as the new CEO works to improve the business. Let's discuss with Bloomberg's Red Brown. Red, what did the CEO say? What was the thinking behind not going forward, at least for now, with the separation?
Yeah, I think right now what they're seeing in the business, and you can see kind of in the fourth quarter earnings results, is they need to get the business in a stronger position before they can kind of execute this plan and feel confident that when they do split, they will be, two standalone entities that are able to kind of live on their own and be profitable. But we can see after, 4 straight quarters of double-digit declines in earnings that right now they're still not there. There's still more investment needed to be making to the businesses, grow market share again, and then kind of contemplate moving forward with the split.
Why are they looking at these declines in earnings? I mean, are they having, like other companies, tariff costs that they're not able to pass through to the consumer?
So it's definitely like a pricing issue, right? So they have been higher priced than some of their competitors. That's definitely probably weighing on their results. We can see volumes are declining as well, which always is kind of a worrying sign for these consumer packaged good companies. So they are right now saying that we need to invest in price. We need to invest in R&D. We need to start getting products in front of customers that they're going to resonate more in formats that resonate more. So they're definitely kind of struggling through the higher pricing and the demand environment at the moment.
Do you think Berkshire Hathaway and Warren Buffett have anything to do with this pause? Because Warren Buffett was very vocal, saying that he did not agree that this split up should even happen.
Yeah, I don't know how much they had in influencing this. Obviously,
who listens to Buffett, right?
Yeah, right. We did see Berkshire starting to unwind their position earlier this year, right? So I think kind of a vote of no confidence into this move. So clearly that's the most prominent investor in the combination, now saying that backing away once the split was announced. So I do think that there's probably people, like you said, Matt, people do listen to Berkshire and Buffett. So.
Yeah, absolutely. The Oracle of Omaha has a say. Red, thanks very much. Red Brown there covers these companies for us on the BN side. Now, Robinhood reported lower fourth quarter profit due to sharp declines in Bitcoin and other cryptocurrency, I'm guessing prices as well as trading. Paige Smith, Bloomberg consumer finance reporter, joins us to talk about this. And Robinhood is a stock, this is why I care, that's been absolutely on fire. I mean, it's unbelievable the growth in this valuation, but it's come to a screeching halt today.
It has, and I think it was really interesting kind of listening to what the executives highlighted on the analyst call last night, which really was, there were a lot of questions on crypto. There were a lot of questions also on prediction markets, which are certainly the talk of the town in the retail investing space. And when it comes to prediction markets, Robinhood is sort of emerging as a leading contender, kind of a go-to platform for a number of consumers who wish to kind of engage in this sort of wagering.
How reliant then are they on crypto? Because if they're becoming one of the top players for prediction markets, also retail trading has just boomed. I mean, the stock exchange's volumes are now dominated by retail traders who presumably a lot of them are using Robinhood. So why aren't they more diversified?
So I would push back on that a little bit. I would say that as a company, Robinhood certainly is diversified. However, there were a number of sort of key growth businesses that have sort of slowed in growth a bit. Crypto revenues being one of them, for example. So crypto trading dropped 38% in the fourth quarter to 221 million. And, there's a little bit of a slowdown, again, as kind of attributed to some of the drop in digital asset prices. But we will kind of have to see sort of where the company continues to focus. It's always interesting, again, to tune into the calls and see what the key questions are asked and sort of where the executives like to spend their time.
Look at this 5-year chart here. The ride up was amazing, like 400% from the lows, right? But over the last 6 months, the stock has lost like 40% of its value. What's going on?
I think we still need to watch closely. The executives were kind of hitting tones of optimism for the rest of the year. We are just in February. I think we kind of need to take a minute and see where the stock goes for the rest of the year.
Yeah, I mean, it's still up 60% in the past year, but it would just be bad if you bought in that October peak.
Yeah,
there.
if you bought it in October.
That would hurt.
Yeah.
Yes, definitely. Paige, thank you so much for joining us. Always appreciate your time. That's Bloomberg's Paige Smith. Still ahead on the show this morning, strategist Katrina Dudley joins us as the trading day gets underway after a blowout jobs report. She says that equity markets are being supported by solid earnings growth and a Goldilocks macro environment. That conversation coming up soon. Stay with us. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Six minutes to go until the opening bell. It's a rally underway, turning around from a negative day yesterday thanks to a jobs number that beat everything but I believe 2 estimates, double the consensus among economists. A 0.5% gain is where we stand on the S&P 500. The future session trades at 7,000. We'll see if we can get there. On the equity market, on the cash trade, NASDAQ, that outperforms, up 0.7%. You'd probably assume small caps would outperform too, and they are this morning, up 0.8%. As yields move higher, Matt, we are now no longer pricing in a June rate cut, but instead that moves to July.
Yeah, it's interesting to see, these moves. Investors, we're pushing out rate cut expectations. And investors are selling treasuries, I guess, because they, don't expect the Fed to cut sooner. But you have some weakness in the dollar. You have gains in equities. Let's get a look at some of the other movers on our radar. Activist investor Ancora is said to have built a stake in Warner Brothers and plans to oppose Warner's deal with Netflix. You can see Warner up, Netflix up, Paramount up. So it doesn't look like any differentiation or reaction there.
That's true. Maybe this doesn't move the needle that much. Elsewhere, Elliott, speaking of other activist investors, has built a stake in the London Stock Exchange. It's grappling with disruption from artificial intelligence and a plunge in listings.
Lyft is plunging in price as its global expansion is not progressing as expected despite bookings for the fourth quarter beating estimates. You can see Lyft down 16.5% in the pre-market.
And then there's power and cooling equipment maker Vertiv. It is surging as orders jumped 250% in the fourth quarter on strong demand from, as you might guess, hyperscalers. Those shares are up 15.4%. Less than 4 minutes to go until the opening bell and what's set to be a positive day. Katrina Dudley will discuss the economy and which sectors could be the next targets of AI. Stay with us. This is Bloomberg Open Interest.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Bloomberg has learned that there are discussions around a potential all-cash offer for Warner's studio and streaming businesses.
For the past few years, we hadn't really seen any deals above $30 billion. And now we're seeing, Warner Brothers, $80 billion, the big railroad deal. And what we're hearing from sources is that next year we're going to see more of the same. It's just going to be the mega deal.
I would expect next year will be an even better year for M&A and IPOs.
That's just kind of what we do at Serena Ventures, is just kind of learn how we can fill in different gaps in different areas that are being missed. And by the way, these gaps tend to be really, really massive.
I know you've been very bullish on the return of M&A. Do you expect more deals, if they are of this size, to have the same sort of structure and contours?
I think we're going to see the return of large transactions, and I think they're going to avail themselves of both private credit options and public options.
There's a lot of merger talk. There's a lot of firepower.
Investors wanted to know at what price would this deal be, and now they answered that question at $70 a share.
So congratulations to Bloomberg's deals team for getting it first.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslada Amin in Davos, Switzerland, and this is Bloomberg.
We are moments away from the start of trading on this Jobs Wednesday. This is Bloomberg Open Interest. I'm Matt Miller. You can see futures up across the board as the jobs number clobbered expectations. We had 130,000 jobs in January. The expectation was for half that, 65,000. The whisper number was even lower, so much better than had been anticipated. You hear the opening bell and see the guys. It's Marciano Tesla, the founder of Agibank, AGI. It's a Brazilian fintech. I would say Brazilian banks are hot right now because we have seen a couple come to market here in the U.S., but they're not so hot because they originally wanted to offer 44 million shares. They had to cut that down to 20 million shares. And they originally wanted to sell them for $18 a share, and they had to cut that down to $12 a share. So you got there. At least you got there. That's the important part. You're playing now. Solve Energy here. You can see Mr. Hirschman there, CEO, ringing the bell. And they just started trading. And they have a very cool ticker, Megawatt, MWH, which we're all kind of learning what a megawatt of power is. How many households could that run?
I still don't think like my puny
households could that run.
I still don't think like my puny tiny little human brain can comprehend any of these things. Like I don't know if I'll ever get the hang of it. Just how much power these things generate and how much is needed for AI.
Right, but Manhattan Island, when it's running on a regular basis, needs like, I don't know, 8 or 9 megawatts of power. So to me, that translates pretty easily to about 1 million households, but I don't know.
Well, business is clearly booming, either way, I think is the takeaway from that. Matt, one of the stocks I'm looking at the open is Kraft Heinz. Shares are down more than 4.5%. The new CEO of Kraft Heinz says that the company will not split into 2 publicly traded companies this year. Steve Callahan wants to focus on profitability and will invest $600 million in marketing, R&D, and select pricing.
The pricing is, to me, what's interesting there. Now, Ford expects, speaking of pricing, Ford expects profits to jump this year. They did have, at the end of last year, a $900 million tariff bill. Of course, that was 2025, so it doesn't have anything to do with profits this year, but they do not only expect to make more money, they expect to spend more money. Capital spending this year is going to increase to $10.5 billion, and that's got to be good news as they claim to be the most American manufacturer. I guess Tesla would dispute that, but they're up there, right? A lot of factories, a lot of employees, growing the economy. Joining us now at the desk is Franklin Templeton Senior Investment Strategist Katrina Dudley, and I lead into you on that, Katrina, because of course, the jobs number was absolutely killer today, right? We added 130,000 jobs. We were only looking for officially 65,000, and the whisper number was for 35,000.
And look, we keep telling people we're in Goldilocks equilibrium. Okay, the growth number is not too hot and it's not too cold. I look at inflation, not too hot, not too cold. I look at supportive fiscal, I look at supportive monetary policy, and I look at a reasonably stable unemployment outlook, which means we've got job creation in order to absorb all of those new graduates that people have actually been concerned about. So I think that there's been a lot written in the headlines about the graduates are not getting employment, and that employment number I think is the first big positive indicator we've had here.
What do you make then of yesterday's retail sales data? Do you just put that to the side as an anomaly?
I think in terms of retail, you need to understand that that's disproportionately focused on the lower end consumer. The higher end consumer obviously has other needs and wants. And if I have a look, I think we are starting to see concerns about that low end consumer. Look at the comments that PepsiCo made on the snack and beverage market. You compare that, however, to what Costco is saying. Costco is a little more of that middle income consumer, and things are going fine. So I think if you're in the middle, upper end consumer, you're okay. But from an overall retail sales number, we've seen a little weakness, and that is driven by the low end.
I mean, earnings are still incredibly impressive, right? What are we looking at? 12% with 75% of the companies in the S&P reported?
Yeah, and that comes off a third quarter, and we've talked about this. You had 18% in the third quarter growth in the Mag 7, but the rest of the market was still growing in like the low teens percentage, and that's what we're continuing to see. And what does that support? It's this going back to it's a goal. We talk about it. I want to say it again: Goldilocks equilibrium and a broadening of this market. And that broadening of the market has so many macro underpinnings that we are just very confident that we're going to see more companies benefit this year than just those 7.
The broadening started and it was everything. And then it's only some things. And tech started to fall, and that's part of the way that the broadening started to happen. Do you anticipate that as this broadening happens, it's not a rising tide that lifts all boats, that tech valuations necessarily need to come down at the same time?
I don't think they actually need to come down. I think that what will happen is that the valuations that will adjust with the earnings growth. So I think that we've had a little bit of concern about that earnings growth sustainability, and that's been driven by the high CapEx numbers and the investment returns. We've been suddenly starting to be concerned about that. But we were talking about it earlier. The difference now with AI, I remember for my entire investing career, you could always predict the losers from any kind of big change in a market. With AI, it's actually really difficult to spot the losers. It's so much more easy to spot the winners. And I think that's what's driven the tech sector. Now I think we're going to start to see some of those winners in the middle part of the market starting to emerge.
I'm going to ask I'm going to ask Dan Ives this when he comes on as well, but I wanted to ask you too, how do you think about the shift in these hyperscalers? You know, previously, if you were investing in them, and Danny's been pointing this out for a while now, they were asset light, they were generating a ton of free cash flow, they were returning it in the form of tens of billions of dollars of share buybacks to investors. Now, it's a totally different investment proposition, right? Because they're generating cash and then recycling that into data centers, and the guaranteed ROI isn't there anymore, and they're borrowing money on top of it. So
you need to have something that protects your moat, okay? And moats can be protected in multiple different ways. They first can be protected as a network. So where does a network investment happen? It's in your advertising, in your marketing, and spending, you know, to get more people into scale. A moat can also be created through capital, and that's what we're starting to see here. Is people are saying that, you know, I'm not as trusting in my network moat. I want to give myself a little bit of optionality, and that optionality will come in the form of fixed capital. Does it mean that the returns are lower? I think that people just randomly think that the returns on a network effect are much higher than the returns on actual physical capital, but that's not always the case.
How are you thinking about the SaaS-pocalypse? The end of days for software. I mean, obviously, I'm being very facetious here, but every day does feel like
slightly
we get
facetious,
slightly.
not very.
Yeah, no, that's true, because every day there's a new press release, like this startup happens, Anthropic has put out this sector sells off, that sector sells off. What's noise and what's actually impactful?
I think where is the value? I mean, the value is in data and in databases and data that you can feed into a system and an ecosystem. We own our own orchestration layer, and so we're looking for partners that can give us our data into that orchestration layer and to then deliver the results to our, you know, our partnership. So if I have a look at the companies, you want the ones where they've got that data, they're really recognizing that having a user interface of your own that people actually have to go out of an ecosystem to is no longer a competitive advantage and a moat. And if you have been slow to switch to their mentality, they're the types of companies I would be wary of.
Are there any winners that we, you know, that are kind of uncovered because, or that you can uncover? Because I always think of Reid Hoffman at the Economic Club a couple of months ago was saying he thought radiologists were going to be out of a job because AI was so good at screening for cancer. And it turns out it just made radiologists better at screening for cancer, and more people went in for screens.
And that's the same argument we're having with the power companies at the moment. We're saying, hey, you get a new technology, it uses less power or it needs less cooling. But if power becomes cheaper, it becomes cheaper to deliver AI. And if I've got cheaper AI delivery, you know, it means that we're basically going to use it more. That is a fundamental condition. And I think that our use cases for AI at the moment are limited by two things. First, you know, just human attention span. I mean, I've run, you know, our ChatGPT in the pro mode, and sometimes, you know, it's a couple of minutes and everything. So you kind of get distracted and everything. But I think that we're going to see just more people integrating AI into daily workflow. And that's where you want to be looking for companies. It's companies where it's part of workflow. You want to look for the companies that are giving you tangible metrics on how it's impacting. Is it making meeting prep shorter? Is it giving you cost efficiencies in your back office? And I want to say that at the moment, we're so focused on the cost side of everything. I think 80% of AI use cases are currently focused on cost. It's going to be when it shows up in the revenue side. And I'm not talking about you all signing up for AI.com handles, but I'm really talking about it, you know, in different companies, in different industries, AI driving earnings. And I think that's what the next leg of this rally and what we're looking for.
Katrina, we're going to have to leave it there. Thank you so much for joining us this morning.
Great. Thanks
for having me. Great to see you. Katrina Dudley from Franklin Templeton. About 10 minutes into your trading day, let's get a check on your equity market because we're moving higher. Thank you. Blowout jobs numbers higher by almost 0.5%. Breadth, though, pretty even, just slightly more on the upside to the downside. We're looking at percent change. I wonder if in the control room we can change this to points.
Look at points.
Because that's more interesting to see the big ones that are driving it. So as we wait for a change on points,
Come on, Joe.
Come on, Joe, in the control room. You do have some of the tech players doing pretty well today. If you change it by points, you will see some of the more economically sensitive type companies. Let's just go to the losers, because Robinhood's at the top of the pile, again, based on percentage change, not on contribution to the S&P. It is down Well, there you go. It's still down there. Now that we're looking at points, it's down 10% after an earnings where crypto looked weak, disappointed. And at the same time, Amazon, Microsoft, those are up there too. Netflix is down. Some concerns about activist investors saying you should take the Paramount deal. So those shares start to slip a little bit. Let's look at the sectors, because you will see a lot of the economically sensitive sectors, and indeed most of them doing well today after really strong jobs figures. So energy does well, industrials, materials, infotech is having a good day. The only ones that are down at this moment, Matt, are healthcare and communications.
Communication services, those are the hyperscalers that I want to ask Dan Ives about, and I will do that on the other side of this break. Wall Street's new AI trade is sell the disrupted, but Wedbush's Dan Ives says not so fast. We'll talk to the big bull on his call next. This is Bloomberg Open Interests.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Wall Street has a new AI trade, dump anything that's at risk of disruption. Wedbush's Dan Ives has a more nuanced take. He says to use the sell-off to focus on Microsoft and Google as weaker software and wealth names slide. Hyperscalers are committing over $650 billion in AI infrastructure capex this year alone. Dan joins us now on set to talk about his call. Dan, great to get some time with you. This has been the SaaSpocalypse. Did you coin that term, Danny?
I wish I did. I did not coin it.
Okay, so I hear it from Danny all the time. But I guess we've seen, little press releases from Anthropic drive hundreds of billions of dollars in sell-offs. What do you make of that?
There's a better chance of me beating Ilya in figure skating than ultimately Anthropic taking out the software index. I mean, to some extent, look, the hearts and lungs of AI are going to be the use cases. So when you look at ServiceNow, Salesforce, they're going to play instrumental roles in the AI revolution. I mean, I can make an argument like a ServiceNow will be incrementally bigger in the next 2 or 3 years than they are today because of AI. So I just think there's a view. It's a knee-jerk. Look, on the edges, is it going to disrupt? Yeah. But I think right now, this is the Armageddon-like trade, the way software is selling off. And in our opinion, like in my career, going back to the late 90s, like it is the most head-scratching structural sell-off relative to what I believe is going to be the opposite as it plays out that I've ever seen in my career.
Not really head-scratching, because I think if I was running a big company and I had access to amazing AI, I would say, listen, chatbot, look at my CRM software and like make a better copy of it, so I don't have to pay for it every month.
Look, and that's like one, like in theory, okay, like from a high level, that makes sense. But the reality is, let's take a Salesforce, the hundreds of thousands of customers they have. You're talking about decades of data, how instrumental they are to come. A lot of times, if you're an outside vendor to get in, just based on security and infrastructure and everything, it takes 2 years to even get a demo. So I think there's a view, like, is it going to be disruptive? Yeah. But I also think there's in my opinion, it's about the ripple effect. For every dollar spent on an NVIDIA chip, there's an $8 to $10 multiplier across software infrastructure. That's why my view is like Microsoft, Oracle, you look at Nebius, you look at like some of the infrastructure players. I think what we essentially are going through what I'll view as almost like a DeepSeek type moment in tech. I view it as more of the golden buying opportunity given the CapEx, given the spending. I feel more convinced about the thesis today than I did before earnings.
There has been this other argument about spending, but specifically from corporate clients who are now just spending more on AI. That's what they're focusing in on. Everyone's trying to grapple and figure out how they make their company more proficient, more better, kill costs. And that comes at the sake of spending on enterprise software. Do you think that's fair?
No, I think that is fair. And that's why in the near term, it's a headwind relative to like 67% of IT budgets right now have to have some sort of AI focus. But my whole point is that as the use cases play out, and we've seen with Palantir front and center is really the one that's almost been the poster child. I think you'll see with Mongo, Snowflake, and others, they will play huge roles in the build out, because I don't believe like the AI revolution will not get to the heights that we believe it will without software, without infrastructure, without Microsoft, without Oracle. And that's why, I think some of this nerves here is, I think it's misguided relative to when we look at this year. This is going to be viewed as more the opportunity to own some of these winners rather than the time there was a structural sort of short.
Dude, my phone is blowing up because of your outfit. Viewers love it.
Well,
absolutely love it. And
I actually thought I thought we were going to match, but I guess I never got.
I wish.
He came in wearing something similar.
I'm on board. Listen, I wanted to ask you about the hyperscalers, like the business model changing. It's not asset light anymore. They're spending a ton on, obviously, the data centers. But Katrina Dudley had such a great answer that I'd rather ask you about that. I mean, her take is they're just digging a deeper moat with every $1 billion of CapEx they're spending, and that makes a lot of sense.
It's an arms race. I mean, the reality is you're building Vegas 1950s from the ground. You're building Dubai from 25 years. I mean, you're essentially building new cities, new infrastructure. Big tech right now, they're not going to slow down. That's why you talk about $700 billion, what ultimately will be $1 trillion spent. And that's why they need to do this, because if they sit back and watch from the stands, then they'll be out of a fourth industrial revolution. We're only in year 3 of an 8 to 10 year build out.
So when there is disruption coming, is it from them or is it from AI startups? Because some of the sell-off we've had, I think there was like a tax strategy AI startup that just announced, and it made Charles Schwab and other stocks like that sell off. Are they the disruptors, or is it these foundational models, the hyperscalers, that are going to be doing the disrupting?
Look, I think it's a combination. I mean, it's my view. Like, look, for the first time in 30 years, the U.S. is ahead of China when it comes to tech. So this is going to be a time of innovation in this country in terms of startups, in terms of the hyperscalers, in terms of what I believe is going to be also a lot of M&A as it plays out. You're going to go through white-knuckle moments like we're seeing over the last few weeks. But when you look at earnings, you look at CapEx, it's like follow the yellow brick road, follow CapEx. As CapEx continues to increase, that's bullish for the tech trade. And those derivatives, you could argue, are going to go into energy, financials, healthcare, as it plays out in terms of broadening market.
I just want to call out a client from My Huntington Bank, writes in and says, tell Dan Vernon Reed from Living Color called and wants his jacket back.
I like.
It's the cult of personality, bro.
Look, I mean, and this is, look, it's one, like, we dress the way we call stocks, maybe a little unconventional, but again, it's like, you know, it's one, like, it's adding some colors to this AI revolution.
I literally want to put in an order for that blazer.
You can. If you go to danivesclothing.com. So
Dan Ives from Wedbush Morgan. Always awesome to have you on.
Great to be here.
Thank you, Dan, as always. I wish we could continue this conversation, but we have to head to break. And after the break, Nike betting on new products to fuel its comeback. Will they be as colorful as Dan Ives' clothing line? We're going to bring you an exclusive interview with Nike CEO Elliott Hill in Milan. That's next. This is Bloomberg. Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersetchi in Davos, Switzerland, and this is Bloomberg.
The CEO of Nike, Elliott Hill, says he expects the company's wholesale business to pick up steam across the world. He spoke exclusively with Bloomberg's Romaine Bostic during his visit to the Winter Olympics in Milan on a wide range of topics, including opportunities in the outdoor market.
By the way, it's not just trail running, it's the overall outdoor industry, if you will. And there's no question that consumers there is a movement to getting outdoors, and whether it's in China or in Europe or in the United States. And so we looked at the overall outdoor market and the opportunity that exists there. And there is some crossover, but it is incremental opportunity from a branding and positioning and a revenue perspective. So we decided to go after that through the lens of trail running, which is a point of strength from us, where we can bring innovation to the market and newness and freshness, and decided to do it with the ACG brand because there is some awareness already around that brand, and it has an attitude and that we think is new and fresh, and it brings something different to the outdoor market. So we're really excited about what ACG is going to do for us long term.
So we're going to see more products
from
this line.
No question. You will see us continue to invest in the ACG brand. It's going to be around design, protection, attitude, innovation, and you'll see us extend beyond trail running moving forward.
I'm curious though, ACG's been around for a long time. It started out as a performance brand to a certain extent.
Top of the mountain.
Top of the mountain. A bunch of K2 climbers who for some reason decided to do it in a pair of Nike sneakers, and they sent it back to Nike. Said, look, here's some feedback. Here's how we can make this better. But ACG's been through some fits and starts, and I am curious as to why there hasn't been that continuity in the brand. Was it the marketing of it? Was it the innovation or lack thereof? What?
You know, I think with anything, it comes down to positioning, and I'm really excited about where the team's going to take this brand. We're going for the wild ones. So you think about the outdoor world with a little bit of an attitude and a swagger, with an element and an approach around design and innovation. And so, again, I'm excited for what the team has come up with and the positioning and the opportunity that lies ahead.
That was Nike President and CEO Elliott Hill speaking exclusively with Bloomberg's Romain Bostic, who is somehow at the Olympics in Milan.
How do I get that job?
That's pretty good.
It's pretty good.
He managed to wrangle that, and I'm proud of him.
I'm proud and quite jealous.
Coming up in the next hour, we'll discuss the gaming outlook with Hasbro's CEO, plus Kevin McCarthy joins us on his new role in defense.
Say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
CBS News on the Hour, your home for original reporting.
I'm Deborah Rodriguez. Hours after the FAA announced it was closing the airport in El Paso, Texas, over security concerns for 10 days, it's reopened. The problem, turns out, were drones from Mexico. Transportation correspondent Chris Van Cleve.
There had been concern about cartel drones that appeared to have breached U.S. airspace, prompting a government response. And those activities were creating some concerns about how all of those aircraft would interact with commercial aircraft, prompting the FAA, out of an abundance of caution, to halt all flights under 18,000 feet.
The Pentagon says the drones have been disabled. The El Paso airport is just across the border from Juarez, Mexico. A man investigators called a person of interest in Nancy Guthrie's kidnapping has been released after he was detained at a traffic stop south of Tucson.
They just told me to stop moving. Like, what's your name? Carlos. And that's it. They put me in the cop car. I got to wait like 2 hours. I waited like 2 hours until the detectives came here and everything.
It happened hours after the FBI released surveillance images of a masked person with a handgun holster outside Guthrie's door in Tucson. She's been missing for a week and a half now. The job market stronger than expected in January.
The Labor Department says the unemployment rate fell to 4.3% as employers added 130,000 jobs last month. Wall Street was only expecting 50,000.
This is a very healthy labor market overall.
Joseph Quinlan, the head of market strategy at Bank of America, was happy to see more people jumping back into the labor market because companies everywhere are looking for workers.
Good job growth, a lot of demand. So this is a very good story for the underlying economy heading deeper into 2026.
Michael Wallace, CBS News.
A big brewer is planning layoffs.
Heineken will cut up to 6,000 jobs, 7% of its workforce, over the next 2 years because of an industry-wide drop in demand for beer caused by rising prices and consumers moderating their alcohol consumption. The Dutch brewer says beer sales were down last year in critical markets, including Europe and the U.S.
CBS's Jim Crisula reporting. Lots of Seahawks fans will be calling out sick. Seattle is throwing a parade for its Super Bowl champs this morning. Lauren Ozick will be among them.
I told my manager, though, way before we even went to the Super Bowl, I said if we win, I'm not coming in on whatever day the parade follows.
The city estimates as many as 1 million fans could show up for the parade today. The Dow is up 119 points. This is CBS News.
Bonus.
An Olympic athlete comes clean on camera.
Sturla Holm Leigrid of Norway, after winning bronze in the men's biathlon, tearfully admitted to being unfaithful to his girlfriend. He called it the biggest mistake of his life. He says he revealed it publicly in a bid to win her back. Critics said it overshadowed a teammate's win in the event. Leigrid apologized for that and says he regrets speaking up. His girlfriend, who remains anonymous, expressed her pain and reluctance to forgive. Steve Kathan, CBS News.
Casting controversy resolved.
Have you ever thought about what you're doing to me?
Marty Supreme's Odessa Azayan has been replaced in the movie Deep Cuts by Last of Us actress Aurelia Bearer. Azayan dropped out after social media backlash. Post said it wasn't right.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube.com. We're also streaming live now on Bloomberg.com/videos. You can find all of the live radio and TV video there, as well as all the curated videos. That's the place to go for you. It is a busy jobs morning. Better than expected jobs report. We're going to break that down with Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. We'll get his thoughts there. Carol Pepper, founder and CEO of Pepper International, will get her thoughts on the markets going forward. Kevin Tynan, Director of Research at Presidio Group, he's going to recap those Ford earnings, taking more charges on the EV business. Brian Egger, Bloomberg Intelligence Senior Gaming Analyst, is going to talk to us about Hilton Hotels. They reported some earnings, so we'll get some news on the Hilton numbers and what it means for the greater hospitality space here. So it's Scarlett Fu, it's Paul Sweeney. We are live here, and we are with the Bloomberg Intelligence program for the next 2 hours, which we're going to kick off right now with John Tucker. John.
All right, the Dow Jones Industrial Average adding to its record close. This Bloomberg Business Flash brought to you by IBK. Our financial advisors switch to interactive brokers, lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest. Learn more at ibkr.com/RIA. You got to get used to this. The Dow over 50,000, 50,239. 50 points higher. That is up about 0.1%. The S&P 500 hovering near a record. 7 of the 11 major industry groups in the S&P 500 higher. We're being led by energy, industrials, materials, all the stuff that does well when the economy is doing well. I have to take a look at Mattel. That's one of the standouts, and not for the good reason. Mattel taking it on the chin. It's actually set up for the biggest decline on record. The holiday quarter missing earnings and revenue. Remember, they sell toys. It was the holiday season. Still, the major stock averages all higher. After the January jobs report, it came in much better than expected. Treasury yields, they're pushing higher. The idea that there's less reason for the Fed to cut rates. The 2-year 6 basis points higher at 351, 10-year up 3. That's at 417. Meantime, Claudia Sam at New Century Advisors says the adjustments we got, that adjustment showed job growth was nearly 900,000 lower in the 12 months through March 2025 than initially reported. She focused on that.
There's something here for us to understand about what exactly is happening with job creation and how comforted should we be by the latest numbers? Have we turned the corner, or is that just an aberration and we're going to get back into these really low numbers?
Once again, the Dow up 32 points right now. S&P 500 11 points higher than NASDAQ 100 up 59. Another retail comeback. Five Below. The story there, it's doing so by ramping up marketing to tweens and teens.
I thought that's what they always focused on.
Well.
Or tweens as parents.
I don't even know what that is. The discount retailer leaning into licensed products. It's capitalized on viral trends from Dubai chocolate to K-pop demon hunters. Again, I have no idea what those are. Anyway, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and Bloomberg.com/videos, and that's where you'll find us. Let's take a look at some of the stocks on the move. Today, we're joined by Bloomberg's Tatiana Darie. Tatiana, what are you looking at today?
Looking at Kraft Heinz, those shares are down about 1.5%, pairing a steeper drop from earlier after surprising plans to halt the split in two. That's a reversal from weeks after bringing in a CEO with experience to break up a food company. So Steve Cahilan took over on January 1st, said he made the decision to temporarily hold the breakup of the company to concentrate on bolstering profitability. Remember, the plan was to separate the company's fastest growing brands from the slower growing brands. And that breakup was essentially intended to undo Kraft Heinz' $46 billion mega merger from a decade ago. Warren Buffett really championed that one, but has since also expressed disappointed because since then, shares have fallen by about 2/3. So just last month, Berkshire Hathaway said they're seeking to sell their 28% stake in the packaged food company, and shares here have not been doing really well. So to investors, there's real confusion about this reversal right now.
But maybe the reversal also helps keep Berkshire Hathaway around. Who knows? What's the second stock you're watching?
Looking at Lyft, also shares down 15% after a disappointed forecast that missed Wall Street expectations and fourth quarter revenue coming in below estimates. The market is taking this basically as a sign that the company's global expansion and new product offerings are just not performing as quickly as anticipated. And to a lot of the analysts, Waymo's aggressive expansion continues to be the cause of that. We've also seen some of those cracks in Uber earnings, and analysts here are saying that this partnership with robo-taxis will take years to grow and become profitable for the ride-sharing companies like Uber and Lyft. And even a forecast from Bloomberg here saying that robo-taxis will double this year. So real competition there for Lyft and Uber. And really the stock here is back to where it was a year ago, basically flat, undoing some of those earlier gains
yesterday
this
I
year.
took a ride share for a variety of New Jersey transit issues. So I go to Uber, boom, $32. I say, okay, I'll go to Lyft, $25.
See?
Boom. I take the Lyft.
Done. And if you have a credit card, like the Chase Sapphire card, sometimes you can get credits with that too.
So I don't get that whole model there. But
wait, $25 to go from Manhattan to South
Long Branch.
Oh, so okay.
You said a variety of New Jersey transit
Yeah, so we're just New Jersey and I were just working it out here over the last couple of days.
It's complicated.
All right, one more.
All right, so at the end, it's Ford. Shares are pairing those gains actually about flat right now. They earlier reported an unexpected profit jump for 2026, even after being hit by a surprise $900 million tariff bill, because the Trump administration said the company could only apply a measure to trim tariffs paid on imported auto parts dating back to November rather than May. It looks like the market is sort of reassessing this report right now. Adjusted EBITDA seen climbing by about $10 billion in 2026. That is supposed to reverse the decline from last year. But really what stands out in this report is the focus on cost, that the company is seen as finally getting a handle on those costs. A lot of those issues stem from the fire at their aluminum plant. So now they're going to face those higher costs. And earlier, analysts said that this report is overall good, will add to momentum to a stock that's been gaining 49%. So it has a lot of tailwinds there coming from the rollback in emissions, coming back perhaps in consumer demand later this year. At the same time, costs really weighing on this company right now.
All right, Tatiana Darie, strategist for Markets Live, joining us with our market drivers. And for more conversations like this, subscribe to our Stock Movers Reports, 5-minute audio reports available on the biggest winners and losers in the stock market. That is available to you on Apple Podcasts, Spotify, or anywhere you listen. All right, we had a jobs report. It's weird that it's Wednesday and we had a jobs report, but the government shutdown, partial government shutdown, meant that data points were delayed, and the jobs report was a big one. And there's some big changes too, not just to what we saw for December, but for the previous 12 months leading to March. Ira Jersey is our Bloomberg Intelligence Chief U.S. Interest Rate Strategist. And Ira, there's a lot to unpack here. Let's just start with the January jobs numbers, which was a blowout compared to what economists were anticipating. And the bond market is reacting very decidedly by pushing yields higher, bond prices down, yields higher. We're looking at 130,000 jobs added in the month of January. How did everyone miss this?
Well, I think people didn't know how many healthcare people would have to be hired, because almost all of that came from the healthcare sector. 124,000 new jobs in the healthcare sector, which had been running more or less at 50 or 60,000, right? So a lot of this big miss was all from one sector. And the interesting thing about that sector, Scarlett, and this is, just to preview a little bit what I'm working on right now and we'll put out tomorrow morning, is that is actually the lowest paid sector within all of the major sectors within the economy, and one of the reasons is that it's not doctors and nurses that are included in that. That's actually very small part of it, but it's home care workers and people who work in assisted living facilities and the like that are there, and they tend to have somewhat lower wages, and also their wages are growing very slowly. So I'm not sure that this is necessarily like this blowout jobs report, and I think that the market kind of gets that joke too, right? 6 basis points in the 2-year yield is basically saying that's a quarter of an interest rate cut over the course of the next 2 years. You know, it's not nothing, but it's also not a massive move here.
We're going to hear about inflation on Friday. So how do you think that, you sit there, you put yourself in the Fed's chair midday Friday, how do you think they're viewing kind of what they need to do as a next step?
Yeah, I think that, the inflation story is going to be really interesting because you still have a little bit of tariff hangover, and, so the goods sector could still be contributing a little bit to inflation being pretty sticky. But I think that some of the important information that we're going to get is, how are services being affected by all of these things? Because if you look at the wage gains from today's jobs report, it does suggest that in January you had actually reasonably good wage growth. There's not a lot of hiring in some of those higher income services sectors, like I was mentioning before, but there were wage gains in those sectors. So basically, the people who have jobs are getting decent bumps in their paycheck, and that should keep services inflation relatively high. So it becomes a challenge for the Fed to cut interest rates if you wind up with something above 2.5%, CPI on a sustained basis. So I do think that they're going to be focused on some of those details. Not only do we get a 2.6 or 2.7, but what is the distribution of the price increases that we get within the CPI report.
Very quickly, Ira, so it's appropriate then that the first Fed rate cut is priced for July?
Yeah, we'd been thinking that they would wait until probably the second half of this year to cut interest rates, but then once they do, we think that there'll be a series of cuts. So that they might cut 75 basis points. Certainly, today's jobs numbers make us a little bit more skeptical that they'll go as quickly as we think. But I think as a base case, the potential for slower jobs growth, somewhat slower wage growth going forward, and that's the catalyst. It has to be the catalyst probably for the Fed to cut rates again the second half of this year.
All right, good stuff. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist on this January jobs report. It was a blowout if you just look at the numbers, but perhaps, as he mentioned, you look at the kinds of jobs and the quality of the jobs and the wage gains, and it tells a different story. It's always very nuanced when you look at the jobs market and the labor economy overall. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Let me start off with more Fed speak that we just got. The Federal Reserve Bank of Kansas City president, this is Jeff Schmidt, saying the central bank should hold rates at his words, somewhat restrictive level because of concerns over inflation that he says remain too high at this point. Now, the major stock averages, what a whipsaw. They've all turned lower right now. The jobs report today showing employers adding 130,000 jobs last month, way more than expected. But as Ira Jersey just pointed out, a lot of that was due to increased health care workers, which are lower paid. Still, it did push rates higher on the idea there's less reason for the Federal Reserve to cut. So you go to the more policy reactive 2-year, 5 basis points higher right now, 350, the 10s up 2 at 416, and the long bond just 1 basis point higher. That is right at, I'll call it 480 at this point. The laggards in the Dow right now include Salesforce, IBM, and Microsoft, and the worst performing stock in the S&P 500, down close to 13%. That belongs to Robinhood Markets, the fintech company reporting net revenue for the fourth quarter missed estimates as crypto volumes, they declined. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett.
All right. Thank you so much, John Tucker, for that. It is earnings season right now, and one of the most anticipated set of results that came out today came from Kraft Heinz, mainly because the food company had been on this mission to split itself up into two in order to really free up its faster-growing business from its slower-growing business. Christina Peterson is our food industry reporter and has been reporting on Kraft Heinz. And Christina, the new CEO over at Kraft Heinz surprised everyone by saying, you know what, I'm not going to split up the company. What's the thinking here?
That's right. He's only been on the job since January 1st, so I think this came as a surprise to folks that the split was called off about 5 months after it was announced, or paused. There is no end date to the pause, so we don't know if it will at some point resume. But the CEO, Steve Cahillane, said that he came on the job knowing that there had been levels of underinvestment in Kraft Heinz's brands, and decided that after reviewing all of them, that there were brands that would respond to more investment. So they announced that they would be putting $600 million into things like R&D, marketing, and lowering some prices in hopes that that would bolster the entire company and that would be in a better position, put them in a better position to evaluate whether they should move forward with the split.
So what do most investors want? Do you think they want the split up? Sometimes split ups work. A lot of times they don't. What have investors been saying over the past months?
There's clearly been some anxiety among investors since the news of the split was announced. I think that the new CEO was seen as there were hopes that he would do what he had done with the Kellogg Company, which split into two publicly traded entities, and then were both of those companies were bought by privately held entities. So there was some speculation that the same thing would occur at Kraft Heinz, and Cahillane said basically not yet.
Really?
There's another twist to all of this, which is that Kraft Heinz's biggest shareholder is Berkshire Hathaway. And Warren Buffett, who runs Berkshire Hathaway until he handed the reins to Greg Abel, said he was never a fan of that idea to split up the company. I mean, he was kind of the mastermind behind Kraft Heinz becoming the behemoth it was, and that didn't work out so well. But he made clear that the split was not a good thing in his mind. Do we think that has anything to do with this about-face?
I don't know. It is clear that he had publicly expressed disappointment in the split, and his successor had said in a filing that Berkshire Hathaway was taking steps to sell its 28% stake in Kraft Heinz. So clearly they were nervous about this and not fans of the news.
So do we have any idea how long this pause will last? I mean, is he trying to turn stuff around, make it maybe better, so if when they do split it up, it would be worth more? What do we know?
They clearly are not going to make the decision this year. They talked about returning to growth in 2027, so it seems like this is a months away decision.
Oh, the investment bankers who had that on their deal sheet for 2026.
But they get paid in the meantime for the work that they've done, right?
Nah, you don't get paid until it closes.
Oh, really?
Yeah.
You can't bill them along the way like
No, we're
lawyers?
not lawyers. Okay, we get paid. We take a cut of the.
I like how you still say we.
Yeah, exactly.
Because you feel for these guys.
Yeah. What's next for Kellogg? What does the company want to do now as a standalone company?
For Kraft Heinz?
Yeah.
Well, they've talked about releasing some healthier products. They are launching a Kraft Heinz mac and cheese Power Mac with protein and fiber.
I knew it.
And they will be lowering prices. They talked about the opening price points being important for low-income families. So those are some of the areas that they're going to be focusing on, some healthier options, more affordable price points.
So Kellogg was the example of a company that split into two and then both got taken private. I mean, is that a trend overall in the food industry to split yourself up after being kind of a big overall food company?
You know, I think we're seeing examples of both, of companies getting smaller and bigger. There's obviously a lot more criticism and focus on ultra-processed foods. Packaged food companies are dealing with this. We saw the Super Bowl ad this weekend saying processed food kills. So I think big food, generally speaking, is trying to figure out what to do with these headwinds.
So what is the story there? Is this a short-term blip, this whole processed food thing? Or has this been brewing? Because I hear more and more and more about that being a cause for so many of the ills in healthcare and in people's health.
I think this is the first time we've seen an administration come down so harshly on ultra-processed food. That's clearly been a huge focus of Health Secretary Kennedy, and the White House has backed him up on this. Of course, Americans don't always eat the way they say they want to eat. So, you know, there's plenty of Doritos still being eaten, even as people say they're trying to move away from processed foods.
All right, good stuff. Christina, really appreciate your joining us for this latest story. It's a fascinating one, especially since Kraft Heinz shares had been slumping, because of 9 straight quarters of falling sales. But now they're kind of unchanged as people try to figure out what this all means. Thank you so much, Christina Peterson, our food industry reporter. Let's shift gears and talk about the markets overall. Carol Pepper, she is founder and CEO at Pepper International, joins us now. And Carol, I have a question for you about why it is that initially we got this better than expected jobs report that definitely sent treasuries falling, pushing yields higher, but initially gave equity bulls a reason to bid prices higher. We've now seen equity prices turn around and they are lower, but what does the better than expected January numbers mean for the equity market?
Well, I think the numbers in January are better than expected, but look at the revisions for 25. The revisions for 25 were quite low. Depressing. I mean, think about it. Only 180,000 jobs for the entire 2025, and now they're saying 130,000 jobs in 1 month in January. I think the market is feeling like that number is going to get revised down as well. So yes, it's good news, but are jobs really that strong? And will they have to do more stimulus? Yes, investment has been mostly going into capital assets and not into labor assets. But at some point, if you don't have enough consumers working, it doesn't make sense to keep investing in capital assets. So I think that's where we are. The market is not quite sure how bad is it really, because revisions were radically different.
Carol, we've seen in the equity markets just in the last 3 months or so a kind of a marked rotation out of some of the high growth, high multiple stocks into more cyclical names and maybe even to small and mid cap. How do you view that? Is that something that maybe is a short-term trade, or is that something more pronounced, do you think?
I think it's a short-term trade, unfortunately. I mean, people are always looking for where can I get better value. You know, they would prefer not to get in at a very high price. But the leaders will continue to lead, and those with a lot of cash on their balance sheet are going to win because they can keep investing. And as you guys know, I invest for family offices, and we look for multiple generation plays. So the biggest and the strongest companies in the end of the day are going to win. Yes, you can take a small allocation and try to game the smaller cap stocks, but at the end of the day, the larger cap stocks are going to continue to outperform, I think, in the long run.
What about the U.S. versus international markets? As well as the U.S. market did last year, a third straight year of double-digit gains, it underperformed the rest of the world. And valuations certainly overseas look a lot more attractive than big cap stocks in the U.S. do.
Definitely. I think there's a lot of growth happening in the rest of the world. I literally just got back from Dubai, and it reminds me of New York in the 90s. I mean, the amount of energy and deals being done in Dubai is unbelievable. So I do think there's a lot of action going on outside of the U.S., and I do think people should consider strongly increasing their allocation to non-U.S. stocks. But for U.S. investors, that means maybe going from 10% to 20%. I don't see a case, at least for most U.S. investors, where they're going to go much above 20, 25% offshore. But that's something to consider nowadays, because there is more value happening and there's a lot of growth happening in the rest of the world. The levels of technology now available to every single country is quite level. So whether you're in Dubai or you're in Singapore, you have as much access to technology, and in some cases more, because you have some of the advanced Chinese technology that we can't get over here. So that is giving the emerging markets and the growth markets, where they have a lot of young populations, a chance to really rise. So I definitely think it's time to look at non-US markets and maybe up your allocation by 5 to 10% as you look for value.
Is the Sell America trade, A, was that ever a thing in your mind? And B, is it still out there as you talk to your clients?
No, I don't think it's Sell America. I think it's diversify some part of your nest egg outside of America. Because again, we are in a very uncertain time in this country. And so it's, there is an argument to be made. That's why you see gold going up so much. And a lot of family offices are buying gold and just popping it in a vault in Switzerland or Singapore or Dubai, just to have some assets outside of the US. So it's sort of the nest egg needs to get diversified into different countries, but it's not really so much sell US as it is have a other places as well, just in case, the tail end happens.
Carol, are you doing that? Are you buying gold and popping it in the vault?
Yeah, absolutely.
I think it's the thing to do so.
Yeah, absolutely. I don't think we're out of the woods at all in terms of uncertainty. I think it's going to be a roller coaster of a year here in the United States. And I think gold is going to go more towards 7,000. I really am with those gold bulls on that trade.
All right.
What about silver?
How about silver?
I don't think so. Silver just doesn't have the intrinsic global trading value that gold does.
Carol, thanks so much for joining us. Appreciate it. As always, Carol Pepper, founder and CEO of Pepper International. Got a unique perspective, Carol does. She really works with the family offices, and they oftentimes have, different needs. Maybe they have different time frames, and they can put some stuff in different parts of the market, like alternative investments. And really
gold being one of them, although it's not so alternative these days anymore, is it?
No, people, some people go out and they buy timber. Things like that. I'm like, so that really get off the grid there on some of those names. So we'll keep an eye on that. Coming up, we're going to talk to Kevin Tynan, Director of Research at the Presidio Group. Ford earnings out again. Boy, these auto companies are just trying to figure out, how do I just get from here to there? There being some EV, policy.
But not spending too much on it.
Not spending too much on it, because, boy, I make so much on these trucks, these big vehicles.
High margins.
Exactly.
They guzzle a lot of gas, but the consumers don't seem to mind.
No, and but the rest of the world is just moving so quickly to electric vehicles, but not so much here in the U.S. So it's been a real conundrum for the Fords and the GMs and the Stellantis of the world. So we'll check in with Kevin Tynan. He's been following the auto industry for decades, one of the best voices out there. That's coming up in just a moment. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom. With this Bloomberg Business Flash, it did a real U-turn about 40 minutes ago. The major stock averages all lower right now, but almost evenly split, interestingly enough, between losers and gainers. In the S&P 500, you have the laggards. They include Salesforce and right now IBM. Salesforce down over 4%, IBM down close to 3%. The Treasury yields, that could be the real story this morning. They are higher in the driver's seat to some extent after the jobs report for January. A lot better than expected, at least the headline numbers indicating. So it seems to reduce the chances of a Fed rate cut anytime real soon. Right now, the S&P 500, 6 points lower. The Dow down 168. The NASDAQ 100 down 27 points. The 2-year yield up 5 basis points. That is at 350. Lisa Shallot at Morgan Stanley has a warning for investors. She says, interestingly enough, get out of small caps.
The small cap cohort is really, really low quality at this point. We've gone through, literally a decade of private equity picking off the most durable, leverageable business models. And what's left in the public market, literally 43% of the Russell 2000 is unprofitable.
Russell 2000, by the way, right now, down 1.2%. Here's another warning. This is from, and we've heard this before, the Congressional Budget Office this morning, saying the U.S. is on an unsustainable fiscal path. They've increased the estimate of deficits for the coming decade by $1.4 trillion because of the president's tax law and also the immigration policies. So there you go.
It kind of doesn't matter who's in office. That deficit just keeps getting bigger.
It's close to 40. I don't know. I forget what the number is, but the overall number
gets bigger.
And I
40.
hate the response to that, which I hear from a lot of people. As long as the buyers keep showing up at the Fed window to buy our debt, we're that is scary.
Look at China. But anyway, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul Hall.
All right. Thank you so much, John Tucker. I feel like that look at China remark, that was a bit of a throwaway line on your part. You could apply that to the entire auto sector because of what's happening in the EV space. Speaking of autos, let's talk about Ford. Ford, not doing a whole lot with EVs. It certainly has trimmed down that part of its business, and it's really, really doubling down on the big SUVs and big pickup trucks that are high margin and,
somebody
high
I know
prices.
has been saying that for a long time.
Matt Miller?
No. Kevin Tynan.
Kevin Tynan is our next guest. He is the Director of Research at the Presidio Group and, of course, a former friend of Bloomberg Intelligence as well. Kevin, it is great to see you again. Let's talk a little bit about Ford and the fact that, first of all, it sees a profit rebound in 2026. What is driving the profit rebound beyond? Is it as simple as this doubling down on the big gas-guzzling SUVs and pickup trucks?
Look, and I think the other thing is going to be that big tariff hit that you had in 2025. Not that it's going away in 2026, but I think it gets passed down through the retail base and on to the consumer. So there was a lot of absorption of those costs by all automakers in 2025. And then there's more visibility. Look, and you guys said this in the lead-in, is that the truck strategy has been in place really for going on 15 years. So this is not just simply immediate relief from having to do EVs unprofitably and being able to focus on trucks. This has been the strategy really since really coming out of the bankruptcy period when operating profit returned around 2012, 2013.
Hey, Kevin, I'm looking at the stocks, which is where I usually start when looking at companies and industries. What's the market telling me? Ford up 50% over the trailing 12 months. GM up 75% over the trailing 12 months. What's going on here? Is this investors, I guess, applauding the fact that some of these automakers are maybe stepping back a little bit from their EV plans and maybe focusing a little bit more on profitability?
And look, the other thing there, Paul, is that there's sort of this structural shift in the U.S. auto industry, which is away from volume for volume's sake. And you hear people lament the lack of affordability. But manufacturers have really gotten away from that. And there's two ways you're going to grow revenue and profit contribution. One is to sell more units at lower margin, or you're going to sell fewer units at higher margin. And finally, post-pandemic, the automakers have opted for the latter, which is to say we're okay with a 15.5, 16 million unit market as opposed to 17.5, 18 million, but we'll do it at $50,000 average transaction price with better operating margin on those units. For many, many years, it was about utilizing your capacity, covering fixed costs, and just stamping out units.
Oh,
I think a little frozen
technology is not helping us here today.
No, exactly. Maybe even dial back and see if we can get Kevin. But I tell you, Kevin's been saying that for the longest time, which is, listen, the incentive for these auto manufacturers is not to lead the way into EVs. It's to make money. And you make money on your F-150s. You lose money on some of these EVs. Now, they're willing to make some investment over some period of time. But, given the ability to pull back a little bit and focus on the profitability, they'll do it.
And that's different from, say, the Chinese car industry, where there's a lot of public subsidies to support the development and the growth of that EV industry.
Yep.
And I bring this up because I remember reading that Canada is going to allow the country to import Chinese EVs. And I wonder how that's going to change the competitive landscape for cars in that market and what that means, whether there's any spillover into the U.S. market.
Yeah, I mean, from all I hear, all the reporting is that these Chinese cars are really good quality. And
cheap.
BYD, and they're cheap. And they're really dominating in many, many parts of the world from an EV perspective, with the big exception of the U.S., where they're not sold.
Where there's all these barriers to prevent that from
So
happening.
from a competitive perspective, I mean, that's kind of, it just feels like the Chinese EV makers are going to own the space. And I don't know to what extent any of the, Western automakers want to really be aggressive in competing against them. Like you think about Volkswagen and things like that. I think the European ones are more aggressive than the U.S. companies, but still.
Right, well, because they're competing against the Chinese EVs in their home market, and they're probably decidedly going up market as opposed to trying to compete with China on the lower end, more affordable cars. You have an EV driver in your family, right?
We have a hybrid.
Oh, you have a hybrid.
We did the hybrid
you didn't
thing.
Go full into EV.
No, and for all the reasons that people wouldn't. It was too expensive, number one. Number two, the range is just not there. The recharging infrastructure is not there. So the EV, the hybrid, solves for all of that.
Right.
So
you can still find a gas station. You just don't have to go as often.
Exactly. And it just recharges itself as you drive along. So and he's out there. My youngest is out there in California, where the gas is crazy expensive.
Yeah, that makes sense.
So that was the pitch he made to me. It was actually not a bad pitch. It was rooted in economics, so I give him a little bit of credit. So I kind of caved on it. Yeah. I think he talked to his older siblings to map it out. But
has Matt Miller purchased an EV or a hybrid?
No, I don't think so. He's just got the loudest one. Hey, Kevin, thanks for coming back to us. Kevin Tynan, Director of Research, Presidio Group. Just real quick, Kevin, before we let you go, where is Detroit right now in their EV strategy? Is it just going to go slower, but we're still going? Is that the strategy?
Yeah, and look, ultimately China owns the supply chain, right? So until we build that up, where we can have some cost advantage there, it's not going to get more affordable in terms of production. And while it's not profitable, it doesn't make a ton of sense. So moving slower, but really you got to put that supply infrastructure in place first and foremost.
And that's a slow build out. That takes a long time. You got to get a lot of stakeholders on board, and that doesn't come quickly. It's another form of NIMBY, really, because something has to give way for that. Kevin, really appreciate your joining us, and I'm sorry about the technical issues. Kevin Tynan is Director of Research at the Presidio Group, joining us to talk about Ford. Ford, of course, coming out with this profit rebound, a surprise profit rebound after this $900 million tariff surprise. It's been really, really difficult for these manufacturers to try to figure out.
Ford, GM, Stellantis, they've all taken huge multi-billion-dollar write-offs. So it's just been really tough from a financial perspective.
On top of that, the president is thinking about exiting the USMCA that he signed in the first term. So that just adds to the confusion.
Yep, the uncertainty, and a lot of the subsidies that were supporting EVs in this country and benefiting the EV industry and Tesla and Elon Musk, those are gone. So some of the financial incentives to help you get to an EV, they are no longer there. So it has to compete on economics. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. We're also streaming now on Bloomberg.com/videos, and that's where you'll find our stuff as well. So you can get it anywhere you want there. Hilton Hotel reporting some numbers here today. Beat expectations. People, you can't get a room anywhere. If you do, you got to pay through the nose. And the consumer seems to be doing fine when you look at some of that stuff. Brian Negger, Senior Gaming and Lodging Analyst, joins us here in our Bloomberg Interactive Broker Studio. Hilton Worldwide, stocks up about 1% today, 52-week high today, so pretty good for them. It's got a market cap of $75 billion. What did Hilton report from an earnings perspective?
Yeah, so I mean, what we saw in the quarter was kind of mixed in terms of U.S. being down a little bit or maybe a little below RevPAR in the fourth quarter, mostly because of the government shutdown, so a bit weaker inbound travel to the U.S., a little bit weaker government travel. But the outlook for next year, for this year, 2026 is pretty good, 1 to 2% RevPAR growth.
That's revenue per available room.
Per available room, yeah. And so leisure, group, luxury, all kind of strong. International, a little stronger than the U.S. But although this is an aging upcycle in the lodging industry, it's still got some legs to it.
Now, Hilton, along with many of the other hotel companies like Marriott, has an asset-light business model, which means that it's brand licensing, right? They don't actually own and manage any of their own properties. And that, allows it to move more nimbly. The profit margins are much higher. What's the downside of that, Brian?
So, I mean, there's some benefit to actually owning the real estate when you're really in an upcycle, but this kind of fee-based model is a very capital-efficient way to expand and grow. You get your franchise fees and management fees. They've got a little bit of owned hotel exposure as well, but most of the lodging companies separate from the REITs are actually asset-light manager franchisers with some owned assets.
Yeah, I'm looking at, you got a company with, $13 billion of revenue, call it, $4 billion of EBITDA, $100 million of CapEx. Are you kidding me? That is awesome. So who builds if Hilton wants to build a new hotel in South Beach, they don't build it, somebody else builds it?
Yeah, so you have like ownership entities. Obviously, you've got the REITs like Park Hotels and Resorts and others that own the real estate. So this is, as you said, like an asset-light, franchised, management tree-driven business with some owned hotels. There is some owned hotel exposure.
So what do they do with all the free cash flow every year? They get, most of that EBITDA goes down to the free cash flow line.
They have been returning capital, right? So they've got capital returns. And, there is real opportunity for growth within their business model. And a lot of that is international, a lot of conversions, a lot of conversions from other assets that fit very well under their brand flags. And they have also been launching some new brands as well in kind of that lifestyle category.
How many brands do they have right now?
So where do they know? I know Marriott's 31. I'm trying to remember what Hilton's count is right now.
So that's all those 31. Is that just slicing and dicing the market?
Yeah, it is. I mean, I think overall, if you slice the market segment-wise, Hyatt and Marriott are more prominent in the luxury highest end. Hilton has some luxury, but it's also got a very solid kind of mid-scale limited service portfolio. And so what you tend to see is that in this environment, luxury upscale tends to outperforming, and the limited service is somewhat weaker, partly because that's where you've got the government travel, you've got the transient independent business travel, but stuff like leisure, group, luxury, particularly international markets, UAE, Europe, non-China, Asia, all have been really quite strong.
I wonder, Brian, I know you don't cover Airbnb as a company, but do you ever see any correlation between the performance of Airbnb and, a Hilton or Marriott? Because I'm sure in markets where Airbnb is not allowed, like New York City, for instance, Hilton benefits.
Yeah, I tend to think of, the OTAs, the Airbnbs of the world as being a factor with respect to both Las Vegas lodging, particularly in kind of the value-conscious consumer limited service. You've got some extra inventory there where it's good for that kind of last-minute inventory management. But the big focus of Hilton, Marriott, Hyatt has been the loyalty programs and the strong correlation between loyalty members and kind of booking directly. So there's that aspect as well.
The Walt Disney Company called out in their theme park business some weakness on inbound international travel. Are the hotels seeing that as well?
There is some of that. I mean, some of that's from Canada, tariff-related. I think kind of globally, the weaker areas maybe are inbound U.S. travel, U.S. government travel. China's kind of flat. The strong areas are all the other categories we talked about, luxury, group travel.
I always say to my Canadian friends, the first time it drops like below 20 degrees or 10 degrees in like November, you guys are booking your flights down to Florida. Let's be honest.
You'll sing a different tune,
You'll
right?
sing a different tune.
Brian, how exposed are the Hiltons and the Marriotts of the world to, the whole credit card debate? The president wanting to cap interest rates to 10% on credit card companies, and that putting at risk all these reward credit cards programs.
It's a consideration partly because a big part of that franchise fee line you see for Hilton and Marriott is actually fees from co-branded credit cards. That's actually a big kind of fee source. So all else being the same, the royalty rates and the level of credit card activity are somewhat of a driver for these franchise fees, these I should say, co-branded credit card license fees, which kind of find their way into the franchise fee line. So it is important.
Do you book, when you go to book a vacation, do you book a certain brand because of the points and loyalty?
I will be, but I haven't so far. I like using Airbnb because then you have access to a full kitchen and you can find something more to your liking.
Interesting, because for airlines, for example, I have to go United because I fly out in New York. For hotels, I don't. I haven't gotten into that whole brand loyalty thing, but I know I'm the exception.
Yeah.
People are really into that. So, Brian Negger, thanks so much. We appreciate it. Brian Negger, Senior Gaming and Hospitality Analyst for Bloomberg Intelligence. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Wednesday morning. There we go.
Here you go.
I wasn't sure if the microphone is on, but it is on. Good Wednesday morning from the Bloomberg Intelligence team. John Tucker, Paul Sweeney, Scarlett Fu here with you.
It's only Wednesday?
I know. From the Bloomberg Interactive Brokers studio in Midtown Manhattan. The second hour of Bloomberg Intelligence begins right now. We've got a lot going on. Clearly, earnings season is in full swing, but we're going to talk about what's starting off. We're going to start off by talking about what's happening in Washington. Tyler Kendall, our Bloomberg Washington correspondent, will be telling us about how the president is privately considering dropping out of the USMCA, that is NAFTA 2.0. That's a deal that he negotiated during his first term. What's going on there? We'll find out from Tyler. John Butler will join us to discuss T-Mobile earnings. He is our senior telecoms analyst. And of course, we have to take another look at the jobs report that came out today. It was delayed because of the partial government shutdown, but a big blowout number for the month of January and some negative revisions for the past 12 months. Jeffrey Cleveland is chief economist at Payton & Rygel, and he will help us do that. And our Romaine Bostic traveled to Milan to speak with the Nike president and CEO, Elliott Hill, which is in turnaround mode. We're going to hear directly from Mr. Hill on how that effort is going. First, though, let's get a check of the markets with our John Tucker.
All right, Scarlett, thanks very much. And right now, the major averages, they have turned mixed. They were higher earlier after the jobs number, with the Dow Jones Industrial Average losing 167 points right now. That is down 0.3%. Still above 50,017 right now. The major stock averages, again, mixed. Treasury yields pushing higher. We have the more policy-reactive 2-year that is up close to 6 basis points right now. That is at 350, with less reason for a Fed rate cut anytime soon after the jobs report that we got this morning. You have 7 of the 11 major industry groups in the S&P 500. They are higher. Energy in the lead, followed by consumer staples and then industrials. And the worst performing stock in the index that belongs to Robinhood Markets. Nora is going to tell us why in a few minutes. The best performer, Generac Holdings. These are the folks that make the generators, 16% higher. So one analyst is writing they should benefit from the build-out of data centers. Meantime, Stu Kaiser at Citigroup Global Markets is expecting the rotation into more economically sensitive stocks to continue.
The positioning in large cap tech and growth had built up over 2 to 5 years. This is a massive positioning in the market. You're not going to sort that out in 4 to 6 weeks. So I think if the economy remains solid and people want to be in that cyclical part of the market, it can keep going.
S&P 500 right now down a point, 69.40. The NASDAQ 100 10 points higher. And again, the Dow right now down 207 points, 49,979. Kind of all over the place. Elon Musk told employees of XAI in a meeting last night the company needs a factory on the moon to build the AI satellites.
Sure.
And also a massive catapult with which to launch them into space. Since founding...
Sounds totally doable.
Sounds... No commentary, please. This is Elon. Since founding SpaceX in 2002, he actually said he wanted to build the colony on Mars, but in recent months, he's shifting away from Mars more toward the moon, posting on X. Okay. The new focus, the moon.
All right.
Giant catapult. Remember Alice went to the moon? To the moon, Alice?
Exactly.
You know that reference?
Nobody.
The honeymooners. Anyway, we check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker. That's your Bloomberg Business Flash. The Honeymooners was a black and white show with
I've heard of
Jackie
it.
Gleason.
Yeah, back in the day.
Back in the day.
Right, well, you can Google it. It's out there. Scarlet Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and also streaming live at Bloomberg.com/videos, and that's where you'll find us here. John Tucker was just reporting some red and green on the screen today. Let's see what's happening out there in the world with some stock movers. Today we're joined by Bloomberg Television's markets correspondent, Nora Melinda. Nora, what are you looking at today?
Well, tough day for Mattel. That's ticker MAT. We're seeing the toy maker plunging as much as 29% today. That's the worst day that the stock has seen since 1999. So we did see holiday results that fell short of analyst expectations. And the company also issued a 2026 forecast for lower profit. And it seems as though the street doesn't really like that. We did see a downgrade from JP Morgan, cutting the stock to underweight from neutral and lowering the price target to $14 from $23. They're saying that this downgrade and price target adjustment really reflects the lack of visibility to Barbie improving, as well as the uber importance of the back half. So we'll just have to see what happens, but it's not looking pretty right now.
Company went public May 1st, 1969. Smith Barney was the underwriter.
Ah, there you go.
Wow.
Such a contrast to what we heard from Hasbro.
Hasbro, you know what? I think as Hasbro has the all that e-gaming stuff, and I think they have more of that, a bigger share than Mattel does. So
That's fair.
And, you know, Barbie the movie was like 3 summers ago at this point.
I know.
So in the rearview mirror. All right, let's talk about your second stock.
Worst performer in the S&P 500, Robinhood, ticker HOOD. We're seeing shares tumbling double digits as well. This is the biggest drop since April for this company, down as much as 13%. So its net revenue for the fourth quarter missed the average analyst estimate. A lot of people are really pointing to the idea of crypto volumes declining, especially as you look at the end of 2025. That really was a major drag on this company. We saw net income tumbling 34% to $605 million. And the company CEO said it's just the beginning of a prediction market super cycle, and they aim to expand into several new markets later this year. But seems as though Wall Street is really trying to decipher how they feel about the outlook in terms of looking ahead.
All right, real quick, Zillow.
Zillow, ticker ZG. Looking at the housing market, this company hitting its lowest intraday level since August of 2024. This is after its forecast for adjusted EBITDA in the first quarter fell short of analyst expectations, as well as the company has really been contending with a lot of legal costs and expenses because of its partnership with Redfin.
All right, Nora Melinda, thank you so much. We appreciate that. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio updates on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Probably time to get down to Washington, D.C. to get the latest news on what's
We've
going on
managed to
there.
avoid it so far.
We tried to avoid it so far, but here we go. Tyler Kendall, she can't avoid it. That's her job. She is the Bloomberg Washington correspondent for Bloomberg News down there in D.C. Tyler, there's like there is most days, there's a million ways to go here. Let's go with Mr. Netanyahu at the White House today. What's going on there?
Yeah, hey, Paul. So this is the Israeli Prime Minister Benjamin Netanyahu's 7th visit to the White House under President Trump's 2nd term, and it is our understanding that he is here today with the main mission being that he wants to talk to the president about the U.S.-Iran negotiations. There is reporting that he is set to introduce some new military intelligence regarding Iran's military capabilities to the president as these talks continue. Now, this visit to the U.S. by Netanyahu follows his own meeting in Jerusalem last week with Special Envoy Steve Witkoff and the president's son-in-law Jared Kushner, who are leading the now bilateral talks between the U.S. and Iran. We saw that first round of them on Friday. Both sides characterize them as being relatively positive, but going into them, we know that the parameters were contrasting between the two sides and that they ultimately ended up shifting perhaps in Iran's favor. Iran wanted the talks to be bilateral and only focused on its nuclear program, but we know that Israel and the U.S. are pushing for some other critical items to be on the negotiating table. That includes Iran's ballistic missile program, its support of proxy militia groups, and the U.S. wants to bring in some other regional partners to these talks. If you ask White House officials, they'll tell you that their voices are really critical in the engagement in a bid to try to spur some more regional stability that can be a little longer lasting. So Paul and Scarlett, at this point, Netanyahu is here in Washington. He's not quite yet here at the White House, though there was a meeting set for 11 a.m. Eastern. We're waiting for his arrival, but Iran is going to be front and center on the table today.
It is, and you are joining us from the White House lawn. We hear a lot of noise behind you. What's going on over there?
At this point, it appears that there is a rather large protest. I will say they're pretty far away. For our radio listeners, you probably can't even see on television, but the square by the White House is absolutely locked down. There's, of course, heightened security when a foreign leader is here, and they are anticipating Benjamin Netanyahu to walk from the Blair House, which is just diagonal from where I am on the White House North Lawn, and that's where protesters have lined up against that security perimeter to try to catch a glimpse of the Israeli leader as he heads over here for talks with President Trump.
All right, next question for you, which is something that we have been talking about this morning, and it's figured pretty highly in the Bloomberg stories in terms of by reader interest, is the president is considering dropping out of the USMCA, which is kind of NAFTA 2.0. This is a deal that he spearheaded in his first term.
Right. That's a really good point, Scarlett, and kind of gives us some context as we examine this reporting. People familiar telling Bloomberg News that he is privately mulling, potentially exiting the USMCA. Now, we should say that this isn't necessarily surprising. There has been talk here in Washington for months that this could be an option. You ask officials here at the White House, they say that they like to keep their options ultimately open. And look at President Trump's comments from just a few weeks ago when he was touring a Ford Motor plant. He called the agreement irrelevant. Now, our reporting does indicate the president has stopped short of flatly signaling that he will indeed pull out, but officials have made clear he's the ultimate decision maker, and this is potentially a decision that could be on the table. We heard from the USTR Jamison Greer yesterday, who spoke about how bilateral negotiations are ongoing, the U.S. and Mexico, the U.S. and Canada, because relations between the U.S. and Canada at this point are very strained. This is consistent with what has been a recent escalation in tensions between the two countries, perhaps kicked off at Davos when the two leaders exchanged some tense words. President Trump revoked that invitation for Mark Carney from the Board of Peace. He then threatened 100% tariffs over Canada's pact with China, 50% tariffs targeted at Canadian aircraft, and then just in the last week is now threatening to block that critical bridge that's been built between the U.S. and Canada. So there's been a lot of escalation recently, which has led analysts to say perhaps this is posturing ahead of the USMCA as the administration tries to bolster its position going into these very critical talks that could impact about $2 trillion worth of trade in goods and services between the three countries.
And also before the midterm elections as well. Tyler, thank you so much. Tyler Kendall is our Washington correspondent joining us from the White House lawn before Benjamin Netanyahu, the Israeli Prime Minister, arrives to warn President President Trump against a narrow Iran deal. Let's get back to earnings right now because plenty of companies reporting. We are past the point where big tech is reporting. Now it's consumer-related companies. We have a telecom name reporting. One of the biggest, T-Mobile, adding fewer subscribers than anticipated, yet the stock is moving higher. John Butler is our senior telecom analyst. And John, in terms of the actual growth in its subscribers, this was a disappointing quarter for T-Mobile.
It was a bit of a disappointment for T-Mobile, Scarlett. I think one of the things that really impacted them is we've seen Verizon, which now has a new CEO who's come in. He's very volume focused. So he's out there. They're promoting heavily. They're trying to win new subscribers. And I think it took a bit of a dent out of T-Mobile's growth in the fourth quarter. I think one thing T-Mobile did, which was smart, is they combined the 4Q report with a Capital Markets Day update. They updated their 2027 guidance, and they increased their free cash flow outlook for 27 by $1.5 billion. And so when you saw them do that, you saw an inflection in investor sentiment almost instantly, because again, this has gone from a story of revenue growth. Now they're pivoting more to free cash flow growth. They're really pointing investors to that bottom line to get the focus off of revenue growth as things get more promotional and as industry growth slows.
So is this a new wave of just, I guess, across the board? If Verizon's getting a little bit more promotional, does T-Mobile to AT&T, do they have to respond, or are there other things they can do?
So great question, Paul, right? We're in a mature industry backdrop now. Growth overall is slowing for everyone. T-Mobile is not alone in pointing to free cash flow growth. You've got AT&T and Verizon doing the same thing. And so I think, again, with that new CEO in place now, you've got T-Mobile sort of driving a growth story that centers on not only smart promotion, but also driving into adjacent markets like advertising and even credit cards.
Yeah, I'm a T-Mobile subscriber, and there's always a ton of emails from the company offering all kinds of different services and deals. And it really feels like they're just trying to envelop you into their ecosystem. John, I kind of call the effort to sell internet access to add broadband customers a side hustle for these telecoms companies, but this is how they can make sure that they continue to build out their customer base, even as they try to fight for market share when it comes to mobile phone subscribers. How is that side hustle going for T-Mobile?
So the side hustle, as you call it, and I think that's a good word for it, is still small right now. I think the real opportunity for them in the near term, Scarlett, lies in the broadband business. They're pushing into fiber, another side hustle. It's small, but I think over the next couple of years, it could increasingly contribute to growth. And then at the core of the broadband business is their fixed wireless access business. So delivering broadband to the home over cellular spectrum. That's been very popular, and T-Mobile remains a real leader there. It continues to be a growth engine for them. And so I think when you pair that with the ad business, the credit card business, and more importantly, the fiber business, it all adds up to help sustain that free cash flow growth and call it the 5 to 6% range, maybe even more as we go forward over the next 3 years.
John, just about 30 seconds. Dividend policy, T-Mobile's got a 1.8% yield, Verizon 5.6%, and AT&T 3.9%. So there's something for everybody in terms of investors. Does T-Mobile, do they worry about their dividend yield?
Little less so than share buybacks. In fact, one of the things they did with Capital Markets Day was announce that they're buying back $5 billion in shares over the course of the first quarter here, which is double the normal rate. So, I think they're leaning more into that than dividend growth, although it's part of that share buyback program, and it's going to continue to be as we go forward here.
Yeah, that's a good explanation for why the stock is up on the day, despite the fewer subscribers added than anticipated. T-Mobile up by more than 2% at the moment at $203.81. John Butler is our senior telecom analyst here at Bloomberg Intelligence. All right, we have a mixed market right now. The jobs report that everyone was looking for, that we all thought would provide some direction, did provide some direction for the bond market. Bond prices are lower, yields are higher, but for equities, we're pretty much mixed. The Dow Industrials still holding near that record high. The S&P 500 pretty much in record territory as well, not making any big moves. The Russell 2000, though, is decidedly lower. The small cap index is down by 0.9%. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. So the strong data on the jobs report, that raises hopes the economy can remain solid and keep driving some of the big profits for companies. Now, stocks in the energy, also raw materials industries jumping to the biggest gains right now, the S&P 500. And their profits tend to be closely tied to the health of the economy. So there you go. For the broad stock market, the strong jobs report could also keep the Federal Reserve on hold longer when it comes to interest rates. Right now, we're seeing the two-year yield up close to 6 basis points. That is at 351 right now. And we're close to being evenly split between gainers and losers in the S&P 500. S&P 500, that has just turned higher now, up 9 points, 69.51 there, still a ways from the record. Dow Jones Industrial Average down 29 points at 50,161. The NASDAQ 100 up 49 points. That is up 0.2%. Mattel, the toy maker, is set for its biggest fall on record after this downbeat earnings for the quarter that included Christmas, when they're supposed to sell toys. Humana, quick look there, that continues lower, down close to 3% right now. They've gotten caught up in this affordability push for government reimbursements for Medicare Advantage. They just keep evaporating. That's a big part of their business. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube and also streaming live on Bloomberg.com/videos, and that's where you find us. Well, today is Jobs Day for sure. It's not a Jobs Friday. We call it Jobs Wednesday. Consensus was for 65,000 jobs added. 130 was the actual number, so a big beat there. The unemployment rate is probably the other headline. Ticked down just a little bit. The consensus was 4.4%. Came in at 4.3%. So some good data on the current labor front. Let's check in with Jeffrey Cleveland, chief economist for Payden & Regal. He's based out there in L.A. Jeffrey, what did you make of the labor data we saw today?
Well, Paul, I'm not impressed.
Oh.
We did beat the consensus for the month, but after revisions to steal a line from Fed Governor Christopher Waller last week, there has been virtually no job growth, no payroll growth in 2025. Zero, zip, nada. We added about 181,000 jobs, Paul, for the year. I'm not talking about the month. If you do the monthly pace of that, it's about 15,000 jobs per month last year. So 2025 was extraordinarily weak. That kind of sluggish job growth is not happened outside of a recession. So I don't know how you look at this data and come away with the positive spin here.
And Jeffrey, what you're referring to is the final benchmark payrolls revision, which came in negative 862,000 for the year. The consensus was for negative 825,000.
Yeah, so that's a miss on that front. Paul mentioned that the unemployment rate, though, did tick lower to 4.3%. Analysts had anticipated it staying unchanged at 4.4%. That is encouraging, no? Or is there something underneath that number we should be paying attention to?
A lot of noise in that data, Scarlett. So, you had a big gain. I think the last 2 months in the household survey employment is very volatile. So I think we just need to see a couple more months on that front. We're suspicious, though. I mean, if you're only adding 15,000 jobs per month or 50,000 jobs per month even, we are still seeing population growth. So we think we need a bit more in terms of monthly job growth to keep the unemployment rate steady there at that 4.3, 4.4 level. We're suspicious that we're going to get enough. And then the risk is we'll get a little bit higher unemployment rate in the months ahead. That's our gut instinct here.
So does that make you suspicious of the 130,000 jobs added for the month of January if on average in 2025 we got 15,000?
Pop quiz. What last January? I think we had 100. Well, I should do it as a quiz. How many jobs did we get in the initial release last January? 111,000, Jeffrey. And after revisions, it was a minus 48 for January of 2025. So we are seeing downward revisions. So we're a bit suspicious. Investors should be cautious here with these preliminary estimates. Also, for the month of January, very narrow very narrow job growth, really education and health services. Outside of that, we saw a lot of weakness. We saw weakness in financial services. We saw weakness in information services. So just not seeing a broad-based rebound in job growth. I hope it happens, but we're a little suspicious here.
A bullish take I saw on the private versus public labor market for this month was the public market actually declined. The public, maybe it's DOGE related. So any gains you did see, that was all in the private market. That's a good thing.
Correct, but almost entirely health and education related. So pretty narrow job gains there. That sector, by the way, met with a bunch of healthcare clients last week here in Los Angeles at the Payden offices for a little roundtable, and it's sort of a cyclical, non-cyclical sector, Paul, if we could say. It's been adding a lot to job growth. Is really the only sector that added to jobs growth last year on a 5 or a 10-year time horizon. That's been a great story. But it doesn't have much to do with some of the cyclical factors that we're seeing in the broader economy, whether it's interest rates or it's demand. It's just happening perhaps more for demographic reasons than anything else.
All right, so that's the labor market. Tomorrow we get, or I should say Friday, Friday we get inflation data for January, CPI. And right now the consensus estimate is for an increase of 0.3% month over month, 2.5% year over year. And if you strip out energy and food, we're still looking at 2.5%. How are you thinking through what that inflation data means for the Fed as they get ready to think through their plan for the rest of the year?
Yeah, for investors, I think it's important to keep in mind the first couple months of the year, the last few years, we've seen some hot inflation readings. So there could be some residual seasonality, some flukes there. So I don't want to make too much out of any one month. We do think, though, over the course of the year, so over the full balance of 2026, we do expect core inflation to moderate. So what do I mean by that? We've been hanging out around 3% year on year on core CPI and core PCE. And we think by the end of the year, we'll be closer to 2%. We see we see some reasons for goods prices to moderate over the course of the year, services as well as housing. So we think inflation will moderate. So that'll open the door for the Fed to cut sometime later this year. So that's really our main view is an inflation moderation story. Although if I were a policymaker, again, not to belabor a point, I'd be suspicious of this labor market data, and I'd be
all right, Jeffrey.
Zero zip nada job growth.
Excellent. Always appreciate getting your thoughts. Jeffrey Cleveland, Chief Economist at Payden and Regal. Well, Nike President and CEO Elliott Hill spoke exclusively to Bloomberg's Romain Bostic in Milan. He discussed innovation, sports branding, and investor concerns. In this portion of the conversation, Elliott was first asked about Nike's sales growth and profitability concerns. Let's take a listen.
There's no question. If you see where the stock we've held up over the 16 months, the focus on sport, the focus on growth. They understand then the portfolio that we have, 3 strong brands, Nike, Converse, and Jordan. The focus on sport and how we're segmenting each of the brands by sport, and then ultimately paying it off in 190 countries around the world is only Nike can do at the size and scale that we are.
But when I talk to analysts on Wall Street, they're relatively complimentary of what you've done, but they are still concerned about sales growth, which is still relatively flat. They're concerned about profitability, which to a certain extent is not quite there, at least not to their liking. When do you get there? When do you get there to a sustainable growth rate on revenue and, more importantly, generating more profits and wider margins?
One of the things that we've talked a lot about is what is the top line growth rate with our investors and the bottom line expectations, and we're confident that we'll be able to get there. We're confident that the sport offense is the path forward. Those 3 brands, a portfolio of brands, portfolio of sports, footwear, apparel, accessories, and then again paying it off in the marketplace. And so the newness and freshness is working. We had some proof points in the last quarter. North America being back to growth, which was a strong result for us. It's our largest reporting segment, running back to double-digit growth. And then, of course, our wholesale business, which is critically important to the future of our business to serve consumers wherever they choose to shop, also back to growth.
So running North America was up more than 20%. Overall, North America was up 9% across the board. I want to talk about the wholesale, though. In North America, that did great. I think it was roughly about 20% as well. But there's been some criticism that maybe the sell-in that you've done is maybe too heavy into North America and not necessarily broad-based across the globe?
The focus was across the entire globe in terms of the wholesale side of the business. I think the team in North America, led by Tom Petty, who's a seasoned veteran, he has the relationships.
Not the singer.
No, that's P-E-D-D-I-E for correction. But he has tremendous understanding of the marketplace, the consumer, and he and his team have done a really nice job getting back in with the wholesale partners and driving that level of growth. And you'll start to see that across the rest of the world as well. I'm confident in the leaders that we have in place, and the desire for our retail partners to serve their consumers. We have a joint consumer, and they want access to our brands.
Is that relationship better with them? I mean, Nike gravitated away from those retail partners to a certain extent back in the early 2020s. I know they kind of tried to reset under Donahoe before you then came in. When you talk about being able to sell through Amazon or Macy's or whoever else here, they're comfortable with what you're giving them, selection-wise, price-wise?
Yeah, I think there's no question. We're having to pull a lot of our products forward and to really drive that innovation and that newness and freshness. I think we have an opportunity around depth that we're still working through to make sure that we have the depth to drive the revenue and profits that they expect from us. And we are committed to doing that, because ultimately, when we're driving growth and profitability for our retailers, that's how we take market share. And that's certainly I think something that I am really challenging our team around, is that growth, profitability, and then ultimately taking back market share.
All right, that was Nike President and CEO Elliott Hill, along with Bloomberg's Romain Bostic over there in Milan, talking about Nike and their future. Just looking at the stock here, the stock's down about 2% this year, down about 12%. Over the trailing 12 months, and as I recall, it's had an issue with inventory management and kind of getting rid of the inventory so that they can start.
Especially in markets like China,
yes,
where they were once seen as this premium brand, but increasingly Chinese consumers are looking to their own homegrown brands, like Li Ning, for instance.
Okay, there you go. So I mean, again, just recalibrate the business is kind of what we've been understanding it. So maybe they've got it set up here. Looking at the markets here, really quiet out there. We had some big movement earlier when the jobs number came across, but that's kind of giving it back. We have the S&P, I'm going to call it unchanged. The Dow's down 38 points.
It's
NASDAQ, yeah, the NASDAQ 100. I love using the unch term because it really bothers Lisa Abramowitz. So I learned that little nugget early on.
But it's unched.
It is, and back in the day, that would appear on your screen, UNCH. Not so much more now that we've gone to pennies. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages have wobbled between gains and losses, much stronger than anticipated jobs report, at least on the surface, leading to an increase in Treasury yields. Traders trimming bets. The Federal Reserve is going to have to cut rates this year anytime soon. Now, the initial rally in stocks, that has turned as we see a sell-off in software companies. The iShares Expanded Tech Software ETF, we'll use that as a tracker. That's down over 3.5% right now. Meantime, Matt Maley at Miller Tabak says the stock's getting crushed by AI trade. Well, that may have gone too far.
When they hear this news, boom, the buy orders disappear and the sell orders come in, and the whole thing tends to feed on itself.
And then you have Robinhood Markets reporting lower fourth quarter profits, sharp declines in Bitcoin, other cryptocurrencies weighing on results of the online brokerage. In fact, it is the worst performing stock right now in the S&P 500. S&P 500 just turning higher, up 9 points. 69.51 on the index. The Dow Jones Industrial Average 18 points higher, and the Nasdaq 100 up 34 points. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Paul.
All right, JT, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. We're also doing a streaming thing. Go to YouTube, that you'll find us there. And you can also go to Bloomberg.com now, /videos, and that's where all the Bloomberg video is, the live video as well as the curated video from coming out of this complex. So that's a good place to find everything. On that note here, let's check in with somebody who's in the TV business, in the TV advertising business, trying to make it easier for small and mid-sized businesses to really get their message out there versus via all these digital opportunities here, including television. Mark Douglas, President and CEO of Mountain. That is a publicly traded company, a newly publicly traded company. Ticker's MNTN. They reported numbers just today, I think. Stocks up 30%, so I guess just today. So I guess the market likes what they heard here. Mark, appreciate you coming in our studio here. Talk to us about Mountain. I know you guys are trying to work with small and mid-sized businesses and help them get their advertising message out in a world that's got tons of digital and analog opportunities. So talk to us about what's going on in your business.
Yeah, absolutely. So what we do is television, and streaming television in particular has been underserved but for small businesses. It's just been very hard, very expensive for small, mid-sized businesses to use that medium. And what we did is we turned it into a performance marketing channel, like something that they can add to their marketing mix along search, along social, and use streaming TV to get the next customers. And we've been consistently growing. And you know, we did earnings last night, and I had a very strong quarter in Q4, very strong, ended a very strong year, and we're, you know, our focus is on continuing to just execute the business and do the same.
And I am assuming for even the small businesses, the opportunities lie in things like live sporting events, because those are must-view appointment watching that you don't get from other shows.
Yeah, absolutely. Well, the nice thing about streaming is everyone can find whatever is their, you know, thing that they love to watch. For me, actually, one of the things I love talking about in this business is just like the shows I like. So I'm a big fan of Traders right now. Love that show on Peacock. Cannot wait till they only release one episode a week. I'm like, kind of, damn you. I just get all 10 episodes at once. But, you know, live sports, I watch the Super Bowl. You have March Madness coming up. You have a lot of dating shows for Valentine's Day. So all of that, we give our customers access to all of that kind of content, get their message, and really target it, and most importantly, measure the impact, how much revenue that drive to their business. And so we pioneered this space. We call it performance TV. We literally created the term performance TV. It's now ubiquitous in the advertising industry, and we just kind of keep growing into the scale of the opportunity, which we think is enormous.
Talk to us about AI. How's AI impacting the advertising business? Meta calls it out. Google calls it out as it relates to their YouTube business and their search business. How do you see it impacting it?
It's having an impact across the board. The obvious is on the creative. The time to get creative, like meaning what does it take to get a TV commercial? Used to be a lot of costs. very time consuming, lots of people involved. That still occurs for some of the creative, but increasingly there's AI creative. We ourselves are now putting out 2 to 3 Mountain branded TV commercials a week that are being created like in under a day. We have what we now refer to as AI creators using our own tools to do that, and it's just substantially lowered the cost. We did a video last week for around the show Heated Rivalry, which is kind of a hot show right now. So the video has hockey players in it and so forth. Got created in under a day, costs $500. If we tried to do that in the physical world, that would have been like 6 weeks, 50 grand, 100 grand to film that. And so I think there's a mixture of still filmed video, AI video, and you use what's appropriate for exactly what you're trying to do.
Does that mean that the images that the viewer sees is AI generated?
Mm-hmm.
Okay.
Yeah, it's fully AI generated, 30-second.
Do you have to put a disclosure on that, or that doesn't come up?
We don't have to. I actually would like to. My personal view is all AI videos should be labeled AI, period. I actually, there's a CAN spam act for email. I think there should be a similar act for AI content, that if I'm on Instagram or I'm watching a commercial on TV, I should know that this is AI created, and that's kind of a personal opinion. I don't see a downside to that, and I think people would appreciate the transparency. They don't want to guess what they're looking at. Is it kind of real? Ironically, we ran another ad campaign the other day with Jamil White, who's famous child actor and now is involved in a lot of projects as an adult. And the campaign was, "Is it AI?" So
just putting it out there.
Yeah, yeah. And so
Mark, I know you guys with your company, you guys are so involved in the media space in general, from the advertising side. What do you make of what's going on with Warner Brothers Discovery? It just seems to be kind of out there. I don't know if Netflix is going to buy them, Paramount's going to buy them. If Paramount doesn't buy them, what happens to Paramount? What do you guys what's the scuttlebutt out there?
Well, for full disclosure, I worked for Larry Ellison early in my career, and I didn't see him lose very often.
Right.
So
good point.
And so, I mean, when he's determined, he's ferocious, but obviously Netflix is very capable. They have an incredible management team. I think ultimately it comes down to dollars. I don't know how it doesn't. I mean, and at the moment, I believe that, Paramount has a bigger offer on the table, but unless there's elements of the offer that haven't been published. So, and I think Paramount's strategy is let's literally take it to the streets and do a tender offer. So we'll see how that plays out. I'm pretty bullish on Paramount, but I know a lot of people at Netflix, and they're determined also. So unless they're going to come in over the top, I think Paramount has a real shot here.
Can I just jump in here?
Absolutely.
Is it okay if I?
Absolutely.
Sure.
Matt Miller.
I just wanted to swing by. Matt Miller from Bloomberg Television. I anchor Open Interest every weekday from 9 to 11.
Former Bloomberg Intelligence host.
And a friend of the program.
Yes.
I've been friends with Mark Douglas for a number of years, and I feel like you're being really diplomatic. This does not look good for Paramount at all. I mean, even if they get it across the line at this level, they're so levered up that they're going to have trouble meeting their payments. I mean, free cash flow isn't going to be that strong. So it seems like a dead deal, like Netflix has won.
Well, I mean, Netflix certainly has access to a tremendous amount of capital, and they have the capital. But I mean, Larry Ellison, if he's providing guarantees, I think that carries a lot of weight.
But he hasn't raised his price yet. And that's what everyone's waiting for.
Nobody can. I think that he can. And
why isn't he?
Well, because he's doing everything but that, and he has the ability to do that. But as Matt was pointing out, you still got to do something to improve the pro forma capital structure. That's just a banker speaking. I don't know.
My thoughts on the deal is a nice have for Netflix. It's a must have for Paramount. It just literally is a must have for Paramount.
Matter of survival.
Yeah, and so I think when something's a must have, you kind of get to the finish line.
Very good. Mark, thanks so much for coming in. We appreciate it. Mark Douglas, President and CEO of Mountain. MNTN is the ticker symbol. Stock's up 30% today on the back of some very good financial results. So good day. And Mark's based down in, Miami, like all the smart kids are, but he's in our Bloomberg Interactive Broker studio today, which is a good thing. S&P up 5 points. The Dow up 25. NASDAQ 100 down 6 points. No real direction on the back of a very strong labor market report.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We are streaming as well. We're streaming on that YouTube thing. We've been doing that for a long time. Now we're also streaming on Bloomberg.com/videos. That's where all the Bloomberg live and created videos are, and you can find all that good stuff there. Let's talk technology. We can do that with Woo Jin Ho. Woo Jin Ho is Bloomberg Intelligence Senior Hardware and Networking Analyst. We're going to talk about Cisco. But first, Woo, I wanted to ask you about, we saw this big sell-off in software stocks over the past several weeks. Really caught people by surprise. I just got a pitch from a PR person talking about a SaaS apocalypse webinar. From your part of the tech stack, what do you think's going on out there?
So, you know, from a high-level view, some of the AI tools that have been coming out to market, such as Claude's Cowork, and you know, this term called vibe coding, where you use the AI to start building out code for you, is starting to replicate some of the software, or the thought is that it's starting to replicate some of the software that some of these enterprise software companies have been building, like Salesforce.com or Workday. Right, and it destroys some of that value proposition in terms of the subscription revenue model.
I guess at the conceptual stage or the theoretical stage, that could happen to some degree.
Potentially. I mean, we'll see how this all plays out, right? You know, we're in this phase of uncertainty in terms of how these software companies are going to react, right? What they can possibly do is change the software models instead of a user-based system to an agent-based system, right? In terms of a consumption-based, and if that's going to be the case, they may be able to right that ship.
Okay, all right. Well, Bloomberg Intelligence is going to have a set webinar on that coming up, I think, today or tomorrow. So that'll be pretty cool because we are on top of that. Talk to us about Cisco. They reported. What's going on with our friends at Cisco?
Yeah, well, they report later tonight.
Tonight, okay.
And we'll see what happens. I do expect them to deliver upside to their guidance, or at least to the top side, to the top end of their guidance for tonight on sales and earnings, as well as raise their guidance. And there's a couple of things to take into consideration. Their core networking business, fairly stable, upgrades, so on and so forth. They do have a $43 billion refresh cycle, but Cisco has been one of these stealthy AI names.
Yep.
Right. $1 billion in sales in last fiscal 25. They're on track for $3 billion last year. And then, if we recall last week, all of that AI capex that's flowing through.
Yep.
Cisco is going to get a piece of that, and I do think that's going to help drive some upside.
Yeah. So that's kind of what a lot of the companies in the technology space broadly defined. They're trying to position themselves. Hey, we can get some of that wind in our sails, and a company like Cisco can certainly start making that claim, I guess, a little bit.
Yeah, they had their European users conference yesterday, and they were talking a lot about their new AI chip as well as their new AI products. And quite frankly, I think they really haven't captured the full value of AI yet, because they really haven't been cloud exposed. Once that value proposition goes from the cloud to the enterprise, the tailwinds actually strengthen for Cisco.
Can you explain to me, a lot of companies in the technology space have been calling out a shortage of memory chips.
Yes.
How rare is that? How unusual is that? What's causing that? How do you fix it?
And well, it's not going to be fixed anytime soon, right? This is what the memory guys are calling it is a super cycle. And essentially what had happened was a lot of these AI workloads and the cloud guys, they are consuming a lot of memory, especially HBM4. And what that's taking away is the memories that goes for our bread and butter equipment, PCs, smartphones, as well as networking and server equipment. So it's going to be a painful cycle. What we're starting to see is 300% increases in DRAM pricing, as well as NAND price, but a doubling in NAND pricing.
Is this something is this a cyclical thing that you've seen this before? Because I've heard a lot of companies talking about it. I'm just like, we'll make more chips.
Yeah, we saw it, roughly about 7 years back. But this one feels different. This feels like this cycle is going to last longer. There's not enough capacity to help build more chips. And a new fab, I talk to my colleague Jake Silverman all the time. It's going to take about 3 years for a new fab and new capacity to come online to help support what the AI guys want.
All right, so in your networking space, what's kind of the best name? What do people like? What do you think is well positioned in this one?
I will tell you, the hottest names in networking has been anything that involved a high-speed connectivity and optical. Names that both you and I both know. Corning.
Really?
Corning.
Wow. Talk about a name from the past.
Yeah, fiber optic cables, because all of these data centers need to be hooked together, but they're also finding themselves inside the data center. If you look at the chart, the stock, I believe, is up roughly about 20% in the last 3 days or 2 weeks or so.
Yep.
Right? So there are some very strong tailwinds for Corning. And I've been giving Carol grief, the PM radio host grief.
Yep.
We were talking about Corningware and Pyrex.
Exactly. That's what I'm thinking. Exactly. Corning, New York, one of the all-time great, upstate New York towns there. Corning, New York. Good stuff. Woo Jin Ho. Thanks so much. Appreciate it. Woo Jin Ho, senior technology analyst for a Bloomberg Intelligence. For our listeners in the U.S., a reminder. You can listen to us via satellite radio on Sirius XM channel 122. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research on the Bounce Power starting in just moments. S&P unched on the day. The Dow's down 12. NASDAQ 100's down 20. Absolutely nothing happening on there. We had a busy morning when the jobs data came out. Markets were moving, but they've settled down here. In the yield space, 10-year Treasury, 4.15%, pretty much unchanged on the day. Gold higher, $5,075 per ounce. This is Bloomberg. Good morning.
from Washington, D.C., this is Balance of Power with Joe Matthew.
Welcome to the Wednesday edition on Bloomberg Radio, streaming live on YouTube. We're live in Washington with much to cover from both ends of Pennsylvania Avenue, and we start, as always, on Wall Street. Charlie Pellet has the latest on the markets live from New York. Charlie?
Across the board with the Dow, the S&P, NASDAQ, all in the red, looking at a 1-point drop on this Jobs Wednesday right now. Stock's been all over the map right now. The S&P is at 69.39, down under 0.1%. Dow Industrials retreating from a record, down 22, down now by under 0.1%, while NASDAQ down 102. Tough day for a lot of the big tech names. We've got the NASDAQ Composite Index down 0.5. NASDAQ 100 down 0.1%. Software stocks getting hit hard. I'll tell you about that in a moment. 10-year, 4.15%. The 2-year, 3.49%. Gold up 1%, 5,075 the ounce. Silver up 3.4%, 83.55 the ounce. And West Texas Intermediate crude up 1.6%, WTI 64.99 a barrel. It is a tough day for many of the software names today. We are seeing another sell-off in software companies. The ETF representing a lot of software names, the iShares Expanded Tech Software ETF. Right now, it is down by 4% among specific names. Microsoft down 2.8%. ServiceNow tumbling 6.4%. And Salesforce down now by 5.9%. Coming up after the close of trading, we will be hearing from both Cisco and McDonald's. Again, recapping here, the Dow, the S&P, NASDAQ, all in the red. S&P down 5, down 0.1%. That, Joe Matthew, is a Bloomberg Business Flash.
Charlie, we're starting a little early today, so I'm trying to catch up with you. I appreciate your look at the markets, and welcome to the Wednesday edition of Balance of Power. I'm Joe Matthew. Thanks for being with us here on Bloomberg Radio, streaming live on YouTube. I want to get right to the White House, where Benjamin Netanyahu is in the building. This is a meeting, of course, between President Trump and Netanyahu that we were looking forward to and very curious about. Reporters were not brought into the room for this. In fact, we didn't even see him get in. So let's get to Tyler Kendall, who's on the North Lawn right now for the latest. What's going on, Tyler?
Yeah, hey, Joe. So this marks Israeli Prime Minister Benjamin Netanyahu's 7th visit to the White House under President Trump's second term, and it is our understanding that Iran is going to be the focus of these discussions that are happening behind closed doors, amid reports that Netanyahu is actually here to deliver some new intelligence when it comes to Iran's military capabilities. Netanyahu's visit today to the White House follows a meeting that he had last week in Jerusalem with Special Envoy Steve Witkoff and the president's son-in-law, Jared Kushner, of course, the pair that is leading those bilateral negotiations between the U.S. and Iran. The first round of those talks happened on Friday, and both sides characterized them as relatively positive. They said it was a good start, but we know that there are fissures that have emerged, particularly around the scope that these talks are happening, even as we look ahead to officials saying that they are planning for a second round of talks likely next week. But, Joe, going into this, we knew that Iran was asking for them to be more limited. They wanted this to only be bilateral talks focused on their nuclear agreement. But we know the U.S. as well as Israel, which is part of why the Israeli Prime Minister is here at the White House, wants to see the talks expanded to other capabilities of Iran, like their ballistic missile program, their support for proxy militia groups in the region. And the U.S. in particular wants to invite in some other regional allies to these discussions. You ask U.S. officials, and they say that that partnership in the region could ultimately prove to be important for a bid for stability moving forward, making sure that there is cooperation in the Middle East. So those are sort of some of the moving parts that we're tracking here as the Israeli Prime Minister is now here after what's kind of viewed as a last-minute meeting as President Trump weighs his options on the table about what to do next.
Just to be clear, Tyler, I want to ask you about a couple of things, including the jobs numbers today and the reaction from the White House. But do we have any expectation that this will be open to press? Will there be a news briefing later on when they're done with their meeting?
Well, we perhaps could hear from the White House Press Secretary Caroline Leavitt on this, but at this point, the meeting remains behind closed doors. And as you mentioned, we did not see the Israeli Prime Minister Benjamin Netanyahu come into the White House. Typically, it happens right behind me for our radio listeners. I'm right on the White House North Lawn in front of the driveway, but there was none of that today. He went through a side entrance beyond the cameras, which perhaps gives us some indication just how sensitive these discussions are at this point, and how perhaps Israel or the U.S. wants these talks to be perceived, which is behind closed doors and private at the moment.
Interesting. They wouldn't have used the front door on his 7th visit here. Tyler, jobs out today. And if you can hear me over the protesters there at Lafayette, the numbers on payrolls were stronger than expected. As the president is pointing out here, he says great jobs numbers far greater than expected. The United States should be paying much less on its borrowings, bonds, again, the strongest country in the world. But when you look at the revisions, there's essentially a zero net gain in jobs for the balance of this administration.
Right, exactly, Joe. And it's going to be those sorts of details that you're going to start to hear the administration try to push back on and talk about how that doesn't paint the broader picture of the economy. We're hearing a lot of the White House officials here talk about how there has been a shift when it comes to population and point to the president's deportation policies. But by and large, as you just read, President Trump is really applauding these numbers larger than expected, even as traders push back bets for a Fed rate cut, which we know that the White House would like to see happen as soon as possible. So sort of a dynamic there. It also comes on the heels, as you well know, we heard from some top administration officials ahead of this report really downplaying this, lowering the bar, including the NEC director Kevin Hassett and the senior trade counselor Peter Navarro, because you have to keep in mind, as you well know and cover every day on this program, the economy continues to be the #1 issue that this White House is playing defense on as we head into the midterms. I point you to a new poll just out this week from Gallup that finds 50% of Americans are expecting unemployment to increase and have a negative view, particularly when it comes to the job market. So this is something that's going to be following the administration in the months ahead, as we have seen a flurry of policies. Perhaps the one that the administration has been putting out the most at the moment when it comes to the labor market is, of course, that push for reshoring manufacturing and trying to get jobs up in that sector up as quickly as possible.
Great, Tyler. Thank you so much. Tyler Kendall on the North Lawn of the White House. We thank you with our eyes on that statement from President Trump, referring to the golden age. If I could only get my terminal to work here. The golden age of America is upon us, he says. Sentiments echoed by Pierre Yera, the acting chairman of the White House Council of Economic Advisors, earlier today on Bloomberg. Listen.
Not only is it total jobs that are up above expectations, it's also private sector jobs that are at 170,000, so more than, or 160,000, which are more than double expectations. I think the way to think about, the way we were thinking about it is if you look at demographic changes as well as the big reduction in immigration relative to, in particular, illegal immigration relative to what was happening under the Biden administration, those two factors should lead you to lower break-evens.
The annual revisions could be the headline, depending on how you're looking at this, slashing 2025 payrolls by 1 million jobs. This is really remarkable. Stuart Paul will help us dissect some of this. Bloomberg Economics U.S. economist joining live from New York. Donald Trump says the golden age of America is upon us, Stuart. Is that borne out in the numbers?
Not exactly. I think you make an interesting point by calling out the downward revisions. Everybody saw a little bit of what they were looking for in today's report. For folks in the White House, particularly in the Oval Office, President Trump in particular, he's going to be focusing on the upside surprise in total payrolls, but it's really difficult for economists to forecast payrolls when we know we're going to be getting such a large revision. For folks who are looking for weakness in the labor market, they are exactly focusing on the downward revision. End of the year 2025, payrolls were revised down by a little over 1 million jobs. So the portrait of the labor market that folks are now looking at is a little bit more dull than they were expecting, than they understood the labor market to be before the release of today's job market. I think that the real synthesis of what's going on in January, though, is borne out in the earnings numbers, right? And if you look at average hourly earnings, up 0.4% month on month, A longer work week also increases average weekly earnings. And then if you add in total payroll growth, we have aggregate labor income growth during the month of about 0.8%, the fastest pace since early 2024. So I think that that's what really matters most for the month of January. Really hot income growth, separate and apart from the jobs number, separate and apart from what happened in revisions. When we think about where we started this week with just such dull retail spending in December, now that we have the January jobs report in hand, it does suggest that there's probably going to be a little bit of a pickup in spending during the month. I think that that's the thing that should matter most to the administration right now.
Interesting. So the whole Federal Reserve component of this story is interesting. People are placing bets this morning where maybe we're going to get a cut, maybe we're not, but it depends how you read this report, Stuart. We'll get CPI later in the week. How's the Fed going to dissect these numbers when they put them together?
Well, so most folks are expecting that in the CPI report, which will come out at Friday, 8:30 Eastern Standard, the CPI report's going to end up showing a little bit more core goods inflation than we typically get during the month of January. Every January, price is reset. We typically account for that, but folks are expecting that this month, this January, firms are raising prices a little bit more than usual under the cover of tariffs. They're going to be assigning blame to tariff policy and trade policy. And if we see that 0.3% month-on-month increase in core goods core CPI, folks are going to start, again, fading their rate cut bets. We saw a little bit of fading of rate cut bets when the January jobs report came out, I think exactly because of the income item. When you see hot income, you could expect hot spending, you could expect hot inflation. And I think that that's what the totality of the data for January that's going to be released this week is going to show.
Spending time with Stuart Paul at Bloomberg Economics. The president has talked a lot about manufacturing jobs specifically. Howard Lutnick has talked about this, that we were not only reshoring certain industries, but it was going to turn into a jobs boom. If it's not happening now, and you can tell me specifically what we learned about manufacturing in this report, is it in the next year as the benefits of the big, beautiful bill start to take effect?
Manufacturing employment has continued sliding for the most part. I expect that manufacturing employment is going to continue sliding throughout 2026. When you listen to the administration talk about this, they mostly point out that there's been a boom in construction employment, and that's folks that are building new manufacturing facilities. And so maybe we'll start seeing more onshoring, more manufacturing employment, and all of that going forward. It's a very slow process bringing new factories all the way up to, first of all, building them and then bringing them up to full production. When I look at the data, it's been really dismal in the factory space, in the industrial sector. I don't expect there to be, this golden age of manufacturing. Where I do see a little bit of a silver lining is in certain states that are most politically important. There has been an increase in manufacturing production in states like Michigan, Ohio, and North Carolina. And Joe, that's going to matter a lot for the midterms, even if we don't see the manufacturing boom nationwide.
So you throw in our scoop on the USMCA, and you really start to wonder here, Stuart. President Trump privately musing, according to White House reporter Josh Wingrove, about exiting the USMCA, according to people familiar, injecting further uncertainty about the deal's future, knowing that we are riding through this tariff regime with a lot of exemptions that are in place for Canada and Mexico because of the USMCA. What happens if we do away with it?
Well, I'll say this, Joe. I'd be more inclined to call the president's bluff on this one. I was actually just looking earlier this morning at inventories of vehicle parts and of vehicles that are actually finished. Inventories are down for those production of vehicles, and motor vehicle parts are also down materially since Liberation Day. And the automobile manufacturing process is so deeply integrated across the North American continent, it would be very difficult to completely do away with USMCA because of how much it helps the U.S. auto manufacturing sector to pull parts from around the continent, from Canada and from Mexico. So maybe it's just me, but as much as he might want to do away with USMCA, almost just out of spite for Canadian Prime Minister Mark Carney, I'd be inclined to call his bluff on this one.
Really interesting, Stuart. We've only got a couple of minutes left, but I want to get a sense of what you're expecting at the end of the week. We've got jobs today, and I know this is weird. It's a jobs Wednesday, and that's because the schedule got jammed up with the government shutdown. How about Friday when we look at CPI? What will we learn?
We're going to be getting the CPI on Friday. January inflation numbers, I'm expecting both headline and core CPI inflation to print 0.3% month on month. That's a bit too hot for comfort for the Fed. I do think that a big part of it is going to be increased pass-through of tariffs during the month, or at least just an additional annual price hike for those core goods under the guise of increased tariff pass-through. That said, there will be very favorable base effects that allow the annual measure of inflation to come in quite a bit. So I'm expecting a headline and core reading closer to about 2.5% year on year. But what will matter most for the Fed really is core goods and on a month-on-month basis. And I think that it's going to be a little bit too hot for comfort.
Interesting here. So Bloomberg Economics, James just put this in front of me, is still calling for 100 bips of cuts this year. Is that going to happen?
Well, it depends just how sustained the increase in core goods prices is. What's really going on in the month of January is that there's this annual reset of prices, and everybody's basically just waiting to get into February to see how much prices are fading. When we look at pipeline price pressures, for example, when we look at what firms are talking about, we've digested tens of thousands of earnings transcripts to see what macro themes are most front of mind for corporate executives. Pipeline price pressures have basically fallen off the radar as a topic that matters for folks. And as a leading indicator of pricing plans, it seems as though input costs are no longer nearly as much of a factor. When we have that turning over after January, we think that it will open the door for additional rate cuts. And then beyond that, you can't forget all the political factors that are in play. Pressure coming from the White House on the Fed to cut rates, a potential new Fed chairman getting sworn in after May. I think that it does set the stage for more rate cuts than are currently being priced in, just about 50 basis points today.
There you have it. Stuart, thank you. It's great to have you with us, as always. From Bloomberg Economics, our U.S. economist, the great Stuart Paul, live from New York, in a conversation tailor-made for Bloomberg today. I'm glad you're with us here on the Wednesday edition. We're just getting started. We've checked a couple of important boxes already, certainly by way of the administration. We're going to go to Capitol Hill next to see what in the world is going on with the Department of Homeland Security, set to shut down on Friday night. We've got a voice of experience for you. Maura Gillespie, not on the panel today, but with us in studio. Blue Stack Strategies, a veteran of John Boehner's Speaker's office, with her experience next on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We're looking at a Dow that is lower, S&P higher, NASDAQ is lower. The S&P little change right now, up 2 points. This after an initial rally this morning that waned amid a sell-off in software companies. Bottom line here, S&P in a choppy session, up 3 right now at 69.45, up under 1/10%. The Dow retreating from a record, down 17. We've got NASDAQ down 66. The NASDAQ Composite Index down 0.3%. NASDAQ 100 Index, we'll call that unchanged on the day, while the Russell 2000 Index of small cap shares down now by 0.8%. The 10-year on this jobs Wednesday, 4.14%, with the 2-year 3.49%. A stronger than anticipated jobs report spurred a slide in treasuries as traders trim bets on Fed rate cuts this year. Spot gold up $59 the ounce to $5,085, up 1.2%. The VIX, by the way, 17. We've got spot silver pushing higher by 4.1%, 84.09 the ounce. Again, gold up 1.2%, 5,085, and West Texas Intermediate crude up 1.9%, 65.14 a barrel on WTI. And Bitcoin 66,480, Bitcoin down 3.1%. Ford, after earnings, is trading higher right now. Ford up 0.4%. It does expect profit to jump in 2026, even after that surprise $900 million tariff bill at the end of last year dented the carmaker's earnings. And Robinhood Markets plunging 12% after reporting lower fourth quarter profit as sharp declines in Bitcoin and other crypto weighed on results. Again, recapping here, we've got the S&P up 0.1%, the Dow back in the green up 13, NASDAQ remains lower by 0.2%. Cisco and McDonald's report after the close of trading. I'm Charlie Pellet. Balance of Power continues. Back we go to Washington. Once again, Joe Matthew.
Okay, Charlie, thank you so much. We'll be back to Charlie Pellet in about 20 minutes. Time here for another read on the markets on what is the Wednesday edition of Balance of Power. Really seems like it should be Thursday. Is it just me? And until this ice is gone, it's going to probably feel like that. We're just grinding through winter. But the fact is we're back above freezing. And if you're here in the nation's capital, maybe in New York or Boston, you can relate. If you're listening to me in LA, you can laugh at us later. Because Snowcrete remains our reality. And if you think you're a big shot because you survived Snowmageddon, you saw nothing until Snowcrete. 20 days of temperatures below freezing. Are you kidding me? So everyone's walking around, and you're going to see like bros with shorts and flip-flops on by the end of the day, sliding across the ice with a little bit of a melt starting here. And people are like walking across the river now and on ponds and stuff. You see this, James? Producer James, by the way, an avid ice fisherman. If you get bored in the winter, that's who you want to be with. Ice cover on area waterways at its most extensive level in decades. In fact, local ponds are apparently completely frozen, all the way to the bottom. So playing hockey is taking on new meaning here this winter, but it's not going to last long. The melt is beginning, and the mud is coming to the swamp. The question is, will the Department of Homeland Security be open beyond the end of this week even? And it's kind of looking like a no right now. We set the baseline on what's happening on Capitol Hill with administration officials talking reportedly with Democratic leadership, but there is no deal yet when it comes to putting controls or restrictions on ICE and therefore unlocking a funding package that could pass. So we could be in a world in which 11 agencies are up and running, but DHS is closed, unless, of course, there's a continuing resolution. Progressives say they don't want that, and same for the Freedom Caucus, right? So no one's getting along. And it's times like these we benefit from a couple of minutes with Maura Gillespie, a veteran of John Boehner's Speaker's Office, Republican strategist, now the force behind Blue Stack Strategies. It's great to see you in the nation's capital.
Thanks for having me.
We did away with some of the ice before you, but I'm sure it's worse in New Jersey anyway, right?
But there's still ice here.
There's a lot.
I can tell you, I wiped out earlier today.
No, you didn't, really?
I did, yeah.
I'm so sorry.
In a very cartoon-esque fashion.
I don't believe that. Did
legs
anyone
up.
see
Oh,
it?
yeah.
Really?
I would hope that some people saw it.
For their own sense of humor.
Yeah, just listen. Yeah.
That's very gracious of you. I took a major digger on the ice about 2 weeks ago, and it was like one of those redefining, I was seeing stars And it's definitely changed the way
It's
I
humbling.
approach my
It's
walk
humbling. Yeah.
into the office. So humbling indeed. How humbled will Mike Johnson be at the end of this week? Because it's not looking like this is going to turn into a deal. But it's funny, Maura, I keep seeing headlines about cautious optimism, light at the end of the tunnel. You're saying there's a chance. Are you buying any of that?
What other position does he have to have? I mean, he's got to try and stay optimistic given what he's got in a conference where he doesn't have much to wiggle room to have. He's got to stay optimistic. You know, you got Senator John Thune coming out saying he's really urging Democrats to play ball, to find a way to resolve this because, as he pointed out, TSA doesn't get funded if DHS goes without funding again. And the lapse is just to DHS, as you already pointed out. Everything else is funded. But they're only funded, more or less through a continuing circumstance anyway. Appropriations policy, typically it's done in the summer and then goes through another process. But we've kind of pushed and kicked the can down the road so often that's kind of why we're here where we are now. But it becomes a numbers game, as it has been for Speaker Johnson. And I think Thune is trying to do as much as he can to help him be in better footing.
Is there anything that Republicans, that you're hearing at least, are willing to offer beyond body cameras? Was kind of, I think, the attempt by the agency to say, hey, okay, we're just going to do this right now. But when it comes to demasking, total breakdown. When it comes to judicial warrants, total breakdown. Is there anything that Democrats walk away with here, or no?
It's interesting because you're seeing different states say that they're going to be enforcing that mask rule.
Yeah.
I don't know how they're going to do that without having.
Ugly.
Yeah, and I think that's where you're going to see maybe some movement, because if states put pressure on their members, saying we're looking to do this, you need to push, kind of push back. That's going to become an issue. So I do think there's going to be some conversations going on between state and federal to maybe then get them to either acquiesce on the position that Republicans have, or vice versa.
So are you considering a world in which DHS shuts down indefinitely? I mean, there's been a conversation about how do we silo DHS, but or ICE, I guess, would be the real way of putting it, while also funding FEMA, Coast Guard, and the TSA. Is that possible? Could appropriators do this?
I don't know how they'll separate it. I do think that's going to be a problem. I'm sure it's what members would love to have happen, because it's easier for them to get behind a bill that supports FEMA, supports TSA agents, and making sure that that's all covered. But there's something that's going to get done between today is Wednesday, Friday is the deadline. So if so many members are saying they're not going to be part of this continuing resolution, you're going to start hearing from organizations and from constituents who are concerned about travel. There's already enough concerns about travel right now. We just saw the FAA just put out this El Paso and then overturned it within a matter of, which felt like hours.
Totally bizarre.
Very bizarre situation. And so more questions and more confusion, and that's the last thing that airports need is fearful travelers. It's already a heightened situation. And so I do think that a continuing resolution to get through Friday and through the weekend, if they're not willing to play ball there, then you have to look at what's going to happen next week. And members weren't slated to be, at least the House, to be in town.
Yeah. TSA would go without pay once we get into March, from what I understand. So maybe Democrats see a couple of weeks to play with before this becomes an urgent front page story, airport story. But talk to me about what happened with this tariff vote yesterday. This is interesting, and it is being framed, at least in the tip sheets this morning, as a very big deal, a turning point. Donald Trump finally found the line in the Republican-led House and Senate. What we're really talking about is 217, 214. 3 Republicans crossed over to block future votes or to block a block on future votes over the president's tariffs. Mike Johnson tried like heck to keep the conference together. Is this a watershed moment or a jailbreak of just 3 members?
I think what it shows you is that there is an appetite to reclaim control over a power that the Congress has. It's Article 1 of the Constitution. And many members have privately expressed frustration over it being handed over to the president, because they also know that back at home, tariffs, while it was messaged differently during the campaign, it's a tax. And it's largely felt by the American consumer. And that's a message that they're having a hard time not only justifying to their constituents, but then in talking from a constitutional aspect, that's a role that they had, that the speaker has more or less given over to the president. And I understand that Speaker Johnson's approach to this is saying, let's let the courts play out and let them decide. Members who have said, okay, fine, they've waited a long time for the court to decide on tariffs, and it still hasn't come out yet. And so presented with this vote last night, they chose to say, no, I'm going to reclaim the position of the ability of Congress to make decisions on tariffs. I I don't know that I necessarily say it's a watershed moment, but it may give other members who are feeling this privately a little bit more courage to say, I support that.
Okay, so that's my next question is because Democrats aren't waiting around. There's going to be a vote tonight, it looks like, on Gregory Meek's bill when it comes to Canada tariffs. And they're going to come around again and again and again to try to get Republicans on the record one way or the other. You either like tariffs and you can make Trump happy and maybe your constituents unhappy, or you're going to cross the boss on this. Is that the actual strategy here?
Well, I'd have to see what Gregory Meeks' legislative, kind of text is, because if it's revolving around this bridge situation that we saw kind of play out on social media this week, that may give some members some cover to say, well, we're still figuring this part out with Canada.
Picture, though.
Bigger picture.
Do you
if
want
this
to be
bill keeps
called
going,
out if you're a Republican?
being put on record.
Being put on record here.
Saying you're pro-tariffs,
because the president can veto
pro-taxes.
whatever they pass, right?
Right. That becomes a problem, again, when you're getting, we inch every day closer to the 2026 midterms.
Yep.
And they're going to be on record saying that they are pro-tariffs, pro-taxes. That's going to be a problem, and it's ripe for an advertisement against them come the summer.
Over and over and over. By the way, the Senate has already voted against these tariffs. I'm assuming that there's no anti-veto majority here.
Well, and you have several senators who have come out saying this is our responsibility. In the Constitution, it lays it out for Congress to decide on taxes and tariffs, and then for the executive to implement it. And I think on this show I've said it's hard for me to recognize that I've agreed with Rand Paul more times this year than I can really remember in my lifetime on the Hill. But he has been pretty vocal about it, and among others who have, again, pointed to the constitutionality of this position to give them cover in their conservative, values, that they're standing by the Constitution and the president isn't. And so trying to draw that line, I also think is going to be a benefit to them as they look forward in their elections, because again, the president's not running again, right? He can't, and they are. And if they are, they need to be standing in their conservative principles. And so this is in a position where they could point out that difference.
This is going to get even more interesting after the midterms, but
Certainly.
He's trying very, very hard to put himself on the ballot. It's going to be a Republican midterm convention. Does that keep the conference largely in line until then?
I don't know that it does.
No?
I do think that there are more and more cracks in the Trump stronghold as people recognize the economy is not where it was supposed to be, that was promised, that these ICE raids have been more damaging and making people feel less safe, which is the opposite goal, which was intended to create a safer, stronger security. And you find more and more of these fissures in the Republican stronghold that Trump has had. And I think, you're pointing to some off-ramps for Republicans to look to and say, I'm standing for my constituents, not just for what the administration is pushing out today.
Really interesting. I think you pointed to something really important, and remember this, if and when it happens, this could turn into a states versus federal law enforcement issue when it comes to masking if Congress can't figure this out.
And it may.
That in itself is a pretty scary prospect.
It is, but I also think you have to remember that conservatives, in a principle, they believe in smaller, more accountable government. And that's what that looks like.
States' rights.
Absolutely.
Great to see you.
Thanks,
Maura Gillespie, what a rare treat to have the founder of Bluestack Strategies with us in the flesh in Washington. Let us know when you're back in town, and I'm sure you'll be back on our panel soon. Maura Gillespie on Bloomberg Radio. Live on YouTube, search Bloomberg Business News Live. We'll assemble our panel next, only here on Balance of Power, Bloomberg Radio.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg Jobs Wednesday. We've got the Dow and the S&P back in the green right now. S&P up 12 to 69.54. That is a gain of 0.2%. NASDAQ, however, does remain lower. We did see a sell-off in tech names. Many of those names still trading lower. NASDAQ down 16, drop there of just under 0.1%. The Russell 2000 index of small cap shares down 0.7%, with a 10-year 4.15%. The 2-year 3.49%. Payrolls rose in January by the most in more than a year. The unemployment rate unexpectedly fell. Spot gold up $60 the ounce, back at $5,085, up 1.2%. Silver at $84.65 the ounce, up by 4.8%. West Texas Intermediate crude $64.86 a barrel. WTI up now by 1.4%. A sell-off in Bitcoin down 2.9%. Bitcoin at 66,620. After this morning's better-than-expected jobs report, the focus is now on the Federal Reserve. The interest rate swaps show traders see less than 5% of a chance that policymakers lower rates when they meet in March. Eric Winograd is Director of Developed Market Economic Research at AllianceBernstein. He was a guest this morning on surveillance.
If the labor market determines the pace of easing, if the Fed is easing because of the labor market, they'll go 4 times, they'll go further, they'll go faster, whatever. But if the labor market holds together, as it appears to be doing, then it will be disinflation that sets the pace of rate cuts, and that will be slower, shallower, more like 2 cuts. We'll see what we get on Friday, but at least for now, the 2-cut camp looks to be in the ascendancy.
And that's when we get the CPI report, 8:30 a.m. Wall Street time. Eric Winograd of AllianceBernstein. Nike down 1.5%. It says it expects its wholesale business to pick up steam across the world as it accelerates the launch of new footwear and apparel products and doubles down on its commitment to sports. Again, Nike lower by 1.5%. Bonus payments at Lululemon Athletica are currently tracking below target this year. That's according to a recording of an internal meeting that was reviewed by Bloomberg News. Lululemon down 1.6%. Recapping, S&P up 13, up 0.2%. The VIX at 17. Spot gold up 1.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, we thank you. On a Jobs Wednesday, boy, it gets weirder by the minute, and we'll have a CPI Friday for you later this week. That's the market you get for it. Interesting. We're back to 66,000 on Bitcoin. I guess you're happy you hang out of that Micron, huh? That's quite a story today, back above $400. Up 8% because the company said it's executing well. Doesn't take a lot in either direction in this market. Thanks for joining us on the Wednesday edition of Balance of Power. It's an interesting day here in the city because guess what? Well, no one's getting along. And I dare say the level of trust has reached a new low, as evidenced in this morning's hearing with the Attorney General. And boy, there was a lot to talk about there. Did you hear the Department of Justice failed to secure a grand jury indictment? What about the ham sandwich? Against the 6 Democratic members of Congress who made the video that the administration, the Pentagon, was very upset about, right? This is Mark Kelly, Alyssa Slotkin, others. We've talked to them here on the air about this, and they were being investigated by the FBI, I believe, at one point, on behalf of DOJ, urging the military, members of the military, to not follow unlawful orders, which is, I think, in the Constitution. But it's bringing out the best in everybody. Jason Crow, the Democrat from Colorado, the tide is turning. Check this out. The president swears a lot on the record, right? So now I guess lawmakers are doing it. This is a direct quote. If these effers, and he used the word, if these effers think they're going to intimidate us and threaten and bully me into silence, they're going to go after political opponents to get us to back down, they have another thing coming. My mother used to say that. Enter Jerry Nadler when it comes to the Epstein files. Boy, Pam Bondi, she must have been up all night getting ready for this one because she came out with red meat, teeth showing. Aggressive, I think is the word the playbook used in anticipation of the event. They had no idea what was going to happen. Listen to the gentleman from New York get into the Epstein files, lack of prosecutions with the Attorney General. See if you can find any air in between these two. Listen.
How many perpetrators are you even investigating?
First,
You showed it. I find it.
How many have you indicted?
Excuse me. I'm going to answer the question.
Answer my question.
No, I'm going to answer the question the way I want to answer the question.
No,
Your
you're going to answer
theatrics
the
are
question the
ridiculous.
way I asked it.
Chairman
How many have you
Jordan, I'm not
indicted?
going to get in the gutter with these people,
How many
but
have you-
I'm going to answer the question.
How many have you indicted?
Again, the time belongs to
Reclaiming my time.
the time belongs.
I think it's very
Reclaiming
interesting.
my time.
I think it's very interesting.
You can
when
reclaim
he
your
talks
time,
about they indicted, the president said they indicted him twice.
Mr. Chairman, please
They
stop the
sure
clock
did.
and
And
stop
he
the clock and
indicted.
restore his time.
Okay, here we go with these
Committee will be in order.
theatrics.
We could have kept that going for you. It went on like this for hours. Jerry Nadler had nothing on his fellow Democrats, and she was ready for all of them. Nothing was accomplished, but you're going to see this played, the beautiful bean footage, all day now on cable news and everywhere else. Let's assemble our political panel to get into this, because that was a doozy. This is the way all these hearings go now, right? Bloomberg Politics contributors Jeannie Shanzano, Rick Davis are with us. Jeannie is our Democratic analyst, democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick Davis, Republican strategist and partner at Stone Court Capital. Rick, I'm going to start with you because you've helped to prepare any number of elected officials and members of the military for very intense congressional hearings, grillings, the hot seat, the murder boards. What do you make of this approach here where the witness is almost jumping over the table with Oppo research to get to members who have challenging questions? Have they redefined the congressional hearing?
Well, they certainly redefined the ones that I've been witness to. I mean, the reality is, could you imagine sitting in a room briefing a cabinet secretary? Now, here, this is the plan. Attack all the Democratic members the minute they ask you their first question. Right. Answer no questions. Be combative. Be theatrical. Do everything you can to draw attention upon yourself and talk the entire time that the member had 5 minutes. I mean, honestly, it's like so much fun. I wish I'd ever had some kind of an opportunity like that. Is it effective? Absolutely not. Absolutely not. Let's make fewer friends today. I thought you said this was Make Friends Day.
Right. No, just Wednesday. I couldn't stop listening to it, Jeannie. Forgive me, I'm having trouble here. Maybe that's the point, but to Rick's point, typically you're trying not to make news in these hearings. Was this just all about an audience of one?
It absolutely was about an audience of one, and the most shameful part of this entire thing, and of course you and Rick are right, you can't hear a word that is going on. She's screaming, they're screaming, and who is sitting in that audience but a group of survivors, a group of victims who sent the Attorney General an open letter this morning asking for answers to 15 questions. We have victims, by the DOJ's count, over 1,200 women who are victimized, some as young as 9 years old. And they have to sit and listen to this back and forth nonsense going on and do not get answers to the questions. At one point, one of the Democratic members asked the victims to stand up, to raise their hands, and asked the Attorney General to apologize to them. She did not do that. She continued to talk over the Democratic member. And of course, for the victims, the irony of this entire thing is in her opening statement and throughout her back and forth, and her being the Attorney General, she has repeatedly made the case that anybody who's a victim can go to the FBI. And they are screaming from the rooftops. Over the last 2 or 3 decades, they've been going to the FBI and have gotten absolutely no response and recourse. And even in the last few days, their names and likenesses and pictures as victims have been released to the world for the world to see. So it is disgusting and clownish what is going on in that hearing, but there are real victims here, and it is very, very shameful on all sides.
Well, I appreciate what you just said, Jeannie. There were victims in the room here, and we still, to my knowledge at least, have not heard an update from the Department of Justice on those errors when it comes to redactions. By the way, Tom Massey's on this panel. He was questioning the Attorney General, the very man who was part of the duo that forced the release of these files, and is going to be, he says, back at DOJ every day reviewing them. We'll see if the unredacted files emerge. But Rick, when it comes to styling here, if you're testifying before this committee and you work for this White House, there was apparently She had the binders in front of her. She had Oppo research on specific members here and had an agenda. But there was a break glass in case of emergency page in one of those binders. If this thing goes off the rail, the questions get too intense. Point to the stock market. Listen.
The Dow is over 50,000 right now. The S&P at almost 7,000. And the NASDAQ smashing records. Americans' 401ks and retirement savings are booming. That's what we should be talking about. We should be talking about making Americans safe. We should be talking about, what does a Dow have to do with anything? That's what they just asked. Are you kidding?
Rick, of course, a lot of Americans are not invested in the stock market. What do you think of this mechanism? At one point, she referred to the Dow being at $50,000. From the Attorney General, how does that strike you?
Well, that's why you allow the Treasury Secretary to answer questions related to the markets and not the Attorney General. Look, I mean, it's pretty obvious. It's exactly what you described, you know, when the heat gets turned up too high. Completely change the topic. Talk about something you actually don't know much about. Read the talking points off of today's markets. And by the way, you know, maybe not a bad device considering how off the rails the hearing was going. Yeah, mostly as a contribution of her efforts. But at the end of the day, it's completely irrelevant, right? What anybody who sees the news on this is going to see that the House of Representatives and the Department of Justice are at loggerhead. There's no cooperation. There seemingly is no investigation related to the Epstein files. And for those people who care about this, the ones, you know, that Representative Massey was addressing, because that was really his focus, they're not going to get what they want out of this administration. And for whatever reason, after having set this up as some kind of a major effort during the campaign, to then so severely block any effort whatsoever to get some kind of settlement on it is going to hurt their base. I mean, like, and by the way, their base couldn't give a hoot about what's going on in the S&P or the Dow. Most of those are not, you know, they're barely banked. And so when you really boil it down, who are they talking to? They're talking to Democrats, who are likely the primary beneficiaries of the stock market right now. And I don't mean that to be all-encompassing, but the reality is they're off message. And they're certainly off message when the head of the Justice Department, with all the weighty issues that they've got right now going on in the country, are spending their time talking about what happened today in the stock market.
The stock market? Yeah, maybe she's got a future as a chief investment strategist, Jeannie, or a market analyst on Bloomberg if she sticks with this. But it does seem like we're plumbing new lows. You heard me mention the statement from Jason Crow as the DOJ fails to secure a grand jury indictment against 6 Democrats who, in many cases, veterans, if not all, telling people to, members of the military, not to follow unlawful orders. We've got a Homeland Security shutdown expected on Friday. Does it get worse from here?
Oh, I hate to be so negative, Joe, but you know,
it's my fault. I'm going dark on you, Jeannie. I know you're better than this.
It's ironic because you listen to that statement you just played by the Attorney General, and she's, you know, hair on fire. Look at the stock market. Look over here. And of course, in the meantime, her own DOJ is wasting the time of grand jurors in this country to see if they can indict 6 sitting members of Congress who are decorated veterans of the military and intelligence for repeating in a video something that our own department says is the rule and is what we've all known, which is that if you are a member of the military, you should not obey an unlawful order. She wasted time going there because, of course, Donald Trump wants to pursue these ridiculous indictments. And in the meantime, when she doesn't like what Thomas Massey, a Republican, is saying, she's screaming at him, "You're a political joke. You have Trump derangement syndrome. You're a hypocrite." And of course, last night, Thomas Massey said, if this thing goes off the rails, if he doesn't get the answers he wants on the Epstein files today, he will pursue contempt charges. Now, can he get those? I think it might be really difficult to get against her. Of course, those would go to the DOJ. But this is how off the rails this thing has gone. And she is wildly off message here.
Off the rails. We're all in agreement, I guess, on that one today. What a day in Washington. Thank God we've got Rick and Jeannie. They'll be back in our second hour. Kaylee Lyons is on the way in. Only here on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lyons.
1 million jobs disappear. Welcome to the Wednesday edition as today's payrolls number beats estimates, but revisions show a 7-figure loss from 2025. I'm Joe Matthew alongside Kaylee Lines in Washington. Kaylee, the president says the golden age of America is upon us.
Yeah, the president also says we should have the lowest interest rates in the country. The question is whether, or in the world rather, this country should have. The question is whether or not this data actually supports a Federal Reserve lowering interest rates further when you did have a higher than expected print on non-farm payrolls. The revisions, yes, nothing to sneeze at, but 130,000 print on jobs in January has this market pricing in a later Fed cut this year, looking at July instead of June.
That's right. We're going to get an update live from the White House. Tyler Kendall will tell us what the administration is saying, the way they're framing this. Of course, a lot of politics involved here. And then we'll dive into the numbers and look under the hood with Kitty Richards, who's back with us from the Groundwork Collaborative. We'll get a sense of what's important to her in these data. It's a Jobs Wednesday, which feels a little weird, kind of like a CPI Friday will too.
Yeah, we're all mixed up this week, at least when it comes to our domestic data. And while they are focused on that at the White House today, they're also focused on geopolitics as the president is meeting with the Israeli Prime Minister Benjamin Netanyahu as we speak. Didn't open it up to press, as seems to be the norm now in 2026, but we know Iran featuring heavily on their agenda.
That's for sure. We didn't even see him go in the door. This is his 7th visit, and we've normally seen him walk into the West Wing with a bit of an arrival. We only learned that he was in the building after the meeting began, so we'll keep tabs on that for you. I'm sure Tyler's going to give us the latest as well.
I'm sure she will, just as Nora Melinda right now is preparing to give us the latest read on the markets on this Jobs Wednesday. So let's go to her now in New York. Hey, Nora.
Hey, Kaylee. Well, it's 1 p.m. here on Wall Street. I'm Nora Melinda. We check the markets for you all day long here at Bloomberg. So an initial rally in stocks is waning amid yet another sell-off in software companies. Take a look at the S&P 500, hanging around 69.48, just above flat. We have the NASDAQ, that tech-heavy NASDAQ 100, up about 0.2% higher, and the Dow Jones Industrial Average lower by about 0.1%. Taking a look at the 2-year Treasury yield, we have that hanging around 3.5%, while the 10-year Treasury yield is around 4.1%. We've got West Texas Intermediate crude hanging around $64 a barrel, while spot silver trading around $84 an ounce. We've got spot gold just above that $5,000 mark. And jobs data, you mentioned that. We got some belated jobs data today after the partial government shutdown pushed the release of the reading back. The U.S. added more jobs in January than it has in over a year. The unemployment also decreased unexpectedly. That's a sign that the labor market may be starting to cool in 2026. So we are seeing that it may be starting 2026 on a solid footing. Shopify's fourth quarter results beat expectations after strong holiday spending lifted revenue. So we did see the stock, though, plunging after its adjusted earnings fell short of forecasts. Over in telecommunications, we have T-Mobile shares jumping for their highest since December after raising the outlook for service revenue to as much as $81.5 billion in 2027. Shares of Micron climbing after its CFO told Wolfe Research Conference that supply is likely to remain tight beyond 2026, and he gave an update on production of the company's latest high bandwidth memory. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Nora Melinda, and that's a Bloomberg Business Flash. Back to Balance of Power with Joe Matthew and Kaylee Lines.
Nora Melinda in New York, thank you so much. I am Kaylee Lines alongside Joe Matthew here in Washington, D.C. It's a place I haven't actually been to, the district, much in the last 6 months. I've been hanging out in the suburbs. I think, Joe, actually, the Israeli Prime Minister Benjamin Netanyahu may have made more trips to the District of Columbia than I have in the last
6?
half a year.
That's
He's
got to be
making
true.
his 7th during the Trump administration's
Pretty remarkable.
today.
7th. We didn't really see him on the last one. We may not see him today, which is interesting. They're talking about some pretty critical stuff here with potential strikes against Iran. Gaza, of course, is on the agenda as well. But we didn't even see him go in the front door, Kaylee, and I'll be curious to see how long they talk.
Yeah, and if we learn anything about what exactly they discuss, as we know, Israel may be singing a bit of a different tune than President Trump himself on as to what they'd like to see from Iran and its nuclear and ballistic missile program specifically.
That's true. Obviously, we've heard from Iran wanting to sort of narrow these talks around nukes, but Israel is deeply concerned about the progress being made on its ballistic missile program, and I'm sure he'll be urging the president to get into that. But also, having claimed that their nuclear program had been totally obliterated, the president today has to face the Israeli prime minister, who wants him to acknowledge the fact that they are making progress on rebuilding it.
Yeah, and let alone, of course, progress on rebuilding Gaza or reaching the next phase of the ceasefire agreement. There's still an open question mark in that regard, too.
That's for sure. Bloomberg's Tyler Kendall is with us, Washington correspondent, live from the North Lawn of the White House, where all of this is happening. Tyler, do we expect to see these two gentlemen later today?
Well, Joe, at this point, nothing remains open to the press, perhaps underscoring the sensitivity of these discussions. As you and Kaylee were just outlining, we know Iran is at the top of the agenda amid reports that Israeli Prime Minister Benjamin Netanyahu is going to present new intelligence to President Trump regarding Iran's military capabilities. Now, ultimately, we know that this meeting this week comes after the Israeli Prime Minister had met in Jerusalem last week with Special Envoy Steve Witkoff and the president's son-in-law, Jared Kushner, the two that are leading the now bilateral negotiations between the U.S. and Iran, which kicked off last Friday, and both sides characterized as relatively positive and said that they're going to have future talks likely next week when it comes to the second round. But going into the discussions, we know that there was sort of this shifting of parameters around what the talks would revolve around. Iran wanted them to be bilateral and only focused on their nuclear program. But part of the Israeli Prime Minister's goal here today, it's our understanding, is to press President Trump to make sure that those talks expand to other key issues for Israel and the United States. As we've repeatedly heard here from top administration officials, they want to also discuss Iran's ballistic missile program, as well as its support for proxy militia groups in the region. And the U.S. actually wants to bring in some other regional partners to these discussions, which officials say could help ultimately bolster the potential that a longer-lasting deal could remain in place. At the moment, President Trump maintains diplomacy is on the table, but Joe and Kaylee, as you well know, our own analysts at Bloomberg Economics have spoken about the high likelihood that we could ultimately see military strikes, particularly as President Trump just yesterday floated the idea that he could send a second armada to the region to bolster what is already a very large presence of U.S. military assets in the Arabian Sea.
Yeah, could be bringing in another carrier potentially. We'll see whether or not we get more commentary from the president in that regard, or anything at all that he might say about his meeting with Netanyahu today, Tyler. So far today, though, the only thing we've directly heard from the president on True Social, at least, is praise for the jobs report we got on this Wednesday. He said great jobs numbers, far greater than expected. No surprise, perhaps, that the White House is trying to focus exclusively on the positive here.
Right, no surprise there, Kaylee. Even as this report showed revisions to last year, there was this market slowdown in hiring. President Trump also in that post calling for lower interest rates, even as we know that traders are now pushing back bets for a Fed rate cut. So there's a lot that the administration is going to try to pull out of this report. They are focused on that upside surprise. It was interesting to hear officials ahead of this report, including the NEC director, Kevin Hassett, as well as the senior trade counselor, Peter Navarro, try to actually downplay expectations, saying that any weakness that may come is ultimately due to shifting population changes and the president's deportation policies. I've heard a few officials out this morning blaming any weakness on the prior administration, because this White House right now is really playing defense when it comes to the economy as we head into the midterm elections. I point you to a new poll out just this week from Gallup that shows 50% of U.S. adults are concerned about unemployment going up in the next 6 months and view the economy, but in particular the labor market, negatively. So there's going to be a lot to watch here as we head into November. But as you well know, this administration is really pushing those domestic manufacturing policies. In this report, we did see that factory jobs increased for the first time since late 2024, something that White House officials here have been pushing pretty strongly.
All right, Bloomberg's Tyler Kendall live on the North Lawn at the White House. Thank you so much. And standing in the spot where Tyler was standing just now earlier this morning was actually the acting chair of the White House Council of Economic Advisors, Pierre Yared, who spoke with Bloomberg earlier today about these jobs numbers. This is how he characterized the figures.
Not only is it total jobs that are up above expectations, it's also private sector jobs that are at 170,000, so more than, or 160,000, which are more than double expectations. I think the way to think about, the way we were thinking about it is if you look at demographic changes as well as the big reduction in immigration relative to, in particular, illegal immigration relative to what was happening under the Biden administration, those two factors should lead you to lower break-evens.
And joining us now for another analysis, perhaps, is Kitty Richards, who's here with us in our Washington, D.C. studio. She's Senior Strategic Advisor at the Groundwork Collaborative, also former official at the Treasury Department under the Biden administration. Thanks for being with us on Bloomberg TV and Radio.
Thank you so
Good
much
to
for
see
having
you
me.
again, Kitty. When we consider the first part of what he had to say there, this notion that jobs were double what the average expectation was. We did see a lower than expected unemployment rate, even as labor force participation was picking up. That is one way you could view and characterize this report. The other is, of course, look at the revisions. Look at how gains are kind of exclusively in sectors like healthcare. How do you look at it today?
That's right. I do feel like focusing on the revisions is important. And I don't want to take away from the fact that we beat expectations on the labor market for January, although I do think that it's important to recall that expectations were quite low. So the revisions that the BLS announced led to a total net job gain for last year of 181,000 jobs. That is a number that we used to see as a month-over-month gain on a pretty regular basis. And in fact, in the 10 years prior to last year, the average job gain over the year was about 1.9 million jobs a year. So what we've seen is this very anemic job growth. And, you know, I was here last year during some of these prints, and it was already concerning what was happening with the unemployment rate, what was happening with the pace of hires and firing, and to then see that actually we were way off and the labor market was much softer than it appeared, I think is troubling, though it does kind of align with some of the anecdotes that we've been hearing from job seekers who say it's difficult to find a job. We're seeing those jobs numbers start to look a little bit more like that soft labor market that people were experiencing.
Interesting, Kitty. But the president says the golden age of America is upon us. So when do the jobs start showing up?
I think that's a great question. And, you know, Kaylee, you mentioned that what we saw in the revisions and in the monthly data is increasingly what job growth there is driven by the healthcare sector specifically. And in fact, you know, last year outside of healthcare, there was actually a net reduction in jobs across the economy. And thinking about, you know, where are those healthcare jobs? Are they good jobs? Are they going to continue to deliver, especially given that the president has passed into law really large healthcare cuts that are going to start coming down the pike over the next few years, and families are having to face really high healthcare premiums. You know, thinking about, we see GDP growth continuing, and people are often very focused on, is this a sign of a recession? Are we at a tipping point? But I think the bigger question is, how is the economy performing for real people? Mm-hmm. And so when we see GDP growth that is driven to an outsized extent by, for example, the building and stocking with materials of data centers for AI. One way to look at that is that AI is driving GDP growth, but is it driving jobs? Is it driving increases in wages? Or is it just sort of an accounting fact that we have a lot being spent on computers? So really thinking about how this impacts workers and the day-to-day. And we might not be in a recessionary environment, but you can still have a softening labor market that's going to hold down wages, going to make it hard, especially for new graduates and other entrants into the labor market, to get a job that can pay the bills.
Well, and I'm sure the Fed officials there are considering some of those very same questions you were asking about what dynamics are actually at play here, both when it comes to growth overall and in the labor market. So if you're sitting in the Federal Reserve right now, you look at all this data before you, is it supporting the idea that we need looser policy, that more cuts should be coming, or not?
I think it's a complicated question for the Fed to deal with because, of course, inflation remains elevated, and the Fed is very concerned about signaling to the markets that they are going to keep inflation under control and bring it back down. You know, Jerome Powell has reiterated on multiple occasions that the Fed's target rate is still 2%, and we're well above that. And so they are balancing those equities. I do think that, you know, the president's advocacy is a little bit of a double-edged sword. As you were pointing out, he's at the same time saying that this was incredibly strong labor market conditions that we're seeing, and also we should cut interest rates. I think there are also issues issues with the new nominee for the Fed Board of Governors, for the Fed chair, is really being received as mostly a political appointment who will do what the president says or will try to. I think that other members of the Fed Board of Governors are going to be concerned about maintaining a posture of neutrality and of independence. And it's all going to be really difficult as it plays out. And I'll be watching along with you.
I want to get back to this impact of AI on the job market, because it's impossible to quantify right now. Elon Musk just told a podcast that created this vision of buildings 20, 30 stories tall, filled with humans doing calculations that will soon be replaced by a laptop. If you can't forecast that, how does the Fed forecast that? How do you have any estimate for where we're going?
I think that we are in a little bit uncharted territory in some ways, but also this isn't the first time that we've had a potentially disruptive technology enter the scene. And I think it's important to keep our wits about us as we measure what we think of Elon Musk's predictions versus what we're actually seeing in the labor market.
Well, I could point you to Anthropic, and it only gets worse from here in some cases, by the way, that will all be replaced at some point. You're going to have two AI, Kaylee and Joe, sitting here interviewing Kitty Richards.
I mean, one thing that I'd say is that what we know from the history of technology adoption is that it's really up to us as a society to decide whether technologies like AI are used to provide more to Americans, to provide more, leisure, more productivity gains that lead to higher wages, support people in their jobs, or whether things just kind of get worse and worse and cost-cutting increases and people are de-skilled, people's jobs are de-skilled. These are policy choices that we really have to make. And I think if we just let the sort of techno-optimists who also stand to make another $1 trillion, if things go their way, if we let them entirely set the agenda, we're gonna see the worst possible effects.
He was wearing a T-shirt that said, "Optimism Prime." It's funny.
Optimism for whom?
Yeah.
You could probably do a whole thing on Elon Musk and the various T-shirts.
It's gotta be
remember
true.
the apparel he had early on in the early days of this administration. Just quickly, Kitty, before we let you go, as we're approaching tax refunds, we are in tax season now, and the argument Republicans are making is Americans are about to get a way bigger refund than they expected, and this is going to be juice for the economy. Given everything that we're seeing with the cost inflation, with wages not necessarily keeping up, as you were alluding to, should we expect that's going to be funneled back into consumer spending, or is that literally just assistance in making ends meet?
Well, unfortunately for the Republicans making this argument, I think that given how much they've hyped up the effects of their tax policies, Americans might be expecting a significantly larger refund than they are going to get. Because remember that the vast majority of the Republicans' tax bill flowed to the wealthy and corporations. And so your typical American family did not have much to gain there. What they have seen, unfortunately, is these skyrocketing healthcare premiums, partly because of the expiration of the ACA subsidies. And what they're going to see out of the One Big Beautiful Bill Act is Medicaid cuts that are already starting to impact hospitals and state budgets around the country.
Great to have Kitty Richards back with us in studio. We never got to 15% growth. We have so much more to talk about.
Next time.
Don't be a stranger. Senior Strategic Advisor, The Groundwork Collaborative, and great insights from Kitty Richards. Thank you, as always, for the conversation. I'm Joe Matthew alongside Kaylee Lyons in Washington. We'll assemble our political panel next, only here on Balance of Power on Bloomberg TV and radio.
It's 1:21 here on Wall Street. I'm Norma Linda. We check markets for you all day long here at Bloomberg. But first, let's get to a redhead crossing the Bloomberg terminal. The Federal Reserve plans to abandon some confidential warnings sent to lenders to improve operations. This is a part of Vice Chair Michelle Bowman's effort to relax oversight of U.S. financial firms. Over in the markets, U.S. stocks are a bit skittish as a widespread decline in software stocks stunted an earlier rally. We have the S&P 500 at 6940, just below flat, while the tech-heavy NASDAQ hangs around 25,153. That's up 0.1 of a percentage point. And the blue chip Dow Jones Industrial Average we have lower by about 0.3%. We have the 2-year Treasury yield, that policy-sensitive 2-year Treasury yield, at about 3.5%. While the 10-year Treasury yield hangs around 4.2%. West Texas Intermediate crude just below $65 a barrel, while spot silver is trading at about $84 an ounce. We got jobs data earlier. The labor market may be starting the year on a solid footing. And we did see that it showed that U.S. jobs added more jobs in January than it has in more than a year. The unemployment rate also decreased unexpectedly. Among the worst performing stocks in the S&P 500, we're watching Robinhood. Shares are tumbling after it reported lower profit for the fourth quarter, declines in Bitcoin and other cryptocurrencies at the end of last year weighing on results. Mattel tumbling double digits for its worst day since 1999. The toy maker's forecast for 2026 adjusted EPS fell short of the average analyst estimate. While over in the housing market, we've got our eyes on Zillow. Shares sinking to their lowest level since 2024. That's after its first quarter profit missed expectations. Legal costs and expenses from its partnership with Redfin weighing on metrics. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Norma Linda, and that's a Bloomberg Business Flash. Back to Joe Matthew and Kaylee Lyons in Washington.
All right, Norma Linda, keeping an eye on the markets. Thank you so much. Meantime, Joe and I here in Washington are keeping an eye on the White House as well as on Capitol Hill today and every day. And there will be some action on Capitol Hill potentially later this evening, specifically when it comes to a vote in the House of Representatives on the president's tariffs policy, tariffs on Canada. Specifically, it's a resolution that has been put forward by Democratic Congressman Gregory Meeks of New York that will now see a vote forced, despite the attempts of the House Speaker, Mike Johnson, to make sure that that did not happen, putting some of his vulnerable members in the majority in a tricky position of going on the record as to whether or not they support these policies. Because Speaker Johnson, despite knowing that he had a very thin majority and the math was going to be hard, did try to pass a rule yesterday, Joe, that would have seen effectively an extension of the ban of putting forward tariff-related resolutions like this on the House floor. And 3 Republicans told the Speaker and the President, we're not with you on this one.
That's true. Not all the names surprising, but this is getting back to why margins matter here. 217, 214. The Speaker's seen this movie a lot of times, all right? Tom Massey of Kentucky, I know you're not surprised. Add Kevin Kiley of California, Don Bacon of Nebraska, and it's a fail. The question is, and we'll have to pose this to the panel, is this a watershed moment or just a jailbreak of 3 members?
Well, and when we consider the composition of those 3 members, yes, Bacon's retiring, Massey, as you point out, not unusual to break with the party. Kevin Kiley, though, could potentially be representative of an entire group of Republicans, those who are in swing districts having tough seats to defend, who have to consider these policies and what they mean for their constituencies a bit more carefully. So could there be more Kevin Kileys coming out of the woodwork on actual tariff resolutions?
Well, you outlined that perfectly, and this is what Democrats are hoping, because they're going to have a series of votes like the one tonight with Meeks on Canada to try to put Republicans on the record, knowing that this won't likely become law. The president's going to veto it, but a lot of political ads can be made in the meantime. We're going to find out who's worried about tariffs and who is worried about Trump. Let's assemble our panel for their take on this. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us. Jeannie is our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick, a partner at Stone Court Capital, our Republican strategist. How are you reading these 3, Rick, knowing that the Senate has already voted against Donald Trump's tariff regime? Is this, in fact, a rebuke? Did the president find the line, or are we making too much out of this?
Yeah, I think Kaylee nailed it with sort of the various motivations, although I would say Kevin Kiley, I mean, he actually doesn't have a district. His was wiped out with Proposition 50, the redistricting. So he's out there wandering around trying to figure out where he's going to run for re-election. But he does plan to run for re-election. But he does represent, I would say, almost the majority of the Republican caucus in the House of Representatives, who are very offended that the president has usurped their Article 1 constitutional responsibility to make tariffs. And so if you needed 4 votes and not just the 3 that you got, would you have gotten another Republican? Probably. And I would say, too, with this one, this goes right to the White House. I mean, yeah, we like to see the speaker deliver the votes, but the White House said, you know what, this is on us. We're going to make this happen. We're going to put the pressure on these guys. And so the White House Ledge Office was all over this thing. And this is a huge loss for Trump. It's his first big loss legislatively where he thought he could actually win. And so is this a thing of the future? Maybe. A lot of these guys are from districts that are not going to be easy to win re-election in a bad cycle year. And I wouldn't be surprised to see more jailbreaks in that regard.
Well, so when we consider the potential scope and scale of said jailbreaks, Jeannie, Rick just suggested it might be a majority of the Republican conference in the House of Representatives that actually disapproves or at least wants the congressional authority to be the one that matters on tariffs. Are we wrong in assuming that a 2/3 majority, veto-proof majority, could actually be present or not be present on this issue?
Yeah, I mean, this is one of there's so many confounding things about what happened last night to me. Number one, if this passed Congress, the president was going to veto it, and it was going to, it's hard for me to imagine he wouldn't survive that veto. But, setting that aside, we knew very clearly, because all 3 of these individuals forecast that they were not going to vote for this thing. So Mike Johnson knew it, the White House should have known it, and yet they let it go forward as if it wasn't going to be a big loss for them. As opposed to what you would think a normal White House would do is you are facing a very difficult election year in just 9 months from yesterday. Let your Republican members in these swing districts, these purple districts, who are trying desperately to win, give them a little latitude to go against you on something that most Republicans don't support, which is tariffs and taxes. But instead, they want to keep everybody together. And, to me, this seems like the same thing we see Pam Bondi doing in the DOJ. Mike Johnson is playing to an audience of 1. You go to the DOJ, try for indictments you're never going to get. You go to the floor, try for votes you're never going to get, and then say to Donald Trump, oh, listen, I tried, can't blame me. Look at the grand jurors or look at Tom Massey if you're upset. I mean, I think that's what's going on here, but it makes no sense politically or strategically for these Republicans or for this White House.
Well, I'll tell you, it also did not make sense, apparently, to a grand jury to indict the 6 Democratic members of Congress who urged members of the military in a video that came out some weeks ago now, we've talked about it, to not follow unlawful orders. This is when we were busy blowing up alleged drug boats coming out of Venezuela. You remember this video, Alyssa Slotkin, Mark Kelly, and others? Here's a little refresher.
This administration is pitting our uniformed military
and intelligence community professionals
against American citizens. Like us, you all swore an oath
to protect and defend this Constitution.
Right now, the threats to our Constitution aren't just coming from abroad, but from right here at home.
Our laws are clear. You can refuse illegal orders.
That was called sedition by the president. This grand jury decided that this was not a case. They failed to secure the indictment here, despite the better intentions of the Attorney General. This is something that came up in Pam Bondi's testimony earlier. Rick, what do you make of this? I know that Mark Kelly is still in some hot water here with Pete Hegseth specifically, but as far as these other members go, is this a good day for the Constitution? If you read the quote from Jason Crow, the Democrat from Colorado who we saw there, I can't even read it on the air. I'll do my best. If these effers think they're going to intimidate us and threaten and bully me into silence, they have another thing coming. Rick, this was clearly a bridge too far. What's the recourse?
Are you baiting me to do something I shouldn't do on air? No, I doubt
I wouldn't.
Look, I mean, this is the most confounding thing I've ever seen. First of all, it was a total political stunt by these 6 Democrats to do that video. I mean, when does anybody do a video to talk writ large to 1 million uniformed service personnel? I mean, come on. But what happens? The White House totally takes the bait. I mean, like, you're supposed to ignore stuff like this. And in taking the bait, not only does the president say some pretty injurious stuff about, like, this is seditious and these people should be put to death. That's a bad thing, right? That's a bad news day for Donald Trump. He doesn't really mean it. I'm highly confident he doesn't want to put Mark Kelly to death. But at the end of the day, he unleashes the Justice Department on him. And then what happens? They elevate Mark Kelly. Now people are talking about him running for president of the United States in 2028. I mean, like, that's the best thing that ever happened to Mark Kelly's political career. So, you know, I don't understand why everyone isn't just taking a step back on this and saying, you know what, this makes absolutely no sense. Why are we prosecuting this thing? And now to get the black eye of a grand jury saying no to the Justice Department, by the way, in another high-profile case, like the Comey and the Letitia James case, they're like striking out at the plate. So I don't know. I mean, to me, this was all very avoidable. But I guess if you want to play, you gotta decide whether you're going to win or lose.
Yeah. Well, and to the point Rick is making on these strikeouts, Jeannie, arguably the bar for a grand jury indictment isn't incredibly high necessarily. We're not talking conviction here. This is just the indictment to try to make, to bring the case forward. Do you take heart in the fact that this isn't necessarily just everything the DOJ wants, the DOJ is getting?
Yeah, the old ham sandwich, Kaylee. And, you know, somebody was saying at the hearing today, the number of strikeouts by this DOJ is astronomical compared to any attempts to get grand jury indictments in the years before. And so I believe we are hearing Pam Bondi respond to messages that Donald Trump has accidentally sent to her publicly, and I'm sure she's gotten a lot more heated messages from him privately saying, you need to pursue this. So again, very much like Mike Johnson, even though they know they're going to strike out, they keep pursuing this and end up looking weak. And, you know, somebody said, and it's so true, this video that they put forward is the same message that the Department of the Defense Law of War Manual says. And yet you're going to try to go to grand jurors and indict people for repeating what the Law of War Manual actually says. That's a non-starter. And God bless our grand jurors. We now are in a situation in this country where it is average people on the street who are hauled into a grand jury to sit, who are checking the president and the DOJ, who are wildly overstepping any sort of executive mandate. It's not a great place for our country to be, but it's where we are. And if we had courts that would do the same, we'd be in better shape. But now we have grand jurors who are saying this is a non-starter in a way they never have before in American history.
All right, Jeannie Shanzano and Rick Davis, Bloomberg Politics contributors in our political panel today. Thank you both, as always, for joining us. That was, of course, Joe, one element of the questions the Attorney General Pam Bondi was on the receiving end of today on Capitol Hill. We didn't even mention all the questions she got about the Epstein files and those unredactions.
Yeah, well, we'll see if Massey and Khanna find any unredacted files today. We're going to turn our attention to the White House. Benjamin Netanyahu is meeting with the president right now. It's next on.
It's 1:41 here on Wall Street. I'm Norma Linda. We check the markets for you all day long here at Bloomberg. A redhead earlier crossing the Bloomberg terminal, the Federal Reserve plans to abandon some confidential warnings sent to lenders to improve operations. This is part of Vice Chair Michelle Bowman's effort to relax oversight of U.S. financial firms. Over in the market, we have U.S. stocks wavering between small gains and losses this Wednesday. We have the benchmark S&P 500 just above flat, just about 1/10 of a percentage point higher, while we have the tech-heavy NASDAQ 100 up 0.2%. The blue chip Dow Jones Industrial Average lower by about 0.3%. We've got the 2-year Treasury yield hanging around 3.5%, while the 10-year Treasury yield sits at 4.2%. WTI crude just above $65 a barrel, while Bitcoin is sliding today, hanging around that $67,000 level. Over in earnings, we got Kraft Heinz Company halting its plans to split in two to concentrate on bolstering profitability. The company said it'll invest $600 million in marketing, research, and development. It intends to improve its products, reduce some prices, and launch healthier options. Lyft shares fell after the company issued a forecast that disappointed. Lyft attributed the shortfall to a $168 million impact from settlements related to legacy driver classification matters and reported fourth-quarter revenue that came in below estimates. And Uber, we did see that also falling. Of course, the peer of Lyft falling in sympathy. Shares currently sliding more than 2.5%. And Jobs Wednesday, yes, you heard that right. We did get a belated jobs report out this morning that showed that the U.S. added 130,000 jobs in January. That's the most in more than a year. Meanwhile, the unemployment rate decreased unexpectedly. This all signaling that the labor market continued to stabilize at the start of 2026. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Norma Linda, and that's a Bloomberg Business Flash. Over to Joe Matthew and Kaylee Lyons in Washington.
All right, Nora Melinda, thank you so much, setting us up beautifully on this market action on this Jobs Wednesday. I have to be careful every time I say that. That is indeed Wednesday, not Friday, as usual. We want to dive a little bit deeper into the action we are seeing on this Wednesday trading day and turn to Alexander Semenova, Bloomberg News U.S. equities reporter. As Nora was just running us through, Alexander, you're seeing a lot of fluctuation today. Are we to view this more as a macro story tied to jobs, or is this a micro story tied to more individual stocks, like software stocks specifically?
Hey, Kaylee. So it is a little bit of both today. You know, on one hand, on the macro side, you got a labor market report that showed that jobs growth exceeded expectations handily. So it eased any concerns that investors had about slowing growth. But on the flip side of that, of course, it's causing a recalibration in expectations for interest rate cuts. So the repricing is causing some of the volatility. But stocks were higher in the morning after the report, and it was really the selling of software stocks that saw the market go lower. So the story around AI first was this concern that we're in a bubble, that hyperscalers are spending way too much money, and investors were worried about whether they can monetize that heavy CapEx spending. But now the narrative is kind of that AI is coming for different industries, replacing a lot of the companies' business models, and that is seeing the pressure in software shares. The Bloomberg Magnificent 7 index fell as much as 1% today. It has paired some of that loss, but some of the pain today is in the iShares Expanded Tech Software Sector ETF. That is IGV. It is down about 4% today, and of course, software stocks have been under pressure for a while. Something worth pointing out is that this hasn't really been broad-based selling, but a rotation out of technology stocks. If you look at the S&P equal weight, for example, which gives the same weighting to Amazon, a giant like Amazon, and a relative minnow like Newell Brands, for example, it is slightly outperforming the S&P 500 today, and it is up 6% this year compared to the S&P 500's 1.5% gain. So a lot of it is just rotation out of tech and investors trying to figure out who the new winners are.
Well, to that end, Alexander, it's great to have you with us today. I keep beating the drum on this. Even on our worst day last week, the equal weight S&P 500 hit a new all-time high. Guess what? It did it again today. So this is proof that this rotation is not a head fake this time, right?
Exactly, Joe. We also saw the Dow Jones Industrial Average hitting a record yesterday. It is down slightly today, but it seems like investors are trying to figure out where to park their money after the run-up that we've had in tech. Some pretty remarkable figures out of Deutsche Bank this past week. We saw inflows into sector funds outside of tech hit $62 billion in the first 5 weeks of this year. For context, that is more of all of 2025. So there's really been this incredible rotation. And again, you mentioned that equal weighted S&P 500 outperforming. Really incredible to see, given the strength that we've seen in tech and some of the Magnificent Seven companies outperforming up until now.
It's great to have you again. Alexander Semenova, live from World Headquarters in New York. We'll get another update on stocks from Nora Melinda coming up at 2 p.m. Eastern Time. Thanks for being with us on the Wednesday edition of Balance of Power as Kaylee and I turn to matters abroad. By way of the White House here, Benjamin Netanyahu is in the White House right now with President Trump. We just have not seen him, which is pretty unusual for the visit of a foreign leader. In this case, well, maybe not unusual, because we didn't see him last time he was here either. This is the 7th visit that Netanyahu has made to this White House, and he was brought in the side door today. We didn't learn he was there until the meeting was already underway. It's unclear if we will see these two gentlemen after they meet, but they have a lot to talk about by way of Iran, of course, and Gaza. And it's where we begin our conversation with Rebecca Lisner, Senior Fellow for U.S. Foreign Policy at the Council on Foreign Relations, a former Deputy Assistant to the President, Principal Deputy National Security Advisor to the Vice President in the Biden administration. Rebecca, thank you for joining us. What do you make of the fact that this is happening behind closed doors and away from cameras and microphones?
Well, exactly as you said, this is Prime Minister Netanyahu's 7th visit to the United States since President Trump assumed his 2nd term in office. And that's more than any foreign leader. The agenda is jam-packed. And in fact, Prime Minister Netanyahu was supposed to come to Washington next week, but he accelerated his visit. He moved it up by a week, and he's in there right now, just a block from where I am, because he's worried. He's worried about the negotiations that the Trump administration is pursuing with Iran, and he's concerned that President Trump might make concessions on issues that are a red line for Israel.
Is he right to be worried, Rebecca? Are you worried?
So here's the thing. There are 3 major questions at issue in U.S.-Iran negotiations. The first is the nuclear program. This is the question that has been on the table throughout Trump's presidency and indeed even before. And at the heart of it is whether Iran will agree to give up its right to domestic enrichment of uranium, the process that is required to build a nuclear bomb. And President Trump seemed like he might be poised to concede on this issue back in June before the Israel-Iran war. But Prime Minister Netanyahu preempted any possible concessions and any possible deal by launching a military campaign against Iran, which the United States ultimately joined. So now we're back at the negotiating table with U.S.-Iran talks beginning to pick up momentum. U.S. and Iranian negotiators actually met face-to-face just last week in Oman. And so the question here is Iran going to breach its own red line on never agreeing to constraints on its own domestic enrichment of uranium? Or is the Trump administration going to cave and agree to something short of what Prime Minister Netanyahu would like to see? But unlike in June, there are other issues. Oh, go ahead.
Please go ahead. Sorry.
Just going to say, unlike in June, there are other issues on the table as well. And precisely because the joint U.S.-Israeli campaign was so militarily effective against Iran during the 12-day war, now Israel and the U.S. want to see more. And so now there's a discussion also about limits on Iran's ballistic missile program and also limits on its support to regional proxy groups, both of which were off the table previously and are issues on which Iran is unlikely to make major concessions but have become major red lines for Israel.
The president said that we had totally obliterated Iran's nuclear program, and in fact was offended, said it was an insult to the service members who conducted the strike to suggest otherwise. Is Benjamin Netanyahu telling him otherwise today?
What I think we know and what the U.S. intelligence community seems to have concluded in the wake of the strike is that Iran's nuclear program was severely damaged by the strikes in June. There's no question about that. But in the months since, Iran has been dedicating most of its resources and attention to rebuilding its missile program. And you'll recall that now on several occasions in April and October of 2024 and during the war last June, Iran launched significant missile salvos at Israel. And that's why Prime Minister Netanyahu has somewhat moved the goalposts. He now wants to see limits on Iran's missile program, and if not, he's threatening to strike it himself.
Well, and of course, when Iran tried to send those missiles Israel's way, by and large, the vast majority of them were intercepted either by Israel's own defenses or the defenses of allies, including the United States, for example. When we consider the United States positioning now in this region, President Trump, of course, has said he has sent an armada. One he told Axios could actually potentially get bigger. He's considering apparently sending in a second aircraft carrier, Rebecca. How should we think about that strategic position and what we might actually be looking to do if negotiations are not ultimately successful?
Well, for most of the post-October 7th period in the Middle East, the United States had 2 aircraft carriers in the region. Right now, we only have 1 carrier strike group. So the United States' ability to inflict significant damage on Iran, on its missile sites, on its nuclear sites, on its regime targets, that remains significant. But I wouldn't expect to see military activity unless and until that second carrier strike group is moved into the region, at which point the United States will have more capabilities at its disposal, both to do offensive strikes against Iran should it choose to do so, but also to defend U.S. troops, U.S. personnel, U.S. sites in the region, and also, precisely as you said, to help Israel in defending itself against whatever kinds of missile salvos, UAVs, and so on Iran might send its way.
Wow. That's fascinating, Rebecca. So a second carrier strike group is necessary to complement when it comes to force protection? You don't think anything happens till then?
That would be my expectation. Again, there is still the possibility that military action could happen sooner, but based on my experience in national security policy, I would not say that the region is yet set for major military operations.
Well, and as we lean on your experience, Rebecca, advising a president of the United States on issues regarding foreign policy, from that purview of advising and considering political ramifications, would you be advising this president currently to be focusing so much on these issues, on the Middle East, on Venezuela, on Greenland, rather than issues domestically here at home, like affordability?
Well, look, you are starting to see a pretty significant and growing outcry from President Trump's MAGA movement about the amount of time that he's spending on foreign policy. And it's not completely unusual for a second-term president, and especially for a lame duck president who won't be running again, to focus internationally. But we have really significant issues here at home. And so at the same time as President Trump is seeking to change the nature of the Venezuelan regime and take ownership of its oil capacity, at the same time as President Trump is seeking to shape Iranian politics and potentially contemplating additional military strikes, there are really significant issues happening here at home. People are hurting. They're feeling that their bills have gotten too high. And so I would say that the attention focused abroad is always warranted. It's what we expect from a commander-in-chief. But the balance seems to be off if you look at the feedback he's getting from his own constituents.
We should note that Axios is reporting that meeting is ending now after some 3 hours. Rebecca, we haven't even mentioned Gaza in our conversation yet. Where does it lie on the agenda?
Gaza will certainly be on the agenda today as well. And the issue that's front and center is the demobilization of Hamas, and in particular, the disarmament of Hamas. We've now moved into the second phase of implementation of President Trump's 20-point plan, but frankly, it's been stalled because as long as Hamas retains its weaponry, light weaponry, heavy weaponry, it's going to be impossible to convince an international force to go in and begin the stabilization mission that is envisioned in Gaza. And so the key question is going to be, what is the extent of Hamas disarmament that is acceptable to Israel? What is the extent of Hamas disarmament that's acceptable to the United States? And can they reach a middle ground that Hamas itself will also accept in such a way that allows the peace plan to go forward? If not, we'll find ourselves stuck. Hamas will retain control over part of Gaza. Israel will retain control over part of Gaza. And Prime Minister Netanyahu has been very clear that a resumption of military activity is very much on the table.
We only have a minute left here, Rebecca, but how significant is it that Netanyahu has signed on now to be a member of the Board of Peace?
I think it's an endorsement of that structure at a time when many important countries have declined to sign off, but frankly, it's not determinative in the implementation of a peace deal like this one. The even smallest details can be enough to derail it. And so I would say on issues like the demilitarization of Hamas, what specifically is agreed, it's much more important than these overarching bodies that the president has tried to launch in order to oversee the process.
All right, Rebecca, thank you so much. Rebecca Lissner, Senior Fellow for U.S. Foreign Policy at the Council on Foreign Relations, also, of course, former National Security Advisor to the Vice President during the Biden administration. I should note, Joe, after that meeting that just wrapped, almost 3 hours long, we have a readout from President Trump. He says it was a very good meeting, and the tremendous relationship between our two countries continues. There was nothing definitive reached, he says.
Interesting, referring to Iran. Hopefully this time they will be more reasonable and responsible. Additionally, discuss tremendous progress being made in Gaza. We'll have a lot more on this on the late edition of Balance of Power. That starts at 5 p.m. Eastern Time. Alongside Kaylee Lyons, I'm Joe Matthew in Washington. This is Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms, radio, TV, YouTube, Bloomberg Originals.
We're everywhere.
We are. Bloomberg platforms all over the place. Hey, having said that, this is Happy Hump Day. It is Wednesday, and it's a Jobs Wednesday. Typically, we talk about Jobs Fridays. It didn't
We didn't
happen.
last Friday.
No.
No, thanks to the government shutdown.
Exactly. But we did get a read on the U.S. labor market. The report has traders paring back bets on Fed rate cuts this year. So we're going to get more on that and more on the trade in just a moment.
Yeah, we talked a low hire, slow fire on U.S. jobs and really dig into what's actually going on.
Yeah, because I feel like the monthly data gave us one thing, and then the revisions may be another story. So we're going to get into that. Hey, so delighted to have back with us Aaron Jagdfeld. He's chairman, president, and CEO of Generac. It is all about powering up, I should say, and providing maybe backup power for all of the data centers that are being built up. This stock, by the way, the company came out with its results, #1 gainer in the S&P 500. It's also on a tear year to date.
Also, changing global alliances as President Trump ponders over a key trade alliance. Also, the Middle East and that meeting between Bibi and Donald Trump.
Also, Venezuela, stuff going on there as well. So a lot coming your way geopolitically. Let's get you going, though, with a check on the trading session. In for Charlie Pellet, Nora Melinda.
Hi, it's 2:01 here on Wall Street. I'm Nora Melinda. We check the markets for you all day long here at Bloomberg. We have U.S. stocks fluctuating between small gains and losses. We got the S&P 500, little change. The tech-heavy NASDAQ 100 up about 0.4% higher, while we have the Dow Jones Industrial Average sliding by about 0.2%. We have the 10-year Treasury yield in focus. It's sitting around 4.2%, and then the 2-year Treasury yield at about 3.5%. We've got the VIX just above that 17 handle, and WTI trading at about $64 a barrel. Bitcoin sliding today, hanging around that $67,000 mark, while silver hanging around $84 per ounce. A redhead just last hour, we did see that the Federal Reserve plans to abandon some confidential warnings sent to lenders to improve operations as part of Vice Chair Michelle Bowman's effort to relax oversight of U.S. financial firms. In earnings, we did see Robinhood among one of the worst performing stocks in the S&P 500. Shares tumbling after it reported lower profit for the fourth quarter. Declines in Bitcoin and other cryptocurrencies at the end of last year weighing on results. And Mattel tumbling for double-digit losses. That's the worst day since 1999. The toy maker's forecast for 2026 adjusted EPS fell short of the average analyst estimate. Zillow shares sinking to their lowest level since 2024. We did see legal costs and expenses from its partnership with Redfin weighing on results. And Jobs Wednesday, you called it out earlier. We did get a late jobs report out this morning that showed the U.S. added 130,000 jobs in January. That's the most in more than a year. Meanwhile, we did see that the unemployment rate decreased unexpectedly. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Nora Melinda, and that's a Bloomberg Business Flash.
It is indeed. Nora, thank you so much. Carol Master, Tim Stanovic, live here at Bloomberg headquarters in New York City. Yes, we finally got the monthly labor report, which was supposed to be out last Friday. We've talked about that. Today's data showed U.S. payrolls rose in January by the most in more than a year. The unemployment rate unexpectedly fell, suggesting the labor market continued to stabilize after the start of 2026, and yet not so fast, Tim.
The U.S. labor market coming off one of its worst years for hiring in decades. Revisions to employment figures showed the nation added 181,000 jobs last year. That's the lowest annual total outside of recession years, going all the way back to 2003. That averaged out to just 15,000 job gains per month. That's down from an initially reported 49,000 pace. This according to data that we got today from the Bureau of Labor Statistics.
All right, with more on where we are exactly in the U.S. labor market, because it feels a little confusing. Constance Hunter with us, chief economist at the EIU, the Economist Intelligence Unit. She joins us from Wellington, Florida. Hey, Constance, good to have you back with Tim and me. So January stronger than forecast. Revisions show a little bit of a different picture. What's your read on the U.S. labor market and why?
Yeah, so I mean, for those of us that had forecast a recession in 2025 because of policy uncertainty, because of tariffs and other changing policies, I suppose one could say it feels a little vindicating because we did have a bit of a labor market recession, although other aspects of the economy were firing all cylinders. And I was at Davos last month, and the thing that I heard over and over again from companies, and not just U.S. companies, was we put ourselves on hold in 2025, and we are done with that. The tariffs are bad. They're worse than was originally expected, less bad than originally announced. And all of the other policy uncertainty, I think, to borrow a phrase, the corporate leaders are getting uncomfortable being uncomfortable. And so they're just viewing of it's time to get on with it. But last year was very much a stasis year in terms of hiring.
Yeah, I'm wondering about long-term implications of this. I mean, because if we think about it from the perspective of immigration in this country and the way that the labor force will be changing in the coming years, where workers are going to come from, especially for certain jobs in the trades, for example, in construction, in home building, which we know this country desperately needs. What is your view there?
Yeah, well, I would add to that home health aides and
an aging population,
right?
yes.
So, yeah, well, if you look at the BLS projections of the jobs that require the most absolute increase in workers and the highest percentage change of workers, healthcare has been in that list for at least the last decade. And of course, we're also going to need construction workers to build homes. And a lot of these professions draw upon an immigrant population. So it's certainly, I mean, to borrow Powell's phrase, which is still apt, we're in a very curious balance in the labor market. And of course, if we have fewer or lower population growth, wherever that comes from, we know that you have to make up that for potential GDP in terms of productivity. And while we seem to be in the midst of a pretty solid period of productivity growth, that lack of labor force growth is a long-term problem.
So, yeah. So I'm really wondering, you know, I think about, you are currently a board member on the National Bureau for Economic Research. They are the official, we all know that, the official arbiter of recession, so the start and the end dates. Where are we in this business cycle? And as you look at these longer term trends, maybe with the U.S. labor market, what does it possibly mean in terms of our economic cycle, how that might change, and maybe how it might be more stressed in the future?
Yeah, well, I mean, certainly if we look at labor force growth, that's generally speaking more of a cyclical thing. I mean, I'm sorry, a structural thing. However, when we look at what happened with COVID, right, we had a big decrease in the number of people entering the country during COVID. We had some makeup and a big increase for several years, and now we're at this place where we're not having that many people enter the country. That has distorted a lot of the data. In addition, when we look at the labor market data, it's also distorted by the layoffs during the pandemic, the rehiring, the frenzy to rehire, the fear and labor hoarding that existed for a while. And so as I look at the business cycle, what you're forced to look at is things other than the labor market, in part because that data is so distorted. And so if I look at something like corporate profits, they're actually looking pretty strong. And we've never entered a recession when corporate profits are growing. Usually corporate profits begin to decline a little bit prior to a recession. It's a really important indicator. With that said, the economy has also withstood massive shocks last year, not just on the labor force side, but again on the tariff side. And we seem to be sort of plateauing in terms of the volatility in that regard, right? We seem to be sort of reaching this sort of equilibrium, albeit with higher tariffs, that I think firms are going to be able to better plan. And so I would say, if we were to make a baseball analogy, it looks like we're in, I don't know, the 6th or 7th inning. It's hard to say how much AI and that diffusion of AI is either going to extend the expansion or perhaps cause some significant disruptions. You know,
Speaking of potential disruptions, we have to end with talking about geopolitics. We're going to be talking to Anne-Marie Hordern in just a minute. She's actually in Venezuela. You've been a member of the National Association for U.S.-China Relations since 2004. Geopolitics, not just between the U.S. and China, but the U.S. and the Middle East, the U.S. and Canada and Mexico. What relationship, in your view, could be one that, if it does unravel or if it does change, could be the most damaging to the U.S. economy and the investing economy?
Well, look, and I'll add Canada with Mexico. Since NAFTA and then the USMCA, which I must point out is really the TPP, right? So the Trans-Pacific Partnership, to which Canada, Mexico, and the US were all a party, fixed a lot of the problems with NAFTA. And so the USMCA really pulled from that agreement that took years to negotiate. And these trade relationships are very deeply integrated. If in the renegotiation of USMCA, we see a breakdown in that would be deleterious to the real economy in the U.S. and, of course, would then impact capital markets.
Great stuff and great setup, because we're going to actually even be digging deeper into that relationship between the U.S., Canada, and Mexico, because President Trump's certainly pondering maybe something else. Always appreciate it. Constance, be well. Constance Hunter, she's chief economist at the Economist Intelligence Unit, joining us there from Florida. All right, we're going to stay with geopolitics. President Trump's energy chief, Energy Secretary Chris Wright, arrived in Venezuela today, meeting with the nation's new leader and assessing its energy infrastructure. He is meeting too with oil producers and other officials as the U.S. pushes to revive Venezuela's beleaguered oil sector. With more, we do head to Venezuela, and Bloomberg surveillance co-host Anne-Marie Hordern, she is in Caracas. Anne-Marie, tell us about what's going on, what's moving forward, if anything.
Well, just about 20 minutes ago, Secretary Chris Wright sat down with acting President Delcy Rodriguez. They're in a meeting now. We're at the presidential palace, and it's their version, say, of the Oval Office. So he's having high-level meetings here with the acting president, with the government, and then as well with business leaders. And we spoke to him briefly on the plane before he landed in Caracas, and he was talking about the fact that if you want to transform the trajectory of a nation, you could do more with commerce than, say, with boots on the ground or than with bullets. They also, really, this feels like a trust-building exercise between acting President Delcy Rodriguez and her new administration and the Trump administration, because he is the first highest-ranking U.S. official to visit Venezuela since, of course, President Trump and U.S. Special Forces captured Nicolas Maduro earlier this year in early January.
President Delcy Rodriguez receptive to this group? Is she receptive to American companies extracting oil from the country?
I mean, absolutely. What we've seen so far is the Treasury Department and OFAC really lifting some of these licenses, making it easier for U.S. companies to come in. Venezuela certainly understands that they want to, as her brother put it recently in an interview, Jorge Rodriguez talked about reinstitutionalizing Venezuela and these institutions. And he was saying that needs to happen before there would be elections. So Venezuela needs that capital in flight. There obviously needs to be structural reforms put in place in this country so that U.S. companies could have the confidence to come back in. The Secretary, of course, will be also visiting some Chevron oil fields. Chevron has been operating in Venezuela for 100 years. They're not going anywhere, but they have a presence here, so they're easily able to expand. It's other companies, are they able to come in? And so far what we hear is that some of the big ones, it might take time. They want to see more stability on the ground, rule of law. They don't want to see any sort of political chaos. The wildcatters, those individuals that are a little bit more nimble and small, they're the ones that right now have a tremendous amount of interest in Venezuela. We should also note all of this is going on as some U.S. companies are looking to come back into Venezuela. It is happening also as the U.S. government is trying to reestablish a presence here with the embassy. There is a presence on the ground. I was told that cars are parked there, but they haven't been here since 2019. I've heard there's even mold given this climate that developed in that embassy. So a lot of work needs to be done. But what I'm hearing on the ground is that this has been the most hyped visit since, I would say, the embassy left, the United States left in 2019, but also since former President Bill Clinton visited Venezuela in 1997. Of course, that was the last year before Hugo Chavez took over in 98.
Yeah, totally got it. And there's hype, right, as you well know, Anne-Marie, and then there's the reality of what needs to be done in order for those major oil companies here in the U.S. to actually go all in, because they are still, it seems, very, very cautious. All right, Anne-Marie, thank you so much. Anne-Marie Hordern, she is, of course, one of the co-hosts of Bloomberg Surveillance on Bloomberg TV. Our tour of the world's relationship continues, and we go to a meeting that's been happening at the White House today between President Trump and Israeli Prime Minister Benjamin Netanyahu. Prior to that meeting, Prime Minister
Minister Netanyahu sign on as a member of the Board of Peace. This, according to his office, they put that out on X. And then Bloomberg, ahead of the meeting, has put out a lot of analysis, and they noted that Netanyahu is pressing President Trump to include Iran's ballistic missile program in any diplomatic deal with Tehran. And that, if President Trump follows that advice and demands that Iran roll back or abandon its sizable arsenal, talks are likely to implode. It's testy.
It is testy. And just before we went to air, just a couple minutes, the president sent out a post on Truth Social. He said he's just finished meeting with Prime Minister Netanyahu. Nothing definitive reached in that meeting. The preference is to make a deal with Iran.
All right, very interesting. Lots at stake, as you know, Swith. What we need to keep in mind, really reading the tea leaves as she does so well. Great to have back with us. Bloomberg News Middle East geoeconomics lead, Dina Esfandiari, she Switzerland. What is your read on what's going on in the White House here and those headlines that
I think really what Prime Minister Netanyahu will be trying to achieve with this meeting is first to really impress upon the Trump administration how critical this time is, how important it is that during the negotiations with the Iranians, President Trump really takes on board Israeli red lines, and there are several of them. One is to roll back Iran's nuclear program, and most importantly, I think, is to roll back Iran's missile program. And this is where the sticking point is likely to be.
Well, the nuclear program, we saw what the U.S. did to that in 2025. What are the details that we need to know about the missile, what Israel wants Iran to roll back?
Well, the missile program is critical to the Iranians. They developed it indigenously, largely, under waves of sanctions. So it's a source of pride. But most importantly, it's Iran's first line of defense. They really consider it critical to their deterrence capabilities, especially after Israel really attacked its partners in the region, its proxies that it was also using for defense. So for Iran, its missile arsenal is critical. It's quite advanced, and it can reach most of the Middle East, which is why for Israel, it's a real concern.
Yeah, totally get it. I mean, realistically, you have followed this region, this area for a long time, and I don't know whether it's conversations with you and with others that Iran is where so much of the terrorist activity, right? The various groups that threaten the region and threaten peace or stability. So what's the likelihood? What is the kind of agreement that Iran signs on to that would lead to greater peace and less terrorism in the region?
Well, Iran has been pretty clear what its red lines are. It appears clearly willing to talk about its nuclear program. Not all aspects of it, but most of it. I think Iran's ability to enrich uranium is a little bit of a sticking point. But beyond that, it's been very clear that missiles should be off the table, that it won't talk about them because they're so important to Iranian defense. And finally, it's shown a little bit of openness to partners in the region. Partners like Hezbollah. To Hezbollah, for example, it may be willing to talk about.
In terms of the buildup of the U.S. military presence in the region, what should we be prepared for?
I mean, it's clear that the U.S. and its allies are preparing for any kind of potential blowback from the Iranians. Having said that, the U.S. has more than enough capabilities present in the region to already conduct airstrikes on Iran. The additional capabilities that are being sent are really to improve its ability to defend its assets and its allies in the region, and also give President Trump the option of having a much longer military campaign against Iran, should he want one.
President Trump certainly talks about Prime Minister Benjamin Netanyahu, certainly in friendly terms, has for a long time. And yet there has been some pressure that he has also put on the Israeli Prime Minister. But is that friendship potentially problematic in figuring out a deal here?
I think that the Israelis are a complicating factor for President Trump's plans. He's campaigned on being a president that wants to avoid wars, that doesn't want to get bogged down in the Middle East. But the U.S.'s relationship with Israel is part of why President Trump right now is trying to be so strong when he's facing the Iranians. It's also part of why he's sending so many military capabilities to the region to ensure that Israel is properly defended if the U.S. strikes Iran. So it's a complicated relationship, but it's absolutely not a relationship that's in doubt in any way.
One last thing I want to ask you, or we want to ask you about, you've got a column out, the $108 oil war. I mean, I'm looking at crude right now, New York crude, or West Texas, excuse me, at about just below $65 a barrel. But you write this column, Can the Middle East Crash the World Economy? And you look at three broad paths for how Middle East shocks could play out. What's the most extreme case? What's the most likely case? Because something like this will certainly have global economic implications.
Absolutely. So I'll start with the extreme case. The extreme case really is one in which President Trump strikes Iran hard. Iran sees this moment as existential, and so it retaliates hard. What does that look like? It looks like not only striking at Israel and at U.S. assets in the region, but also at energy infrastructure throughout the region. It may also follow through on its threat of closing the Straits of Hormuz. And if it does that, then not only is oil production being hampered, but the export of oil is also going to be in trouble. And that's a scenario in which the price of oil may skyrocket. The more likely scenario is that this is going to be some kind of managed escalation where we are likely to see a short but temporary brief spike in oil prices, and then the market will adapt shortly after because the Iranians and the Americans will try to find an off-ramp.
So appreciated, as always. And again, thanks for staying up for us late. Bloomberg News Middle East geoeconomics lead Dina Esfandiari joining us from Geneva, Switzerland.
Excuse me?
Switzerland. We all know about that. Try that again, 3, 2, 1. Hey, coming up, we're going to talk about the #1 gain performer in the S&P 500 26. We've got the CEO of Generac. Looking forward to that conversation.
It's 2:22 here on Wall Street. I'm Nora Melinda. We check markets for you all day long here at Bloomberg. U.S. stocks are swinging between small gains and losses. We did see declines in software stocks, sparking some unease. We do have the benchmark S&P 500 up by about 0.2 percentage point, while the tech-heavy NASDAQ is up about 0.5 percentage point. The Dow Jones Industrial Average just below flat. The 10-year Treasury yield hovering near 4.2%, while the policy-sensitive 2-year sitting around 3.5%. The VIX hanging around that 17 handle, and WTI at $64 a barrel. Bitcoin sliding today, trading around that $67,000 level, while silver is at about $84 per ounce. Digging into some earnings, we did see that Zillow is hitting its lowest level since 2024. That's after its first quarter profit fell short of expectations. Legal costs and expenses from its partnership with Redfin weighing on metrics. And over in autos, Ford is rising after it said it expects profit to jump in 2026, despite a surprise $900 million tariff bill at the end of 2025. The automaker's planning to launch new models priced under $40,000 by the end of the decade. The rollout will start with an electric 4-door pickup truck in 2027 and continue with both gas-fueled and battery-powered vehicles. And finally, rideshare company Lyft is falling after the company reported fourth quarter revenue that came in below expectations. It also delivered a forecast that disappointed. The firm pointed to a shortfall of $168 million impact from settlements related to legacy driver classification matters. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Nora Melinda, and that's a Bloomberg Business Flash.
All right, Nora, thank you so much. So, folks, it's often all about the outlook, often for investors. And so shares of the global designer, manufacturer, and provider of energy tech solutions and other power products, we're talking about Generac, they're rallying today, top gainer in the S&P 500, after the company forecast a 2026 EBITDA margin range with a midpoint above analyst consensus. The street weighing in, KeyBank, noting that despite net sales for the fourth quarter missing analyst estimates, shares will trade higher
on 2026 outlook and positive data center developments. Shares of Generac, by the way, what is wrong with me? I think I need a new generator is basically it.
I like that.
They are up nearly 60% year to date and is the third best performer in the S&P 500 this year. We are delighted to have back with us the CEO of the company.
Aaron Jagdfeld is Chairman, President, and CEO of Generac, joins us from Wisconsin. Always good to have you on the program. A day like today, the stock, the best performer, as Carol mentioned, in the S&P 500, up double digits for the year already. Investors are looking through this clearly. They're all about the guidance, but just share with us why the earnings miss when it comes to the fourth quarter. We're going to work on getting his connection back. We're speaking with Aaron Jagdfeld, Chairman, President, and CEO over at Generac. Go ahead, Aaron.
See, we're all having energy, right? We all need a backup generator today.
I guess we need our generators to kick on here. Sorry about that.
No worries.
I lost the program.
Hey, I was just asking, obviously investors looking through that with today's stock performance, but why the miss in the fourth quarter?
Yeah, so the back half of the year, we actually had a lot less outage activity. So our residential business, for portable generators, home standby generators, really depends heavily on Mother Nature, honestly, to help us drive demand for those products. And so it was a very quiet back half of the year, the fourth quarter in particular. Back half of the year was 90% lower in outage hours versus the year before. So sometimes that happens, and we guide based on kind of average outage activity, and we got a lot of below outage activity in the quarter.
Well, it's interesting, so what gives you confidence around mid-teens growth when the weather has been the primary culprit for weak residential sales in 2025?
Yeah, so on the residential side, obviously, we think a return to normal outage environment that will happen. I mean, we will get ice storms again. We had one in January, right, with Winter Storm Fern. So we're off to a good start here this year. And so we feel like, we're going to return to more normal kind of outages and more normal patterns, if you will. We've got some pricing in there as well. The consumer for our products is pretty healthy still. I think there's concerns about the consumer across the broader economy. But when your power goes out, these products tend to become a priority for households. So, we're not very worried about the consumer's health, at least for our category.
Yeah, Aaron, explain the consumer behavior here. Is it that a consumer without a generator goes through a power outage in the middle of winter or the middle of the summer and says, I never want to experience this again? And, when they get power back, they call somebody to install a Generac? Is that how it works?
Right. And we're ramping. We're going to scale this year. We're having some very meaningful conversations as we work towards final contract negotiations with a number of hyperscale customers. And, this is going to be, for us, it's a generational opportunity. The backup power that is required by each data center site. I mean, you can literally have hundreds of large gen sets sitting there waiting for outages to happen. And the project sizes are enormous, and the opportunity is equal to that.
Is this all about the large megawatt generators? Is it all about that? That's what the demand is for? I want you to get into what is the AI play for you guys?
Yeah, for the most part. So for us, there's a direct AI play, which is, you build a data center, you need to have backup power because even a second of downtime, there are requirements there, commitments that they've made to their customers, and there are penalties and things that kick in if they can't supply information or the AI models depending on what they've contracted that data center out to do. Basically, they've got to have a continuous source of power. So they invest in backup generators for those facilities, and that's a product that we're new into, and that's a huge opportunity. The indirect side of data centers is pretty interesting, though. And as more data centers come online, you're going to see a lot more requirements for power, right? Demand is going to grow for electricity. We have supply constraints. In particular, there are parts of the grid around the U.S., like PJM, as an example, up in the Northeast.
Yeah.
This is a major concern on very hot days, very cold days. Going forward, you're going to see more brownouts, more blackouts, and that's going to lead, obviously, to more opportunities for us in some of our core products like home standby generators for homeowners and other generators for businesses and things like that.
So we each have a million questions that we want to get to.
You want to go back to residential?
Yeah. On the grid,
Tim might be shopping for a generator, Aaron.
But there's an interesting thing happening in some parts of the country, and I don't want to get into the details of new laws in New York City, for example, but some places are, years ago, few years ago argued that we want to just get rid of gas lines in general and don't want fossil fuel hookups within new buildings. So new construction in some parts of the country doesn't have any gas. How do you account for that with a product that, you know, you want to have connected to a continuous gas line?
Right. I mean, obviously you can use LP, right? So if you have an LP tank or a propane tank, that works just as fine. In fact, a lot of our installations in parts of the country like Florida, you know, homes down there don't have connections to, you know, a gas line because it's untenable for them to be able to put that infrastructure in. So, you know, what's interesting, like in policy-driven areas like New York, when it comes to let's not have new nat gas hookups, oddly enough, you can still have a propane gas hookup. So, you know, those are the ways to kind of navigate around some of those challenges. And again, you're using it for an emergency, right? This is not a continuous use product. So, you know, I think really cooler heads should prevail when it comes to certain policies like that. I mean, you want to make sure that homeowners, businesses have access to emergency backup solutions, right? Backup power, backup, you know, batteries, things of that nature. And those are the things that I think we've got to be careful of when we do policy-related things like you know, no nat gas, new hookups. You know, sometimes there's unintended consequences of that, and we've got to be careful about that.
Hey, Aaron, you guys have been expanding, and earlier this year you talked about the acquisition of a new facility in Sussex, Wisconsin, and you are quoted in that release saying, our commitment to aggressively invest in serving this booming segment offers a generational opportunity, you've used that word before, for Generac, with the potential of doubling our sales of C&I products in the next 3 to 5 years. How confident are you on this? Is it likely more on the conservative side or more on the optimistic side?
Yeah, it's interesting. We've been having these high quality conversations with data center co-locators and hyperscale operators, and you know, there's obviously a massive deficit of supply for backup power generation today, based on all the things that are on the drawing board to go in the ground for new data center construction in the years ahead. So our entry into this market, you know, we came into the market, we thought there'd be some interest in the product, but we maybe undersized that.
Yeah.
And to be blunt, you know, we went ahead and we acquired a new facility, and with an eye towards doubling our capacity